So first of all, good morning. This was big news here in Saudi Arabia yesterday and really across the Middle East as a whole. So the details, the leaders of Brazil, Russia, India, China, and South Africa, who had been meeting this week at their BRICS summit, have formally extended an invite to 6 countries to join their alliance. Crucially, that list includes Saudi Arabia, the UAE, Iran, and Egypt. Now, if everything goes ahead according to plans, these countries will join the alliance from January, and this would mark the first expansion for the BRICS bloc since 2010. What's perhaps more significant than the expansion itself, though, is the makeup of this expanded group. So BRICS Plus, as this is being called, is a group that would include some of the world's top energy producers along with some of the world's top consumers. So we're potentially looking at a new alliance here that may carry more weight on a global economic stage. There has also been discussion that this group could potentially seek to use alternative currencies to the dollar for trading between them. So yeah, this is a significant development. It was expected that we would see this expansion, and we are awaiting for more details, but significant potentially and something that we will be tracking in the months to come.
Yeah, I mean, there's a debate, of course, as to what happens to the BRICS acronym with all these additional countries coming on board. But meanwhile, I want to turn to Turkish assets because they soared following a jumbo interest rate increase. What are some of the details there?
So this was a pretty big moment for new Turkish central bank governor Erdogan. Going into this meeting, there had been a lot of doubt out there around whether or not she was really committed to tighter policy. She disappointed investors in the previous 2 meetings, but that was not the case yesterday. So she came out swinging. Turkey's central bank raised its key benchmark interest rate by 750 basis points to 25%. That was the biggest increase since 2018 and was also far beyond what economists had been predicting. They had been calling for the rates increase, or the rates rather, to move up to 20%, and markets responded. They clearly welcomed it. The lira was up almost 8% against the dollar. That was the most in almost 2 years. We saw Turkish banking stocks soaring by the regulatory limit of 10%. We also saw a drop in credit default swaps. So yeah, use of the market clearly welcoming this news. Much of the market commentary out there from some of the key voices that are tracking Turkey have also welcomed this, saying that it signals that Turkey is indeed serious about its pivot toward more orthodox policies. It has to be said, though, that inflation still remains very high, near levels around 48%. So there's still quite a bit of work to be done.
We saw the Turkish lira briefly go below 26 against the US dollar. We're 26.02 as we speak. Christine, thank you very much for that. That's Christine Berg in Riyadh. Let's get a bit of a snapshot of what else is still to come on the program. We'll discuss the growing clout of the BRICS bloc. It invites Middle Eastern powers to the EM club. MUFG's Ehsan Koman joins us for that later this hour. But up next, we'll talk market strategy with Al Dhabi Capital's Rashmi Garg, ahead of Jay Powell's speech in Jackson Hole. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
reacceleration could put upward pressure on inflation, stem the disinflation that we're seeing, and instead delay plans for the Fed to change policy.
The former St. Louis Fed President James Bullard. In the meantime, equity markets are in risk-off territory as traders brace for the Fed Chair Jerome Powell's speech in Jackson Hole. Hong Kong-listed tech shares are echoing heavy selling in U.S. tech. Meanwhile, treasuries are largely flat after two-year yields climbed above 5% on Thursday. I want to bring in Rashmi Garg, the senior portfolio manager at Al Dhabi Capital. Rashmi, what would success look like for the Fed chair as he approaches the few minutes of commentary he needs to deliver today?
So, good morning, Yusuf, and thanks for having me. So, I think it has been a bit disappointing because what happened is, the NVIDIA earnings were like a really big anticipated event, and they delivered on the earnings. And yet, the market seems to have written them off. We were expecting like a huge rally in tech after the NVIDIA earnings, but all focus is on now Chairman Powell's speech at Jackson Hole today. I think he's going to reiterate that Fed is going to be data dependent. Now, we have seen some signs of reacceleration in the economy in terms of the strong retail sales data that we saw. We saw very strong 2Q GDP growth. We saw industrial production numbers being strong. But at the same time, we've also seen some cracks in the, the very strong pillar for the economy, which has been the consumption expenditure of the consumer, the US consumer. Now, of late, we've seen several earnings come out from, from U.S. retailers such as Macy's, Target, the exporting goods, etc. And they've all talked about the consumer being very cautious, credit card delinquencies increasing. So I think it's a very mixed picture for the Fed, and it's going to
that's also partially why we're trying to kind of get a bit of a sense of which direction you're leaning towards. Do you think the Fed's going to lean, or the Fed chair is going to lean hawkish today, and as a result, you'd be cautious on asset allocation?
So my view is that they're going to keep their stance in terms of, higher for longer. They're not going to give any commitment. They are going to say that they will need to see more data in order to make any decision. They are going to indicate that September is going to be a pause. However, they will leave the room open for more hikes if needed, depending upon the economic data that we expect. However, we do feel that we are towards the end of the rate hiking cycle, and personally, I believe that we should not be seeing more hikes.
You say that they should be higher for longer, and it might not be that easy because there's a fiscal reality in the United States. Yes. One of the most read stories on the terminal is about U.S. budget deficits that are exploding, and investors seeing a high-spending new normal that may keep interest rates and inflation elevated. These are some of the highest levels for treasuries since 2007. And borrowing costs, the average rate for 30-year fixed mortgages surged above 7% for the first time in more than 2 decades. That's going to be another front they're going to have to take a look at.
Yeah, so definitely. See, if you look at it the other way, then also, these yields being so high, and also if you look at borrowing costs being so high, this is also a sign of financial tightening for the consumers as well as businesses, especially for the small and mid-sized businesses, where, it's going to be very difficult for them to carry on with their business plans and their capital spending plans. So this is also, in some ways, the percolation of monetary policy into the real economy, and we will see the impact of this, which is why we should eventually see a slowdown in the U.S. economy, which should be sufficient for the Fed not to rate hikes further.
We're seeing some houses like Goldman Sachs start cutting targets around Asian growth. We saw Morgan Stanley in the last few hours as well cutting their China stock targets. If you're cautious on the U.S., are you cautious as well on everything else, and Asia in particular?
So, in terms of preference, I would still have a higher preference for U.S. as compared to China. I would be more cautious on China. Reason being that Chinese economy faces some real issues. We all know the issues that they're facing with the property sector. In terms of, the stimulus that was expected from the government, we haven't really seen the kind of stimulus that would have really stimulated the economy. The interest rate cuts that were announced were also not enough to satisfy the investors. And right now, the focus of the Chinese government is different from what it used to be in the past. They want to focus on certain sectors. They do not want to focus on infrastructure or industrials. They want to focus on the green economy, on semiconductors, on the high-tech sectors, and they want to take a very cautious and gradual approach. So as a result of which, I expect that it is very unlikely that we will see a huge stimulus from China, and therefore Chinese stocks are unlikely to really outperform in this kind of a backdrop.
What kind of initial ideas are you drawing together around the BRICS expansion? Because that, if successful, is going to be a real test to the dollar dominance, right?
Yeah, so that is the thought process, I guess, behind this whole expansion of the BRICS. And I guess everybody is sort of, talking about combating the dollar dominance. I don't know if that really happens, because eventually, I mean, forming an alliance is one thing, but to really have a market which has as deep a liquidity as the US Treasury market, which has sufficient bandwidth to accommodate the kind of investments at a very short notice that the US Treasury market can accommodate, I doubt that is easily done in a very short span of time.
All right, a little bit of skepticism there, at least in the short term. Rashmi, great to catch up. That's Rashmi Garg, the Senior Portfolio Manager at Al Dhabi Capital. So much more to come on Daybreak Middle East and Africa. This is Bloomberg.
Would you say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
ECB Governing Council member Mario Centeno says policymakers must be cautious in their next steps as risks for the Eurozone economy turn from forecast to reality. He spoke to us from Jackson Hole about why it's vital to focus on the data.
This is just starting, but I can tell you that we are going to be focused, of course, in the numbers for the economy, in the numbers for inflation, following up on what has been so far the monetary policy transmission that it's already in the numbers. We have to be cautious this time around, because downside risks that we identified in June in our forecast have materialized. Yes. This is an inversion of what happened throughout the pandemic recovery, because usually we have been surprised in the upside.
Yeah.
This is in part, in my opinion, because the transmission of monetary policy is up and running. We need to take that into account in our decisions.
Mario, it's Alex in New York. So that seems like a pause for September. Would your vote be a pause for September? And if so, is that a peak?
Well, you know, we have been data dependent in our decisions. There's plenty of data still to be made available until the September decision. We have a new forecast. That forecast will tell us precisely how we see this transmission of our decisions into inflation and the economy going on. And we will decide in September on that regard. But it is important to keep in mind that inflation has been falling faster than its way up. We have been successful in our mission so far. It's probably too soon to call it as a down deal, but we certainly will have to focus on these numbers.
Bank of Portugal Governor Mario Centeno speaking to our colleague Alex Steele. I want to switch to regional equity markets. For most of the Gulf, this was the last trading session of the week before the weekend, so that excludes Dubai and Abu Dhabi, which have one more trading day to go today. Broadly upside, with Abu Dhabi leading the charge, up 0.2%. The Saudi Tadawul closing just under 11,500 points. I want to get to another development on the luxury watch front. Dubai, of course, being an important hub globally for luxury watches. So Rolex is buying the luxury retailer Bucherer AG in a deal that will give the biggest Swiss watch brand a major presence in customer sales for the first time. So Bucherer has more than 100 stores worldwide. They're going to continue operating independently. They'll keep their name. They'll sell other watch brands. That's according to Rolex. The financial terms were not disclosed, but we will continue to monitor that. I want to flip the board, get your equity futures, give you a sense of, well, how cautious we are ahead of the Jackson Hole speeches. Maybe it won't be the Fed chair's speech that makes the biggest difference. Maybe it's going to be the ECB's Christine Lagarde. Either way, we're called just marginally higher on the S&P 500 mini. Let's flip the board one more time. Get you your bonds where US 2-year yields popped above 5%. We remain above that historic milestone. And then US 10-year yields at 4.24. Much more ahead. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg Daybreak, Middle East and Africa. Our top stories this morning. Stocks slump and bond yields rise as traders wade through remarks from a slew of Fed officials and await Jay Powell's speech for clues on the interest rate outlook. Donald Trump turns himself in and is booked on state charges that he conspired to overturn the result of the 2020 presidential election in Georgia and insists he's innocent.
What has taken place here is a travesty of justice. We did nothing wrong. I did nothing wrong. And everybody knows it. We did nothing wrong at all. And we have every right, every single right, to challenge an election that we think is dishonest.
Turkish banks and the Turkish lira soar following a jumbo interest rate increase, spurring hopes that it signals the unwinding of policies that have sent foreign investors fleeing the $900 billion economy. Plus, the BRICS group invites Saudi Arabia, the UAE, and others to join their bloc in a push to expand its global influence. Welcome back to the program. Happy Friday. Doesn't feel like a Friday with Jackson Hole looming over global markets. A lot to potentially take away from the series of speeches in the coming hours. On the S&P 500 mini, you can see the caution is still very much prevailing. We're barely above the flat line. U.S. 10-year yields at 424.50. We saw quite a bit of action in the front end of the curve. Cash flooding that part with buyers grabbing 4- and 8-week Treasury bills. Eurodollar pops below 108. This is the 200-day moving average that's broken for the first time since November. And then Brent crude marginally higher. I want to get to a chart to set the scene on where the thinking is in terms of the Fed fund futures for December 2024. They're looking less dovish with a yield of 4.450. Now, that's still pricing in expectations that the Fed is going to start cutting rates in the first half of next year. Now, PIMCO's warning, though, that Fed rate hikes in 2024 are not unthinkable. Their economist is seeing the recession risk cut by consumer spending. Recent data suggests that the consumer and the economy could remain surprisingly resilient in the face of higher interest rates. But we're not seeing that resilience with some of the big corporate retailers. Take, for example, Nordstrom, which gave a negative outlook and shared concerns about the strength of the U.S. consumer, and that weighed on the stock in after-hours trade, down about 0.2%. But it's ahead of the crucial holiday season. You've got increasing credit card delinquencies, and equity investors were already on edge with Macy's credit red flag earlier this week. The shockingly poor results from a string of other consumer-facing firms. Think along the lines of Dollar Tree, Dick's, and Foot Locker. Let's hit the board, get you a highlight from the commodity space. Gold, because on track for the first weekly gain in 5. Currently, we are at $1,914 announced. The Polish central bank is making some big gold purchases, the most in 4 years in July. Something to think about. I want to think about the markets in Asia as well. Everil Hong is going to help us do that from our Singapore studio. Everil, you're focusing on China stocks.
I am, and that is because we're seeing another down day, a reversal from yesterday's gains in the Chinese stock market. Even these authorities' calls to top financial institutions to help stabilize the financial markets is doing very little to help this entrenched pessimism. And we also heard a couple hours ago from Morgan Stanley cutting its price target for some of these major Hong Kong as well as China benchmarks. So this is a key issue. The concern in the market is the stress from the property sector as well as the slowing economy, and that is really being highlighted by Meituan warning of a slowing in its food delivery business. Those same worries are weighing on the Chinese yuan. Let's take a look at how the currency is faring despite a stronger than expected fix from the PBOC. Once again today, doing not much to help prop up the currency. Asia FX is declining, and there is a dollar story here ahead of Powell and Jackson Hole. We're also seeing the dollar yen actually hovering near its highs for the week. Yusuf.
Everil, thank you very much for the roundup. That's Everil Hong there. I want to get more on the supersized rate hikes from Turkey. Joining us now from Istanbul is Selva Demiral, professor of economics at Koç University. She was formerly an economist with the Federal Reserve. Selva, you were surprised, just as anybody else was on the street, in terms of expectations and what was actually delivered from the Central Bank of Turkey. To what extent did the appointment of 3 new vice governors help carve and shape that decision?
I think the jumbo rate hike was mostly due to the new governors that were assigned to the Monetary Policy Committee. The reason I think about this is because typically, central banks who consider a long path of tightening cycle front load, because by doing that, you can actually control inflation expectations better when the markets believe that you are sincere and you have the government behind you, and that large couple of rate hikes at the beginning of the cycle are a good way to signal that you have credibility. But our central bank started with 6.5 points of a rate hike, then 2.5 points. And then yesterday it increased up to 7.5 points. So it's not really a typical front loading. If anything, we have a V pattern. So clearly the old governor, or let's say the new governor, before the addition of the members, knew about the power of front loading, but apparently they could not. So the new members, I think,
I mean, like, let's build on that argument a little bit, Selva, and build on also the work that you've done on the Federal Reserve for 5 years. The front loading that you reference, how does that take shape for the remainder of the year, right? So you talked about the V so far. If you were part of the advisory committee, what would you suggest needs to happen over the next 6 months?
Okay, so what we have to look at is inflation expectations in the next 6 to 12 month period, and look at the policy rate. At the moment, the policy rate is at 25%. Yet the central bank in yesterday's decision said, don't worry about this year's inflation. If anything, I'm going to revise up inflation expectations for this year it's going to be even more than 58 percentage points. But for the following year, believe in what I telling you, which is 33%. So let's take central bank's word for given, which is 33% by the end of next year. So 25% interest rate still gives a very negative real interest rate. So I would say the central bank still has more way to go. So let's say 7.5 is the new front-loading move. I would expect another maybe 5 percentage points in the next meeting.
Okay.
And I would hope that the year is going to end by around 35 percentage points as the policy rate.
Sam, I was looking at a note from Brown Brothers Harriman in New York, and they're saying it's really hard to get excited about this hawkish surprise after 2 straight dovish surprises. Let's talk at the next decision at September 21. And if it delivers another large hike, perhaps things have really changed. How do you respond to those who are still skeptical of this new credibility push in Turkey?
So we all have a question mark, although we want to believe that this is a clear shift in the central bank's policy stance towards a more hawkish move. However, in the very recent past, we had seen an experience where a former central bank governor, Naci Ağbal, was sacked after he increased interest rates to 17%. So the same government is still in charge. So one would wonder if the same thing might happen to the new central bank if they push the limits or tolerance limits of President Erdogan. So what we have to do is wait and see if the new team is going to continue to convince him that this is actually better for the economy. And if you want to have sustainable growth, you have to first bring interest rates at a level that is consistent with inflation.
I mean, one thing's clear, the folks at Citigroup, they've told their strategy team to close long dollar short lira trades that they just made a couple of days before the lira popped to the upside in terms of strength. Selva, again, based on a lot of the research that you've done, what other tools are at the disposal of the central bank that they could utilize to help manage that credibility pursuit?
I would say communication. If you implement effective central bank communication, it's actually the cheapest way to take inflation expectations under control. So the central bank needs to signal that this is not the end of it. If anything, a new era is starting. So with the new team, the new members, the central bank is going to work hand in hand with the government. We shouldn't say this was a kind of rebellion against President Erdogan. This just shows the team's success in convincing him. And if they can convince the markets that, look, we are on the same page, Erdogan believes in what we are doing and provides his blessing, then it might be possible to lower market expectations. But because there are also tons of regulations that the current central bank inherited from the previous central bank, all those regulations need to be phased out. Those macroprudential controls over the economy need to be phased out as the additional way to normalize Turkish economy.
Selva, this has been hugely insightful, so thank you for making the time. That's Selva Demiralp, the professor of economics at Koç University. So much more to come on the show. This is Bloomberg.
Slice through the noise. Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
Saudi Arabia and the United Arab Emirates are among a bunch of countries being invited to join the BRICS group as it pushes to expand its global influence. Bloomberg's Jennifer Zabazaja joins us now for more from Johannesburg, where the BRICS summit has been happening throughout this week. Jen, what has been the reaction to selected lists of potential new members?
Yeah, Yusuf, I mean, we were all anticipating the addition of these new members. We just didn't know that we would get the 6 that ended up being the announcement from yesterday. Now, if we just think about what we heard from the leaders of the 5 initial BRICS countries, they were all welcome and excited about this addition of new members. So just a few of the notes that we got. Lula da Silva from Brazil, he called the new bloc, said it's going to be a driving force behind a new international order. Narendra Modi of India said that it's going to strengthen the bloc as an organization and give shared efforts new impetus. President Xi Jinping said it's going to be important for this new BRICS bloc to be a responsible factor for the world, and says the expansion is a new starting point for the cooperation among member states. So among the leaders, this was definitely good news for them. But when we talk about sort of the public and the general reaction to this, a lot of people are looking at this new coalition of members and saying that the similarities between them are very few. And so there is the potential for a lot of tension to arise given sort of where they sit on different issues, depending on whether that's political, whether that's economic. And so there's a lot of people who are concerned that there's not going to be a lot that this BRICS grouping is going to be able to do as a group, but maybe more so bilaterally.
I mean, here's a reaction from the United Arab Emirates, from all the way at the top, from Mohammed bin Zayed. He tweeted in response to the BRICS announcement, "We respect the vision of the BRICS leadership and appreciate the inclusion of the UAE as a member of this important group. We look forward to a continued commitment of cooperation for the prosperity, dignity, and benefit of all nations and people around the world." What were some of the criteria countries that were being invited and were being considered?
Yeah, that was what we were trying to get to the root of yesterday. Because if you look at these 6 countries that were, invited to be members, again, there's a lot of differences among them. But what we heard from South Africa's chief diplomat, Anil Suklal, we talked to him here in the studio a few weeks ago. They needed to be a country from the global South. They also needed to be a country that had good standing. We didn't really get the definition of what good standing means. But also, and I think this is pretty key, the new members needed to accept the terms of the current block of BRICS. So something like unilateral sanctions is something that they needed to reject. And they also needed to support things like reforming the UN Security Council and others. But I spoke with the foreign minister from Brazil, and he talked to us a little bit about his take on coming up with this criteria that they were tasked with doing.
One of the questions is the reform of international governance, reform of Bretton Woods institutions, and also reform of United Nations. So all those questions are expressed in, let's say, a long list of positions and issues where those countries, the original 5 and the new countries, must have a common view of these points.
Speaking there, a common view, but what we heard from Anil Suklal is that these new members will only be full-time members starting January of 2024 if they accept everything that is in the declaration. And that is going to be the same thing going forward, Yusuf.
Jennifer, thank you very much. That's Jennifer Zabazaja in Johannesburg. I want to widen out the conversation, get out to Ehsan Kamani. He's the head of commodities, ESG, and EM research at MUFG. Ehsan, I go to the ECTR function on the Bloomberg to understand the trade flows for Saudi Arabia and for the United Arab Emirates. You look at the most important trade partners for the UAE, top 2 out of the top 3, China and India, with China in 2022 coming through with total trade of $110 billion. What kind of framework are you adopting to quantify the impact of this BRICS expansion to this part of the world?
Yeah, thanks for having me on, Yusuf. So look, I think for the Middle East, for us, really 2 key pillars stand out. One is on the geopolitics and one is on the economics. I mean, on the economics, I think what's particularly pertinent now is the increase in the energy dominance of the BRICS Plus group, now rising from 20% of global oil production to nearly 42% with the inclusion of the Saudi, the UAE, and Iran. I think the dynamic that we see playing a prominent role is via the new development bank, with one of its core goals being to expand the number of projects and finances in local currency, with the aim to obviously eventually get to 30% on external financing from around 22% today. And the full membership of the Saudi Arabia to the bank now appearing imminent, this alongside with the UAE's position, which could really help the bank accrue further liquidity to progress its goals. But Yusuf, I really want to get to, for us, in terms of, despite the interest from Saudi Arabia, the UAE, and Egypt in contributing to the bank, I think for us, it will most likely be a measured and a limited scale engagement that doesn't really translate into the challenging existing of international financial institutions. Indeed, for us, we would see that as likely that the Saudi and the UAE as a limited scale increase really in non-dollar payments and trade as an opportunity to really hedge and strengthen ties with important trade partners.
Ehsan, for a good chunk of my career, there's been a debate around the Gulf common currency. A Khaliji was thought to be named for some time, didn't really get off the ground. There's no shortage of theoretical experiments with common currencies. Can you foresee a transition towards a BRICS plus common currency, or would you say, based on the EU experiences, that's actually not a likely scenario?
So look, I think we need to go back to the economics. I think there are material barriers to the wholesale shift away from the dollar with the de-dollarization proponents of particularly the petrodollar trade, really often overlooking 3 key and interconnected dimensions. That is the currency that a commodity transaction is settled in, the currency in which a commodity is priced, and the currency in which the commodity exporting countries hold those reserves. When you examine all 3, Yusuf, the dollar dominates, and the structure for us is not going to change overnight. And so, there does, yes, of course, need to be a recognition that developments such as the augmented BRICS Plus, could mean that, we could start seeing some some transactions in non-dollar. But we think that this is going to be a decades-long, if not longer, progression to a multipolar world where potentially the dollar, the euro, and the renminbi become the dominant currencies in Americas, in Europe, and in Asia, respectively. But until then, I think the de-dollarization of petrodollars does remain contained and constrained.
It doesn't really help Egypt's case, does it? I mean, they are desperate for US dollars, and at the moment the foreign exchange markets in Egypt appear to be frozen. The 12 months forwards have kind of been languishing around 40. We are waiting for the breakthrough on the IPO and privatization side. When is that going to happen?
Yeah, I mean, look, Youssef, I think it's safe to say there's no real easy options for Egypt today. I think the policy measures aligned with IMF to drive the balancing, are only making very, very negligible progress, and prospects of any acceleration really is absent at the current juncture. Now, our assumption and our base case is that there will start to be a more policy-led adjustment centered on the coordination between the three key players today in Egypt, which are the authorities, the IMF, as well as the GCC neighbors. But I think really for us, the onus remains on Egypt to act first and to deliver on the two core measures at the center of the IMF program. That is the follow through on significant privatization and the asset sale program, as well as the liberalization of the FX regime.
Ehsan, I want to lean on your commodities remit because Citi's out with a new note and they're saying that OPEC may need to cut again, some of the fragile members recovering. Agree?
Look, I mean, I think if you look at the fundamentals, we're in a supply deficit market. And so I think that's going to play out at least until the remainder of this year. I think gradually we'll start getting to a modest oversupply in the beginning of 2024. I think when you look at those fundamentals, there is, basically shortage of barrels to the market. So we would say that the current stance of OPEC as it stands is likely to remain. Yes, of course, they are price sensitive. And if the prices were to, ebb lower to, they say, the high 70s from the low 80s that we have now, they may certainly, of course, surprise. And I think they have been surprising to markets over recent months. But for now, we would say, Youssef, that the fundamentals are pointing towards a deficit market.
Ehsan, fantastic to get your perspective. Really appreciate it. That's Ehsan Kamal, the head of commodities, ESG, and EM research at MUFG. Still much more to come. This is Bloomberg.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
I want to talk about greatness, not just in basketball, but also in wealth, in terms of the wealthiest athlete, really, because Michael Jordan is really all the way at the top. He is basically, as a result of the sale of his stake in the Charlotte Hornets this month, now with a net worth at an estimated $3.5 billion, according to the Bloomberg Billionaires Index, which is calculating his fortune for the first time, is now very wealthy. Probably the wealthiest athlete out there. Jordan led the Chicago Bulls to 6 NBA titles, won 5 MVP awards. He's a cultural icon. I mean, his silhouette is on pretty much everything. The Hall of Fame player became the league's second black majority owner in 2010, and he bought the controlling stake in the Hornets. And then, back then it was called the Bobcats, but it was the licensing agreement with Nike in the 1980s when Jordan was still relatively unknown that formed the foundation of his trailblazing fortune. Nothing short of inspirational for sure. His documentary on Netflix, if you haven't watched it yet, is something you can't miss. Let's get you some of the market action as we count down to Jackson Hole. We are seeing quite a bit of caution on equity futures in the United States, so we're barely above the flat line here. There's not a lot going on in terms of U.S. 10-year yields as well, just in terms of where we are at the moment. That's not to say that the previous session didn't bring with it quite a bit of movement. The front part of the curve, we saw 4- and 8-week Treasury bills getting eaten up. Cash was flooding the front end of the Treasuries curve. U.S. 10-year yields fairly range-bound. It's your 2-year yield that popped through the key 5% mark. Here's the rundown on the board. And then I want to cross over briefly as well to the energy equation, where Brent crude as well as the WTI contract just with marginal gains here to the upside. For Brent crude, it's at $83.63 a barrel. Give you a live shot of London as we count down to the beginning of the next program there. And of course, even though the show's over, there's so much happening today, I don't think anybody's going to get much sleep. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we can do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Asian stocks fall after a sell-off on Wall Street. Treasury yields stabilise as traders await Jay Powell's speech at Jackson Hole for clues on the interest rate outlook. ECB President Christine Lagarde will also take centre stage today in Wyoming as ECB Governing Council member Joachim Nagel warns it's too early to consider pausing.
When you talk about monetary policy, what I said is that we have to be stubborn here, even more stubborn than inflation. This is what we have to do. This is our mandate. We have to bring inflation down to 2%.
Plus, Donald Trump turns himself in and is booked on charges of conspiring to overturn the 2020 election result in Georgia, posting his own mugshot on social media. Well, good morning. Happy Friday. You made it to the end of the week, and investors are pretty nervous this morning. It's all eyes on Jackson Hole ahead of Fed Chair Jay Powell's speech just after 3 p.m. London time. You've got two-year Treasury yields back above 5%, and markets really asking whether after this week's dismal economic data, the new Fed narrative is high for longer rather than higher for longer. Those worries about potential hawkishness from Powell have even eroded Nvidia's triumph. So it's risk off on equities, I should say, after an ugly close yesterday. The Nasdaq had its worst day in 3 weeks, dropping 2.2%. Asian stocks have followed Wall Street lower, and so that AI buzz is proving pretty short-lived. Options traders taking their profit after the sharp jump we saw for Nvidia earlier in the week. Nasdaq futures now down 0.1%, and S&P E-minis flat. But for more on how Asia markets are faring, let's get over to Paul Dobson. He's in Singapore. He's our executive editor for Asia markets. Paul, I'm particularly interested in why the Nikkei is down so much. All Asian stocks seem to have followed Wall Street lower.
Yes, absolutely. And, you know, it was a pretty nasty day for the Nikkei there with that reversal. Nvidia itself managed to end the day flat. So I think Japan is really reflecting that kind of turnaround, particularly in sentiment towards technology companies, and feeling that drag. It tends to react with pretty high volatility in either direction. And, you know, in addition to that, we had the inflation data that came out this morning for Tokyo, which pointed to still stubborn, sticky core measures. You know, kind of the idea being that at some point, you know, the BOJ is going to have to allow yields to come even higher than they are at the moment. And maybe, you know, that ratchets up some extra pressure on the Japanese market relative to the others as well.
Yeah, where does it leave the yen, that Tokyo CPI print then?
Yeah, well, so it's a really interesting dynamic, I think, that we've got going on at the moment. You know, the yen is weak, right? Again, and particularly against the dollar. And part of that is this big yield differential with US Treasuries. The gap just keeps getting wider every time that the US yields go higher again. The BOJ doesn't like it. I think we had comments from Tokyo Exchange earlier this week saying, you know, at these levels, actually, the yen is ceasing to be helpful. It's not really helping exporters anymore. More, it's a drag on the rest of the economy. And so what policymakers would like to see is a little bit of stabilization and a reversal there, hoping that at some point the Fed will move closer to cutting, and that will, you know, do the job for them. But if that doesn't happen, then the other alternative is to let those yields come higher, to accept that at some point we're going to have to move further away from yield curve control and maybe even get towards liftoff and give that yen some extra support, which would help the economy and help give a little bit more confidence back to the rest of the financial markets too.
And Paul, as we look ahead to Jackson Hole, it's Friday. I'm sure we could all liven up the end of the week with a game of bingo on how many times Jay Powell's going to say the words data dependent. But bond traders seem to be pretty obsessed with R-star again, the neutral rate. Do you actually think that Powell's going to mention those words again?
No, so I guess there's two things, isn't there? Bond investors are really interested to know anyway what the Fed's sort of view on where interest rates are going to be, how much of a premium should be embedded into the market going forwards. Whether or not Powell will actually mention it himself, is up for debate among the economists. But I think either way, we'll be able to glean some sort of understanding from him of two things. One, what he means by data dependent. Does he mean every data point matters, or does he mean the trend of data over time is going to determine the Fed's outlook? And two, what do people see as that the long-term sort of target rate for the Fed going forwards? It's been lifting off from very low expectations recently, and that's what's really caused some trouble in the bond market. Now, all of a sudden, more of a focus on perhaps the Fed really does need to keep rates higher in order to just keep inflation on an even keel. And if that's the case, then the market's going to embed a higher real interest rate and a higher risk premium on yields for US Treasuries all the way across the curve.
All right, thanks to Bloomberg's Paul Dobson. I just want to bring you a breaking line. This is out of Australia. Woodside's union members have endorsed an in-principle agreement with the company. Of course, this has been wreaking havoc in LNG markets, the potential strike action, but a deal was put on the table in terms of pay and conditions, and it looks like there has been an agreement that's going to ease that worry about industrial action. Woodside shares still down, however, down almost 1.2%, and benchmark for LNG is pretty steady, actually, because this simply builds on the previous development, really a rubber stamping here, but big worries previously about the outages that would have threatened about 10% of global supply. It seems those have eased now. But time for our morning roundtable. Today I'm joined by Jill Desis in Hong Kong and Bill Farries in Singapore. Morning to both of you. I want to go back to Jackson Hole now. We're awaiting Fed Chair Jay Powell's speech just after 3 p.m. London time. Two Fed officials have already signalled that the central bank might be close to the end of rate hikes. You've had Susan Collins telling Yahoo Finance that, quote, "We may need additional increments and we may be near a place where we can hold for a substantial amount of time." Then you had Patrick Harker reiterating that the Fed's, quote, "probably done enough tightening." But then on the other hand, you had St. Louis Fed President James Bullard telling us, continuing the hawkish note that he left on last week, that the Fed may not be done with the hikes. Take a listen.
Reacceleration could put upward pressure on inflation, stem the disinflation that we're seeing, and instead delay plans for the Fed to change policy.
So, Jill, I suppose the compromise between those three positions is high for longer rather than higher for longer. What are you going to be listening out for from Jay Powell later?
Definitely, Lizzie. Well, I mean, you hit it earlier. If you have data dependent on your bingo card for what Powell is going to say today, I think you'd probably hit it, because he certainly, I think, has emphasized this idea of needing to look out for what the data is telling us on their decisions going forward. Look, Lizzie, this is a really, really tricky one for Powell. I mean, we all remember Jackson Hole last year. Powell was incredibly blunt about the need to, control inflation, tamp things down. We knew what the rate hike cycle was going to look like at that point. But now we're in this period where it's suddenly become, or not suddenly really, but it's become this, sort of issue of debate over how exactly you handle these high rates, how long you keep everything for, what you need to look out for. I think at this point, what investors are really looking for Powell to answer is when the Fed is talking about data and needing to look out for data to inform its future decisions, whether that means one more rate hike this year, whether it means just holding rates for higher than we may think. We need some kind of clarity on what the most important key data points actually are. I mean, how much are we watching, these core CPI gauges? What are we looking at in terms of payroll data, unemployment claims, that kind of stuff? I'm not sure how much clarity Powell is going to provide today, but I think it's really going to be about the nuance and how exactly he explains this position, because this is really a speech that we're looking for to sort of chart the Fed's position on rates through at least the rest of the year.
It's my birthday tomorrow, Jill, so I'll take a gift for every time we hear the words data dependent. But of course, it's not all about the Fed. At Jackson Hole, we also have ECB President Christine Lagarde due to speak at 8 p.m. London time. And ahead of that, ECB Governing Council member Joachim Nagel has said he's not convinced that inflation's under control enough for a halt in rate hikes. Take a listen.
inflation is coming down. Core is still sticky. And so the next months we will get more information about this. It's, for me, much too early to think about a pause. I think we have to wait for the next numbers.
Jill, what about all this dismal PMI data that we got from both sides of the pond this week? Nagel seems to have more faith in the idea of immaculate disinflation than some of his peers.
Yeah, Lizzie, well, it's interesting to hear Nagel say that, especially because when you were looking at Euro area PMI data this week, I mean, I think Germany had the most severe declines, right? I mean, we were seeing activity worsen there since, I think, the worst since the start of the pandemic in 2020. So certainly, this is another kind of difficult speech for Lagarde. I think, though, it's really hard to see her being anything but dovish on the idea of rates. I mean, that PMI data this week out of Europe really, ticked investors to think that the ECB is going to have to pause at its next meeting. It's really difficult to see them kind of, distance themselves from that because, I mean, as we look at the trajectory of what's happening in Europe right now, it doesn't really seem like there's a ton of room to continue to be incredibly hawkish. So I think I would look to see something a bit more dovish from her today. We'll just have to see what's happening.
Okay, thanks to Bloomberg's Jill Decis. Now, from Wyoming to US politics, the long-awaited mugshot is here. Donald Trump turned himself into an Atlanta jail to be booked on state charges that he conspired to overturn the result of the 2020 presidential election in Georgia. Trump maintains his innocence.
What has taken place here is a travesty of justice. We did nothing wrong. I did nothing wrong. And everybody knows it. We did nothing wrong at all. And we have every right, every single right, to challenge an election that we think is dishonest.
Let's bring you in here, Bill. Trump's back on X, the website that was once known as Twitter. He's posted the mugshot on there. This is him capitalizing on his infamy, isn't it?
Oh, absolutely. I mean, every step in this process, in the legal process, and he's now got 4 separate cases around the country he's facing coming out of 2020. He has used that to try to rally his base of supporters. He's used it as a fundraising tool, and I don't think this mugshot is any different. He has, posted this defiant photo of him at the Fulton County Jail, saying never surrender, literally moments after he had just surrendered. But this will be something that, so far has not done any damage to him or his brand in terms of his core base of supporters, and he's still leading the Republican primaries by 30 or 40 points, depending on which polls you go. So it's not a place he probably wants to be in, but he is definitely going to make the most of it politically and financially in terms of trying to get funds in for his campaign, and he's been using those to help pay the legal fees.
And legally, what comes next, Bill?
Well, it's interesting. The prosecutor in this case in Atlanta is asking the judge to proceed very quickly with the next steps. They would like to have former President Trump back in the courthouse by the end of October. Originally, the prosecutor had been looking for a March or April 2024 date. They've moved that forward. The judge still has to rule on that. It's not clear how the judge will decide that case. But it's what is emerging is that many of President Trump's legal challenges and the cases and the court appearances he'll have to make are going to bleed well into the 2024 primaries. And if he emerges from that as the leading candidate into the general election against most likely President Biden.
All right, thanks to Bill Farries for that. Let's take a look now at what else is coming up on the economic agenda. At 7 a.m. London time, we get the final second quarter GDP reading for Germany. The country's economic woes will be on full display. You could even see the second quarter stagnation revised downwards. Of course, on Wednesday, as we were discussing with Jill there, the latest German PMIs for August were so dismal, along with the European-wide figures, that traders pared back their bets on ECB hikes, so much so that they now see a pause in September. We'll get an even another bit of a reading on the health of the German economy at 9 a.m. That's from the latest IFO survey. You may see more disappointment there again. And then finally, just after 3 p.m., Fed Chair Jay Powell is going to speak at Jackson Hole, and we'll have full coverage of that speech, as we've been previewing right here on Bloomberg TV. You can get a roundup of all the stories you need to know to get your day going on today's edition of Daybreak. Today, they lead, of course, on Jackson Hole. They also have Trump's surrender and UK consumer confidence rebounding in August. Terminal subscribers can find all those stories and more by typing DAYB Go on your terminal. Coming up, it's all about Jackson Hole. Traders are going to be waiting for Fed Chair Jay Powell's speech for clues on the rates outlook. We'll discuss that next, and we've even got a bit of Taylor Swift for you. Get your cowboy hats ready. Plus, don't miss our exclusive interview with the ECB President Christine Lagarde. That's later today at 9 p.m. London time, 4 p.m. New York time. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to Bloomberg Daybreak Europe. If you're just joining us, it's 6:17 a.m. here in the city of London, and stocks have slumped. Bond yields are treading water. This as traders await Jay Powell's Jackson Hole speech for clues on the rate outlook. I'm joined now by our MLive strategist, Mark Cranfield. Mark, what are you expecting? What are investors listening to from Jay Powell's speech today?
As you've been discussing earlier, obviously Jerome Powell isn't going to persuade people that rate cuts are coming anytime soon. He wants to keep people sure that the rate hikes are rates are going to stay higher for longer. That's the mantra he's had for some time. He won't want to give that away. But the picture is completely different to 12 months ago. As Jill was saying, inflation is no longer the big enemy. That's mostly been beaten. There's still some work to do there. But when he's in discussions with people like Christine Lagarde and some of the other global leaders, they will probably be among themselves thinking, well, there are definitely big international risks to the story here. Europe, of course, has got plenty of problems. And Christine Lagarde is the one who's probably going to sound the most dovish of everybody, because she's going to get confirmation today. Germany is probably going to be in recession. The GDP data comes out before she speaks. But as you mentioned earlier, the other PMI numbers and recent German data has been pretty horrible. So it's going to be very hard for her to have anything like a hawkish stance at all. In fact, she is probably going to tell people that the risk of over-tightening is the big problem now for the ECB. And she'll probably lay the groundwork for them to go to a pause, regardless of what the Bundesbank guy said earlier today. But then have you ever heard a dovish Bundesbank person anyway? I haven't in the last 30 years. So Christine Lagarde could end up being the star of the show here. She could be the one that leans the most dovish of all. Powell will try to take more of a middle road, but he also will be aware. He's just seen big revisions to jobs data in the United States, all to the downside. And there are cracks appearing in some of the regional data as well. So he will know the US economy is probably past its best. It's still moving along. It may hit a soft landing, but the best days are probably gone. So he will also be aware that over-tightening is a risk for the US. So by the end of the weekend, investors may come away with the message that rates have peaked. They're not going to be cut immediately, but we're certainly turning the corner where in 2024, that will be the story, lower rates.
Well, Mark, speaking of the star of the show and the US growth, it seems that Taylor Swift's been a bit of a boon to the US economy. Are you a Swiftie?
Well, we're having a bit of that impact in Asia as well. So it's not just what you're seeing there. So it's very interesting. I was reading that piece about how it's going to boost third quarter GDP in the United States. But interestingly, we're going to get that impact in Asia in the first quarter of next year. So we get a double whammy. We have Coldplay and Taylor Swift both doing a series of concerts, all in Singapore, all sold out. Hotel rates have gone through the roof. Lots of people are flying in. Now, it's interesting. What they've done here is they've centralized all their shows around South Asia in one place. So people are forced to come to Singapore. There's going to be a big increase in spending. The hotels are more than sold out. So we're going to see that pop in GDP in Asia in the first quarter of next year. Now, if this is a trend where the big stars do mega shows over a concentrated period of time, we have to get used to this. This may reappear from time to time in the global economies where you do get major events all in a short period of time, and it will affect GDP. It is a short-run effect. It won't last forever, but people will have to take it into account because it does impact the economy.
Well dodged, Mark. I won't tell Taylor. But speaking of celebrities, we have also had the news that Michael Jordan has cashed in on his sale of the Charlotte Hornets this month actually, and it means he's worth $3.5 billion. I'm just looking at the Bloomberg Billionaires Index. He's climbing the ladder, not only the greatest basketball player of all time, but also the richest. Power to you, MJ. Thanks, though, to our MLive strategist, Mark Cranfield, for that analysis. Now, it is Jackson Hole Friday. We're going to be talking about it all morning in the run-up to our exclusive interview with the ECB President Christine Lagarde later today. That's at 9 p.m. London time, 4 p.m. New York time. And, of course, we're going to be bringing you Jay Powell's speech just after 3 p.m. Investors, as we have been discussing, looking ahead to the future outlook for US rates. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is just starting, but I can tell you that we are going to be focused, of course, in the numbers for the economy, in the numbers for inflation, following up on what has been so far the monetary policy transmission that it's already in the numbers. We have to be cautious this time around because downside risks that we identified in June in our forecast have materialized. This is an inversion of what happened throughout the pandemic recovery, because usually we have been surprised in the upside.
Yeah.
This is in part, in my opinion, because the transmission of monetary policy is up and running. We need to take that into account in our decisions.
Mario, it's Alex in New York. So that seems like a pause for September. Would your vote be a pause for September? And if so, is that a peak?
Well, you know, we have been data dependent in our decisions. There's plenty of data still to be made available until the September decision. We have a new forecast. That forecast will tell us precisely how we see this transmission of our decisions into inflation and the economy going on. And we will decide in September on that regard. But it is important to keep in mind that inflation has been falling faster than its way up. We have been successful in our mission so far. It's probably too soon to call it as a down deal, but we certainly will have to focus on these numbers.
Data dependent. I doubt it'll be the last time you hear those two words today. That was the Bank of Portugal Governor Mario Centeno speaking to our colleague Alex Steele. And don't miss our exclusive interview with the ECB President Christine Lagarde later today. That's coming up at 9 p.m. London time and 4 p.m. New York time. Just checking in on your futures ahead of the start of cash equities trading. You've got Eurostoxx 50 futures down 0.3%, S&P E-minis flat, and Nasdaq futures down 0.2%. And it's all eyes on the Kansas City annual gathering in Jackson Hole. We'll give you a full roundup of what we've heard from policymakers so far and what to expect today. That's what markets are watching. It's up next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I'll try and play that role.
This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that you're waking up to. Asian stocks fall after a sell-off on Wall Street. Treasury yields stabilise as traders await Jay Powell's speech at Jackson Hole for clues on the interest rate outlook. ECB President Christine Lagarde will also take centre stage today in Wyoming as ECB Governing Council member Joachim Nagel warns it's too early to consider pausing.
When you're talking about monetary policy, what I said is that we have to be stubborn here, even more stubborn than inflation. This is what we have to do. This is our mandate. We have to bring inflation down to 2%.
Plus, Donald Trump turns himself in and is booked on charges of conspiring to overturn the 2020 election result in Georgia, posting his own mugshot on social media. Well, good morning, happy Friday, and it's all eyes on Jackson Hole today. Investors nervous ahead of Fed Chair Jay Powell's speech after 3 p.m. London time. The two-year Treasury yield back above 5%. Markets really want to know whether, after this week's dismal economic data, the new Fed narrative is high for longer rather than higher for longer. And those worries about potential hawkishness from Jay Powell have even eroded Nvidia's triumph. So it's risk off on equities after an ugly close yesterday. The Nasdaq had its worst day in 3 weeks, and Asian stocks following Wall Street lower. Nasdaq futures are now down 0.2%, and S&P E-minis are flat. But for more on how Asia markets are faring, let's get over to Paul Dobson, our Asia Markets Executive Editor in Singapore. Paul, Asian stocks following Wall Street lower, but the Nikkei especially down this morning. Why?
Yeah, good morning. Great to be on again. I think, it was a pretty ugly day, as you were saying, in US markets. The Nikkei reversing, the Nasdaq reversing and coming lower, and Nvidia ending the day little change despite those blowout results that had created so much excitement this time yesterday. So maybe that's a little bit of a flush out of positions ahead of Jerome Powell, but also, some concerns or some profit taking at these stretched valuations. Yesterday, of course, that all lifted Asia. Today, we're taking it all back again, and Japan is taking it on the nose, particularly the Nikkei. So I did a bit more research on this since we last spoke, Lizzie. And what I think is interesting there is the Nikkei relative to the Topics Index, which is perhaps a broader index of Japanese stocks, has been showing a lot of underperformance recently. And that's because the constituents of the Nikkei that include the tech companies is much greater weighting. And so therefore, when we have a day like this where tech is under pressure, the Nikkei tends to underperform, and actually the Topics relative to it has been holding its value over the last few months. And so it's, it depends which way you look at the Japanese market to see whether it's really underperforming or just in line with the rest of Asia.
And well, I'm glad that you had a look into that, Paul. It was well worth it. I also want to ask your take on Jackson Hole, of course, the highlight of the day. I'm sure that we're going to hear the words data dependent many times throughout it. But what are markets, traders going to be listening to in terms of clues for when the pause or the peak is coming?
Yeah, and I think data dependency is definitely something that markets will want to interrogate a little bit more. When the Fed policymakers are talking about that, does they mean every single data point counts? Every time we get a payrolls number, is that going to determine whether we hike or stay the same at the next meeting? Or is it a longer term trend? How exactly is the Fed thinking about that? But I think the other thing that's really kind of come up the agenda recently, the traders are trying to glean a little bit more insight into, is the Fed's understanding of the R star, which is the sort of interest rate that the Fed can set that would neither stimulate nor constrain the economy, i.e. keep everything running on an even keel. And in the past few years, the perceptions of where the R-star has been coming lower and lower as inflation has been, quelled basically. But the big blow up that we've seen in the last 2 years now has people raising those estimates, and that's why we're seeing increases in US yields, increases in the real yield, the extra risk premium that people are taking after inflation. And so trying to get a perception of how the Fed thinks about those long-term stability and interest rates is going to be something that will really help fixed income traders with their decision making into the end of the year.
Yeah, R-star is one of those things that it goes in circles. Everyone doesn't seem to care until they do. Bloomberg's Paul Dobson, thanks for that preview. Now let's stay in Wyoming. The Kansas City Fed's annual gathering in Jackson Hole is underway. Traders watching the jam-packed two-day symposium of central bankers for any signs on the policy path ahead. Bloomberg's Mike McKee's been covering it for us, and he's here to break down the schedule of the conference.
Friday's symposium comes in two parts, one of interest to global Wall Street at 10 Eastern when Fed Chair Jay Powell speaks, and later at 3, it's ECB President Christine Lagarde. Neither is likely to deliver what investors want, clear clues to the timing and path of interest rates ahead. Instead, expect them to reiterate inflation is bad and they will keep the rate pressure on. What they won't say is whether that means higher rates longer, or both. In between their keynotes, the central bankers and economists here will turn to the topic of the symposium, structural changes in the global economy. The post-pandemic economy already looks different. They'll discuss what that means for monetary policy, but in the longer run. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
Now, ECB Governing Council member Joachim Nagel said that he's not convinced inflation's under control enough for a halt in rate hikes. He spoke to Mike McKee at the Jackson Hole Symposium.
It seems to be in Europe that the labor market and the similarity with the US is really pretty good. So we have a good labor market situation, but the economic activity is slowing. This is for sure. But this is not a surprise to me. I think when you're hiking interest rates 9 times, it's for sure that there is an impact on the here, and we are seeing this, and this is good and bad news. Inflation is coming down, core is still sticky, and so the next months we will get more information about this.
Well, do you think going into it at this point you would lean towards pausing? There's a split in the markets about it, and there seems to be a split on the Governing Council among those who think you can wait, take a look at what's happening with the economy, and others who think we still need to do more.
I think it's, for me, much too early to think about a pause. I think we have to wait for the next numbers. So we agreed in our July meeting in the Governing Council that we will wait for the numbers we will see in our September meeting. And I will more or less follow this path. I will wait for the September numbers and then we will see.
You're in a kind of interesting position because historically the Bundesbank has been the most hawkish, the most opposed to inflation, and yet the German economy is one of the weakest in the Eurozone and in the EU now. So how do you lean in a situation like that?
Maybe, first of all, I hear a lot of talk about Germany, the sick man of Europe. This is definitely not the case. We shouldn't underestimate the adaptation capacity of the German economy. Yes, we are going through some, let me say, complicated months. This is for sure. But I'm not too pessimistic. There's also no time for complacency. This is also for sure. We see what is necessary to do. And I have a lot of trust in German politics that we go into the right direction, at least for next year. And when you're talking about monetary policy, what I said is that we have to be stubborn here, even more stubborn than inflation. This is what we have to do. This is our mandate. We have to bring inflation down to 2%. And I guess there's this overall understanding in the Governing Council that this is our mandate, and we will more or less be pretty focused, and we will do our job.
Joachim Nagel, ECB Governing Council member there at Jackson Hole. So what's ahead today? Let's bring in Bloomberg's Maria Tadeo for analysis. Maria, you've abandoned me for the continent, but you can still tell me what you think. How much different do you reckon Lagarde's going to be from Powell in her remarks?
will be very interesting because, again, just to maybe set the scene when it comes to Jackson Hole, because some would say these are the Oscars of monetary policy. Maybe it's Friday and I got carried away too. But to me, the overall theme, however, it is interesting to see how much things have changed from a year ago. Remember, Lizzie, a year ago it was all about inflation. Central bankers, both the Fed but also the ECB, having to prove and show to markets that they were serious about taming and containing inflation. We've had this very aggressive hiking cycle, and a year later the question is now changing to how much. That was the initial question, to how much more and for how much longer perhaps we're going to see this cycle here. I think we're both going to get both Mr. Powell and the head of the ECB, Lagarde, reinsisting and instating this idea that it's about the data, but when it comes to the ECB in particular, they would want to make a difference with the Fed, suggesting even the nature of inflation at times is different between the two economies. The European Central Bank was perhaps later to the game, and one of the key lines from the head of the ECB is that whatever the Fed does, it obviously factors into the global conversation, but they are not, quote, Fed dependent, they are data dependent.
So beyond that emphasis on data dependence, what clues are you listening out for in terms of Lagarde when it comes to the next steps, hike or pause, in terms of clarity from Jackson Hole?
Yes, and I'm not sure if it's going to bring us clarity, but it will certainly bring us debate in terms of where this decision is heading, because as you say now, the head of the ECB has introduced a possibility in September of a hike or a hold. This is really going to be the first time we hear from the head of the ECB ever since that July decision. And we could see the contours of that debate already, because the German central banker, Mr. Nagel, who was very surprised, really defended the German economy in that clip that we played, saying we're not the sick man of Europe, saying it is too soon to pause. We also had the Portuguese central banker saying the downside risks are becoming manifested in the economy. And then we also spoke to the Croatian National Bank, or central head of the National Bank, Boris Vujic, who perhaps bridged the two together, saying again, look at the data. Let's take a look.
So the important thing is to look in the next sprints of the data, whether we will really see a softening of the core inflation and inflation moving towards our target.
And that was the head of Croatia's central bank, Mr. Vujic. I think the really listed, to answer your question, the challenge for Christine Lagarde today would be to stay again on the data dependency. Remember, they have new forecasts that will come up in September, but also be able to gather all these opinions around her, because this is a central bank where it is difficult to bridge the many different voices that you have at the governing council. We have this whole string of voices that we just played back to back, all of them providing their insights. But the goal, the challenge, and this is really almost the merit of the head of the central bank in Europe and at the ECB, is to be able to deliver a decision that puts all of them together in a conciliatory way that provides monetary policy for 20 economies. So that is a significant challenge today for the head of the ECB.
All right, thanks for that look ahead. Bloomberg's Maria Tadeo, great to have you on. Stay tuned with Bloomberg TV and radio. We'll bring you exclusive, extensive coverage from Jackson Hole, including, of course, the most awaited speech by Fed Chair Jay Powell at 3 p.m. London time, 10 a.m. UK time, and our exclusive interview with ECB President Christine Lagarde. She's going to be speaking to Tom Keene, simulcast on all of your Bloomberg channels and the terminal. That's at 9 p.m. London time, 4 p.m. New York time. Coming up, BRICS gets bigger. We look into the expansion of the bloc and the global influence new members like Saudi Arabia will be adding to the group. This is Bloomberg.
Would you say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better.
than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
Welcome back to Bloomberg Daybreak Europe. If you're just joining us in London, it's 6:45 a.m. and we're going to go back to US politics now because the long-awaited mugshot is here. Donald Trump has turned himself into an Atlanta jail to be booked on state charges that he conspired to overturn the result of the 2020 presidential election in Georgia. He maintains his innocence. And for more analysis, we're joined now by Bloomberg's Bill Farries in Singapore. Bill, Trump's back on X, the website that we once knew as Twitter. He's posted the mugshot. Is he capitalizing on the infamy?
Absolutely. We've never seen a presidential mugshot before, and now we have. It's one of many firsts for former President Trump. He tweeted that out, or put it on X, as we say now. It's the kind of moment that he uses to rally his base of supporters and to try to raise more money for his campaign. Much of that money ends up getting sent back to his legal team. He's got now 4 active cases around the U.S., and many of those cases are likely going to interfere at some level with his campaigning. But so far, the former president has essentially been like Teflon. He has not been hurt by any of this with his base. He continues to lead most of his opponents in the Republican primary by 30 or 40 points at a minimum. So it's a strategy that's worked for him, but it remains to be seen whether there will be any kind of erosion once people start focusing more on the campaign and once we get into the meat of 2024.
So what does come next legally? How does that tally up with the outlook for the presidential campaign?
Well, we just had that Republican debate a couple days ago that the former President Trump didn't take part in. Legally, the prosecutor in this case in Atlanta is hoping to have him back in court by the end of October. That's much earlier than the spring of next year that we were expecting. The judge hasn't ruled in that case, but Trump already is set to appear in court in late March, right before the major Super Tuesday primary. That is often a do-or-die moment for many presidential candidates. That will give us a good sense of whether there's any other person in the Republican Party coming close to being able to threaten him for the nomination going into November 2024.
All right, thanks to Bill Farries. Now, Saudi Arabia and the UAE are among a bunch of countries being invited to join the BRICS group. I don't know what it'll spell after they've been added, but it's pushing to expand its global influence. And Bloomberg's Jennifer Zabasajja, has been well across that summit from start to finish. She joins us from Johannesburg. Jen, what's been the reaction to this selected list of potential new members?
Yeah, Lizzie, look, let's start with the positive, right? I mean, this group definitely would boost the BRICS bloc, influence diversity and power on the global stage. Bloomberg Economics even projects that it could potentially increase, the BRICS could account for 37% of global GDP, eclipsing the G7. And so, yes, there's a lot of positive news around it. We heard a number of leaders talking positively and welcoming this news, but there is still a lot of skepticism, as you mentioned, unclear what this really spells, because there was already a bit of divisions between the BRICS countries with the five. Now, some people are saying maybe this imports even more potential tensions about things like trade, human rights, democracy. Egypt and Ethiopia have their own tensions that exist within there. China and India have been having a standoff over the border. And so this could spell some more concern about whether or not this BRICS coalition, or this BRICS grouping of countries really is what it is, whether they'll be able to get a lot done considering a lot of the divisions that they have on some of these key issues. But what we heard from the leaders on Thursday is that they are welcoming these countries and they're hoping that it really could increase their influence and their ability to transform a lot of multilateral institutions. So we're going to have to see whether or not that actually pans out.
Yeah, and of course, there had been a lot of talk about moving away from dependence on the dollar, but there don't seem to be much development on a joint currency. All right, thank you to Jennifer Sabasaja for that roundup of the BRICS summit. Coming up, it's Friday. Are you hitting the pub after work, or are you staying in for a tipple? We look at how hungry developers, stay-at-home drinkers and rising prices may all spell doom for Britain's boozers. That's next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. I just want to bring you some breaking news out of China. China has issued rules to ease mortgages for some home owners. This is according to a document from the PBOC and other regulators, of course, in response to these concerns about the weakening Chinese economy. So the drip feed continues, but no bazooka yet. Of course, these property sector concerns we've been talking about all week. So that is the latest development out of China. But I want to get back to the UK now. We've had insights on the UK economy this morning from the GfK data, the UK consumer confidence actually rebounding in the month. And this plays in, of course, to the inflation story, which we can give you a little bit more colour on. Now, it is Friday after all, and pubs have been part of British culture for hundreds of years. but numbers have dropped precipitously in recent years. According to the British Beer and Pub Association, more than 560 pubs closed in 2022, more than either 2020 or 2021 during the height of the pandemic. So what's driving down the number of pubs in Britain, apart from the inflation story? Bloomberg's Helen Chandler-Wild joins us. She wrote this story. Helen, great to have you on. Why are more pubs shutting then?
I think it's a combination of things, because there have been that big closure of pubs in 2022, as you said, more than 10 a week shut. But it has also been a long-term decline as well. So we've lost a quarter of our pubs between 2000 and 2022, which is a huge number. And so definitely some of those short-term pressures are a big deal. Obviously, if you have to shut for a long time during COVID, that's never going to be good for your business. But there has also been just a long-term shift in consumer habits away from going to the pub every night and that really being central for your community to doing other stuff. There is just other stuff to do now. A lot of people go to the gym, or they might go to a cafe, the kind of things that people just weren't really doing in the 90s.
And what are the solutions to this then? Because, of course, we don't really see many working British phone boxes, another pillar of British life. How do we save the pub?
Well, I guess in your question, we don't see a lot of working phone boxes, but a lot of them, people love them so much that they have found other uses. So the one by me has been turned into a little library. Some of them have been turned into places for defibrillators. So that's all great. And some similar things have happened with pubs. So they've stopped being just a place where you can go and have a drink. And some of them will now have a little grocery or a post office in store, or they might have a space for like kids or whatever. And that is definitely a solution for some of them. For other of them, it's just a different form of ownership. So a lot of pubs have been saved from being shut down by community ownership, where a community will come together and purchase a pub together and then run it literally just for the benefit of their town or village. And that's a really nice model, which does seem to work.
All right, thanks to Bloomberg's Chandler-Wild, or should I say cheers. Happy Friday to you, Helen. Now, I just want to get you back to this China line. China issuing a new rule to ease mortgages for some home buyers. You're actually seeing the yuan paring losses on this new mortgage guidance out of China, so adding to the drip feed, but not a bazooka yet in terms of China stimulus in response to the concerns about the weakening economy in China. This is expected to help home buyers to be qualified for the lower down payment ratio and preferential interest rate that's currently enjoyed by first-time buyers. That's the latest on China. I'm sure they'll bring you more next in Markets Today. Tom McKenzie, Anna Edwards and Mark Cudmore coming up. This is Bloomberg.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open
for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Bloomberg Markets Today. I'm Anna Edwards, live in London with Tom Mackenzie. Mark Cudmore, our Markets Live managing editor, joins us from Singapore to take us through all the market action this hour.
The cash trade then just less than an hour away. Here are your top headlines. US and European futures extend yesterday's risk-off sentiment as markets look ahead to Jay Powell's speech today at Jackson Hole for interest rate clues. Christine Lagarde speaks exclusively to Bloomberg after the ECB president gives her address in Wyoming as some of Europe's top central bank officials hint that more hikes are possible. Plus, Donald Trump surrenders in Atlanta and at a jail there to be booked on charges that he conspired to overturn the 2020 election results. The ex-president posted his mugshot on social media.
Those are the headlines, including the politics. Let's get to some of the data. We've got German GDP for the second quarter. Confirmation of what we already knew, essentially, here, Mark. 0% growth for the German economy, 0% contraction, depending on which lens you want to view it through. And I've seen it written up both ways, in fact, as a number of 0 on GDP. I've seen it, people saying that this confirms the winter contraction, an extension of the winter contraction we had for Germany over at least 2 quarters, Q4 and Q1. Or others cast this as Germany sluggishly exiting recession, but still looking weak ahead. What lens do you look through when you look at this kind of number then, Mark? 0%. I guess it comes after that really disappointing set of PMI data we got earlier this week.
Yeah, good morning, Anna. Good morning, Tom. I definitely view this through the negative lens. Look, the fact is the high frequency stuff is very negative. As you mentioned, Anna, PMI data this week was very, very poor. PPI deep in deflation in Germany, and I think that shows that just the general factory slowdown. They have suffered from the disappointment around China's reopening. They've suffered from higher gas prices. So generally, Germany's economy is really, really struggling. So I don't see this as slowly exiting. I see this as an economy that is still struggling to generate growth. Overall, I think that's a real problem. Otherwise, in the short term, in the market's view, it has generally been a quiet Friday in Asia as we wait Jackson Hole later on, but it's been quietness with a clear risk-averse tone overall.
Mark, I think that's really interesting, particularly given what we heard from the Bundesbank President Nagel speaking to Mike McKee and the team on the ground in Wyoming, pushing back on this narrative. He said, look, Germany is not the sick man of Europe. We are still on track, he says, for a soft landing, and that underscores his push that the ECB may need to do more on interest rates. So he would take the other side of that view when it comes to Germany. Really interesting from the Bundesbank President, Mark. As we weigh up the picture here in terms of the European Open leading up to this Friday Open at least, futures pointing a little lower by about 0.1%. It's been a choppy session, hasn't it? A week at least for the tech sector. And we saw that drag on the Nasdaq yesterday, and I'll dig into that shortly. But the futures in Europe pointing just slightly lower. We've got a bit of news flow coming through from China, changing the momentum in that economy at least on some of the major indexes, just turning a little bit more constructive on the back of the news around the real estate sector. FTSE 100 futures currently pointing up by about 0.1%. DAX futures over in Germany down 0.2%. On the futures then, with the US, yes, the bleed came through on tech. The sell-off, the AI catalyst has faded. At least it did yesterday. There's this tussle between, of course, the upside coming through from Nvidia and the higher rates environment. And yesterday, the focus switched back to that part of the equation with a 2%, plus 2% drop for the NASDAQ. Currently, futures there pointing to build on those losses just by about 0.1%. S&P futures, though, pointing to green, just 0.1%. A bit of a holding pattern, of course, before Jay Powell. Dow Jones futures pointing to gains of 63 points, 0.2%. Mark, what across the GMM is looking most interesting this Friday morning for you?
It reflects a reassertion of the main August themes on this Friday. And what I mean by that is higher yields generally across the board. We saw that theme in the US session yesterday. It's a little bit of follow through here rather than pushing much higher. But note the long end, 1 basis point up in 30 years. I think the steepening dynamic will be a big part of next week post Jackson Hole. As a result of that, we've seen stronger dollar yet again. Note sterling and euro, particularly on the vulnerable side here, those European currencies suffering. And despite what the Bundesbank said, that is about growth negativity, that they are worried about the European continent and the UK as well. And note this means risk aversion. Stocks are generally lower. China is that grey box at the bottom there. It was higher up until only a little while ago, and there's been yet some more kind of policy tweaks coming out of China. These ones were expected, but they did impact the market to pare those losses a little bit. But it is those dominant August themes of higher yields, stronger dollar, and China negativity.
Okay, so that's what we see across markets, almost a sort of default back to the early August position on markets and in terms of sentiment. Let's focus in on Jackson Hole then, because we are going to be there in force. We're going to be watching very closely what we hear later from the Fed Chair, Jerome Powell, who'll be delivering his keynote speech at the annual gathering of central bankers. Traders will be following closely for any clues on the interest rate outlook and hiking path ahead. We're joined now by Bloomberg's Maria Tadeo, who, of course, often speaks to us around European policy, but has been casting her eye wide for us today around the global economic narrative. Maria, what are we expecting then? Set this up for us in terms of watching the Jackson Hole story today.
Yes, Anna, and it'll be interesting because if you go back a year ago, the whole debate at the time was about proving and showing to markets and traders that central banks across the globe were serious about taming inflation and taking action to do that. Now, if you go, well, fast forward a year, we've seen a very aggressive hiking cycle, and the question now changing from how much to how much more is left and for how long. So that is a theme that brings together a lot of the central banks. To me, it'll be interesting to see, not just from Jay Powell, obviously we're keeping an eye on the Fed, but also the head of the ECB, because remember, the European Central Bank has now introduced the possibility of a hold or a hike. This is the first time that Christine Lagarde will really take center stage in explaining potentially herself and showing maybe where the data is heading to. Let's remember also that the ECB will put out new forecasts in September. And again, this is the first time we'll hear from her on such a platform since that decision in July, where again, the ECB now opened the door for the first time to go in potentially for a pause.
Maria, we set up the divergence there with Mark taking a slightly more pessimistic view on the German economy and outlining why he thinks Germany is going to struggle in terms of growth. Bundesbank president, as I mentioned, being slightly starry-eyed about the prospects for Germany. He has skin in the game, of course, and wanting to push that hawkish message. Who's winning out in terms of the debate when it comes to the officials at the head of the ECB, the hawks and the doves?
Look, I think who's winning out, we'll find out in September. To me, I was also very surprised, and I thought it was very interesting, the comments from Mr. Nagel about we're not the sick man of Europe, and the reference and the reason why he says we're not the sick man of Europe, it's because of an economist. The Economist has put out a story, a front-page story that suggests Germany is the sick man of Europe, that has created pushback from the German government, but I wasn't really expecting that the central bank would weigh into this. Now, in terms of the inflation debate, obviously his voice carries weight within the governing council, and yesterday he spoke to Bloomberg and suggested, in his view, it is too soon to talk about a pause. Let's take a look.
Inflation is coming down, core is still sticky, and so the next months we will get more information about this. It's, for me, much too early to think about a pause. I think we have to wait for the next numbers.
And that was Joachim Nagel, head of the German Central Bank. And at the same time, the same day, we heard from Mário Centeno, the head of the Portuguese Central Bank, who was pointing to the flip side of this debate, saying the downside risks to the economy are manifesting. So therefore, the ECB should wait. That the challenge for the head of the Central Bank, Christine Lagarde, today will be to bridge all of those opinions. Because remember, the job of the ECB is not just to set monetary policy, but for the president itself is to gather that consensus around the governing council, which, as we know, it's not always easy when you deal with 20 different economies.
Maria, thanks very much. Bloomberg's Maria Tadeo joining us there with the latest on the central banking narratives. And we'll have live coverage, of course, from Kansas City, the Kansas City Fed's Jackson Hole Economic Symposium throughout the day here on Bloomberg. Also coming up from Jackson Hole later today, don't miss our exclusive Bloomberg interview with the ECB President, Christine Lagarde. That's at 9 p.m. UK time, so we may have to wait for some of the market moving thoughts she has to filter through into Monday, but of course FX markets will be able to respond. Mark, let's talk about the markets in 3 minutes, and let's start then with expectations for Jackson Hole. A lot of what I've been reading has been talking about the R-star obsession, the obsession around neutral rates and whether they need to go higher. Data dependency gets a lot of mentions as to what Jerome Powell is likely to talk about. What will help us get through all of the noise? What will you be looking for from Jackson Hole?
I think you're right that everyone is focused on any mention about the long-term neutral rate in R-star, which is interesting because I think many people basically have ignored this concept for many years and are only just kind of catching up on the idea. So I think it's one of those topics that's kind of really on vogue at the moment, but we might move on very quickly. What do I expect to be the message? I think people are very caught up around some of the short-term messaging, whereas Powell is going to be reluctant to pre-commit. I think he's going to be very consistent on his short-term messaging, which is that we might still have more to do. We're open-minded to that, but we're also open-minded to we're near the end of the cycle. I think it's going to be vague enough to not move the front end much. So that means the bigger message here is about the long end, which is why people care about the R-star, the neutral rate. And that's why I think that ultimately we're likely to probably get a steepening curve coming out next week. And I'm going to talk about this a little later in the show as well. But I think that's that idea that if we have the front end anchored, if he's hawkish, the impulse will be to drive up yields, but it won't be a message that we're going to hike much more. It's going to be holding the rate higher for longer, not necessarily raising it much further. Whereas if he's dovish, he's going to be hard to justify that. And people are going to worry, wait a sec, he's dovish in a strong economy. That means we need a steeper curve to justify that.
Okay, so not a victory lap, though. That's not where you think we are, despite the fact that soft landings seem to be getting a lot of mentions. Bloomberg Economics says that's now the consensus among economists, that we will get a soft landing, and we have inflation down at 3.2, unemployment at 3.5, GDP at over 2. So that's something that will run and run, perhaps, that conversation. Let me ask you about China, though, Mark, because just before we came on air this hour, we got some more headlines around China. Is this more drip feeding of small-scale policy initiatives? It does seem to be something that could support the property market.
Yeah, it really is a drip feed, and it really is small scale, and it was expected. I'm surprised the market reacted so much, and I did note after the initial big jump in mainland stocks and Hong Kong stocks, they're already pairing those gains since that headline. There's no big bazooka from China. There's not likely to be one. That's not what the narrative is. If you're buying China stocks on waiting for a big bazooka from policy front, you're going to be sorely disappointed.
Okay, but you do see better news around the Chinese consumer. You're actually in contrast to the US consumer, where there's some slightly more negative headlines coming through, in particular around Nordstrom and their guidance.
Yeah, look, I think the resilient US consumer has been the big story the last couple of years, and it's been driving my kind of general theme of we're going to keep on having higher yields than people think because the US economy will be more resilient. I'm always very concerned by the US consumer because it drives the US economy. There are cracks starting to show, which I think back up the idea of US starting a recession in the fourth quarter. But as you mentioned, Chinese consumer is starting to pick up from a very low base, so their cycles are at complete opposite ends of the spectrum.
Yeah, really interesting to watch how those develop then. Thank you to Mark for thoughts so far. Remember, you can get up-to-date analysis from Mark and the rest of the Markets Live team. MLIV Go is the function to use on the Bloomberg terminal. That'll take you to the Markets Live blog. So have we mentioned, Tom, that it's Jackson Hole? We'll hear from Jerome Powell and Christine Lagarde later. But there are other things on the agenda for today.
Jackson Hole? Yes, we may have mentioned that. I did a road trip through Jackson Hole. It's beautiful. We bumped into a moose. I haven't worked out what the plural of moose is, so if someone can tell me, that would be helpful. It's Jackson Hole, everyone. Who knew? That's happening. Also, German IFO data. Mark has views on the German economy. He doesn't think it's doing too well. The Bundesbank president, though, who of course is in the hawkish camp, thinks it's holding up rather well. Well, the German IFO data is going to be interesting in that context as well. We're going to be throughout Wyoming, of course, and we're going to get to Jackson and Jay Powell's speech shortly. But University of Michigan survey, this had been really important towards the end of the last year and at the beginning of this year in terms of the guide on inflation, but also consumer sentiment. And this is the consumer sentiment survey tying in to the comments between Mark and Alia just now around whether or not the consumer in the US is starting to crumble. We've had some earnings from some of the big retailers suggesting that there is pressure. Just look at Nike sales. Just look at Foot Locker. There is that challenge there, at least at some parts of the consumer base, some parts of the retail space in the US, and that's consequential. Jay Powell, he's going to be giving a speech, everyone. Yes, 10:05. US time, we're going to be getting that speech. For me, what's really interesting is the market reaction. Are we going to start to change the pricing? There is a 30% chance, according to the market pricing, of another hike in November. And don't forget, the markets are pricing in 100 basis points of cuts come 2024. How does that adjust on the back of this speech? Do we get more clarity in terms of what higher for longer actually means from the Fed president? And then we have the Bloomberg exclusive. President Christine Lagarde going to be speaking to us after her speech in Wyoming. That is certainly one you're going to want to tune in for. Anna.
OK, so lots to come then from Wyoming today. Coming up on the programme, Donald Trump marks his return to X, formerly Twitter, with a mugshot. But will it help mark his return to the White House? We will get the latest on the run-up to 2024 and US politics. Plus, economic downturns seem to be impacting high-end watch sales and also the pub business. We'll get the latest on both of those sectors. Up next, though, the big market event of the day will no doubt be Jerome Powell's speech. If you're in Wyoming, stay away from the moose. If you have any questions for our guests, please do get in touch with us. ID plus TV Go is the function to use on the Bloomberg terminal to get in touch. You can also stay across the markets today blog. You'll find that by going to the Bloomberg UK website or TLIV Go on the Bloomberg terminal. This is Bloomberg.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Today, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Tune in for continuing coverage with a special edition of Bloomberg Surveillance live from Jackson Hole starting at 8 a.m. Eastern. Bloomberg, your global business authority.
Reacceleration could put upward pressure on inflation, stem the disinflation that we're seeing, and instead delay plans for the Fed to change policy.
That was the former Federal Reserve Bank of St. Louis President James Bullard, of course, discussing the U.S. economy, inflation. He also went on to talk about, of course, FOMC policy and interest rates. Joining us now is Wei Li, Global Chief Investment Strategist at BlackRock International. Wei Li, nice to have you with us. Let me start on inflation, as we were hearing from Jim Bullard about that, and then we'll get to some more thoughts around Jackson Hole. But I noticed in your notes you say that you expect inflation on a roller coaster ahead. I feel like inflation's already been on a roller coaster. Will this be smaller in scale? What do you mean by that? What are you expecting?
Absolutely. Hi there. Good morning, Anna. So basically, as we think about what has been driving inflation, we have really seen two structural shifts. One is around during the pandemic, the goods service rotation and the mismatch between supply and demand. And by our assessment, about 2/3 of that mismatch goods service rotation has now been unwound. But then there is the other structural shock to inflation, which is around labor shortage and aging demographics. And because of that, we actually think that the current running job creation in the US is too high for the population to support. Really, the population can only support about kind of 2/3 or maybe even a half, 1/3 of the current running rate of job creation in the US. So unless job market cools down quite a bit, we actually think that wage pressure will push inflation higher again. So of course, now compared to 1 year ago, Jackson Hole inflation in the US was above 8%, and now it has a 3 handle. So certainly the alleviation of the first shock drives us down to where we are in terms of inflation decrease. But because of the interplay between the two shocks that I'm talking about over different horizons, we believe that inflation will be on a roller coaster, not to be taken for granted that we have won the inflation war, which is why the messaging from central banks will be quite consistent around kind of staying higher for longer, which is our expectation today.
And Wei Li, in some respects, you and the team at BlackRock were ahead of the curve and ahead of the central banks in making that call that rates would have to be higher for longer. As you project out to 2024, markets still pricing in about 100 basis points of cuts. Does that seem reasonable to you? Does that align with the higher for longer view? Or do you push back that we're going to get cuts of that extent, 1% at least, by the end of 2024?
Actually, if we look at kind of market pricing for rate cuts until the end of 2024, it's not that off versus our expectation anymore. But where we differ, I think, is the terminal rate, and the difference also varies from region to region. So in the US, we think terminal rates will be higher, but in the case of Euro area, we actually think terminal rate will be lower than what market is currently pricing for, which is why whilst we are underweight US long duration, we're actually a bit more constructive on developed market government bond duration over this side of the pond. For example, we prefer on a relative basis European duration. So it's we're moving from the how high conversation to how long, and also just how deep the cuts will be. I think after recent market repricing, US rates for up until the end of 2024, 100 basis point rate cuts does not seem that off anymore.
Whaley, good morning. You've talked there about US rates seem about right. You like duration in Europe, but I guess overall, what is your top trade for playing this view between now and year end? So we've got just over 3 months left in the year. Sorry, just over 4 months left in the year. What is the best way to position for your kind of view on what happens in this inflation roller coaster?
Well, inflation roller coaster means that we cannot just kind of hope that the soft landing type of momentum market narrative can take us from now until the year end. In fact, recent market trading sessions already put some doubts around that narrative. So being selective is very, very important. So if you look at the latest earning season, yes, broadly the picture is that earnings have been stagnating, but within that there is a huge amount of dispersion, right? So sectors like tech and AI, related themes, they have delivered versus even very, very elevated expectations. And then consumer discretionary, for example, also surprised on the upside, which in the context of labor taking a bigger share of the pie is not entirely surprising. And on the other hand, you have sectors like healthcare a bit disappointing versus expectations. So all of that just to say, from now until the year end, we do think that being very selective is important. We have a modest underweight to develop market equities, but against that backdrop, we have overweight in AI tech theme because we think that earnings are coming through as the latest reporting season shows.
Yes, I mean, the tech sector responding to the earnings story, Whaley, as we saw with NVIDIA this week. Also, we'll be watching closely what we get from Jackson Hole today from the Fed around interest rate expectations. How will it be possible for the Fed to surprise? If we were to be surprised by Jackson Hole today, Whaley, and by what Powell says, how will we be surprised, do you think?
Well, this is a great question. How can they surprise markets given that their messaging has been quite consistent, which is higher for longer, and we're not out of the woods with fighting inflation? I would say, though, that if you look at VIX, if you look at MOVE, volatility indicators, they're pointing to somewhat comfortable market sentiment. I know that there has been a bit of a nervousness, but volatility indicators are not too extreme, right? Which points to potential room for upside surprise, for greater volatility surprise, which was the case last year at Jackson Hole as well. You know, like markets were not expecting a lot, and then it was surprised after Powell's speech. So I think if they were to, and I also think that there's a regional differences here too, in terms of where surprises can come from. So last year, inflation was high for all the major central banks, above 8%, the ECB and the Fed. And now the Fed has a 3 handle, ECB has a 5 handle, Bank of England has a 6 handle. And then if you look at bankruptcy filings in the UK, it's getting closer to, you know, even the global financial crisis levels. In the US, it's a bit more contained because of the fixed rate kind of in terms of a fixed structure in terms of loans. So I think we're going to see a greater dispersion in terms of central bank narrative, and I think markets are looking for a simplistic set of tone coming from Jackson Hole, and that dispersion could create some surprises.
Okay. Wait, we've run out of time, but we really appreciate your insights with a preview of Jackson Hole. Whaley, Global Chief Investment Strategist at BlackRock International. This is Bloomberg.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Welcome back to Markets Today. Happy Friday. We are 30 minutes from the cash equities open, futures in Europe pointing lower.
Here are your top stories. US and European futures extend yesterday's risk-off sentiment as markets look ahead to Jay Powell's speech today at Jackson Hole for interest rate clues. China unveils further mortgage easing policies to bolster its property market in an attempt to support the world's second biggest economy. Plus, Donald Trump surrenders in an Atlanta jail to be booked on charges that he conspired to overturn the 2020 election results. The ex-president posted his mugshot on social media. Tom, you mentioned what we're seeing in futures. Take us through in a bit more detail where we are as we run up towards Jackson Hole.
Quite the glare there from former President Trump. Right, in terms of the futures then, we snapped 3 days of gains across European stocks yesterday. It was tech that was the biggest downside in terms of your sectors, losing more than 2%. And then that was reflected again in the session on Wall Street, where tech really turned around, with Nasdaq closing lower by a little over 2%. The futures here now pointing to build on those losses further. Around 0.3% is the downside that is being flagged by DAX futures. Over in France, you're looking at further losses, about 21 points. Here in the UK, the FTSE 100 pointing lower by a little less, about 0.1%. It was financial services, utilities that were sectors that posted gains amongst around 5 or 6 amongst the sectors yesterday. We'll see how that transpires today. On the central banking front, interesting to continue to see that debate and that division within the ECB governing officials, the likes of the Bundesbank, saying there may be scope for more rate hikes to come through, data dependency being the key there. But Centeno over at Portugal saying they may already have done enough. Futures, again, pointing to further downside as we gear up to that all-important speech from Jay Powell, Anna.
OK, yeah, absolutely. So waiting for Jackson Hole. Mark, with that in mind, I know one thing that's caught your eye has been the steepness, the extent of the inversion that we've seen in yield curves over in the United States. What are you expecting to see from this position of inversion? Not as much as we were, but still pretty deeply inverted.
Yes, Anna. People may not be aware, but there is actually some policy conference going on in Jackson Hole this weekend. I'm not sure if we've mentioned it in the show today. But anyways, I think that the main impact of this policy meeting will be to see further US yield curve steepening. Now, let me talk to that view. This is the 3-month, 10-year segment of the curve. Now, regular viewers will know that I'm still a believer in the yield curve signal, and that I think that the US will go into recession in probably around the end of the fourth quarter this year, maybe in the first quarter, but my base case is still fourth quarter this year. And if that's going to tally, that view is going to tally with the yield curve playing ball, then we'd expect this to steepen significantly by around the start of the recession. Normally, it ticks back up into positive territory just before the recession starts or around the start of the recession. It's currently 125 basis points negative. That implies the 10-year rate is 125 basis points below 3 months. So, are we going to see that climb 125 basis points in the next 4 months, which would roughly tally with my view of a recession? As I said, I'm open to a couple of months either way. Yes, I think we will. So this weekend, if Powell is dovish, the default of the market will be buy bonds. We'll see the curve go lower. And if he's hawkish, the default will be sell bonds, go higher. But as I talked about at the top of the show, I actually think the front end is going to be relatively anchored. And so therefore, the higher beta reaction at first will be in the long end. But if he is dovish, while we might see 10-year yields tick down initially, everyone's going to go, wait, the Fed is dovish despite the fact labour market's still strong, inflation's still sticky, growth is still fine. That implies that if he's not going to hike rates much more, that means that the curve needs to tick up and we can't be pricing in these aggressive cuts down the line or this kind of growth slowdown. And that will see the steepening. So how do I think we'll get back to zero? I think 10-year yields have easily 50, 60 basis points of upside before the end of the year as possible. And I also think that by the time we get to December, we'll see enough weakness in the labour market that suddenly the 3-month rate will be pricing aggressive cuts. And that way, I think we might even up to getting pretty close to 125 basis points in steepness by December. Could be out by a month or two, could be January or February, but that's the narrative that I'm playing. And I think that's the impulse will be given for the next month out of Jackson Hole, even if maybe not the first 24 hours of trading on Monday.
Okay, so that's the view leading up to December. Mark, I'm really interested in your view on this as well. In terms of real rates, in terms of how much work has been done by this Federal Reserve, the catch-up in terms of the rates coming through from the Central Bank of the US and the downside coming through from PCE and CPI. And you can see, of course, the gap that they had to close starting in 2020 all the way up as rates rose. Inflation, though, that mountain of CPI peaking at around the middle of 2022, and they had to grind that lower. And they've been successful. And now you get this crocodile mouth shape coming through with rates above CPI and PCE. So real rates are higher. To what extent? How much further does that have to go? To when does that extend? And does that get to your December timeline? Does that push through to 2024 as markets are pricing in 100 basis points of cuts? How consequential is that, Mark, I wonder, in terms of how you play that in to the yield environment?
I'm looking forward to some technician using the crocodile mouth shape to give us a bullish or bearish view later on today. But I think that chart's really interesting, Tom, because it does show that by that basis, we only reached restrictive territory only a few months ago in 2023. And therefore, with the long and variable lags, we'd expect that to impact the economy next year. And again, that ties in the idea that we're probably going to be in recession next year. The one problem is that we've had in this policy, that's headline rate, is that throughout this cycle, the 10-year has been lower for most of the last year or so than Fed rate, because we've priced in aggressive cuts coming. And that has slowed the policy impact, which is why it hasn't been as restrictive as expected. And that is the dynamic we still have out there. I actually think that before we get the real impact in the economy, before we see that recession, we start pricing in that the 10-year doesn't get those cuts. That tightens us further, and that's the final tightening that seals us into recession in the fourth quarter with that crocodile mouth technical shape.
Okay, Tom seems to have introduced a lot of wildlife into the show today, from moose to crocodiles. We appreciate both. Right, staying with the US, but now turning to US politics. Let's get the latest on on what's been happening with former President Donald Trump. The long-awaited mugshot is here. Donald Trump turned himself into an Atlanta jail to be booked on state charges that he conspired to overturn the result of the 2020 presidential election in Georgia. Trump maintains his innocence.
What has taken place here is a travesty of justice. We did nothing wrong. I did nothing wrong. And everybody knows it. We did nothing wrong at all. And we have every right, every single right, to challenge an election that we think is dishonest.
For more, let's bring in Bloomberg's Bruce Einhorn, who's got analysis for us. Bruce, what were the other major developments in the Georgia case?
Well, Anna, you mentioned the mugshot. That itself is interesting because it's the first time the former president has had his mugshot taken, even though this is the fourth time he's had to go before judges for indictments. Earlier cases, there was the ruling that he was a familiar enough person that they didn't need to take his mugshot. The The sheriff in charge of Fulton County in Georgia said everybody's going to be treated the same. He's getting his mugshot taken. As far as other news from the day, the one surprising thing happened actually before the former president even turned himself in Fulton County, and that was the district attorney, Fani Willis, filing a motion asking to accelerate the trial. She originally had sought a trial date in early March. She's now looking at October 23rd. That's because one of the other people included in the case, one of the 19, Kenneth Chesebro, who asked for his trial to be accelerated. He asked for a speedy trial, which is his right. The judge has agreed with that. And so Fani Willis has said that rather than try him individually and everyone else at the later date, she's now requesting that the trial take place in October, which of course is much earlier than we've been expecting. Whether that actually happens for everyone remains to be seen. Former President Trump is going to ask to separate his case from Kenneth Chesebro, who's the one who does have the October date. So he's going to resist this request to have a speedier trial. It does add to the uncertainty in a very busy legal year for the former president coming up because of all the other trials that he has for the cases in New York, in Florida, as well as the Washington, D.C. case related to January 6th.
Okay, Bloomberg's Bruce Einhorn on the latest when it comes to Trump's legal woes and the time frame going forward. Thank you. Now, the BRICS bloc of emerging economies is expanding for the first time since South Africa joined way back in 2010. Way back, well, at least 13 years ago. Saudi Arabia, Iran, Egypt, Argentina, Ethiopia and the UAE have been invited to join the group in a push to expand its global influence. Bloomberg's Jen Tabasaja joins us from Johannesburg. She's been on the ground all week for us, charting this and monitoring the conversations. The BRICS summit, of course, continues. Jen, what has been the reaction then to this selected list of potential new members? And what happens to the acronym, Jen?
That's a good question, Tom. And that was something that we actually asked about. For right now, I can assure you that the BRICS acronym is going to stay, potentially add to the plus. But let's just get to the reaction. I mean, there's a consensus that this new grouping, potentially these new members that would make the BRICS 11, will be able to boost influence, diversity, and power on the global stage in financial institutions. And we even have Bloomberg Economics that's estimating that this new collective purchasing power of this new bloc, if it were to be all 11 countries, could surpass that of the G7. So on the one hand, this is positive, and we heard that from a lot of the leaders on Thursday. We had President Xi Jinping saying that the expansion is a new starting point for cooperation, and Prime Minister Narendra Modi saying that the expansion gives their shared efforts new impetus. But at the same time, Tom, there's a lot of skepticism about this new expansion and that it may just import even more divisions that were already existing within the BRICS bloc. Of course, we know China and India have their own tensions. Now, if we have the addition of the 6 that were proposed, Egypt and Ethiopia have longstanding tensions over a dam that may or may not be built. Iran and Saudi Arabia, until recently, had their own standoff. And the questions are rising whether or not this collective of countries are going to be able to establish and make some change given all the divisions that they have. But there's also a lot of discussions about what this means for the global supply chain. Of course, this is bringing together the world's largest energy producers with the world's largest consumers. So what does that mean for the petrodollar? So a lot of questions, Tom, still about this new BRICS bloc.
Jen, good morning. A lot of questions. You referred to it there as a collective, and I know you mentioned some of the new countries, but I'm going to repeat them now because it's worth it. Argentina, Egypt, Iran, Ethiopia, Saudi Arabia, and UAE are the 6 new countries invited. What's the common denominator here?
That's a good question, Mark. I think at this point in time, what they would say is that they are all sort of committed to reforming multilateral institutions. Because as you mentioned, I mean, this is a disparate grouping of countries from all over the world. And what we heard from Brazil, at least, was that bringing Argentina in adds another country, another voice from South America. Egypt and Ethiopia are African countries, but still, there's still, again, a lot of divisions about what exactly it is that they want to see going forward. But there is a commitment to reform the UN Security Council. There's a commitment to take a look at more of a voice for the Global South within the IMF and other organizations. And so that's really the common denominator. But whether or not they're going to come to a consensus that they'll all agree on, again, remains to be seen.
Okay, Jen, thanks very much. Jennifer Sabasaja there covering the BRICS summit for us, as she has been doing all week from Johannesburg. Coming up on the programme, we'll look at your stocks to watch at the open, including watches of Switzerland, after Rolex makes a major retail move. We get the details next. This is Pullback.
Almost half of all American women in opposite-sex relationships now make the same or more than their husband. That's a record high. According to a new report by the Pew Research Center, a third of U.S. women are in egalitarian marriages, making roughly the same as their husbands, and another 15% of them are the breadwinners. Women with college degrees and no children, as well as Black women, are even more likely to make more or the same as their partners. But not everything is a bed of roses. Working wives still carry most of the weight of unpaid labor. Women in egalitarian marriages spend almost twice as much time taking care of the home or a loved one, while dedicating less time to leisure.
Women are continuing to go out in the formal labor market and contribute and are still bearing all of the load of responsibility that disproportionately falls on them in terms of family care.
During the pandemic, in the wake of school shutdowns, the height of the childcare crisis pushed nearly half of American women out of the labor force, a trend that's yet to be reversed.
Women are just really struggling to meet the care needs of their family, and at the same time are really, really leaning into the labor market. And I don't think we've seen this before in history, to be honest. Welcome back to Markets Today. 14 minutes until the start of Cash Equities trade. And this is the futures picture for Europe. Looks fairly mixed, doesn't it? Or negative, apart from one market where we are expecting a little bit of upside. Let's get to the dominant macro theme of the day, and that is around the Fed and Jackson Hole. Fed Chair Jerome Powell's speech at Jackson Hole will be in focus later for clues on the central bank's outlook for monetary policy. Sam Unstead joins us from our Markets Today blog. And as always, Sam, of course, a focus on the UK side of things, but also with one eye on the global policy narrative. And that's
what we'll get a lot of, the US policy narrative from Jackson Hole today. What do you think markets are watching for here then?
Well, I think, I mean, not just the US, but Europe as well, you know, with some commentary from the ECB and Christine Lagarde. I think actually yesterday gave you quite an interesting view as to how important central banks are right now. And actually, almost every time I come on here, it seems like the narrative has slightly shifted in terms of what everyone is looking for when it comes to central banks. With the ECB at the moment, it's when are they going to pause? Are they going to pause anytime soon? With the Bank of England, how much further are they going to go? And then with the Fed as well, it's a case of are they going to pause? How long are rates going to be elevated for? And you know, when does that end, basically?
Yeah, whether he'll focus on data dependency as well, whether he'll address the R-star and the neutral rate, that seems less likely. Here in the UK, focusing on the energy picture, news coming through in terms of the cap on energy prices. We're all going to be welcoming cheaper energy, are we, here in the UK, Sam?
Broadly, yes. So the price cap is going down off GEM's price cap. That is, in and of itself, like good news, widely expected because wholesale prices have come down. Fixed price tariffs, there's more of those coming onto the market. That will give consumers a little bit of certainty, and I think that's generally how people think about their energy prices. So that will be, you know, positive overall. But because this is coinciding with the government phasing out support that was put in when we had the price spike last year, it does mean that a lot of houses are still paying more for their energy.
OK, Sam, thank you very much. Sam Onstead from the Markets Today blog. You can get more from the blog. Go to the front page of the Bloomberg UK website and click through to it, or go to T-Live Go on the Bloomberg terminal. Let's get a look at stocks to watch. Joe Easton from our equities team joins us. Joe.
Morning, Anna. So we're seeing lots of negative commentary today around watches of Switzerland after Rolex announced last night that it is going to buy the retailer Boucheray and possibly give it around 100 of its own stores. Rolex currently only has around one store over in Geneva, a single store that it sells its own watches in, and Watches of Switzerland is a key partner, so this does threaten their turf quite significantly. And we're already seeing ratings downgrades at HSBC and also Peel Hunt just a few moments ago. This has been one of the best performing stocks on the UK market since it IPO'd around 4 years ago. It actually rose around 700% at one point. It has come down a little bit at the moment. Shore Capital also out this morning saying the worrying thing is the amount of stores that Boucheray has over in the US, where Watches of Switzerland, which is listed in London, gets around half of its sales, and that's where it could be hit in terms of competition. It's a big shock for the watches market in terms of the retail view there.
Yeah, big move by Rolex, isn't it? In terms of CMC's markets, we've got some earnings coming through. How's that looking?
So CMC given a very, very negative update on the market, saying subdued conditions have continued through August, with trading revenue around 20% lower than it was last year. They say August has been particularly challenging due to subdued client trading, and profit could now only reach around 250 million, which would be well below what Bloomberg consensus shows on the terminal. Now, CMC actually gave a profit warning just a few months ago, and so did the big rival IG Group. There's worries that people will be cutting back on trading given the cost of living crisis. And also, these stocks tend to trade and track the VIX index, and the VIX index is very subdued. When volatility goes down, people trade less. These stocks probably going to be under a lot of pressure going forward.
Joe, good morning. You're looking at Aston Martin as well, which over the last few years, the stock price hasn't done great, but it's having a good year so far. What's the latest?
It's doing very well so far, as you mentioned, Mark, up around 100%, and I'm very excited about this one because my old mate over at Jefferies, Philippe Houchois, I've been following his ratings since Aston Martin listed. He's always been bearish. For the first time ever, he reckons we should be buying this stock. I've spoken to him a number of times, interviewed him, and he's always been downbeat, but he's saying that capital injections have fixed the balance sheet on this stock, and the outlook is more encouraging than ever. The DB12 SUVs and the Vantage models are going to drive sales. Finally, he goes buy on that one. We can see it down 92% over the past 5 years, and it is time to buy it, according to Jefferies.
Time to buy Aston Martin from Philippe Houchois, who's been focused on that sector for a long time, an analyst with some really interesting views. Joe Easton, thank you very much indeed on the luxury car space with Aston Martin in focus. It says here on the prompt that we're going to chat Beyonce, maybe Taylor Swift. I think we tie this to the economy, don't we? I think we tie this to the reporting, or at least the analysis by Bloomberg Economics on the lift that has come through for the US economy from Beyonce, from Taylor Swift, and from half our production team, it seems.
Yeah, exactly. I don't personally have experience of seeing either Taylor Swift or Beyonce live. I do have experience of both parts of Barbenheimer, so I speak with huge authority.
You know who is a Swiftie?
On this subject. One of our producers, for sure.
Yeah, and Mark Cudmore.
And Mark Cudmore. He's here, he can respond. But anyway, the serious analysis here, Bloomberg Economics saying, I think those earrings alone on that video, sorry, they add to the US economy. But I should point out the serious stuff here is that Bloomberg Economics actually thinks that the combination of Barbenheimer, Beyonce, Taylor Swift on tour, that adds $8.5 billion to Q3 GDP for the US economy. That is up by 0.5 percentage point. I don't know what you think about either the earrings or that analysis, Mark.
Yeah, I don't know how you know that I'm more of a Swiftie than a Beyonce fan, but anyway, I'll leave that there. I do think it's ridiculous how often this year we have talked about Taylor Swift and Beyonce and other dynamics like this affecting inflation. I feel this is something, it's entirely new to economic analysis, and I have not caught up with this trend at all. I will admit, though, while we're getting excited about Barbenheimer, Taylor Swift and Beyonce, I've just been getting excited during this show ever since Tom mentioned moose or meese and crocodile shapes about the number of times buffalo can be in the show. You think I'm doing a live TV show. I've actually fallen down a rabbit hole of Wikipedia on the number of times of buffalo in a sentence, which is what I really care about Jackson Hole this weekend.
But yeah, Mark is having a whole other parallel conversation. Tom, I don't know if you managed to make any sense of all the things Mark's been telling us about buffalo during the programme.
Well, the verbiage is interesting. We've managed to crowbar in quite a bit of wildlife, but I think you should plug in London Boy from Taylor Swift and take a listen to that, Mark. It's our producers have been we touched on it. Our producers have been doing their bit, Mark. So Eileen went up to Edinburgh, spent about 500 quid, probably tickets, merch, hotel. So there's that lift coming through. It's not just a US phenomenon, it's a global phenomenon. But plug in London Boy, Mark.
I will have my Taylor Swift dance ready for Monday.
Excellent. And that might be with the accompanying Jackson Hole hat accessories, or it might not be. Back to the serious business of markets. If I could just divert us there just for a brief moment. NASDAQ futures down 0.4%, Mark. What happened to all of the AI hype and excitement of yesterday?
Yeah, again, it's really terrible price action. Look, I have to say, I wasn't expecting August to be this bad. I thought we'd recover a little bit better going to Jackson Hole. The price action's terrible, and the dollar continues to be strong. What's happening in yields doesn't surprise me as much. We're catching up with my narrative of higher yields, but I am surprised we haven't seen the dollar give back a few gains into the weekend and equities recover. It's pretty negative, so people really better have their fingers crossed that Powell delivers a supportive message this weekend.
Okay, Mark Cudmore, thank you for spending the past hour with us. The analysis and the wildlife mentions with Moose on his mind. Mark Cudmore, as we lead up to Jay Powell, thank you. The Open is next. European futures pointing lower. Bit of a holding pattern ahead of that speech. Plenty more coming up, including, by the way, the Open. This is Bloomberg.
Would you say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's certainly been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
York City.
In London, in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
A few minutes to go until the start of cash equities trading. Welcome back to Markets Today. I'm Anna Edwards in London with Tom McKenzie.
And here are your top stories. Traders await Jay Powell's speech at Jackson Hole for clues on the interest rate outlook. Christine Lagarde speaks exclusively to Bloomberg after the ECB president gives her address in Wyoming, as some of Europe's top central bankers hints that more hikes are possible. And China unveils further mortgage easing policies to bolster its property market in an attempt to support the world's second biggest economy. Any of the gains that came through on Chinese markets faded pretty swiftly after that announcement. Focus, of course, on Jay Powell, but I noticed as well Nasdaq futures pointing lower once again after the pretty heavy sell-off yesterday.
Yeah, it didn't seem like that excitement around NVIDIA lasted all that long in the market's thinking, did it? Let's have a look at a few assets then as we run up to the start of the final trading week, day of the week here in Europe. This is the picture on MSCI Asia Pacific, down by 1.25%. This is the Wall Street negativity of yesterday that followed the elation of the NVIDIA numbers. So Asia catching up with that sell-off on Wall Street. And we put in here what was happening to the Chinese currency, because we did see that the Chinese currency pared its losses earlier on the back of those headlines that Tom was just talking about around the property sector. More on China in a moment. Nasdaq futures are down 0.5%, though, really looking to pick up where we left off with sort of unwinding some of that positivity and build-up that we saw into those NVIDIA numbers. And I put it in iron ore as well. It's up another 1.9% over in the Asia session, and that can sometimes be of influence in London. And we are expecting, actually, on the futures picture, I think, Tom, for the London markets a little different from the others.
Yeah, it's a bit of a standout, which is interesting because year-to-date it has underperformed, but you're back above that 7,300 level. Futures pointing flat for the FTSE 100, and a different picture on the DAX, pointing lower by 0.4%. And over in France, you're looking at losses of maybe 20 points leading up to the open.
Okay, so we'll keep an eye on what's happening with the FTSE 100 today, given what we just showed there on iron ore prices. As the team loads the GMM screen for me, we can see where we are at the start of the European trading day. So we have been expecting that the London market might do a little better today, and it is pretty flat, actually, out of the blocks. We are seeing risk aversion elsewhere, though. That certainly was the theme through Asia, and we see that in the FX markets. We've got money going into the dollar, coming out of the euro, out of the pound. Interesting to see 107.82 on the euro right now as we wait for Christine Lagarde to speak after Jerome Powell over at Jackson Hole. How will the euro fare through the weekend? Could be an interesting one to watch. This is what we have on the European economies then, or European markets, sorry, as they open up. The German DAX down 0.25%. The French CAC 40 down by 0.2%. We'll be focused on Christine Lagarde, what she has to say a little bit later on about the negativity we've seen in that high-frequency data, Tom, coming out of the Eurozone. For the moment then, sell-off in stocks, and markets are also selling sovereign bonds, it seems, with those yields going a little bit higher. So we seem to be back to the themes that dominated at the start of August.
Absolutely. Higher yields, bad news for technology. The sell-off there yesterday that you outlined for us, and that continues today. The sector currently down around 0.9% on expectations that maybe yields will have to go higher, maybe rates will have to go higher, and that's going to offset the lift coming through AI. Interesting to hear from BlackRock's Wei Li earlier. They are very constructive on developed markets, AI, and they continue to build positions there. Energy is one of the sectors that remains in the green today, up 0.3%. Basic resources is one to focus in on as well. Currently flat, but you've seen a bit of price expectation around iron ore that maybe you're going to get a lift there on the back of a boost of steel production in China. That question remains open. Banks are currently gaining just 0.1%. High yields, obviously good news for banks. We have a number of guests suggesting that maybe European banks are a bit of a buy in this environment. Utilities, flat. You're seeing a mixed picture across these equity markets. The standout really, as I mentioned, technology is the sector currently down 0.7. Construction materials also off by 0.3, but a little bit of upside coming through for energy, up 0.3, and basic resources gaining 0.1%. of 8% this Friday.
OK, let's get some breaking news. A red headline across the Bloomberg then, Tom, from the brewing sector. And this is to do with Heineken. Heineken has said it has completed a deal to sell its assets that are in Russia and to leave Russia, becoming one of the few consumer companies to successfully withdraw since Vladimir Putin's government shifted rules, of course, to make exiting the country more difficult. So the Dutch firm, the Dutch brewer, is taking a €300 million loss on its Russian assets, and it's selling these assets for just €1 to the Honest Group, a consumer goods business, Russian-based packaging and consumer goods business, the Honest Group. So Honest paying €1 for the Russian assets of the Dutch brewer Heineken. This, of course, goes back to when Putin signed that decree back in April that allowed for temporary state control over the assets of companies or individuals from quote-unquote unfriendly states. So this is where we are on the Russia story, as European consumer-facing businesses have been trying to exit. Some of them have achieved that, and some of them have found it difficult. Some have just had their assets taken and have sort of lost touch with the management teams in place. So we'll continue to watch that one and see what impact that has on the shares. Let's step back, though, and take the broader view of markets. Sam Onstead joins us from our Markets Today blog with a look at themes driving sentiment. And it's interesting, isn't it, to see the decline in tech stocks that we saw yesterday and into the Asia session then, Sam, because NVIDIA did seem to offer a glimmer of hope. You know, the numbers were better than expected, and that certainly boosted that share price and the broader markets for a time. But then both started to lose their luster, and now we find ourselves with a sort of weak Asia session and Nasdaq futures looking weaker.
Yeah, I think what you saw happen over the course of yesterday was that NVIDIA's numbers came out, hugely anticipated, and an enormous company as well. There was sort of a broad exuberance throughout the morning, and then I think what it became was just an NVIDIA story rather than a story about everything in all of markets. And everything started to move back to interest rates, to central banks. And Jackson Hole now today is sort of taken on increased importance because of those moves. And with everybody now looking into that and looking into, you know, what the rate path is for all the major central banks, rather than any boost that NVIDIA can give to sort of anyone else beyond themselves and the AI story.
Sam, on the China story, there's a couple of interesting reports and lines coming through from the team on the ground in mainland China, Hong Kong, for us today. One is the changes around mortgages to make it easier for people to purchase properties in various cities across the country. The other is the news that regulators, Chinese regulators, are going to be meeting in Hong Kong with the likes of Fidelity and Goldman Sachs to try and pressure them basically around these outflows that we've seen, foreign outflows in terms of those investor flows into Chinese equities. One smacks of granularity, I should say, in terms of the mortgages, rather than any big overarching fiscal support. The other smacks maybe of desperation from regulators. I don't know how you read into this, but certainly the Chinese markets kind of turned off on this. There was a little bit of upside, but that's faded very quickly.
Yeah, that's interesting, Tom. It's actually, that's a really interesting point, that you did see this nice spike, particularly when the mortgage story came out this morning. Property companies starting to go up. But I was talking to Sophia Hortry-Costa on the Markets Today blog, who is, of course, our China expert. And she kind of said to me that, you know, this is a broader move, the mortgage one. It's broader, but it's still not quite what people are looking for. And it is still China trying to boost the economy through the property sector, when there's always the talk about trying to reduce the reliance there. So that seems to have not necessarily been taken as well. However, I would also note, though, you know, the property sector, hugely important for mining stocks. And that is likely also why the FTSE 100 is performing a little better today, along with oil being up.
Yeah, Goldman have downgraded their target for Chinese stocks earlier this week by about 4%. And you had Morgan Stanley coming out just a few hours ago, lowering their price target for Chinese stocks for the second time in 3 months. Sam Onstead, thank you very much indeed for breaking down some of the key market themes. Of course, from our Markets Today blog, you can get more from Sam and the team on the front page of the Bloomberg UK website, or by typing TLive Go on the terminal. Now back to the main event of the week. The Kansas City Fed's annual gathering, of course, in Jackson Hole is underway. Traders are watching the jam-packed two-day symposium as central bankers for any signs on the policy path ahead. Bloomberg's Michael McKee breaks down the schedule of the two-day conference.
Friday's symposium comes in two parts. One of interest to global Wall Street at 10 Eastern, when Fed Chair Jay Powell speaks, and later at 3, it's ECB President Christine Lagarde. Neither is likely to deliver what investors want, clear clues to the timing and path of interest rates ahead. Instead, expect them to reiterate inflation is bad and they will keep the rate pressure on. What they won't say is whether that means higher rates longer, or both. In between their keynotes, the central bankers and economists here will turn to the topic of the symposium, structural changes in the global economy. The post-pandemic economy already looks different. They'll discuss what that means for monetary policy, but in the longer run. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
Okay, let's at this point bring in Maria Stehly, Senior Portfolio Manager at Fish Asset Management. Maria, good morning. Thank you for joining us. Financial conditions have tightened arguably over the last week or so, Maria. How much work has that done for the Fed?
Yeah, good morning. So financial conditions had to tighten. I think the last couple of months that we have seen over the summer, that was a little bit of a summer fairy tale almost, driven by the liquidity injections that we got after the regional bank turmoil. That had to fade at some point. We knew that was going to be temporary in terms of the liquidity boost, but it had an effect on markets, and it drove this optimism in this sort of soft landing narrative that we've had over the past couple of weeks and months. And I think it's very telling that now that we are out of this regime again and real rates are creeping higher again, that we are going back to more fragile markets and more concerns about the global economy.
Would you define, good morning to you, Maria, would you say that the US has achieved a soft landing already? I mean, when you look at how far they've come on inflation, down to a 3 handle, unemployment still with a 3 handle. If we'd thought about what a soft landing looks like when inflation was up at really elevated levels, might we have defined it like something like this? I mean, I know inflation's not at target yet, but still.
Yes, I don't think that we have achieved a soft landing yet. I think it's far too early to tell. I would say that it's also not the moment where the Fed is going to really hint at changing an inflation target or something in that area or considerations like that. I think at the moment the Fed is trying to bring inflation down to 2%, and I think they're going to do that no matter the cost. At the moment, it's important for them to achieve that target, and then after that, they can talk about longer-term considerations. And I think that's also framing a little bit how they're going to put the message out in Jackson Hole this time around. I think it's hard to really address anything else right now while you're still trying to achieve that mission. That seemed to be relatively challenging in this cycle.
You're staying defensive as a result of that analysis, Maria. What does that defensive posture, what does it look like?
We are credit investors, and as credit investors, we are always more worried about the downside than the upside. But generally, I think we have come a long way since March. There has been a very strong fear in the market, and spreads were relatively wide after the regional bank turmoil. But there was also a tactical long in our portfolios for some time where we have benefited from higher spreads, and where we also have benefited from a rally in interest rates. But now we are moving back to this more strategic underway towards beta, because we just don't think that it's going to go without leaving any marks in risk premia. Growth at the moment, in our view, is more fragile than inflation. And so we are worried that, the soft data that we are seeing coming out below expectations, especially as we saw PMIs this week, is going to translate into hard data, which currently still seems to be robust, but we think it's going to transpire into more fragile actual hard data. And so, yes.
So we'll pick up on that thought shortly, Maria. Thank you. Maria Stehly stays with us, giving us their thoughts there on growth being more fragile than inflation. Gives us a good place to pick up the conversation shortly on Europe. Also coming up on the programme, we will be focused back on Jackson Hole. Traders will be waiting for Fed Chair Jerome Powell's speech for clues on the rates outlook. And don't miss our exclusive interview with the ECB President Christine Lagarde. That is coming up, of course, later today. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but XPeng is XPeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
This is just starting, but I can tell you that we are going to be focused, of course, in the numbers for the economy, in the numbers for inflation, following up on what has been so far the monetary policy transmission that it's already in the numbers. We have to be cautious this time around because downside risks that we identified in June in our forecast have materialized. Yes. This is an inversion of what happened throughout the pandemic recovery, because usually we have been surprised in the upside.
Yeah.
This is in part, in my opinion, because the transmission of monetary policy is up and running. We need to take that into account in our decisions.
Mario, it's Alex in New York. So that seems like a pause for September. Would your vote be a pause for September? And if so, is that a peak?
Well, you know, we have been data dependent in our decisions. There's plenty of data still to be made available until the September decision. We have a new forecast. That forecast will tell us precisely how we see this transmission of our decisions into inflation and the economy going on, and we will decide in September on that regard. But it is important to keep in mind that inflation has been falling faster than its way up. We have been successful in our mission so far. It's probably too soon to call it as a down deal, but we certainly will have to focus on these numbers.
That was the Bank of Portugal Governor and ECB Governing Council member Mario Centeno speaking with Bloomberg's Alex Steele from the Jackson Hole Symposium. For more on what we can expect on the ECB story today, Bloomberg's Maria Tadeo joins us from Brussels. And the ECB, of course, is also part of the focus at Jackson Hole, even if Jerome Powell will be speaking first. But then we'll hear from the ECB. What kind of clarity are you looking for today, Maria?
Yes, Anna, and it is an important speech because this is the first time we hear from Christine Lagarde since that option for a hold or a hike was introduced in July by the European Central Bank. And you already see it play out in the Governing Council. You just had, and we just heard from Mario Centeno of the Bank of Portugal, suggesting the transmission is working. The downside risks to the economy are there. You've had the PMIs this week. A lot of that should factor into that decision in September. He wasn't really vocal in saying, I want to pause. But if you read between the lines, he does say, let's reassess when we get to there. When you look at the German Central Bank, and we also spoke with Joachim Nagel of the Bundesbank, he was saying it is too soon. The challenge for Christine Lagarde will be to, oversee this Governing Council, but also get to a common understanding where things are going. Are we going to get any clarity in terms of is it a hold or a hike in September? I doubt she will say that, but the tone of the speech will matter when it comes to that. And I presume she will reinstate the idea of data dependency, especially because when you head into September, you will have new forecasts from the European Central Bank.
Maria, thank you very much. Been both Maria Tadeo with a briefing on what to expect from the ECB. Let's get back to our guest, Maria Staley, Senior Portfolio Manager at Fish Asset Management. Maria, thanks for bearing with us there. And interesting to pivot now to your views on Europe. Maria Tadeo just setting out the weakness of the data that we've seen of late. Are you expecting then, with that as the backdrop, to get clues around a hike or a hold for September?
So our view is that Europe is more vulnerable to global risks than the US, but at the same time, we think Europe is behind in achieving actual success on inflation. And so the path towards a soft landing in Europe is much more narrow than in the US. And so I think it's particularly challenging for Lagarde to unite those differing views in the Governing Council. There is many different views, as we've just heard from Centeno and from Nagel as well. That is very challenging. We believe that the ECB needs to continue hiking. It's not the moment yet to pause. One additional hike may actually be enough, but that needs to happen. And we believe that in Europe, it's particularly important to look at the manufacturing sector, which is very weak at the moment. And as well as we've seen in PMIs now, services are also starting to deteriorate in Europe.
Yeah, so the weak data is there. Certainly, we got a reminder of that this week out of Europe, France and Germany, of course, at the forefront. But nonetheless, you still think there's an additional hike that needs to come through from the ECB. What about credit risk then, Maria, across the Eurozone in the face of these higher rates and this deteriorating data?
Well, in Europe, we are particularly concerned about the manufacturing sector, as I've mentioned. But for credit, we have to be also very differentiated in terms of what market segment we're looking at. And we are not concerned about investment grade markets at the moment. We actually do like European investment grade markets because there's also a relatively large market share that is located in other geographies, right? We have a lot of US companies also issuing into the Euro market. And so this is a relatively important market segment that we like. Relative value of European IG markets is good. We are trading still wide to the long-term median spread. Arguably, you can say that the median spread has been skewed lower by corporate QE over the past decade, but still relatively good value in European IG markets. You have to be aware of some market segments that could turn out as value traps, of course. You have to, of course, also deal with higher volatility in parts like real estate, etc. But still, we do like European IG credit. Going down into lower quality market segments, we turn more and more cautious. Refinancing in high yield corporates could turn out as a risk factor. They have been very benign so far, and high yield corporates have done a good job in refinancings. But still, we want to be aware of that and price that.
Okay, so watching for those potential refinancing risks, but still liking investment grade in Europe. Maria Staley, Senior Portfolio Manager at Fish Asset Management, thank you for joining us this morning. Coming up, watches of Switzerland plummets after Rolex makes a major retail move. We're going to get your stocks on the move next. This is Bloomberg.
deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back. Let's get a check on some individual stock moves this morning. Joe Easton from our equities team joins us. Joe.
So watch of Switzerland absolutely hammered in the early moments of trading, down 29% now. As a reminder, we got news last night that Rolex is buying the retailer Boucheray, and Watches of Switzerland is the main retailer of Rolex watches, and investors are worried that this will wipe out some of their market share. So that, you won't be surprised to hear that that is a record drop for the stock, and it's wiped out a lot of the gain that we've seen this year as well. Now, we've just had a statement out from Watches of Switzerland, unscheduled, 15 minutes before the market open. You can tell things are not going well when these statements come out. They say that this is not a move by Rolex into retail, and it shouldn't be taken as that. They say it's all about succession planning, given the age of the Boucheray founder, and that is why Rolex is doing this. But the market not liking that at all, as I say, now down 40% year to date, wiping out a huge rally after it IPO'd around 4 years ago. We're also going to look at CMC Markets, another big dropper here in the UK, warning of a slowdown in trading activity. Retail traders shying away from the online trading market given the cost of living crisis. They say August has been particularly weak, that one down 19%. And then Aston Martin, the best performer in the UK after Jefferies finally says buy that stock. All three stocks to watch, shares going the right way. Miracles do happen. We're also going to have a look at the miners quickly and the chip stocks. Chip stocks coming down once again, that Nvidia rally fading, the Fed in focus, miners coming up after a bad day yesterday. Keep an eye on those sectors this morning.
Joe Easton from our equities team, thank you very much indeed. Worth noting that sentiment is changing, turning a little bit more positive across Europe and European space, the stock space, the benchmark currently flat. The FTSE 100 is doing okay, though, up 0.3%, adding 20 points, 7,353. And across your sectors, just briefly, top of the list, basic resources getting 9/10. Plenty more coming up. Stay with us. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
This is Markets Today, 30 minutes into the European trading day. Here are your top stories. Traders await Jay Powell's speech at Jackson Hole for clues on the interest rate outlook. Christine Lagarde speaks exclusively to Bloomberg after the ECB president gives her address in Wyoming, as some of Europe's top central bankers hint more hikes are possible. And China unveils further mortgage easing policies to bolster its property market in an attempt to support the world's second biggest economy. And Tom, we'll get to some of the China lines in a moment, but it's not just around the property market. There's income tax, there's stock trading being talked about once again. So lots to talk about with China. This is actually relevant for European stocks. It seems to be boosting commodities-related things.
It is, across commodities, across WTI, Brent, copper and iron ore, all turning around, prices higher. And that is feeding into basic resources as a sector, and that is lifting the FTSE 100 here in the UK. 7,356, adding 0.3%. So not a bad session so far this Friday for the FTSE 100, given where futures have been pointing prior to the open. Over in Germany, the DAX is gaining a more modest 0.1% of 15,631. And across the benchmark here in Europe then, adding about 0.1% after the losses of yesterday. You had 3 straight days of gains, losses yesterday led by tech, and you saw that again play out in the US, and profit taking arguably on the run-up from Nvidia, and question marks about how higher rates and higher yields are going to play into tech. That led to a sell-off. Today, though, it is slightly brighter picture given where futures were pointing. But of course, what we hear from central bankers, given the divisions at the ECB, but most importantly, Jay Powell and that speech, whether or not he really can offer some clarity is going to be, of course, consequential for these markets in terms of the direction of travel for the Federal Reserve. Across the sectors then, let's flip it over and see what is leading the charge. Anna talked about energy, we talked about basic resources, we talked about the linkages to China, moderate measures that are coming through from that economy, moderate measures that are coming through from those officials, but nonetheless adding up arguably to something possibly a little bit more consequential, a flurry of modest measures, and certainly a little bit of a lift then for basic resources and iron ore and copper. There you go, 0.9%, the clear gainer across these sectors. Energy also up about 0.7%. Financial services is in the red, taking a loss of about 0.1% so far in the session. Tech is lower again, down about 0.1%. Construction as well as a sector also off in similar territory as well. But again, broadly, the sentiment just marginally more positive, Anna.
Yeah, absolutely. Let's get some further analysis on these China themes then. China has unveiled a further easing of its mortgage policies to halt a slump in the residential property market and try to revive growth in the world's second largest economy. Beijing will also extend personal income tax rebates for people who buy new homes. That, I think, is a regional policy, and we're just hearing talk about changes to stamp duty as well. So, to Tom's point, a murmur of modest measures perhaps coming through from Chinese authorities. We're joined now by Bloomberg's James Mager in Beijing, who can talk us through all of these. So run us through the threads of these policy announcements that we're seeing, James. What are we hearing about today?
Well, the first thing, I think, which is the biggest announcement today, is on the housing market. The government is now going to allow people who previously had a mortgage, previously owned a property, have paid off their mortgage and have sold that property, to now borrow money again as if they were a first-time home buyer. And they were unable to do that previously because the government was trying to crack down on speculation. And so if you'd owned a house before and you'd sold it, you couldn't then use that money to buy a bigger house or a larger house, or to trade up and get the first home buyer benefits of a lower interest rate and lower down payments. So what this is going to do is it will probably encourage people who have a home, who want to get a bigger home, to sell that property and then take advantage of these better interest rates that they will get access to. However, the issue with this is that these rules weren't being really enforced in a lot of the smaller cities in China anyway, because those smaller cities do have some freedom to set their own mortgage policies in smaller provinces. And they weren't enforcing them because they were already trying to boost their own housing markets, which have been slumping for 2 years now. So the real benefits or the real changes from this new policy will come in the bigger cities, Beijing, Shanghai, Guangzhou, Shenzhen, which have been much more strict about enforcing these policies. But that's only about 3% of China's housing market. So this is going to be beneficial for the biggest housing markets, and the biggest cities, but I don't know if this is really going to have a massive effect on stimulating demand across the economy. And for these other policies that we're talking about, a reduction in stamp duty has been mooted for quite a few weeks now as one of the efforts the government is going to, one of the things the government is going to do to boost stock trading. If you have to pay less stamp duty each time you sell and buy stocks, that's beneficial for stock markets. And there was a bit of a rise when that news first came out, was first leaked. And also, obviously, income tax benefits for home buyers. This is also going to be beneficial. But I mean, what you're seeing here is each individual province or each individual government ministry, the housing ministry, the securities regulator, bringing out little piecemeal policies on their own to try and help the economy in any way they can. It's not really a joined up kind of economic stimulus plan of the style that a lot of people are expecting or at least hoping for.
James, we appreciate you putting aside the Kweitao Maotai, strong distilled liquor, on this Friday evening where you are in Beijing to join us. Is this the playbook then from officials, from ministries, from the government of China to address the economic concerns? Or does it have to change to address the downside that we're seeing and the pressure on China?
I mean, I think at this point it's almost September, and the economy has been slowing since April. I mean, the data from April on has been getting weaker and weaker, and I think at this point you have to say this is the strategy. They've had increasingly bad data, and then the government is looking at it and saying, this is fine. In a sense, they are bringing out piecemeal stimulus measures. They are looking to things around the edges. But I think, at least based on their actions, you have to assume that the government is looking at that and saying, look, we want to deal with the structural problems that China's economy is facing. There still is oversupply of housing in China. There still is, the market is not at a point where you're providing enough houses for people, where you're not overstimulating the housing market. There's still speculation going on. They still want to get speculators out of the housing market. There's still a lot of housing companies that are clearly going to fail, but haven't failed yet. And so from the actions of the government, companies like Country Garden, which are about to default, the government clearly seemingly wants that to happen so that they can de-risk the financial system, de-risk the economy, and then move forward. So I look at it in the sense that the government is trying to do enough to make this a softer landing, but they're not looking to radically change the direction they're traveling.
Yeah, moral hazard is clearly a factor that they're weighing up as well. James, thank you very much indeed. Go back and enjoy your Friday evening. We appreciate it, joining us out of Beijing on this flurry of measures, moderate piecemeal measures coming through from Beijing. And of course, what happens in China is consequential for Europe. And talking of Europe, the ECB Governing Council member, Joachim Nagel, says he's not convinced that inflation is under control, from the Bundesbank, of course. Not enough in terms of the need for a halt in interest rate hikes. He doesn't think we're there yet. He spoke to Bloomberg's Mike McKee at the Jackson Hole Economic Symposium.
It seems to be in Europe that the labor market and the similarity with the US is really pretty good. So we have a good labor market situation, but the economic activity is slowing. This is for sure. But this is not a surprise to me. I think when you're hiking interest rates 9 times, it's for sure that there is an impact on the here, and we are seeing this, and this is good and bad news. Inflation is coming down, core is still sticky, and so the next months we will get more information about this.
Well, do you think going into it at this point you would lean towards pausing? There's a split in the markets about it, and there seems to be a split on the governing council among those who think you can wait, take a look at what's happening with the economy, and others who think we still need to do more.
I think it's, for me, much too early to think about a pause. I think we have to wait for the next numbers. So we agreed in our July meeting in the Governing Council that we will wait for the numbers we will see in our September meeting. And I will more or less follow this path. I will wait for the September numbers and then we will see.
You're in a kind of interesting position because historically the Bundesbank has been the most hawkish, the most opposed to inflation, and yet the German economy is one of the weakest in the Eurozone and in the EU now. So how do you lean in a situation like that?
Maybe, first of all, I hear a lot of talk about Germany, the sick man of Europe. This is definitely not the case. We shouldn't underestimate the adaptation capacity of the German economy. Yes, we are going through some, let me say, complicated months, this is for sure, but I'm not too pessimistic. There's also no time for complacency, this is also for sure. We see what is necessary to do, and I have a lot of trust in German politics that we go into the right direction, at least for next year. And when you're talking about monetary policy, what I said is that we have to be stubborn here, even more stubborn than inflation. This is what we have to do. This is our mandate. We have to bring inflation down to 2%. And I guess there's this overall understanding in the Governing Council that this is our mandate, and we will more or less be pretty focused, and we will do our job.
That was the ECB Governing Council member, of course, the president of the Bundesbank, Joachim Nagel, speaking at Jackson Hole there to Mike McKee. Now, Germany's economy, as Mike mentioned, is facing some challenges. It exited a recession by the slimmest margin in the second quarter, but its sluggish performance continues to drag down growth across the whole euro area. Let's bring in then, for more context, Bloomberg's Western Europe economy reporter Jana Randau. Jana, he kind of bristled at the idea that Germany is the sick man of Europe and suggested that a soft landing is still possible for Germany in the Eurozone. Does the data back that up?
Well, ever the optimist, Joachim Nagel there. The data tell a slightly different story. Yes, we exited the recession. The economy stagnated in the second quarter. But whether that's really good news, I'm not so sure, because if you look a little deeper into the data, there is a lot of trouble ahead. We saw an export slump of more than 1%. If you look at the global slowdown, the Chinese economy, then you know there's more trouble in the cards there. Private consumption is only stalling, and that, of course, tells you that high inflation, the ECB's interest rate increases over the past year, they are now taking a toll on the consumer. They are staying home, and that is backed up also by the services figures we saw earlier this week. And then, of course, we saw a build-up in inventory, which just shows you that demand across the economy is weakening. And taking all that together, the outlook really isn't all that great. We're expecting business confidence data later this morning, and also there, economists expect another decline. So we might not see a big slump, a big deep depression style a slump in Germany, but certainly for the next months the outlook is bleak, it is gloomy, and you know, I'm a bit puzzled where Joachim Nagel takes his confidence from, but you know, maybe the data will prove him right. We'll definitely stay tuned.
Yes.
and check.
Yeah, we certainly will do that. I mean, maybe he's reflecting on what could have been a worse performance, I suppose, for the German economy. In many people's eyes, the expectation going into last winter, Jana, you'll remember it well, was that the German economy would struggle so much given the energy challenges that were being thrown against it. Perhaps he's just reflecting on some of that resilience relative to expectations. But we'll have to ask him once again next time. Thanks so much to Bloomberg's Western European economy reporter Jana Randau for joining us. Coming up on the programme, it is Friday. Are you hitting the pub after work or staying in for a drink? We look at how hungry developers, stay-at-home drinkers and rising prices may all be spelling doom for Britain's boozers next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg.
Welcome back. It's Friday, so we thought we'd dabble in luxury watches. Prices for the most popular high-end watches from Rolex and Patek Philippe kept falling over the past month, even as mid-tier timepieces from brands like Cartier outperformed. The Bloomberg Subdial Watch Index, which tracks prices for the 50 most traded watches on the secondary market by value, declined by 1.1% in a month, and it is a trend. Joining us now is Bloomberg's Andy Hoffman. Andy, what is driving this performance then on the index the past month? And do we expect further softness in terms of the pricing? It's all relative, isn't it, for the likes of Rolex and Patek in the weeks and months ahead?
Indeed. Well, I mean, what we're seeing here basically is that, the secondary watch market, which we track closely using data from Subdial, and it's basically on the same trend that it's been since March, April 2022, which is in decline. That's prices for the most in-demand references from Rolex, Patek Philippe, and Audemars Piguet. They're still going down. They went down about 1.1% in the past month. However, that is still a slowing of the pace of decline that we saw last year, which was quite violent and severe. So things are starting to even out.
Okay, starting to even out. And why is Cartier outperforming in that context?
Yeah, it's interesting. So obviously, Rolex, AP, and Patek watches are much more expensive. Cartier prices around £5,000. That's what they would average for a Cartier watch. These watches are also much more available at retail, and they've shown a price pattern that has been much more stable. And in fact, the Subdial data shows that prices for Cartier watches have gone up by about 1.6% over the past 30 days. That's for an index of 25 Cartier watches. And that is in contrast to the Bloomberg Subdial Watch Index, the 50 most traded watches by value, which has declined. And that's, there's a lot of reasons for that. The major one being that Cartier watches are readily available and you can buy them. They also trade below their retail price on the secondary market, but they've shown stability.
Yeah, because that demand for Rolex and Patek, as you said, is still really red hot, isn't it? Other big news in the luxury watch space this morning, Rolex buying the luxury retailer Bucherer. What are the details there, Andy? How significant is this?
This is a huge surprise, and this has the potential to really upend the luxury retail watch market. Rolex has never owned, with the exception of one store here in Geneva, Rolex doesn't own retailers. Now it will own Bucherer, which has about 100 stores across the world. It's a Swiss company, privately owned, estimated to be worth, by the way, as much as $4 billion in terms of valuation. That's by Von Tobel. Now, this is a threat to other Rolex retailers, like the UK's biggest Rolex retailer, Watches of Switzerland. We saw those shares fall as much as 25% this morning on concerns that they won't get the allocations, or concerns that Bucherer, a retailer that Rolex now owns, will come to dominate retail sales of Rolex watches, the biggest brand.
Andy, thanks very much. Bloomberg's Andy Hoffman with the latest on the watch market. A nice story for a Friday to another story for a Friday. Pubs have been part of British culture for hundreds of years, of course. But numbers have dropped sharply in recent years. According to the British Beer and Pub Association, more than 560 pubs closed in 2022, more than either 2020 or 2021 during the height of the pandemic. So what's driving down the number of pubs in Britain? Bloomberg's Helen Chandler-Wild wrote the story for Bloomberg and joins us now to talk us through some of the details. So why are these pubs shutting then, Helen? Is this the aftermath of the pandemic, or is it more to do with pricing pressures? What's the story?
Definitely both of those things play a huge part. The pandemic being shut for months is not good for any business. And as well, inflation hit them massively, and so have gas bills. So the average energy price cost even for a pub is over £18,000 a year with all of the increases. So all of those things have definitely had a big impact in the last couple of years. But also pubs have been shutting for a really long time. So since 2000, we've lost a quarter of our pubs. And that is due to some longer term shifts in just consumer habits as well. So people just tend to drink a bit less than they used to and go out a bit less. And there are just more options of what people want to do in the evenings now. So a lot of people might go to the gym or like go out to a cafe or something rather than spending every single night in the pub.
The gym versus the old boozer, the sticky Ford boozer. What's happened to this great nation, Helen? Is there anything, Helen, is there anything they can do just briefly? Anything they can do briefly to stop this collapse in pubs across the UK?
Well, yeah, the government has helped out slightly by reducing the amount of alcohol duty on draft pints in pubs. So that was called the Brexit guarantee, which just came in with the most recent budget. So that has helped slightly by making pints about 11 pence cheaper each. But obviously that is not that massive. If you have 3 pints in an evening, that's going to save you less than 50p. It's not big. Yeah, one big thing that some pubs are doing is just increasing the number of their uses. So adding extra functions like a little shop or a post office, and that can help.
Maybe Helen, after 3 pints, you're struggling to count to 50 anyway. So.
Yeah, would 50? Yeah, maybe 50 feels a little better. 50p once you've had 3 pints. On the sad demise of the British boozer, those are not live pictures, by the way, people, but they are pictures of sticky floored boozers in the UK. Helen, really great read. Thank you. Helen Chandler-Wild joining us on the travails and the challenges around the British pub space. Coming up, it is, of course, all about Jackson Hole when you're not thinking about the pub. Traders will be waiting for Fed Chair Jerome Powell's speech. For clues on the rate outlook, we're going to be discussing that. Stay with us. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg. This is Markets Today. We're 55 minutes into your European trading day, and this is the picture for European stocks. Things looking brighter. The DAX is flat, but elsewhere, Tom, we have a better picture for European stocks. Basic resources, energy leading the way today. So it's a real turnaround from yesterday. We're not seeing technology positivity. Technology stocks under pressure, just flat actually here in Europe, and down 0.2% on NASDAQ futures. But even that is off earlier lows, isn't it?
Yeah, and our MLive team as well pointing out that the AI uplift that came through from NVIDIA around the tech sector in the US, well, that just bypassed Europe almost altogether. You saw losses. In fact, there's a leading losses coming through for the tech sector yesterday, and losses in the tech sector continue in Europe today by a more modest 0.1%. We've had a flurry of measures coming out of China. We'll see how those play out into the Chinese markets on Monday. Piecemeal, moderate, modest, but there are those measures coming through on everything from taxes to property to pressuring maybe some of the big fund managers in the West to maybe hold in and hold the line on Chinese stocks.
Yeah, and it does seem as if that Chinese story is doing something to boost sentiment around European stocks, isn't it? We have basic resources and energy perhaps rising on the back of some of those lines coming out of China. So we'll see, have to wait for Monday to see the impact over in China. Interesting to note, going into Jackson Hole, we have yields a little bit higher. Now stay with Bloomberg TV and Bloomberg Radio for our extensive coverage from Jackson Hole, including, of course, the most awaited speech by Fed Chair Jay Powell. That's at 3 p.m. London time, 10 a.m. UK time.
And, of course, Bloomberg's exclusive interview with ECB President Christine Lagarde. She's going to be speaking live with Tom Keane. Simulcast on all your Bloomberg channels, and the terminal, that's at 9 p.m. London time, 4 p.m. New York time. Here in Europe, slightly more positive, 0.1%. Futures over in the US, S&P E-minis up 1/10. NASDAQ futures, though, lower by 1/10 as we gear up for Jay Powell. That is it for Markets Today. Happy Friday. This is Bloomberg.
Would you say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better It's certainly been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
A very good morning. Welcome to The Pulse. I'm Manish Krani in Dubai. Here's what's coming up on today's program. European stocks, they're muted and risk sentiment wanes as traders await Jay Powell's speech and Jackson Hole for clues on the rate outlook. Christine Lagarde speaks exclusively to Bloomberg in Wyoming as some of Europe's top central bankers hint at more rate hikes. In just a moment, we'll bring you the latest business sentiment from Germany. Plus, Donald Trump surrenders to jail in Atlanta to be booked on charges that he conspired to overturn the 2020 election results. The former president posted his mugshot on social media. A very good morning. Welcome to the show. Let me take you straight to the European market complex. We're waiting to hear what the narrative is from Jackson Hole. That is the backdrop that we are looking at the moment. I can tell you in terms of the nervousness, it's whether Powell channels his inner Alan Greenspan rather than Volcker. We saw a little bit of a movement and news flow from China in the past couple of hours about bolstering the mortgage market in China, and that has given a little bit of an underbelly to risk. Just check out Watches of Switzerland at the bottom of your screen. Now, this is brutal. Watches of Switzerland down 27% as we're seeing Rolex move to buy a luxury retailer, Bucherer, 100 stores. Now, Watches of Switzerland say this is not a strategic move by Rolex into the retail market. Well, if you don't call buying 100 luxury stores a move into retail, I don't know what you do. But just to give you some context, Rolex produces 1 million timepieces a year. What does it do to those relationships of the the shops that actually sell you your Rolex, like Watches of Switzerland on Regent Street, indeed those mega stores around the world. Now, let me just bring you some of the breaking news in Germany. We've already had stagnation in Germany in terms of the GDP, but this is the IFO confidence index, 85.7. The estimate was for 86.8. Now, the current assessment index, 89, and the estimate was 90. So again, underneath on both of those. I want to look at the expectations. This is perhaps the most important. 82.6, and the market had anticipated a little bit higher than that. So on the expectations front, 83.6. This is obviously going to be another dagger in the heart of the German recovery story. It will be the only G7 country to contract in 2023. That is according to the IMF. Let me take you across the assets. This is what we've got. We're waiting for Jackson Hole. What will the narrative be on the rates narrative? We've got a poll in from 22V Research. 78% it's going to be about data dependency, but the short end of the curve is inching higher, above 5%. That has a direct, is it rates or risk that's going to drive the dollar? I'm telling you, it's rates. Get back to basics. It's rates. I mean, the dollar, by the way, is the imperial currency. That is the view from Dan Moss. The dollar is the fortress as China struggles with its situation. So money flows to the dollar on a risk-off narrative on the known unknowns within China. There are many more unknowns within China than knowns. Yields spike a little bit higher. Iron ore is up 2%. It's had a restocking narrative come through from China. Combined with that, the biggest weekly gain since June. The Chinese mills are restocking. And of course, you've got this new policy on mortgages. If you've had a mortgage before, don't worry about it. You can get another one if you're in China. It's just changing what a first-time buyer really is. Of course, dollar Turkey. Let me just show you 2 days of the Turkish lira. 7% rally yesterday on a 750 basis point hike from the Central Bank of Turkey. 25% is where we are on rates. Quite a dramatic day there. To Kansas City Fed's annual Jackson Hole meeting today. Will it be as dramatic? Joining me now is Maria Tadeo. Maria, good morning. Good to see you. What are we going to be watching for? We've heard from Nagel so far, but what do you think the main belly of the message will be from Jackson Hole?
Well, yes, Manis. And look, I think a year ago, when you look at the same symposium just 12 months ago, it was about really showing markets and proving and convincing that central banks were on the case for inflation and that they could tame it and complete their goal and their mission. And obviously, that is price stability. I think a year later now, we've seen this super cycle of very aggressive hiking policy. And the debate is now changing from how much to how much more is left. And then for how long. I think specifically, too, when you look at the European Central Bank, it is interesting the data that you mentioned and referred to when it comes to Germany at the start of the show, because Manas, ultimately, this is a country, and yesterday we spoke with the head of the German Central Bank, who is still saying it is too soon to talk about a pause in this hiking cycle, but at the same time is seeing this downturn in the economy. I was also very struck by the comments from Mr. Nagel yesterday with Michael McKee saying, I do not believe Germany is the sick man of Europe. And just to give you an anecdote here, there is a front page story by The Economist where Germany is referred to as the sick man of Europe. That has ruffled feathers in Germany, especially with the government. But I was surprised to see that also the central banker decided to weigh in on this and defend his country.
Yeah, and of course, everybody's going to have the different opinion. And we've already heard from some of the policymakers earlier, including that Bank of Portugal governor. What was the story?
Yes, and again, Bank of Portugal tells you a very different story. We spoke with Mario Centeno, who was pointing to the downside risks to the European economy. He did not openly call for a pause, but actually seemed to say it's something that the ECB will have to factor when it puts out their new forecasts in September, but also makes that decision, which then obviously takes us back to Christine Lagarde today in Jackson Hole. I think, man, is that you're starting to see maybe not clarity of what they do in September, but really the lines of debate here, and also the challenge for the head of the ECB. It's always the same situation here. She has to gather this governing council. She has to get to a consensus and get to a landing zone where everyone feels comfortable. But obviously, when you set monetary policy for 20 different countries, that's not an easy job.
No,
we have to be cautious this time around, because downside risks that we identified in June in our forecast have materialized. This is an inversion of what happened throughout the pandemic recovery, because usually we have been surprising the upside.
And that was Mario Centeno, head of the Bank of Portugal, again, on some of the lines and the debate that is going to feature, I'm sure, very heavily today. And how will Christine Lagarde put it all together in a speech? Will she give us clarity in terms of where they go from here in September? I really doubt it, because she will probably stress it's about the date, and they have the forecast that will come up in September. But it'll be interesting to see the tone of the speech.
Yeah, maybe her speech is actually probably going to be much more important, and what she says to Tom when she sits down, perhaps rather than Powell. They've both attacked the dragon of inflation, but neither of them have beaten that narrative, have they, Maria? They have ways to go there. Maria Tadeo on the setup for Jackson Hole. And we'll have full coverage from Kansas City Fed's Jackson Hole Economic Symposium throughout the day right here on Bloomberg. The surveillance team are on the ground. And also from Jackson Hole later today, don't miss our exclusive conversation with the ECB President Christine Lagarde at 9 p.m. UK time. Staying in the US now, but let's turn our attention to politics. The long-awaited mugshot is here. Donald Trump turned himself into an Atlanta jail to be booked on state charges that he conspired to overturn the result of the 2020 presidential election in Georgia. Trump maintains his innocence.
What has taken place here is a travesty of justice. We did nothing wrong. I did nothing wrong. And everybody knows it. We did nothing wrong at all. And we have every right, every single right, to challenge an election that we think is dishonest.
Bruce Einhorn is with me. Bruce, as ever, President Trump there, trying to win the narrative and make various statements. But for the first time, Greg and I were looking at this, for the first time since January the 8th, 2021, he came back on X, formerly known as Twitter, and he posted his mugshot. What is that about? Capitalizing on this infamy, trying to hold the narrative, his narrative?
Well, Manus, there are ups and downs for the former president of being back on what was formerly known as Twitter. Obviously, he used to use it quite a lot. He was suspended from it shortly after the attack on the Capitol on January 6th. Elon Musk, upon buying Twitter, reinstated the former president. Up until now, he has stayed away from it, kept to his own web social media site, Truth Social. So he's posted his mugshot. The risk for the former president, if he's using social media even more, is that part of his conditions for release in Fulton County, Georgia, is that he has to avoid doing anything that could potentially interfere with the trial. And one of the conditions was to not do anything on social media that could be seen as interfering with witnesses or other things that would violate the terms of the deal. So having an even bigger social media presence could potentially be risky for the former president. The fact that he has a mugshot itself is significant. This is, of course, the fourth criminal indictment that the former president has had in the last few months. In the previous ones in New York City with the alleged hush money to adult film star, the documents case in Mar-a-Lago, the January 6th related case in Washington, D.C. In all of those cases, the decision was made not to take the former president's mugshot because, of course, he's a very familiar person. Most people know and recognize him. In Georgia, the sheriff in Fulton County said, no, we're just going to treat him the way we treat everyone else. He's getting a mugshot. So that mugshot is now available on the former president's social media site. The other big news to come out of Georgia is Fani Willis, the prosecutor there, has now asked the judge to move forward the trial date, which originally she requested to be in March. She's now asking it to be in October. That's because one of the co-defendants in the case, Kenneth Cheeseborough, has requested to have a speedy trial to sever his case from the others. And the judge has granted that request. Fani Willis wants to now make sure everyone is tried at the same time.
All right, Bruce, let's see what comes next. Bruce Einhorn there, tracking the latest on Trump, handing himself in there. Coming up, it's all about Jackson Hole. Traders are waiting for the Fed Chair Jerome Powell's speech. The clues on where rates go from here. Oliver Kettlewell is my guest from First Abu Dhabi Bank. He joins me around the desk ahead of Jackson Hole.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Treasuries have retreated for a second day. That's ahead of the Fed Chair Jerome Powell's speech later on at Jackson Hole. Joining me now is Oliver Kettlewell, Executive Director for Fixed Income Fund Management at First Abu Dhabi Bank. This is your peak day for peak nervousness. 11 hikes, 5.25, 5.5 offered, the highest in 22 years. What you need to do now as a bond trader is decide whether we're trying to find what is higher for longer. Is that what Powell, you think, if you had to bet, is that what we're going to hear, higher for longer, data-dependent verbiage?
Yeah, I think so, because he's not going to be dovish, because then he risks undoing all the hard work that they've done over the past couple of years by retightening financial conditions. So I think he'll try and be balanced, but more on the hawkish side. But I think for fixed income, it doesn't matter. I think a lot of the repricing over fixed income you've seen this summer has been because of the debt downgrade, the supply issuance coming out, the big budget deficits in the US. That news flow is washed through now. So let's see what Powell has to say, but we're pretty comfortable with fixed income right now. You say it's a summer sale, and you'd be a buyer here. You've been on the phone to Stephen Major at HSBC. I presume the two of you got like a lot of action in the market. But with that in mind, you say it is a summer sale. Now, then you go to the other side, and you've got Bill Gross, a veteran of the bond market, who says get ready for 5. You've got Bill Dudley telling me 4.5, and a lot of other people pitching in there. Why are you comfortable with a summer sale? You and Bob Michael buy every dip? Yeah. With the other side of the trade too. Is it Bill Ackman? I think he was short US 30-year treasuries,
yes,
right?
He was short.
Yeah.
You're a buyer of his paper every day.
Yeah, I mean, look, I think above 4%, it's great value today. It's what, 4.30 or something, I think. Look, the year-end forecast for 30-year yields on BYFC, bond yield forecast on Bloomberg Terminal, is 4%. So if you get a 30 basis points drop in the 30-year, that's a 5-point gain. With a 2% carry thereabouts, you're making 7% potentially there over 6 months. Sorry, that's a lot of maths to throw at you in a short space of time. But the math is not my strong point. But I get it. I get a capital carry plus my 4% yield. I get a capital carry of 2, 2.5, whatever. So I'm at 6.5. And where am I going to be in 30 years, Oliver? You don't have to wait 30 years, Manish. You can sell it in 6 months and rotate back into equities once they've sold off. Yeah, but you're a little bit cautious about equities. I mean, by the way, I said to the producers this morning, have we maxed out on AI and NVIDIA? You know, have we had too much NVIDIA pie? Have you had too much NVIDIA pie? Are you bored to the back teeth of NVIDIA on Bloomberg TV? No, it's always interesting hearing about these tech stocks, and I'm jealous of, stocks. I'm just jealous of the people who are long. Yeah, I mean, actually, I have to give kudos to my equity colleagues. They had a bit of exposure to NVIDIA, so they did really well there. But in general, we're underweight equities. We think it's been led more by FOMO, not fundamentals. Everyone's talking about Goldilocks soft landing. We think it's not going to be a fairy tale. Think of the PMIs that we've had this week, Manus. They're all rolling over. They're all sub 50, apart from the US mortgage applications, the lowest since 1995. Yeah. PMIs in the bin. I mean, is this the beginning of a long? I mean, I'm the arch grouch. Is this the beginning of a long variable life? Rents will not come down quickly enough for my move to the United States of America. But is this the beginning of a long variable lag, and does that underpin then why you want to be a buyer of 10s, a buyer of 30s, and buyer of duration? Exactly, because people renew mortgages every 5 years. They renew car loans every 5 years or so. So consumers are going to get a nasty shock when they go to renew mortgages and car loans, etc., in the next few months. And I think those sorts of cracks are going to permeate through to the economy. And that's why you don't want to be in risk assets. You want to be in those safe haven securities, i.e. US Treasuries or IG bonds from this part of the world.
And your narrative as well, I mean, this is the performance on stocks. We're flat for the week. I mean, understandably nervous going into Jackson Hole. I mean, this time last year, it took a bit of a bath afterwards. But then, do you think, and we're writing a lot about what he will focus on or what the focus will be at this Jackson Hole. Now, I am not even going to try and define or star. You're supposed to be more intelligent than me. You're a bond person, so you should be able to do this. But the or star has come down even by the Fed's own admission from 3.5%. The neutral rate, in other words, not too hot, not too cold, the Goldilocks zone, 3.5 to 2.5. Do you think there's going to be a lot of verbiage around that? But really, is that a distraction?
Yeah, but look, I think it probably is around 2.5%. But it doesn't matter how quickly we get there, by the way, particularly for the bond market. I mean, I think investment grade and high quality double Bs can easily cope with rates being held high for 12 months. I mean, that's why we're so confident on that part of the fixed income market.
Do you think the market has just forgotten what normalised rates were?
Exactly. I mean, a lot of these bond companies and countries can roll over debt at these levels. It's the single Bs, the triple Cs, the stocks which are going to struggle.
I mean, we're just showing some high yield and some investment grade there, and you want to be longer of investment grade. How much talk has there been around your shop this week about China? I am just deeply mentally scarred by a lot of crises in the world after 35 years. Is China a big risk to that kind of compression of yields in IG and high yield?
I mean, China, it's such a... I feel like...
It's a big term, isn't it?
Yeah, no, I mean, every time I've come on your show the last 12 to 18 months, I feel there's been a policy announcement. I've kind of gone, yeah, I think this is the policy announcement that can turn the market for China. It doesn't happen. So I think, you know, once...
creatively calling second-time house buyers first-time house buyers is a robust policy response.
Exactly. They've got a new mortgage policy.
So if you were a first-time buyer, you can be a first-time buyer again.
I don't get that one either. So, I mean, they had that 16-point plan at the back end of last year. Remember this massive plan, and bonds rallied and then they fizzled out. So, look, I mean, we're staying away from China for the time being.
Okay, you can live without China. Let's see what we can live with after we speak to Christine Lagarde and Jay Powell. We'll hear from them today. Oliver Kettlewell there, who wants to be long the summer sale in duration, right here on Bloomberg. Executive Director, never under title, Executive Director for Fixed Income over at First Abu Dhabi Bank. Coming up on the show, plenty more from Jackson Hole, including our interview with the Bundesbank President Joachim Nagel, right here on Bloomberg. A very good morning.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
The catastrophe caused by the wildfire in Maui could have been avoided. Like recent fires in Colorado and California that between them took scores of lives, there were both natural and man-made factors. They share the same failing: risk blindness. Before we get into risk blindness, we need to get to grips with what we know about the Maui disaster.
Back in 2019, Hawaiian Electric said that they were going to start identifying areas that its power infrastructure may be vulnerable to wildfire or starting a wildfire, and that included flying drones over its power lines.
By 2022, it had submitted a spending plan to address the risks it had identified. By the time the fire struck, that spending had yet to be approved. The official cause of the fire is still undetermined, as Hawaiian Electric has pointed out. The utility says it is working with officials on the investigation. But preparation for wildfires by both the community and utility was incomplete, even as similar disasters elsewhere in the US heightened concerns. Running through all of this is what in the business world has become known as risk blindness.
Risk blindness is when people underestimate risk, and that can be because they're looking at the past to try and better understand what's going to happen in the future, or because they're overestimating their ability to respond to a risk. Maui is a reminder that risk is growing and that we need to be aware of what our risk is today.
Alex Wegg from Bloomberg. Quick take there with the report. You've had the numbers from the IFO index. Business confidence there takes another hit as we see it below expectations. We'll talk to Klaus Wohlrab next.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I try and play that role.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question. The best question I get all night.
Bloomberg, top experts, great questions.
European stocks are muted. Risk sentiment wanes as traders await Jay Powell's speech at Jackson Hole for the clues on the rate outlook. Christine Lagarde speaks exclusively to Bloomberg in Wyoming as some of Europe's top central banks hint at more rate hikes. Plus, Donald Trump surrenders to a jail in Atlanta to be booked on charges that he conspired to overturn the 2020 election results. The former president posted his mugshot on social media. Good morning. Welcome to The Pulse. I'm Menace Cranny in Dubai. So business confidence in Germany took another hit in August, despite the economy just exiting a recession in the second quarter. Germany's Ifo Business Confidence Index came in below expectations at 85.7. This follows a set of disappointing PMI readings earlier in the week. For more now, we're joined by Klaus Hohl-Raab, Head of Business Surveys at Ifo, the man behind the survey. Good to see you, Klaus. Look, the GDP is hardly inspiring. The PMIs are absolutely awful. Here we are with the Ifo index, hardly inspiring me. Are we at the beginning of a much deeper and more protracted period of stagnation in Germany? Good morning.
Good morning.
Klaus, let me just check in with you. We will recheck in with Klaus in just a moment on the data. In advance of that, let's set the stage for my conversation with the head of Ifo. The ECB Governing Council member Joachim Nagel said he's not convinced that inflation is under control, certainly not under control enough to halt an interest rate hike. He spoke to Bloomberg's Mike McKee at Jackson Hole Symposium.
It seems to be in Europe that the labor market and the similarity with the US is really pretty good. So we have a good labor market situation, but the economic activity is slowing. This is for sure. But this is not a surprise to me. I think when you're hiking interest rates 9 times, it's for sure that there is an impact on the here, and we are seeing this, and this is good and bad news. Inflation is coming down. Core is still sticky, and so the next months we will get more information about this.
Well, do you think going into it at this point you would lean towards pausing? There's a split in the markets about it, and there seems to be a split on the Governing Council among those who think you can wait, take a look at what's happening with the economy, and others who think we still need to do more.
I think it's, for me, much too early to think about a pause. I think we have to wait for the next numbers. So we agreed in our July meeting in the Governing Council that we will wait for the numbers we will see in our September meeting. And I will more or less follow this path. I will wait for the September numbers and then we will see.
You're in a kind of interesting position because historically the Bundesbank has been the most hawkish, the most opposed to inflation, and yet the German economy is one of the weakest in the Eurozone and in the EU now. So how do you lean in a situation like that?
Maybe, first of all, I hear a lot of talk about Germany, the sick man of Europe. This is definitely not the case. We shouldn't underestimate the adaptation capacity of the German economy. Yes, we are going through some, let me say, complicated months, this is for sure, but I'm not too pessimistic. There's also no time for complacency, this is also for sure. We see what is necessary to do, and I have a lot of trust in German politics that we go into the right direction, at least for next year. And when you're talking about monetary policy, what I said is that we have to be stubborn here, even more stubborn than inflation. This is what we have to do. This is our mandate. We have to bring inflation down to 2%. And I guess there's this overall understanding in the Governing Council that this is our mandate, and we will more or less be pretty focused, and we will do our job.
ECB Governing Council member Joachim Nagel there at Jackson Hole. Let's get back to my guest, Klaus Hall-Rabe. He is the head of business surveys at IFO. Listening to Nagel, he's not ready to call time on rate hikes. Given the survey that you've just produced, is this the start of something much deeper and more protracted slowdown in Germany? Good morning.
Good morning. We expect that the German economy will roam alongside the zero growth line. So the current numbers also from our surveys point to the fact that there might be a slight negative growth in the third and also the fourth quarter. But it's not as a deep, we do not expect a deep recession as many are forecasting or talking about. So there's a weak development of German economy, but not as bad as propagated recently often.
I mean, when you look at the survey data, you know, you've got Nagel saying he's not prepared to call time on rate hikes at the moment. Do you think more rate hikes would have an onerous impact in Germany and on business sentiment?
Yeah, especially for the construction sector. We also see a slight impact also for manufacturing and the service sector. So more and more firms are complaining about weak demand. So there are less and less incoming new orders. We also see a lot of cancellation of orders, especially in the construction sector. So a further increase in interest rate might put a little more pressure on the development of the German economy, yes.
When I was with one of your colleagues, I think it was last month or the month before, I said, is Germany the sick man of Europe? And there was a very strong pushback from that title. But it does appear that Germany is unwell and potentially turning into the sick man of Europe. The IMF say it will be the only G7 country this year to contract by 0.3%. Is the patient ill?
Yeah, a little bit. So I would not call it a sick man of Europe. And as the Economist put a question mark behind the statement. So what we see is that the more structural problems of the German economy, as the transformation, decarbonization, or the lack of skilled labor, so they become more and more apparent. So with respect to the upcoming years, so the German economy is not at the forefront of in the economy of in Europe. That's right. But currently still, although we are in the last place, so to say, with the economic outlook, but there's still a lot of room of improvement for the next year.
Well, China, I mean, oftentimes when we talk about the industrial strength of Europe, led by Germany, symbiotically matched with China. China is definitely unwell. China's throwing everything but the kitchen sink at trying to get their economy stabilized. To what extent is the slowdown and lack of assurance about China impacting confidence and orders in Germany?
Yeah, we see a little impact of these China slowdown in our survey. So if you take a look at the export expectation in manufacturing, they deteriorate a little bit. So they are not as pessimistic as we've seen sometime in the past. So, but we see a slowly increasing impact of the slowdown of the Chinese economy. So it might be that the impact of the slowdown might be higher in the upcoming months.
And if, you know, when we look at the influence of industry, I'm just trying to get a sense from you. We've got this whole onshoring, friendshoring narrative globally. To what extent can that be a floor creation for Germany? How does Germany benefit, if at all, from that global narrative?
Yeah, what we see also in the aftermath of the supply bottleneck crisis that we had in the past 2 years, we see some slow structural change or an adjustment to be more independent of the world economy. So So we still have to rely on strong exports. So this is our business model, so to say, in Germany. But the last 3 years have learned us the lesson, or the German economy a lesson, that we should adapt and also be more diversify our economy, our supplies. And this will have to be strengthened or have to go on further in the upcoming years. Yeah, you're right in this case.
Okay, Klaus, thank you very much. Klaus Hohlraab, Head of Business Surveys over at IFO. Coming up on the show, the big breaking news from BRICS. They're getting bigger. And we look at the expansion story and the global influence the new members like Saudi Arabia will add to the group, right here on Bloomberg.
Would you say race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress, and somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Today, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Tune in for continuing coverage with a special edition of Bloomberg Surveillance live from Jackson Hole starting at 8 a.m. Eastern. Bloomberg, your global business authority.
The conversations that matter, the insights you need right here on The Pulse. I'm Manish Krenny in Dubai. The BRICS bloc of emerging economies is expanding for the first time since South Africa joined in 2010. Saudi Arabia, UAE, Iran, Egypt and Argentina and Ethiopia have been invited to join the group in a push to expand its global influence. Bloomberg's Jen Zabazaja has been tracking the story all week from Johannesburg, where the summit has been happening. Jen, what has been the reaction to the selected list of potential new members? We've had a tweet from the UAE leadership, but nothing so far from the Saudis, unless I've missed something. Good morning.
Morning, Manus. No, I don't think you have. I mean, a lot of the reaction is still sort of mixed at this point in time, right? I mean, you look at this group of six, and they're all a bit different, and sort of what the collective response has been is that these groupings could help the BRICS bloc really with their influence and their power on the global stage. Of course, they could they're projected to be an expanded GDP surpassing that of the G7. And we heard that from a number of leaders yesterday who were here in Johannesburg. President Xi Jinping saying that the expansion is a new starting point for cooperation. Narendra Modi saying that it gives the shared efforts new impetus. But as a lot of people have talked about that, they're also talking about a lot of the skepticism that is now arising from this grouping. The original BRICS bloc already had some divisions and some tensions within them, right? So China and India had their own divisions, and they had a standoff over the border. Now you take a look at the countries that are being added. We have Egypt and Ethiopia that have been sort of in dispute over a dam. Until more recently, Iran and Saudi Arabia had considerable tensions. And Argentina, although we did hear, welcome from the country's leader at this point in time, they have an election later this year, and there's concern that potentially there could be a new administration that is not necessarily so pro-BRICS. And so, there's still a lot of questions about what this grouping of countries is actually going to be able to do, and also what they could potentially do to the energy supply chain in the world, right? As you mentioned, this is bringing in some of the biggest energy producers in the world with some of the biggest consumers in the world. So what could that mean for the dollar? We've heard leaders talking all week about wanting to trade more with local currencies. So do we eventually see that happening? So a lot still to pay attention to. But yes, this is a very disparate group of 11 countries.
But then you think about some of the biggest products that go from Saudi Arabia and the UAE into China. It is oil, it's in dollars, and we've had all the speculation, of course, between the UAE and India. Would they dare to price the oil exports to India in rupee? We can maybe put those questions to some of the ministers when we catch up with them. Talk me through the criteria that these countries are going to have to meet to join.
Yes. Yeah, and Manas, I'm glad you said that, because these countries, now that they've officially been invited, but they still need to review the terms of the declaration that the original 5 BRICS countries made, and then be officially sworn in, accepted into this BRICS bloc. And so some of the criteria that we heard from the experts on the ground was that they needed to be from the global south, they needed to be in good standing, and also we spoke to the foreign minister of Brazil. Take a listen to what he said, he and his colleagues came up with.
One of the questions is the reform of international governance, reform of Bretton Woods institutions, and also reform of United Nations. So all those questions are expressed in, let's say, a long list of positions and issues where those countries, the original 5 and the new countries, must have a common view of these points.
And in addition to that, Manas, we also heard them talking about how these new countries will need to reject unilateral sanctions, which is something we've heard these countries talk about. And the door is still open for other countries to be added down the road. But the idea is that they are all in unison with these specific points that the foreign minister was making there, and what we'll hear probably down the road.
Okay. Jen, thank you very much. Jen Zabazadeh tracking the BRICS Summit throughout the week. You can have a rest now, glass of wine, put your feet up, you've done the hard work. News this morning is that China has unveiled yet another for easing in its mortgage policies to halt the slump in its residential property market and revive the growth in the world's second largest economy. Let's get to our senior reporter for China, James Mega, in Beijing. James, what exactly is the new policy, and will it give the kicker that they hope for?
So the new policy that was announced earlier today is basically allows people who previously had a mortgage, have then sold their home, to be seen as first home buyers, and that allows them to get lower interest rates on the mortgages, and it allows them to pay a lower down payment. So previously, if you'd owned a home and then you sold it, and you wanted to upscale to a bigger home, for example, you would be seen as someone who already had a home, and so you'd have to pay a higher mortgage, you have to pay a higher interest rate, and you'd have to put down as much as 80% of the price of the house as a down payment. And these are attempts to stop property speculation, especially in places like Beijing, Shanghai, Shenzhen. And what this rule now is, if you own a house right now, you've paid off your mortgage, you go and sell that house, and then you borrow money to buy a bigger house, or you borrow money to buy a better house, for example, you can be treated as a first home buyer. But the issue with this easing that's being put in place is it really only going to have effect in the bigger cities, because all the smaller cities across the country have leeway to already set their mortgage policies, or that they have the leeway to enforce them or not. And so a lot of these smaller places that have seen the worst falls in housing prices, the worst falls in home sales, have already basically allowed this kind of thing to be going on for quite a while now. And so this rule change is actually just going to sort of regularize what they're already doing. And so the places that are really going to see an effect from this, or possibly see an effect, will be Beijing, Shanghai, Shenzhen, Guangzhou.
And we've got the Chinese regulators. They're going to meet with some of the asset managers today. Just briefly, what's the top line of the plan?
I'm sorry, I'm not actually aware of that issue. I mean, I just saw a few headlines crossed, but I haven't been following that question.
Listen, no problem at all. Let's see what more they come out with. I mean, they come out with many plans. Let's just see what the details give us. James, as you say, 80% down for a second home in Beijing. That is a belter. James, thank you very much. James Mager there in Beijing. Coming up on the show, Michael Jordan, he made his billions. He becomes the richest basketball player of all time. Our sports correspondent, Greg Tanner, joins me next.
I don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
The conversations that matter and the insights you need. It's The Pulse. I'm Manish Krani in Dubai. It's official. Michael Jordan is the richest basketball player of all time. That's according to the Bloomberg Billionaires Index, which is calculating his fortune for the first time. Let's get more with our executive producer and resident sports correspondent globally. It is Greg Tanner. And in a former life, he was a basketball journalist and a commentator. And at 5 a.m. in the morning, most days, he does still continue that role. He's interviewed Jordan himself. good to see you. I mean, this story, it popped as soon as I came in. Look, he is the greatest. That's undisputed in terms of basketball. But now he's the richest.
I wouldn't say it's undisputed. It's actually a debate that rages across the world every single day. Is it LeBron James? Is it Michael Jordan?
Depends what day I come in and talk to you, which one you're glorying.
Well, I mean, I have my own belief in that, but I won't mention that. But what is not up for debate any longer is who the richest is, because Bloomberg has done the maths for the first time, like you say, and they're putting the figure at $3.5 billion. So where did that money come from? Mainly from his sale of his stake in the Charlotte Hornets basketball team earlier this month, for which he got $3 billion. A massive increase from the $270 million that he paid in 2010. So that's where the majority of this wealth came from. But where did he get the money in the first place to buy that stake? Yeah. Mainly from the licensing agreement that he signed in the 80s with Nike, which is legendary.
Well, let's talk about that deal, because actually we were chatting on the IB just throughout the show, and I found some of those stats, and they are quite staggering. Where were you in 1984? Don't worry, we won't go back that far. But it was 1984 when that deal was signed. So just the evolution of that.
It was arguably one of the best business decisions in the history of sports. Michael Jordan was coming out of the University of North Carolina. Everyone knew he was a good player, but he was not a household name. Nike were taking a punt on him blowing up and, you know, promoting their brand. Yeah. And he was taking a punt on Nike. They were a small player in the basketball space. Converse and Adidas were way ahead of him. Anyway, as part of the deal, he agreed to take a percentage of some of the sales. Nike hoped that within the first few years they'd do $3 million of sales. They did more than $120 million in their first year.
And what is that number now?
Now, Jordan Brand last year accounted for $5.1 billion of Nike's sales, which represented about 11% of all their revenue. Bloomberg is estimating that it's a wild speculation, has always been around for 40 years. How much is his stake? Bloomberg has used the calculation of about 5%. So he is raking in 5% on $5 billion worth of sales nearly 40 years after he signed that deal. It's unbelievable.
And yet you look at the contracts now with that Beckham is signing in Miami with various football players, and it is all about the percentage from the brands that those individuals are potentially going to earn. So you need to declare, not your tax status, how many Jordans have you got? How much have you contributed to the overall wealth pile of this man and detraction of your own?
I have certainly contributed. over the years, maybe 100. Currently, I've got maybe 40 sat at home.
What's the most expensive pair that you have?
I have a pair that I queued up outside Madison Square Garden for in 2015 in minus 20 degrees that I've never worn. That I'd probably get $5,000 for them if I sold them.
Bet you don't regret a minute of that queuing up, do you? No. Well done. We'll continue the stories on Bloomberg on the Pulse. Greg Tanner, our resident sports correspondent and executive producer of Daybreak, Middle East and Africa. Just a reminder, full coverage, Jackson Hole. We are revving up to go. It's the Economic Symposium. It's the highlight of the bond market's dream. This is where dreams come to be shattered and hopes are raised, that we are at the peak of the rate cycle. Will pause be the tone and intonation from Jerome Powell. Christine Lagarde might just be the more important conversation on Bloomberg at 9 p.m. tonight.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's Renewable Assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we can do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and then it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It is 10 a.m. in London, 5 a.m. in New York and 5 p.m. in Hong Kong. Our top stories today. Risk sentiment wanes as Fed and ECB officials debate the next steps on rates. Now investors await Jerome Powell's speech at Jackson Hole, plus Christine Lagarde speaks exclusively to Bloomberg. Meanwhile, China unveils further mortgage-easing pressures to bolster its property market in an attempt to support the world's second biggest economy. And former President Donald Trump was booked on charges that he conspired to overturn the 2020 election results. It is the first time Trump had his mugshot taken, which he promptly posted on social media. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie stepping in for Danny Berger in London. Kriti Gupta in New York. Kriti, I'd love to talk about that stern look from the former president. I'd love to talk about the flurry of measures from China. I'd love to talk about luxury watches, and we will do all of that. But the gravitational pull of Jay Powell is undeniable.
Yeah, the rally that we saw, I want to say, in the last 48 hours and then kind of unsaw could all be at risk as we hear from Jackson Hole today. What's important to keep in mind is the green on the screen that we saw, again, yesterday, driven by the NVIDIA rally, completely pared back, Tom. I mean, we were talking about this earlier in the week. Do we start to see these earnings become kind of some sort of hurdle to a bigger leg in the S&P 500? Is this a moment where you buy the rumor, sell the news? And it kind of feels like that is how it panned out on a longer-term time frame. S&P futures higher by 0.2%. No brainer here. It's a Friday. We have a little bit of a bounce back from yesterday's session. But here's what's crucial. The underperformer is the tech index. And here's where the NVIDIA story really comes in. The idea that it had such a big rally, it's only natural, just kick the technicals into play, to pull back a little bit. And that underperformance really is driving, again, the lack of enthusiasm for tech indices, not just here, but around the world. And that is going to be crucial. Pair that with the China story, and you aren't seeing sentiment with as much conviction, as much momentum as usual. The two-year yield gets interesting. We are flat on the day at the moment, but 5.03 on that two-year yield. Can it stay above 5%? What does Jay Powell say about whether 5% is the new norm? Remember, the theme of the Jackson Hole kind of academic symposium there is changes in the structural economy, and that really means, are we coming back to a 5% world? That was the read from Bank of America last week. And of course, let's a quick check on the dollar against the euro. Euro dollar at 107. We'll call it 108 if you want. A little bit of weakness down, about 0.2% for the euro. That's the biggest contributor to the Bloomberg Dollar Index this morning, Tom.
And Chrissy, just picking up on your thoughts, your analysis around NVIDIA, the company obviously firing another arrow towards the bullseye of AI, but that arrow swiftly diverted past Europe because we just don't have those big linkages, the significant linkages that, of course, other US companies do, and arguably many of their suppliers do in Asia, not to the same extent, not to the same scale. And so actually, as a sector, you saw technology in Europe closing lower by more than 2% yesterday. It was the leading loss maker in terms of sectors. Now, today, the sentiment is a little bit more positive than the futures had suggested leading up to the European Open. You're actually seeing gains of around 0.3%. Some of that is coming through from China. Yes, a flurry of what have been described as pretty modest, pretty moderate measures, but it does suggest that at least policymakers are thinking about the concerns, addressing some of the concerns, and maybe long-term, if they are implemented, it could lead to a lift. Also, basic resources, iron ore, copper up as well. So that's lifting the FTSE 100, it's lifting the basic resources sector. Now, gilts and debt here in the UK. Some of the best performing sovereign debt this week as investors rethink how far the Bank of England is going to have to go because the data is looking soggy here in the UK. OK, today, yields are edging a little higher, 2 basis points. But the weekly story is the gilts have been bid this week on a change in those expectations around the Bank of England. Here's the corporate story I wanted to flesh out for you around luxury stocks. It's a Friday, so we can talk about luxury timepieces. Watches of Switzerland, listed here in London, taking a deep dive, 23% on the back of this news, and it's shaken up the luxury world. That Rolex is actually buying a major retailer, Buchera, in Switzerland. They have about 100 stores around the world. Rolex has always said we're not getting involved in retail. Now it seems they are. And Watches of Switzerland, one of the competitors of Buchera, falling heavily on the back of concerns as to whether or not they'll get that supply of Rolexes going forward.
The watch industry is so interesting from a macro perspective as well, just given that you can talk about kind of whether there's that consumer disposable income. I think there's so many celebrities who are now actively investing in kind of the second-tier watch market that, who knows, could be some sort of beacon of inflation at some point. We know that's certainly the theme around the world, especially at Jackson Hole, as central bankers are gathering. Of course, investors at the same time waiting for more clues on the outlook for those interest rates. Former St. Louis Fed President James Bullard spoke on Bloomberg about the impact of the strong economic data.
Reacceleration could put upward pressure on inflation, stem the disinflation that we're seeing, and instead delay plans for the Fed to change policy.
Joining us now, Bloomberg's Eddie Vanderwall, the deputy managing editor over at our Markets Live blog. Eddie, Jay Powell, not unlike yourself, is kind of a reserved guy. He picks his words very, very carefully. How much of what he says is actually going to move the markets? What could he possibly say that's going to change the narrative?
All I can say is thank goodness that my words don't have the same effect on markets. Look, I think Powell, at the moment, he won't want to come out and say, hey, job done against inflation. But I do think that he will want to subtly shift the tone a little bit more dovish because inflation has been coming down. Now, of course, we had that one uptick in the most recent reading, but we're seeing the core numbers starting to come down. And I think they want to account for the lag effects. And we've already seen that in that they are talking more about data dependency, less about forward guidance, which of course means more volatility in markets, because if you're not going to tell markets what you're going to do, then every data point shifts the narrative. But I think at this particular juncture, Powell will want to set the tone for what they do going forward. And I think he knows that they are shifting to a slightly more dovish stance, more focusing on that support for the jobs market than they are, really taking the fight to inflation. And of course, that will feed through into tech stocks again.
Eddie, do you think there's going to be a pushback? You've outlined there what you think we're going to hear from Jay Powell, but a pushback maybe on the market pricing around 100 basis points of cuts for 2024. Does that seem overly aggressive? Are they underpricing? How much is going to come through in terms of cuts in the face of maybe a US recession? How are you thinking about the market pricing into 2024?
Yeah, there's still a really interesting split, right? Because I think if you ask Powell, if Powell, if you were to ask him privately, I don't think he would say anything like that is likely, because I think the market at the moment is pricing for a hard landing and therefore the Fed being forced into cuts. I think Powell shifts slightly more dovish, but the market shifts slightly more hawkish, if that makes sense, because I think Powell will want to say, look, we are closer to that path for a soft landing. We won't have to hike as aggressively as we have in the past, and that therefore we're going to see rates probably staying at this higher for longer rate. But therefore the market has to shift slightly up in its expectation for rates next year. Still, I think the read through to equities would be slightly more bullish than it is for the bond market.
Okay, Eddie van der Walt from our MLive team, thank you very much indeed, with the preview there of Jay Powell's all-important speech later today. Meanwhile, ECB President Christine Lagarde will also be speaking at Jackson Hole today, and Governing Council member Joachim Nagel says he is not convinced inflation is under control, not enough at least for a halt in interest rate hikes.
When you talk about monetary policy, what I said is that we have to be stubborn here, even more stubborn than inflation. This is what we have to do. This is our mandate. We have to bring inflation down to 2%.
Okay, joining us now is Maria Tadeo. Maria, the Bundesbank president is hawkish. Shock horror. Is it too late to talk about a pause?
Look, when you listen to that interview, I don't think he gives any leeway to suggest that at this point today, the day that we speak, he would be inclined for a pause. I think he says this also very openly. When you see inflation, which is still above target, and he believes is still stubbornly high, the central bank has a responsibility to remain stubborn on bringing down that inflation. He did say, maybe to add some nuance here, that of course any future decisions from the European Central Bank will hinge on the data, which of course reflects the line that Christine Lagarde introduced in July when she said there could be a hike or maybe a hold, but all of this will be determined by the data. The paradox for the German economy is that on the one hand is one of those countries that is still seeing inflation remains a problem, but it's also one of the countries on the receiving end on the economic downturn. When you look at the indicators that we got this week, be it the PMIs or the surveys that we got today, it does show that this is an economy that is still hurting. To me, it was interesting in that interview how Mr. Nagel, as the head of the German Central Bank, kind of pushed back on this idea that Germany has somewhat become the sick man of Europe. This has, infuriated some members of the German government. But to me, I was also struck by the head of the central bank coming out and feeling like he had to publicly defend his country, saying, do not underestimate the capabilities of the German economy. The problem, as I say, is that when you look at the numbers, they do not paint a positive picture for the biggest economy in the euro area.
Where does President Lagarde stand in all of this, Maria? Of course, we do have an interview with her due from Jackson Hole on Bloomberg Television later in programming, but what could she possibly say to perhaps change that narrative?
Look, we have a keynote speech, and we have an interview, of course, with Tom Keene that is coming up today. And it's also an interesting timing, because this is the first time we hear really from the head of the European Central Bank ever since that July meeting and that introduction of potentially a pause in September, always looking at the data. Remember, she said it would not be up to me. It will really hinge on the data. Are we going to get an inclination of what that decision looks like? I really doubt it, especially because, look, she's not going to move until the forecasts come out, and that will be in September, but the tone will be key. What is interesting to me, too, is that, again, you highlight the difficulty of this job. You see the German Central Bank saying, I don't see a reason to pause. You speak to the Portuguese, they say we need to factor the downturn in the economy. She has to bring them all together and come up with a consensus decision.
Maria Tadeo in Brussels will be looking out, of course, for that interview with Christine Lagarde. Some people in London will have to put down their pints at the local boozer to tune in for that one. You can't talk about Europe without talking about China, of course, and China unveiling a further easing of its mortgage policies to halt a slump in its residential property market and revive growth in its economy. Joining us now with the details is Bloomberg's China and Economy Government Editor Jill Desis, who does such a great job charting the evolution in this economy. Jill, what do you make of the flurry of measures on mortgages, on taxes around stock trading, and indeed the efforts by regulators to compel some of the money managers in the West and on Wall Street to stick with it when it comes to Chinese stocks?
Well, that was quite a mouthful, Tom, and I think it's worth parsing through some of these things. I think that, you said the mortgage rules in particular, you described them as modest earlier. I think that's pretty apt. So essentially, to break it down, in major Chinese cities, there's a rule that if you've ever held a mortgage, even if you fully paid it off you can no longer be considered as a first-time home buyer. And so that, of course, precludes you from perhaps more favorable down payment restrictions on how much you actually have to put up to then get another home. So what the Chinese government put out today was saying that local governments can consider removing those rules, and so that could potentially help things out. I think what's really important to remember here, Tom, though, is that the central government was essentially leaving it up to these local governments to then implement that rule. So this really, I think, only has a lot of heft if it's employed in the largest cities. In Beijing, for example, I think if you're a second-time home buyer, you have to put up a down payment of something like 80%, whereas like a first-time home buyer would be like, 40%. So, I mean, those are the types of cities where you'd actually have to see action really, really take hold for you to see something that actually makes some meaningful movement in the property market. That being said, I think that the fact that these rules are even being eased whatsoever maybe portends some additional steps that the government could roll out in the coming weeks and months that actually help the property sector. So it is, I think, a positive step forward. It's just not enough to make a substantial change right now.
80%. Oh my gosh, that's an enormous number. Jill, let's talk a little bit about the other China piece if we can. Going into next week, we know Gina Raimondo, our Secretary of Commerce, is going to China specifically. Looks like chips will be on her mind. What can we expect out of that conversation? Anything positive, anything negative? Walk us through it.
Yeah. I think that ultimately, Kriti, the Commerce Secretary visiting Beijing is, I think, one of the most positive step forwards that you can really kind of, engineer for the U.S.-China relationship at this point. Now, look, we've had several high-profile visits to Beijing by prominent U.S. officials. You've had Antony Blinken, Secretary of State, Janet Yellen just visited. We haven't really seen a whole lot of fruitful measures take place within a lot of those meetings. But I think that the thing with Raimondo is that, the U.S.-China trade relationship is obviously incredibly critical. She's visiting China at a time when we've seen, some heightened investment restrictions on, American investments in AI and quantum computing as it relates to China. We've seen, some other restrictions. But what Raimondo has the opportunity to do is sort of smooth out, to the extent that it makes sense, the U.S.-China relationship. Maybe it involves removing curbs in other ways. I mean, we just saw earlier this week what I described as a bit of an olive branch, the U.S. Removing some restrictions or, taking some Chinese companies off of a list that precludes them from, working with some, American companies. So there is opportunity for her to work within that sphere to try to figure out ways in which the U.S. and the Chinese economies can continue to cooperate, even if the U.S. wants to protect, some sectors on national security grounds or what have you.
Okay, Jill Deeses, thank you very much indeed, laying out the implications of those mortgage changes and previewing Gina Raimondo's important visit, of course, to Beijing in the next few days. Thank you. Coming up later this hour, we're going to catch up with Sarah Hewen, head of Europe and America's research at Standard Chartered. Her views on where central banks go from here. And of course, our coverage of Jackson Hole continues throughout the day. Catch a special edition of Bloomberg Surveillance. That starts 8 a.m. Eastern Time. We're going to hear from an all-star lineup, including Philadelphia Fed President Patrick Harker. And we're going to bring you, of course, Jerome Powell's speech live, 10 a.m. Eastern. Plus, don't miss that exclusive interview with ECB President Christine Lagarde. She's going to speak to Tom Keene at 4 p.m. Eastern Time. So much on the docket to stay tuned for. Stay with us. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns. compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes.
Or
yes. Not keeping, look, people have conviction, or they invest for the, if they invest for the right reasons, just keep at it.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
What has taken place here is a travesty of justice. We did nothing wrong. I did nothing wrong. And everybody knows it. We did nothing wrong at all. And we have every right, every single right, to challenge an election that we think is dishonest.
Former President Donald Trump there speaking yesterday after turning himself into a jail in Atlanta, Georgia. He was booked on state charges that he conspired to overturn the result of the 2020 presidential election in Georgia. It's the first time Trump had his mugshot taken, which he then posted on X, formerly known as Twitter, marking his first return to the social media platform since January of 2021. For more, we're joined now by Bloomberg's Bill Ferry, a senior editor and former U.S. national security team leader in Washington, D.C. Bill, a pleasure to have you on the program. Talk about the strategy for us. I mean, we know in previous arraignments, it's been a very kind of hush-hush process for the Trump kind of campaign and for President Trump himself and his legal team. This seems to be a little different. What do you make of it?
Well, it's the fourth time the president has had to go in to face face charges. In the past, officials did not want to take a mugshot. They said it wasn't necessary. This time, the sheriff in Fulton County said that no one was going to get special treatment. That's why you saw former President Trump and much of his legal team, 18 co-conspirators, all have mugshots taken. For him, the legal cases have not been an impediment. He's still, of course, leading the Republican side of the race, the primaries, to be the candidate for president next year. He was able to skip a debate earlier this week. He has effectively been Teflon, but there's a real question about whether the schedule ahead in terms of these court cases and the demands of the trail, the campaign trail, mean that some of that support will erode. We'll have to wait and see on that.
Bill, he pulled out the blue steel look for that mugshot. What comes next from the former president?
Well, the prosecutor in this case is hoping to have this case really get expedited. She wants an arraignment next month and the trial to get underway. President Trump's lawyers, not only in Georgia but everywhere where they've had to face charges, have been pursuing a strategy of pushing things off as long as possible. They've proposed dates for hearings that take place after the November 2024 election. It's doubtful that the courts are going to go along with all of that. We know he has one court hearing in New York in late March, and that's just 2 weeks after the big Super Tuesday primary. So by the time we get into the meat of 2024, you're going to see the president having to leave the campaign trail for court appearances and then running to get back out and give his speeches or hold his rallies like we saw in 2016 and 2020.
Wow. That's going to be quite something, isn't it? Historic, obviously. Bill Ferries, thank you for the latest on the travails of the former president and what it means for his standing. Of course, still has that healthy poll lead amongst Republican candidates. Coming up, Hawaiian Electric facing multiple lawsuits on the handling of that deadly wildfire. More on that next. This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open. Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance, the early edition. I'm Preeti Gupta in New York with Tom McKenzie in London. Let's get to some of the stories that caught our eye this morning. The lawsuits piling up for Hawaiian Electric on claims that the utility company's compromised safety protocols put the island at higher risk from the damages of the deadly wildfire. The firm is facing liabilities of almost $4 billion, and if it's found negligent, according to research firm Capstone, the Maui fires destroyed much of the city of Lahaina and killed more than 100 people. Now let's turn to some of the earnings stories as well. Gap delivering sales and revenue that missed the street's estimates for the last quarter. Nordstrom, on the other hand, posting lower than expected losses at its off-price rack stores. Nordstrom CEO also highlighting that losses from the theft are at a historic high, adding to concerns over the health of consumers after Macy's cited accelerated credit card delinquencies earlier in the week. And over in Hollywood, Warner Brothers delaying the release of the film Dune Part 2 from November to March 2024. That comes amid the ongoing strikes in the industry that prohibit actors from promoting their work for companies that they are striking against. The Screen Actors Guild went on strike in July, seeking changes in a new contract, including higher pay. Tom, this situation getting worse and worse. And, I've spoken to folks in the industry, and they say that it could really last almost even a year. And you're already seeing some of the studios really kind of lean into that. We're going to talk about the economics effect of the strike story across both sides of the Atlantic. Coming up, Sarah Hewen, Standard Chartered Head of Europe and America's Research, joins us next. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is Bloomberg Surveillance, the early edition. Here's what you need to know. Risk sentiment waning as Fed and ECB officials debate the next steps on tackling those interest rates. Now, investors awaiting Jerome Powell's speech at Jackson Hole in Wyoming, plus Christine Lagarde speaking exclusively to Bloomberg TV. Meanwhile, China unveils further mortgage easing policies to bolster its property market in an attempt to support the world's second biggest economy. And former President Donald Trump booked on charges that he conspired to overturn the 2020 election results. It's the first time Trump had his mugshot taken, which was then posted on social media. I'm Kriti Gupta in New York with Tom McKenzie stepping in for Danny Berger in London. Tom, there's a lot of news from around the world, from China to D.C., but when it comes to the market trade, all eyes on Wyoming.
Absolutely. Even here in Europe, of course, that is where the focus is. Will we get some kind of clarity from the Fed Chair, Jay Powell, in terms of the next steps from that central bank? A reiteration of the need to be data dependent. We also heard that from European central bank officials as well. Nagel over at the Bundesbank of Germany saying that he does not see the case yet to close the book on further interest rates. He still sees resilience in the Eurozone economy, and so for him at least, keeping the door open as a hawk to further rate hikes coming through from the ECB. But the sentiment here in Europe is modestly positive. We've had a few catalysts coming through from China in terms of further modest moves, at least to try and shore up that economy. And across the benchmark here, you're seeing gains of 0.3%. When it comes to the debt markets, there's been a lot of focus, of course, this week, rightly so, on what's been happening in the US Treasury markets. But actually, the best performer in terms of sovereign debt has been UK gilts as we reassess and readjust to the ability for the BOE to go higher with rates, maybe pairing some of those bets, the markets, and that is leading to money moving in this week. If today is a bit of an outlier by 2 basis points, a little bit of sell-off, but the weekly story is gilts have been bid. One of the corporate stories to bring to your attention, we touched on this earlier, luxury watches. And I wonder if you've got a Daytona on your wrist there, Kriti. It's Watches of Switzerland under pressure because Rolex has gone in and bought a major retailer in Switzerland. They've never done this before. They haven't had that retail experience and that exposure. And there's concern from some of the competitors in the retail space, like Watches of Switzerland, listed here in London, that maybe they will get a shortage of supply of Rolexes. That stock taking a hit down 0.2%. When it comes to luxury timepieces, that's the story, Tim. Kriti.
Tom, I have to admit, I'm not quite at the caliber of a luxury timepiece yet. In fact, this one is one I bought in high school with my very first paycheck for about $100, and I'm still wearing it. So a luxury timepiece is perhaps a few steps away for me. But anyways, the green on the screen you were seeing stateside is a direct read-through, I think, from what you're seeing in the European session, although underperformance in the tech sector seems to be a key theme. It's really diverging from that kind of NVIDIA hullabaloo, we'll call it, when it comes to just how good their earnings were. A lot of people front-run those earnings and then ended up selling the rally that you saw post those numbers coming out. So you did actually see some of those movements. The S&P 500 higher by 0.2%. We're going to get you the graphics back in just a second. But what you need to know here is that the underperformance is crucial. The bond market also getting very, very interesting when you look ahead of Jackson Hole. Remember, the 2-year yield not doing a whole lot at the moment. And even Eurodollar, which is the biggest contributor right now to the Bloomberg Dollar Index, again, only weaker by 0.2%, Tom.
Okay, let's get more then on Jackson Hole and the conference featuring central bankers, of course, from around the world. Bloomberg's Michael McKee, none other, filed this report on what to expect today from the conference.
Friday's symposium comes in two parts. One of interest to global Wall Street at 10 Eastern when Fed Chair Jay Powell speaks, and later at 3, it's ECB President Christine Lagarde. Neither is likely to deliver what investors want, clear clues to the timing and path of interest rates ahead. Instead, expect them to reiterate inflation is bad and they will keep the rate pressure on. What they won't say is whether that means higher rates longer, or both. In between their keynotes, the central bankers and economists here will turn to the topic of the symposium, structural changes in the global economy. The post-pandemic economy already looks different. They'll discuss what that means for monetary policy, but in the longer run. Michael McKee, Bloomberg, Jackson Hole, Wyoming.
Okay, let's bring in Sarah Hewen now, head of Europe and America's research at Standard Chartered. Good morning, Sarah. Thank you for joining us. What kind of message do you expect to hear then from Jay Powell? Is he going to be centrist? Is he going to lean hawkish? Or does he have the space now to suggest that maybe we are in peak territory?
I think he's going to be quite cautious about giving a firm indication that rates are at a peak now. So we're expecting still a hawkish lean. That said, the message of data dependency is going to be central, I think, both for Powell and Lagarde. The jury is still out, I think, in terms of the direction of inflation, the direction of the labour market in the US. But we have seen some encouraging signs. Core inflation pressures do seem to be easing. Input pressures are fading. And of course, we've had a couple of months of slower employment gains in terms of the payrolls. So those are all very encouraging messages, but at the same time, Powell won't want to signal that the Fed is done just yet. So we're expecting more a sort of cautiously but somewhat hawkish message, I think, from this meeting. That said, they don't want to be too hawkish. There are some concerns about over-tightening, that policy goes too far and really brings the economy down further than it needs to.
It is, of course, a very fine balance, as you kind of outlined there for us, for Jay Powell. How difficult does that make it, Sarah, for you and the team at Standard Chartered to project into 2024? The market's pricing in, at this point at least, 100 basis points of cuts from the Fed by the end of next year. Does that align with your view?
That broadly aligns with what we're expecting as well. I mean, we're not expecting rate cuts to start until the early months of next year. We think that, of course, policy is still going to be in restrictive territory, even if you get 100 basis points of cuts. So that would still suggest that the Fed is fighting inflation. And 100 over the course of a year is a very sort of gradual decline. And still recognizing the need to bring core inflation all the way back down to 2%. But the signs are very positive that we're moving in the right direction. Of course, today it's highly unlikely that we get any signal from Powell that there are any rate cuts on the horizon. That's the last thing that policymakers from the Fed, or indeed from any of the central banks, the Bank of England, the ECB, that's the last message that any will want to deliver at this moment.
But then pausing kind of more than just one meeting at a time isn't exactly the best vote of confidence either, it feels like, for the markets. Sarah, talk to us a little bit about the divergence in terms of that framework between what you're seeing from the Federal Reserve and from the ECB. Is it a problem that they don't seem to be on the same page at the moment?
In some ways, they are on the same page, of course, because the latest comments that we had from Lagarde and from Powell at their last policy meetings were that, we could raise rates, we could cut rates. that they very much emphasize data dependency, and both really stepped back from the earlier message, which was for ongoing tightening of rates, a clear forward guidance that there were further rate hikes to come. So both really left the September policy meeting with a question mark over whether indeed there would be a need for further rate hikes. But at the same time, both Lagarde and Powell shied away from any suggestion that rates are definitely at a peak. For the ECB, the problem is that the downturn in inflation has been very tentative so far. We may get more news in that respect next week. We're expecting that we will see core inflation and headline inflation coming down again in the euro area. But there are real concerns about wage pressures still in the euro area and the impact that that might have on core inflation. For the US, there are, in our view, very clear signs that inflation is on a downtrend. If we look at the latest monthly data annualized, then you have a lot of comfort that inflation is heading towards the target.
And Sarah, at the core of that, though, is going to be, when does this kind of recession call happen? Even the folks that are still sticking to the recessionary calls, at least stateside, are calling it a modest recession in 2024 even. It doesn't feel like those same calls are coming for Europe, where perhaps a recession could be a little bit more dramatic. Are you at all worried about, again, the timing of that?
Yes, the real dilemma for euro area for ECB policymakers is that the data, certainly the survey data, are looking very poor. We've got purchasing managers indices, we've got the IFO indices now at levels below the troughs that we reached last October. And if you remember, that was the point at which there were real concerns about the energy crisis and the impact that that would have on growth in the euro area. So the recession signals, I think, are pretty heightened for the euro area, potentially for as early as the current quarter, turning down again. For the US, the current quarter still seems to be very comfortably in positive territory. We're seeing perhaps some easing of activity, but there's certainly no signs that a downturn is imminent, although we think that the impact of the accumulated impact of higher interest rates over the past 15 months or so is going to ultimately be negative for the economy. So we still see a risk of a recession in the US.
Yeah, so resilience or recovery, and it feels like Sarah Hewen is leading a little bit more to the resilience story. Standard Chartered Sarah Hewen, we thank you as always for joining the program. Our coverage continues of that Jackson Hole, continuing throughout the day, catching a special edition of Bloomberg Surveillance. It starts at 8 a.m. Eastern. The team is on the ground. We're going to hear from an all-star lineup, including Philadelphia Fed President Patrick Harker, and then, of course, bring you Jerome Powell's speech live at 10 a.m. Eastern Time. Plus, don't miss an exclusive interview with ECB President Christine Lagarde. She speaks exclusively with Tom Keene at 4 p.m. Eastern. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. that risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis. We're going to go get straight to some breaking news.
I'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
All eyes on Jackson Hole, Wyoming this morning on both sides of the Atlantic as, of course, we talk about what Jerome Powell and Christine Lagarde and their central banking colleagues are really going to say about the path of interest rates at a time when you were still seeing about 100 basis points of cuts priced in for next year. And for our radio audience, stick with me. For our TV audience, I am showing you a chart right now about exactly what that looks like. I mean, nothing has really changed in terms of the market pricing, I think, in the last year or so, where they're still saying, look, that downturn that we're really expecting might just show up in 2024, and therefore the market is expecting 100 basis points of cuts. Is that reasonable, given the resilience we've seen in the economic data lately? Let's get a true expert's opinion on this. Bloomberg Opinions columnist Marcus Ashworth joins the program. Marcus, is that reasonable? Does the market have it right?
I have actually absolutely no idea. I don't think the market does either. And nor, I think, does the Fed really. All the Fed wants to do is make sure that doesn't get any worse, in the sense even more rate cuts priced in, or more accurately, priced in earlier. They want to buy themselves time to get through into the first quarter next year with this higher for longer mantra, this plateau of rates. I don't think they'll go up much more, if at all. But they don't want this sort of, oh my word, they've paused, it must mean the end of rate hikes. Instantly we start pricing lots of cuts, because that then takes out all the momentum in this monetary pricing policy tightening they've done over the last year and a bit now. So it's a game of chicken with the market. If, for instance, Powell mentioned something about policy already being restrictive, or he won't say too restrictive. He's going to sound generally hawkish, but the hints, the nuances we're after is, does he say anything about monetary time lags and how restrictive policy is? That'll be the clue for the market to rally. He probably won't want that. I think he's pretty happy where the bond yield curve is priced now. I think he will be slightly unhappy, as you're showing in that excellent chart, that 2024's expectations of rate cuts are probably a bit more than they like to see.
The game of chicken there with the markets for Jay Powell. Marcus, talk to us about how you fold that into your views around treasuries then. There's this kind of debate going on still. You have the likes of Stephen Major over at HSBC saying rates at these levels, particularly the 10s and the 30s, they're looking pretty attractive. But you have the issuance question coming from the US Treasury. You have, of course, the inflation implications. You have, of course, quantitative tightening as well. What is your view as you kind of project out to 2024?
Well, I mean, I think I sort of agree with that view generally. I think bonds are looking pretty cheap. I have to say, I thought they were looking quite cheap, a few basis points lower as well. So I'm slightly surprised at how aggressive the bond move has been, higher in yields. It's partly a supply argument, it's partly a budget deficit, and I think possibly a China story as well, or a fear of China selling. Whether the reality is or not, we don't know. But I think the market is definitely overshot going to Jackson Hole. The chances it will want to rally quite hard, especially if Powell says something dovish. So, as far as Treasury is concerned, I think it's had a very, tough time of it. And I think probably the market's going to settle down. I would say overall, this is a good time to buy bonds, but, you may get a better trade location.
Marcus, what does something dovish actually sound like when we already know that the economic data, it is slowing, not dramatically, but it is slowing across the consumer sector, across the business sector, and even exports, imports data showing that as well. How much more dovish could Powell get?
Well, I think Powell's been pretty hawkish, and certainly this time last year, he was very hawkish. It was the most hawkish speech I think I've ever listened to, certainly in modern history. I don't think he'll repeat that, but he's not going to be as dovish, for instance, as he was in 21. So he's going to steer somewhere to the middle of those last two speeches, probably closer to last year's very hawkish speech. He's going to be hawkish. I think the market expects him to be hawkish. We know he's going to say higher for longer. We know he said there may be a need for more rate hikes. And he certainly doesn't want, as I said, to get in these rate cut mentality next year building in any further. However, words like restrictive or lag are the key things. If he mentions that in a certain way, I think the bond market will take that as fairly positive and in a sense, interpret a hawkish speech as a dovish version of it.
Marcus, are we still worried about financial pricing inflation, asset price inflation? If we're seeing green on the screen driven by the AI story, is that interpreted as a positive or a negative in Wyoming?
Oh, I think a negative in the sense they don't want to see too much of this. They understand how markets are and how bubblicious they're going to continue to be, particularly in things like NVIDIA. But I mean, I don't think they want to see this spreading out like obviously we had the meme stock issue a year or so ago, which was getting out of control. I don't think they'll view one game-changing stock as being necessarily something to worry about too much. But they can see the S&P has calmed down a bit. I think they'll be quite happy with that. I don't think they want to cause a stock market collapse, but certainly I don't think they want to fuel any more asset prices. So it'll be a minor and a negative, I think, from generally, but has been for some while. I think they want to try and slowly ease this stuff out of the stock market. That may mean flat prices and not necessarily a down market.
Marcus, very briefly here on the UK, gilt yields edging up today. It's not the story of the week, though. Gilts have been bid, and markets and traders are now pricing in below 6% in terms of the terminal rate from the Bank of England. I know you have very strong views on what they should be doing at the BOE. What do you think they will be doing in light of the weaker data here?
Okay, I think the Fed probably doesn't hike again. I think the ECB almost certainly can't hike again. Having said that, the Bank of England probably almost certainly, definitely will have to hike one more time, but that probably will be it. So I think 5.5, maybe 5 3/4 as at the moment makes sense. I think the market's coming down to that sensible presumption because the PMIs are so weak, because the ECB will be pausing, and maybe the Fed does as well. If the Fed decides to hike again, all bets are off. Maybe we do get to price in 6% again, but for the moment, I think the logical sort of peak rate to price in, a little bit of hedging there, is 5 3/4. Though I don't think they'll get to it eventually.
Marcus Ashworth, we could have you for an hour and still not pick your brain completely. We appreciate you joining the program this morning, joining us from Bloomberg Opinion. We thank you as always. Coming up on the show, a look at some of the stocks moving ahead of the U.S. market open. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall? That's a great question.
I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg Surveillance, the early edition. I'm Kriti Gupta in New York with Tom McKenzie in London. Let's take a look at some of the stocks we're watching in pre-market trading in the U.S. Now, remember, it is a summer Friday. All eyes are on Jackson Hole, so there are slim pickings here stateside. But some of the big major market movers, Hawaiian Electric down about 20% in the pre-market. Shares trading about $9.49. Look, they're dealing with multiple lawsuits from investors, but also from Maui itself, and also talking about suspending their dividend. So seeing some real pain in those shares right now. And of course, we'll bring you the latest fallout as we get it. But right now, under quite a bit of pain. NVIDIA is also another major stock we are watching this morning. NVDA is your ticker there. Shares higher by 0.3%. But Tom, this is not the momentum we've seen in the last, 48 hours or so around the artificial intelligence boom. Remember, you had a lot of folks front running these earnings stories, then ultimately selling the rally in yesterday's trade. And again, perhaps not catching that second win this morning.
Yeah, it certainly didn't hold in Europe, where you actually saw tech stocks as a sector down a full 2+% yesterday at the close. I also want to bring your attention back to the luxury stocks story, the luxury watch story, part of the luxury stock story, because this really surprising move for anyone who follows luxury timepieces, Rolex moving into the retail space, and the impact is being felt on Watches of Switzerland. It's listed here in London. It relies, according to some analysts, on about 50% of its sales coming from Rolex. The concern from Watches of Switzerland is that it's now going to be competing with Bucherer, which is a retail luxury watch seller, and they may be squeezed in terms of supply. So a big hit there and big changes in the luxury watch space.
It's so interesting how quickly the luxury watch space has kind of entered the conversation in terms of inflation broadly, because it's not really something I think about often when I think about inflation, but it's actually part of some of the inflation indices, which I think is fascinating.
Yeah, you saw that pandemic push, didn't you? That rush.
Or a house, just buy a Rolex apparently, and that can
invest
of course
in a beautiful selection of luxury watches. Hey, the other big story of the day, Kriti, so I've heard on the grapevine, is that a loss for New York is going to be a big win for London. It's your last day on set in New York.
It is my last day on set. I've got to say it's bittersweet because, look, I've been at Bloomberg for about 5 years now, and all here in New York doing some stuff on the print side and the TV side. And yeah, I'm crossing the Atlantic, braving new waters, if you will. But it's been quite the ride.
We welcome you with open arms. We're really excited about welcoming you here, Kriti. I know the team in New York are going to be sad to miss you, but we are going to be seeing you here on the ground in the studio here in London in the next few weeks. We wish you well, of course, with the move. It's a big uplift. Kriti Gupta, I'll let you close it out.
Daybreak Europe, 6 a.m. in a couple of weeks. Thank you to their team. Thank you to our audience. Folks, stick with us. Early edition ends right now. Surveillance begins. Coverage throughout the day. This is Bloomberg.
middle of a massive exhibition center located on the western suburbs of Shanghai, where the annual car show is taking place. This is the first exhibition after the end of the COVID lockdown. We can feel a lot of excitement on the ground. Electric vehicle is going to be the new theme of the industry. Most of the European companies and Japanese car makers who are considered latecomers to the China EV party are launching their EV products. They are making their foray, intensifying competition in the market. For example, Volkswagen yesterday debuting their ID.7, which is electric vehicle rivaling the likes of Model 3, which is one of the best-selling products in China. And Mercedes-Benz, they are announcing the launch of their new super luxury model of Maybach, which is going to be a fully fledged electric vehicle priced at $200,000 each. Domestic players are also trying to maintain their lead in the market. BYD, for instance, unveiled its first luxury model called Yang1 yesterday. It's priced at about 1 million yuan. At the same time, it's seeking to gain market share in the mass market as well. Needless to say, attracting all the car makers to the Chinese market is the rosy growth prospect. Demand is surging. By some estimates, EV sales in China are on track to exceed 8 million units this year from more than 5 million last year. The future of the car industry is EV. For sure, no question about it. This is Charlie Zhu, Bloomberg News, reporting from Shanghai Auto Show.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We look at the broader market sentiment, that's clearly become a little bit more bearish over the last 2 weeks or so.
Even though the Fed has raised rates an extraordinary amount, there are parts of the economy that still remain very, very insulated from it.
They're coming to the end of hikes. That's without a doubt. I think 6% is a hard cap.
I think the extent to which we get global disinflation might catch markets by surprise.
I think it's a bit premature to say, okay, the coast is clear now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning from our New York City studios. For our audience worldwide, this is Bloomberg Surveillance. I'm Matt Miller alongside Damian Sassower. Tom, John, and Lisa are in Jackson Hole ahead of their special coverage that kicks off at 8 a.m. Eastern, and they'll be on air for 4 hours throughout Powell's speech and beyond. So definitely a show that you don't want to miss. It's, I think, more important now, Damian, because, yesterday and going into NVIDIA earnings on Wednesday, the narrative was, wow, NVIDIA earnings may be more important than Jackson Hole. But after the market action we saw yesterday, I don't think that's true anymore.
NVIDIA news, it felt like last year already. I mean, my goodness. But I mean, I think it's, as we set up for Jackson Hole, but the fallout effects from higher debt servicing costs, both at the fiscal level, I mean, CHIPS Act, IRA, but at the household level, student loans. Did you know the word student loan was mentioned in S&P companies who are announcing their earnings 40 times, by far the most ever? So the fact that student loans are resuming, households are going to have to resume payments on their student loans, it's really going to impact consumption and spending.
Student loan and shrink.
Yeah,
a real concern for sure. And I just thought it was interesting, NVIDIA had such a blowout quarter and the shares rallied. They were up 7% in the early session yesterday, and they closed up only 1/10 of 1%. We had all the major indexes closing down below 1%, tech really leading the losses. So everyone is looking forward to Jackson Hole to see what the Fed has to say about rate raises. Do they have one more hike left?
Sure. And if you look at equity market action into Asia overnight also, in Meituan, I mean, the big Chinese food delivery service, I mean, they had, revenues were up, I think, a third. I mean, double like what they were. And now, I mean, my goodness, the shares were down 7% overnight, because basically you just can't get anyone to buy anything with China's name on it, unfortunately.
Yeah, and on the debt servicing costs, I saw a story by Liz McCormick. The estimates now, considering the size of deficits, 1.6 trillion this year, are that debt servicing alone in the years ahead is going to be 20% of all federal revenues if we don't change something. So that's going to be...
fundamentals don't matter anymore. Come on.
Yeah, all right. That could be the case, and I guess it happened in other countries. Let's take a look at what's going on in markets right now. We did have, as I said, big drops in the benchmark indexes yesterday. The S&P 500 futures this morning are up, but only about 0.1% as we fell down below 4,400 on Thursday's trade. You can see the euro dollar is down right now. The greenback stronger against the euro and the pound, so the Bloomberg Dollar Index moving up just a little bit, and we do have a 107 handle there. We heard some strategists yesterday saying, considering the interest rate differentials, we should be more like 105, 106. Take a look at the U.S. 10-year yield. It had come down pretty substantially after rising up to more than a decade high. It was actually the highest level it had been since 2007, so far before the collapse of Lehman Brothers was the last time we saw anything over 430. At the beginning of this week, we saw 434, I believe, at the high. We then came down below 420, and we're now back up at 4.25. The crude price back up over $80 a barrel, but it also lost a lot of steam this week, and now we're starting to gain some of that back. We saw a drawdown yesterday, and there are reportedly talks between the Biden administration and Venezuela into easing some sanctions so they can bring some more of that in. We're going to cover all this for you in the program ahead. Right now, crude trading at $80.16 a barrel. I want to bring in Steve Sosnick right now, Chief Strategist at Interactive Brokers, up early in New Canaan for us. Steve, great to have you on the program. What do you expect today from Jackson Hole? What's the big issue that you're going to be watching for?
Good morning, Matt. Thanks for having me. I think this morning what I'm going to be watching for is, do we get a replay of last year's type of speech, which is him sort of sternly talking into a camera, with the nice prairie and mountain backdrop. But what we've gotten before from Powell is sort of on one hand, it's this, but it still could be that, like we'll raise rates, but we can cut them. But because I think he does that when he's in the room with reporters, and I think he's basically a nice enough guy and doesn't want to be super confrontational. When he's standing by himself reading from a script, he sticks to his message. And I think his message will be, number one, we continue to fight inflation. Number two, we may be done hiking rates, but we're not cutting them. The analogy I'm using here is, with all due sensitivity to people who've been affected by fires, the fight against inflation is 80% contained. We've basically done about 80% of the work we need to get inflation back toward the Fed target, but we're not there yet. And just as firefighters don't put away their equipment when the fire is 80% contained, he's going to remind people that the Fed is not going away until the job is done. And I don't know that the market really wants to hear that.
Only you, Jay Powell, can prevent resurgence in inflation, especially with the resurgence that we've seen in GDP growth, right? I mean, depending where you look, at which nowcast you consider more important, we're looking at 4, 5, 6% nominal growth. Are you concerned about a resurgence in inflation? Are those embers going to spark the fire back to life again?
I think so, although there are some different, you guys mentioned the student loans at the top of the hour. I think that's going to be a bit of a headwind. I do think also, the fact that, call it a third of Americans are facing utility bills of the likes they've never seen before. Both of those are headwinds on spending. And remember, the consumer is 2/3 of the economy still. But the bottom line is people have jobs. Unemployment is low. People have money. They spend it when they do. I think they're moving a bit more toward necessities away from discretionary spending in many cases. But if people have jobs, which is great, and they're earning more money, which is also great if you're the person getting the money, not so much if you're the Fed or the employer, then that money is going to be spent, and that's going to have positive effects on the economy. I'm not too concerned about that, but this is why the Fed has to remain vigilant and continue to give that message of vigilance.
Steve, I know it's early, but I wonder if you can put on your options hat for me. I mean, cross-asset vols, I'm talking FX rates, equity, have been very, very well behaved of late. But a lot of these risks that you mentioned are still out there. What's really going on there?
That first of all, it's never too early, Damien, to put my options hat on. It's on all the time. But it's actually been kind of fascinating because you would think that a restrictive monetary environment would be would induce inflation. I'm sorry, would induce volatility. But we really haven't seen that. Part of that is there's been a fair amount of dispersion between assets, certainly on the equity side. And when you get dispersion among, let's say, an index or a basket, that actually does depress volatility. If stock A goes up and stock B goes down, well, the index has gone nowhere. And so that's depressed it on the equity side. And also the idea that people have de-risked, a lot of the institutions that drive VIX and things like that have moved to cash. In terms of the bond market, we are starting to see the volatility pick up again. And in terms of cross markets and FX, again, we've sort of got these relatively well-behaved regimes. For whatever reason, as you say, that I do think the euro probably is a little overvalued here on a technical basis. But as long as investors are just sort of willing to sit on their hands, and I don't really know where the complacency comes from, but as long as people remain relatively complacent, realized and implied volatilities tend to remain subdued.
I find it so interesting. You first mentioned cash and then you mentioned complacency, right? And so for me, with vols at these current levels, is this the time you believe investors, look, we're going into the seasonally weak September-October period, right? I hate to talk seasonals, but, for whatever it's worth, is this the time to be buying protection?
Yes, I think buy the dip is an important mantra no matter what you're trading, and I think it's especially important right now in volatility. You talk about seasonals. The best seasonal month for VIX is August, and the reason being is VIX. I don't know that people always appreciate it, but VIX is designed to be the market's best estimate of volatility over the coming 30 days. Well, what comes 30 days after August? That's September. And I think that, the idea that, we haven't seen much of a rally in volatility, we haven't seen people looking for volatility protection, comes from the idea that I think a lot of the institutions who are the big traders of VIX feel that they've de-risked sufficiently so that they don't need the vol protection. But that's one of those things in my career as an option trader. It's like selling umbrellas during a drought. Nobody wants them when it hasn't rained in a while, but as soon as those clouds appear, guess what? You can't get enough of them. And so that's why I like to be very opportunistic. And I think a 16, 17, 16 VIX, which was yesterday and before we moved up, provided an opportunity. We're still below long-term averages in terms of major volatility measures on the equity side.
You're not wrong about the seasonality. I just pulled up the SEAG function on the Bloomberg terminal, which is tremendous. Gives you a tremendous picture of seasonality. Put on the heat map, and I see over the last 29 years, we've added 9 points on average in August, more than any other month of the year. So I think that's absolutely fascinating. What happened, speaking of volatility, yesterday with NVIDIA? This was, the earnings report that it's the most important earnings report I can remember in recent history. And expectations were so high, and they knocked the ball out of the park nonetheless. We had a 7% gain between 9:30 and 10, and then it just started to dissipate. By the end of the day, we were basically unched on NVIDIA. Why is that?
Yeah, I agree with you that I was also thinking this is among the most consequential earnings reports I can remember. But this is what happens when you outkick the coverage to a certain extent. My fear going into the number was that they wouldn't really change their guidance. They would say our guidance last quarter was fabulous and we're going to stick with it. And that would have, I shudder to think what would have happened considering how built up the stock got. Another important thing to remember is traders react, investors consider. And so the traders looked at that number. I looked at that number when it came out and said, "Oh my gosh, I can't believe they came out with this." But as you thought about it and thought where the valuations were and how much the valuations have expanded, not just in the aftermath of last quarter's report, but in the weeks or two coming into this report, there wasn't really much left. And I think the investors who thought about it a bit more coolly than the traders who reacted, said, you know what, this is a pretty fully valued company, even with this new guidance. We're not going to chase into it. And so you didn't get the institutional follow through that I think you got, from the first round of buying, and without follow through and with perhaps a little profit taking, you end up with a messy kind of blah day that you ended up with yesterday.
All right, maybe traders wanted to get a little bit neutral into the Jackson Hole speech. Steve Sosnick from Interactive Brokers, great to get your insight this morning. Thanks so much for joining us. We are awaiting, obviously, Jackson Hole, and one of the conversations, Damien, we were having yesterday is whether the Fed would even consider moving the goalposts on inflation, right? I don't think so either. But I look down and see on the eco screen that we're getting UMISH inflation expectations out today. And 1 year out, it looks like the survey at least is for 3.3%.
Yeah, well, I mean, look, look, growth is slowing, credit is tightening, and it's not unusual to see unemployment at these really low levels before things roll over, So I take what Scott Sosnick is saying to heart, I mean, vol markets are really not reacting to some of the risks that I think are out there. What I wanted to ask was really, what do we believe the pain trade is for markets? Is it really long U.S. Treasury yields rising to the extent that we've seen in recent weeks? Can that extend? That's the real question for me.
All right, well, we have plenty of people to talk to about that coming up, including Dana D'Auria of InvestNet. She joins us at 7 a.m., an interview you don't want to miss, and we'll continue to build up to our coverage. The special edition of Bloomberg Surveillance with Tom, John, and Lisa out of Jackson Hole. That starts at 8 a.m. On this Friday. Good morning. This is Bloomberg.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Today, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Tune in for continuing coverage with a special edition of Bloomberg Surveillance live from Jackson Hole starting at 8 a.m. Eastern. Bloomberg, your global business authority.
We have to be cautious this time around because downside risks that we identified in June in our forecast have materialized. This is an inversion of what happened throughout the pandemic recovery, because usually we have been surprised in the upside.
There's Mario Centeno there, the governor of the Bank of Portugal, speaking yesterday to Bloomberg from the annual Jackson Hole Symposium. Of course, we're going to go out to Jackson Hole shortly, and Tom, John, and Lisa have special coverage for you all morning long. One of the things, one of the key factors that's played into inflation over the past couple of years that the Fed has been trying to deal with, as well as the Biden administration, is oil. We saw a big run up in prices at the pump that then came back down. Now we're back up to levels that we haven't seen in quite some time, as we saw a resurgence in the underlying barrels of crude as well. Amrita Sen, co-founder and director of research at Energy Aspects, joins us this morning out of Italy for a look at what is going on in terms of oil. Amrita, you know, the march up made sense to me as we have the Saudis and Russia tightening supply. On the other hand, we see some weakness, which also makes sense because the resurgence of the Chinese economy has been far weaker than expected post-COVID. So what's your general view of the oil price now at, I mean, $85 a barrel for Brent, essentially $80 a barrel for NYMEX crude?
I mean, look, you're exactly right in saying that there are quite a few pull and push forces. It's not a very clear that this is like a very bullish market or a very bearish market. I think what I will highlight, though, is that fundamentally, the Saudi cuts and the OPEC Plus cuts have been instrumental in getting crude inventories drawing. We are looking at potentially record draws in August for inventories overall of around 4 million barrels per day. We've rarely seen a monthly draw of that sort. But and you know, I think that's partly why there's a lot of skepticism in the market. Everybody keeps asking me, oh, but these cuts can be reversed. And I mean, I will maintain that I think Prince Abdulaziz in particular is very keen to make sure that we don't have inventories rebuilding. So it's not that they're just going to reverse the cuts overnight. And he has highlighted that. But even if you take that away, I think the thing that the market is missing is just how tight oil products markets are. And you mentioned gas prices at the pump as well. That has been going up, as has been diesel, because fundamentally demand has actually surprised to the upside significantly this year. Even China, right? The macro is weak, but oil demand is growing by 2 million barrels per day. And refining capacity has really struggled.
Amrita, I'm wondering if you could talk to us a little bit about the marginal producers both in oil and gas. You know, when I think of oil, you know, I don't really think of Iran the way I used to, but lo and behold, Iran has really re-entered the market and certainly impacting prices, at least at the margin. And then in gas, Algeria and the importance of that nation to the European energy supply. I wonder if you could just comment briefly on both those two countries within, you know, this world we now live in, this multipolar world where, you know, countries are being asked to pick a side between China and the U.S.
Yeah, I mean, look, the Iran thing on oil is interesting for the simple reason that everybody's been talking about, oh, what could Iran bring back should sanctions be lifted? The U.S. administration has taken an active strategy to not really enforce the sanctions. So Iran has been able to surprise us and the market this year. They are exporting quite a lot. I mean, we think production in Iran is almost 3 million barrels per day and rising further into year end. And I think that's where, in some ways, even if sanctions were to get lifted, it's not going to really make a difference because Iran is producing what it can right now. And yes, you're exactly right. I think that has been the one miss this year for oil market watchers, where supply has outperformed expectations, and that has definitely had an impact on prices at the margin. Similarly for gas, I mean, right now, the big news, of course, has been the Australian strikes or the potential threat of Australian strikes, and that had buoyed gas prices across the board, TTF and JKM. And we've been saying for a while that, look, we don't think, especially if the strikes don't materialize, we are going to get European gas prices come off. And again, Algeria is supply-wise, I think Europe is being given plenty of supply, be it from Algeria, be it from the Middle East, or even from the US. Stocks are actually brimming. It's a complete contrast of what had happened last year this time.
So Amrita, despite the Woodside strike being averted, you know, it's my understanding that Chevron's two downstream Australian facilities, I believe Gorgon and Wheatstone, and we're not quite out of the woods yet, are we?
Correct. And we're not out of the woods yet. But I guess the market is a little bit more hopeful given that at least one of the strikes have been averted. But no, we are watching that very, very closely, what happens with Chevron, because obviously that is going to have a material impact in terms of gas flows out of Australia, but also condensate. It will actually at the margin have an impact on oil as well.
How important is the recession, the on-again and off-again recession we see in Germany and Europe, maybe getting worse? Because unlike Americans, if the economy's bad in Europe, they can leave their Volkswagen Golfs at home and get on a train.
Yeah, very true. But I think that they have pretty much, most Europeans have probably already left their Volkswagen at home and they do take the train. And what is fascinating for me this year is, we've been talking about a recession, and whenever I'm talking to you guys as well, it's been like a 12-month thing now, right? We keep talking about this recession, and yet oil demand has been around. Like at the start of the year, we were expecting demand growth to be 1.3 million barrels per day. Right now, we are tracking 2 million barrels per day for the year. That's how much it's surprised by. And that is, again, it's China, US, and Europe, the three places where the macro data is absolutely appalling. I think you're at a point, particularly in places like Europe, where it's baseload demand, right? It's not that people are driving to pick up milk. It is the bare minimum people need to go to work, and industrial demand, which is already, by the way, in the gutter, and whatever little demand there is out of that. I think that's kind of been the main driver. In Europe, one thing I will say is that low prices has meant people have restocked, like at the consumer level, people still tend to use heating oil. They've restocked a little bit over the summer, so that's probably boosted artificially demand somewhat, but that's still small at the margin, right? I think overall, what you are seeing is the consumer is still holding up very well, but industrial demand has been weak.
Amrita, global oil inventories are at a 6-year seasonal low. Where do we see oil prices headed from here?
I think prices are going to head higher, probably towards $90. We do have refinery maintenance, which is seasonal, always happens, but the pace at which inventories are drawing, and my belief that OPEC Plus and particularly Saudi Arabia want to ensure that that continues and we don't get into oversupply, does suggest that they're going to keep cuts going, at least partial cuts, if not the full cuts, going into year end. That does tell me that inventory draws will continue counter seasonally, which should push prices higher. I am still more concerned about diesel and gasoline prices than crude, because I think they are already trading at crazy levels, and that could go up even further.
All right, Amrita, thanks so much for joining us. Amrita Sen there of Energy Aspects talking to us about the oil price. One of the things I thought was interesting that she mentioned to us before coming on the program was the flows.
Yeah.
We've seen so much money flow out of USO, which is the biggest oil ETF, $180 million out of there in one day on Wednesday. And if the flows go like that, you can expect to see the underlying fall as well.
Well, I mean, I'm just looking at the weather outside, Matt. I mean, record heat waves in Iowa, in Texas. My question, and I really wish I had a chance to ask Amrita it, is can the grid handle it, right? I mean, this climate change is real, and we're feeling the brunt of it, and it's not reflected in energy prices right now.
Yeah, for sure, the grid cannot handle it. And if we continue to get that kind of heat, and in the winter, everybody's starting to, it gets cold in Texas now, which sometimes, which hadn't happened so much before, and that is a problem for the grid. If we all plug in our EVs, that also is going to just add to the issues. So we've got to really boost our capacity in terms of those grids. Later today, don't miss Tom Keen's interview with ECB President Christine Lagarde, talking about what's going on in Europe. He is live from Jackson Hole, obviously, all morning. But then at 4 p.m. on Bloomberg Television and Radio, he will talk to the president of the European Central Bank. This is Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest for the, if they invest for the right reasons, just keep at it.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only will remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
This is Bloomberg Surveillance. I'm Matt Miller alongside Damian Sassower. Tom, John, and Lisa will be with you from 8 a.m. New York time. Special coverage live from Jackson Hole, straight through noon, straight through the Powell speech. So I'm really looking forward to that program. Right now, what we're looking at in terms of markets, you have S&P futures bouncing a little bit after the big drop yesterday. We were down more than 1% on the Dow, the S&P, and the NASDAQ yesterday, almost 2% drop on the NASDAQ. I think 1.87% was the loss. So now we're looking at what could be a little bit of a dead cat bounce. Traders, I'm sure, are going to be sitting on their hands until they've heard what Jay Powell has to say, for the most part, maybe even turning off the computers this morning. So very interesting, going to be very interesting to watch. Definitely the event of the week, overshadowing what we saw from NVIDIA after that kind of fizzled out yesterday. Euro dollar at 107.97, so essentially 108. We heard a little bit earlier that maybe the technicals support a higher euro, a lower euro dollar, I should say. 105, 106 is what we've been hearing from people throughout the past couple of days. Steve Sosnick from Interactive Brokers confirmed that. In terms of the yield, we've been all over the place this week. We were up to 434, the highest level since 2007 on the 10-year. We've been down below 420. Right now, we're looking at 4.25, and there for sure, traders are waiting to hear what Jay Powell has to say. And then NYMEX crude, $80 a barrel, 80.09 right now, holding steady right around there. We just heard from Amrita Sen that demand has been, demand has been consistent even with recession concerns in Europe. It's been stronger than the macro picture in China, but there's a lot more supply coming online. Under surveillance this morning, investors awaiting, obviously, Fed Chair Jay Powell's speech from Jackson Hole, looking for clues on the central bank's economic outlook. He's set to speak at 10:05 Eastern time. And then later on, Tom Keene has got an exclusive interview with ECB President Christine Lagarde. She's also out there in Wyoming. That comes up at 4 p.m. Eastern. And clearly, Damian Sassower here with me. Clearly, markets are waiting for this. You're not going to see much volume until the speech.
I think the markets have it right. It's going to be today's Powell comments. It's going to be about data dependency, obviously, and it's going to be about moving slowly. The real question is, can Powell communicate that without sounding dovish? So really, the ball is squarely in his court. I mean, think about where we were just last year at Jackson Hole last year. Recession indicators were calling 100% probability of a recession within the next 12 months. I think Bloomberg Economics was saying much the same thing now. I think the consensus now is that we're in for a soft landing.
Anna Wong's model was calling for a 100% chance of recession this year, which I thought was, pretty aggressive.
Yeah, well, I mean, look, she wasn't alone, right? And so my point is, now, if you look at most recession indicators, they're calling for a soft landing, So something's obviously changed. Let's see if Powell can deliver and not,
Yeah,
mess up the message.
I mean, look, last time he said September's live, he said they won't cut rates for years. So he is certainly more hawkish than the dot plot, for example.
Yeah.
Former President Donald Trump is back on Twitter. we're supposed to be calling it X now, but I don't think that's really going to stick. He posted his own mugshot in his first tweet on the site since he was banned in 2021. The post came after he was booked in the Fulton County Jail in Georgia last night. If I read the story right, the former president spent 20 minutes in jail. I don't think that means he was in a cage. But I think, I got to say, a little editorialization here on style. Great mugshot.
Yeah, it's a great mugshot. I mean, look, Matt, the real question I have is President Trump or former President Trump back on Twitter, X, whatever you want to call it now? He used to have 86 million followers. He only has 6.7 million on Truth Social after the Tucker Carlson interview this week on X. I mean, is the former president back on X?
It looks like he's back.
Back on X.
And I know what I want to call it. Not X. China unveiling new mortgage policies aimed at halting a slump in its residential property market. The rules include more support for home buyers as they look to revive the world's second largest economy. And China has been, I think, slower than many market participants have expected in terms of the stimulus.
Yeah.
They are asking big banks to lend more, certainly in terms of mortgages. What's the story here?
It's not just big banks. They're asking to lend more. They're asking foreign investors to invest more. They've called a meeting. I think Goldman Sachs, Fidelity, some other big institutional investment managers are being invited to talk about why are they retreating from local equities in China. And so that's interesting. They've also offered, I think, to cut the stamp tax, the duty tax on foreign investment in stocks. So by cheapening the ability to invest in and own Chinese stocks, clearly there's some issues there. They want to bring foreigners back into the fold.
Let's, talk a little bit more about this. We've got Ian Shepherdson with us now, chief economist over at Pantheon Macroeconomics. And of course, I want to get to the Fed and the important speech from Jay Powell today with you, Ian. But first on China, we expected them to do a lot more after the reopening seemed fairly lackluster. Amrita Sen said to us just moments ago that at least gasoline demand is stronger than the other macros in the economy. What's going on over there, and what do you expect from the authorities?
Well, I think that the story of a really disappointing post-reopening rebound is real and will be sustained. I don't really see anything in the domestic economy to turn that around anytime soon. But the policy response, as you say, has been kind of piecemeal. It's been no sort of big bang events like we saw, after the crash in 2008 when China was extremely aggressive with huge stimulus. We haven't done that this time around. It's been much more gradual, much more let's try this and see if it works, let's try that and see if it works, and cross our fingers. And I think that probably continues for a while yet. Now, whether later down the road they are forced to do something much more aggressive is a kind of an open question, but the backdrop for all of this, I think, that everyone needs to appreciate is that China has some fundamentally really quite big problems which aren't going to go away anytime soon and aren't going to be fixed by small cuts in interest rates and shouting at banks to lend more to potential mortgage borrowers. They have a massively overburdened, massively over-indebted private sector. The public sector isn't, so they can't afford to bail it out if they need to. But the private sector is carrying this enormous burden of debt. The consumer doesn't want to spend. There's excess capacity in the manufacturing sector, so prices are falling, so that's hurting profits. It's a really big mess. Plus, of course, the problems with the commercial developers that we all know about. So can this be fixed quickly? No. Will it require more policy response? Yes. Are we going to wake up one day and find they've done something massive? Well, no sign of that yet.
We have, there's a great piece on the Bloomberg today by Liz McCormick about the fact that our current president here in the United States and the previous president have opted to, just pour fiscal stimulus into this economy. Right now, even though we're not in a recession, we're going to run a $1.6 trillion deficit. Is it possible that while Biden and Trump have opted to run the economy hot, spending trillions and trillions of dollars and building up a ton of debt, the President Xi is trying to break China's addiction to stimulus, trying to pull back on the debt-fueled growth model of his predecessors?
Oh, I'm sure that if he could wave some sort of magic wand and get the economy to grow more quickly, more sustainably, without aggressive fiscal action, then he would do it. And that's what they're doing right now by this drip-feeding the interest rate cuts and putting pressure on lenders and trying to attract foreign investors back into the stock market. These are all kind of in place of doing something more drastic. And they don't want to throw the consumer a huge pile of money. Their view is that when European and the US did that during the COVID pandemic, that was a mistake with consequences. They don't want to get people addicted to fiscal stimulus. But on the other hand, they do have to keep the economy growing. You know, the last thing that the Chinese government wants to deal with, you know, is tens of millions more unemployed young people. I mean, they've stopped publishing their youth unemployment rate. That's not an accident. It's very high, and it's likely to rise further. So there is a limit to how far they're willing to run this experiment of not doing more aggressive stimulus. Of course, what we don't know is where is that limit? When will the stimulus be ramped up, and what form will it take? Clearly not yet. I mean, they're still in the let's try and do this in a piecemeal sort of mode, but there is a very clearly the Chinese authorities' position depends on maintaining some degree of growth in the economy. Now, that the about 5% target for this year is going to be very difficult, so they'll have to do more.
Dr. Shepardson, I wonder if you can square all that fiscal stimulus in the U.S. that Matt is referring to, the CHIPS Act, the Inflation Reduction Act, with student loans here in the U.S. and what the more immediate impact will be on inflation and on productivity.
Yeah, so the impact of the CHIPS Act and the IRA has clearly boosted commercial construction in the U.S., manufacturing construction's boosted manufacturing jobs. It's been quite a big event. But at the margin, of course, that becomes less important going into next year. The big bang for the buck comes in the first year. And from October, of course, the student loan repayments start again, which is about 1% of personal income if people choose to start paying it all off at once, which is a big hit. You know, consumption is 70% of GDP, and taking out that amount of money from the economy overnight potentially is a threat. And this is why I'm very nervous about all these sort of blasé declarations that, well, the recession risk is over, it's definitely going to be a soft landing, we don't need to worry anymore. That makes me nervous. You know, we just don't know how people are going to behave when the loan repayments start. We do know that the excess savings that people built up during the pandemic, which was as a result of very generous fiscal policy, though 3/4 of that money is now being spent. Plus, of course, what everyone doesn't want to talk about, the Fed's raised rates by 525 basis points, and lags are a thing. It takes time, and longer than markets want it to take, and longer than the media wants it to take, for interest rates to work through. So I think the idea that we've now suffered all the pain we're going to feel from those rate hikes is delusional. Whether the lagged effect is enough to trigger a recession, it's a different question, but I think it's far too premature now to make the judgment that the risk is over, that's for sure.
Dr. Shepardson, do you feel that markets currently underestimate the Fed's determination to normalize policy? And if so, what does it mean for 10-year yields?
Oh, I think markets get it now. I mean, there was a period, you know, last year when markets really didn't get it, and I think Chair Powell, including the Jackson Hole speech last year, made it very clear the Fed would do whatever it takes. Now that inflation is falling, unambiguously, the core rate's coming down very nicely, and even some of the sticky things in services are looking better now. So my guess is that this track will continue. I don't think it's just some sort of flash in the pan. I think it's a sustained disinflation. But I don't expect Chair Powell today to declare any sort of victory. I think he will want to retain optionality just in case things go wrong again. I mean, you know, we've been disappointed over the last couple of years when we get good numbers followed by bad numbers. So we've all learned that lesson. He's not going to say we're done. He's not going to start promising rate cuts anytime soon. But I think ultimately there comes a point in every economic cycle where the market says, oh, okay, Fed, you know, you're talking tough, but actually we think that you've done what you need to do now. And at that point, we see yields rallying. So I see a fair bit of scope now between now and the year end for the 10-year to make a fair bit of progress. I'd be really disappointed if we didn't get, you know, meaningfully below 3% by the end of the year. And I would hope that by the time we get to the middle of next year, it'll be more like 350. So definitely improving. But again, we just need to be cautious. Chair Powell is not going to wave the victory flag today.
I think we all agree he's not going to change the inflation goal as well. 2%, he'll keep it there. But why would they want to raise it anyway? I mean, it's a regressive tax on the poor. It's as violent as a mugger, as frightening as an armed robber, as deadly as a hitman, according to Ronald Reagan. Why would anyone think it's okay to run inflation at 3%?
Well, I don't think it's okay to run it at 3. I mean, I probably wouldn't object if they raised the target to 2.5. 3 makes me a little bit nervous. I mean, remember when the target was set at 2% back in 2012, inflation was persistently below that level. So it was an idea that it was a signal that we would get it up rather than, you know, run the risk of a Japanese-style deflation, which was, you know, a significant concern for quite a while. So the context has changed during which the inflation target was set. Lots of other countries have targets which maybe are in a range 1 to 3, something like that. Seems to work perfectly well. But I completely agree with you. Sustained inflation is a really bad thing. Even Keynes, the much maligned Keynes, said that inflation is the easiest way for governments to rob the people, and that was right. Sustained inflation that changes behavior is a very bad thing, but it's not clear to me that 2.5 would do that. 3.5, yeah, I'd be nervous about that. But the 2 target maybe is just asking a bit too much to maintain in the medium term. We're in a different world from when those targets were set.
Yep. Well, that's what the symposium, I think, is all about, structural shifts, right? Dr. Shepardson, thank you so much for joining us. Really appreciate your commentary. Ian Shepardson there of Pantheon Macroeconomics. Now, Tom, John, and Lisa will be live from Jackson Hole with a special edition of Bloomberg Surveillance starting at 8 a.m. Don't miss that show with Jay Powell's speech, plus the Peterson Institute's Adam Posen, Kristalina Georgieva from the IMF, Philadelphia Fed President Patrick Harker, and insight from Bloomberg opinion columnist Mohammed El-Arian. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
If there was ever a soft landing, taking 6 percentage points off the headline inflation rate without an increase in unemployment would sound like a soft landing to me.
That was Jim Bullard, former St. Louis Fed president, speaking with Bloomberg's Mike McKee yesterday. Mike was in Jackson Hole. Bullard was at Purdue, where he is now the dean of the business school. Really interesting conversation, and he brought up maybe a new inflation regime as well, which we're going to talk about in just a moment with Cameron Kreis. Right now, I want to take a look at the markets and where we are. Just about 3 hours, a little less than, ahead of the market open. But you can bet there's going to be very low volume and traders kind of sitting on their hands until we get through that Jerome Powell speech at Jackson Hole. Right now, S&P futures pointing up about 0.3%. You've got the euro a little weaker against the dollar, as is the pound, but not a big move right now. Still at 108 on the euro dollar. 10-year yields creeping very slowly higher, holding at about 4.25, where we finished the day yesterday. And NYMEX crude also kind of holding a level at $80 a barrel. We see Brent at just under 85. So I think wait and see is what we're doing right now. Let me bring in Bloomberg's Cameron Kreis to talk about what to expect from Jackson Hole. And Cameron, I was reading a lot of your work last night, fascinating stuff, and it reminded me of an interview that Tom Keene had done with Claudia Sahm a couple of days ago, where she said to her the most important or most interesting thing would be a discussion about a change in R-star, which I thought was already like an ephemeral, abstract, idea anyway. But is it the case that everyone kind of agrees what it is now and that we're going to raise that forecast today?
Yes, it is ephemeral, but when did that ever stop academic or policy economists from talking about it? I would say no, it's not the case that everybody agrees what it is. Certainly, the FOMC seems to think that it's still 0.5%, given that that's the dot plot median and has been for some time, although the distribution of those dots have moved up somewhat. A couple of weeks ago, the New York Fed staff released a paper suggesting that looking at a couple of different models, one of which had R star, I think, up to like 1.8%. And again, this is the neutral real after inflation level, the policy rate. Another of their models had it at 0.7%. So it's kind of like a carnival barker. Pick a card, any card. Pick an R star, any R star. What I think is fair to say, though, is that the 0.5% implicit in the Fed's dot plot looks awfully low compared to what those New York Fed models suggested, and also what we've seen empirically in the economy. If the neutral nominal rate really were 2.5%, or the real, we would have expected the economy to perform much, much worse than it has done over the last year and a half as the Fed has put rates up so aggressively. And the fact that it hasn't, I think, is a testament to the fact that something has changed. And, to quote the title of the symposium, that maybe there has been a structural shift away from the sort of post-GFC regime of very low inflation, very low nominal growth, and very low neutral interest rates.
Yeah, ever since I was a kid, I've been obsessed with this neutral real rate of inflation, mainly because on the Bloomberg terminal, Damien, if you type in TAYL Go, you get the Taylor rule. So you can see where, John Taylor's rules estimate that the rate should be the Fed's benchmark rate, and you have to plug in your own variables, right? So you can plug in what your own NAIRU is, which I've always also found really interesting, and your own neutral real rate. I've always used 2%, but apparently now I think consensus is more like 2.5%, and if that moves up, it's going to change everything. Right now, my Taylor rule estimate shows that we should be at 7.65%.
Well, that's if you listen to Ian Shepperson, 2.5%. I think, look, it only makes sense that we should be talking about the Fed ahead of Jackson Hole here. For me, there's a lot of other central banks that carry a lot of great meaning, and we have Powell at 10, but we also have Christine Lagarde at 3 p.m. So for me, Cameron, I wonder if you could tell us
4 p.m.
Is it 4 p.m.
Eastern time?
Sorry, he's
Eastern
right.
time.
That's my bad. But 4 p.m. Eastern time, and given the Euro PMI data that came out, Cameron, and all that's going on in the world, I wonder, does that carry a little bit more weight for markets than Chair Powell at 10? I wonder what your opinion is on that.
Well, no, if not, for the simple reason that the U.S. is still the world's biggest economy. The Fed's still the world's most important financial institution, and very prosaically, markets are shut when Lagarde's speech will hit the tape. And obviously they're wide open when Mr. Powell's does. Clearly, Europe is at something of an inflection point insofar as they put rates up much, much more aggressively than anyone would have thought possible a year and a half ago. And unlike the U.S., the impact seems to be feeding through more vigorously. As you alluded to, the PMI data was pretty execrable a couple of days ago. That being said, inflation remains more elevated than it does in the U.S. So that's kind of an unfriendly trade-off that the ECB is having to confront. They will need to sacrifice more growth to get inflation back down to target. We've had some of the usual leaks this morning from ECB sources suggesting that the arguments are building for a pause, but that nothing is decided yet, which, that and $5, I guess, will get you a cup of coffee these days, or €4 or €5 or however much it costs in Berlin or Frankfurt.
So Cam, for me, I guess the question is, in your opinion, what's the biggest pain trade for markets? We saw when U.S. long yields, 10s and 30s started to spike higher. We felt the pain there. Is it U.S. Treasuries? Is it the dollar? Is it the Japanese yen? I'm curious to hear your thoughts on that.
Well, I guess the rejoinder question is, are we talking about sort of short-term traders, or are we talking about investors?
Yes.
Right? Because investors tend to have long-only portfolios. So obviously the biggest pain trade in that regard is asset prices continuing to fall. The equity rally this year, I think, took a lot of people, including myself, by surprise, not only in terms of how it shot out of the gate, but the magnitude that of what we've seen. So I think at this point, given sort of tactical investor positioning, probably the biggest pain trade out there would be technology going back to where it was 12 months ago. And I think the reaction to yesterday's NVIDIA earnings, which were clearly very, very good.
Sure.
And the guidance was clearly very, very good. And yet the stock opened up a lot and closed more or less unchanged. I was just looking, I think the 500 calls expiring today, they opened at, I don't know, $15 or something, and they closed at 26 cents. That's pretty painful. So I would suggest that the pain trade is that everyone who's been buying these short-dated options that drive the market higher suddenly finds that money starts turning worthless. And as interest rates continue to adjust higher, then we find that this entire equity market rally this year turns out to be something of a head fake. Will that be the case? Quite possibly not, but certainly that would hurt a lot of people, I think.
Looking at the Starbucks in Berlin, Cameron, right on the Brandenburg Gate, looks like a venti latte, which is my go-to, is €5.30 right now. But
I can't drink that stuff, man.
Well, I mean, if you're just looking for a filter coffee and you want to go with a grande, then you can get it for $3.19, which is pretty good.
Okay, that's my jam. Okay, $3.19, that's not too bad.
Cameron Kreis, great having you on the program. Thanks so much for joining us. You can read his Macro Man column on the Bloomberg terminal, or check it out if you go to the website, Bloomberg.com. Fascinating stuff. Gets pretty wonky. Cameron gets pretty wonky.
No, I mean, I would have taken him as a strawberry acai refresher kind of guy, but that's or maybe a Kai latte, iced something or other. But Cam's great. I mean, look, interesting that he says the pain trade, and he's right. I mean, the market value that's been made in U.S. equities, that makes sense. If that reverses in on itself, I guess there's going to be a lot of money lost.
All right, coming up next, we're going to talk to Dana Dioria. She joins us from Envestnet. Get her view on what to expect out of Jay Powell and Christine Lagarde at Jackson Hole. The main event with Tom, John, and Lisa starts in 1 hour at 8 a.m. This is Bloomberg.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
They're brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
We've had the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
What's been supporting equities, despite the higher rates that we're seeing, is actually the earnings.
A lot of people, a lot of companies are not feeling the pain of these higher interest rates.
I still think the probability of a recession is quite high.
I actually think we're on the cusp of a seminal change in Fed approach to targeting inflation.
Jackson Hole, if you're a bond investor, is the kind of main event this week.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning from New York City. For our audience worldwide, this is Bloomberg Surveillance. Alongside Damian Sassower, I'm Matt Miller. We're filling in because Tom, John, and Lisa are in Jackson Hole. But don't fret, they'll be along in just about 60 minutes' time. We've got special coverage with the OG surveillance team starting at 8 a.m., and that'll go through Jay Powell's speech into the afternoon. In fact, Tom has an exclusive interview at 4 p.m. With Christine Lagarde of the ECB. So a lot to cover today and a lot, I guess I was going to say a lot going on in markets, but actually that's not true. There's not much at all going on in markets right now because I think people are waiting, right?
Yeah, absolutely. And I think, look, if you just look at how great a quarter it's been economically speaking in the U.S., I mean, we're tracking at, I think, 4% growth here in the third quarter. I think the Atlanta Fed is at 5.8%. And again,
5.8%, yeah.
5.8%, and unemployment's at what? 3.5%. Go figure.
Yeah, New York Fed at 3.8%. So there's a big delta there, but it's still better than a stick in the eye, no matter how you look at it. Dana Dioria joins us right now, co-chief investment officer over at Envestnet, to give us her take on, I guess, first of all, Dana, what's most important to hear from Jerome Powell at Jackson Hole? He seems to me already to have told us, like, September's a live meeting. We still need to nip inflation in the bud. We're not done with that. And we're not going to cut rates for years. So
That's right.
What's new?
Well, I think that may be why you're not seeing much movement in markets. I think pretty much what Chair Powell is going to tell us has already been priced in. I don't expect any surprises from him today, right? I mean, he is completely empowered. If you look at the minutes, FOMC minutes from July, they were already striking kind of a hawkish tone. Inflation has come down since then, but at the same time, most economic indicators have come in pretty good. GDP blowout, basically, compared with what was anticipated. As you're discussing, growth looks fantastic right now. So no recession yet. I think Chair Powell is pretty empowered to just continue with the tone that he's had all along, which is to say, look, I'm going to look at the data. I'm not going to tell you that we're done, notwithstanding some of the other comments that we heard yesterday.
is the growth that we're looking at right now concerning, because that means inflation could be reinvigorated? Is this boom going to be a problem, leading to more rate hikes, leading to a bust?
Yeah, it could. I mean, you don't want to say growth is a bad thing, right? I mean, it's fantastic that the economy has been so resilient. Who would have predicted? If you look at it, beginning of this year, pretty much every pundit was saying, expect a recession in the second half. And it's not that I, practically speaking, think that we're past that necessarily. To a certain extent, that could just be pushed out a bit. But the resilience of the economy has been fantastic. It does, of course, mean that the Fed, whose mandate is inflation and unemployment, just may want to hold on longer, right? And exactly what they've said, whether we get a rate increase in September or not, expectations of a rate decreases are just probably too early. I mean, unemployment remains low. The economy is doing well, and the Fed knows that inflation tends to come in waves, right? That kind of looks good, but we know what's happening in wages, we know what's happening in energy. These are signs that inflation could come back, and there's no reason to think that the Fed is not going to want to have a firm hand on inflation. So I think it's entirely possible we get another hike.
Dana, I agree with you. I agree with everything you're saying. The economy is healthy, and the markets have really priced in much of the same, right, as it relates to Chair Powell and Jackson Hole. But to deliver that message, to deliver the message that we are going to pause in the face of economic growth, again, third quarter running at 4% with unemployment at 3.5%, the messaging, how are you going to thread that weave? How does Powell thread that weave? And are the markets prepared if he messes up the end game?
I think he's got the wind at his back. I hear you on this. And yes, the messaging, I actually think Christine Lagarde has a more difficult, thread or needle to thread, so to speak. But I think Chair Powell can stay pretty hawkish, and the market is not going to get surprised by that. Well, I mean, he's been, right? We saw the minutes, and it's been clear sailing since the last, the FOMC minutes. So I think the market fully expects a somewhat hawkish tone from him. I think he'd have to go pretty far to, kind of upset the market at this point. And he may well, given some of the comments that we've heard, he may well talk about, hey, look, we could have a pause, right? I mean, even a little bit of dovishness from him, I think, the market might actually agree very well. I think the market expects him to signal that he's going to retain a firm hand, that we're not going to blink in the face of, potential increases in inflation. I mean, the good news, of course, is that inflation really acted symmetrically, right? It went up very fast, but it came down very fast as well. So, I think he's got tailwinds here for today.
Dana, I love that you mentioned Christine Lagarde. I wonder if you could just build on that for us. What are the challenges that she faces in communicating her message?
Yeah, I mean, I think it's tougher for her because, of course, the economy there is not showing as much resilience, looking like it's slowing down. Definitely, I spoke about the fact that some economists think the U.S. economy is soft landing. Some, I get a lot of information from a lot of different sources. Some are definitely just pushing out the forecast and saying, no, we're going to probably have a recession, but it's just going to come a little later. I think Eurozone, just more of the statements are expect a recession. Obviously, growth is slowing there. PMI data that has come out, business survey data. So, but she still has an inflation problem to a certain extent, right? Or at least to the extent we do. So, does she do another hike before it becomes evident that it's really difficult for her to do another hike, right? Because before economics, kind of force her hand to stop on the hike. So I do think she has a tougher message. That narrative that you're talking about, I think is tougher on her than him.
If we look at the markets, Dana, as you do, right, at InvestNet, what are you doing? We ran up to 4,500 on the S&P in an AI kind of frenzy. It seems that, the market feels like all of the good, at least for NVIDIA and the rest, is priced in, the rest of the Magnificent Seven. So what do we do going forward if we are worried about the possibility of another hike and not optimistic about any cuts coming anytime soon down the line?
Yeah, I think it calls for some caution, right? I mean, we cater to advisors of retail investors, and I do a lot of talks, along these lines, economic talks, and whether you want to predict that there's recession, in which case probably obviously market volatility is still more to come, or you think there's a soft landing, maybe slow growth, whatever that is. I think, as investors, we're behooved to have some caution going forward. I think there's more risk to the downside in this market because, to your point, right? I mean, AI kind of comes in, but I think we all know AI may be, a huge boon to the economy. It may increase productivity dramatically, but that's not going to happen overnight, right? We're not there where we're going to see some great AI driven productivity gains in the next 6 months to a year. So, the AI that's been priced in, now it's kind of a waiting game on that, whether that's going to, amount to anything that actually impacts cash flows, that impacts revenues. So, yeah, you've got this priced in great outcome. Multiples are higher. Really, the returns from this year are largely multiple driven, right? And then you have these downside risks to the economy still. I mean, we're not past, we are seeing great data come in on GDP, earnings, obviously beat, but we're not kind of past, we all know just from history looking at it, monetary policy acts with a lag, and it's not uncommon for unemployment to be pretty low before problems in the economy start to fester. So it's not a prediction, but it's more, if you're an investor, kind of battening down the hatches and being ready for market turmoil is probably the smarter place to be.
Long and variable lags. Dana, you take what the market gives you, and one thing the market is giving us today are positive real yields. I'm talking 10-year real yields here in the U.S. of about 200 basis points. What are your thoughts on that? I mean, usually that's a negative for risky assets. I'm curious to hear your thoughts this time around.
Yeah, well, and also the dollar, right? Those are signs too that the markets are saying maybe there's trouble ahead. And don't get me wrong, it's not by any means my message that you should get out of equity markets. I'm actually, again, we work with advisors, and the job of the advisor, one of the main jobs is to keep the client disciplined in the market, so they're not obviously selling out at the wrong time. I think it's a question of your posture in the market. It's not a matter of get out of the market, because you could well miss some great additional upside, and you're not going to make that back. You're not going to time it right coming back in. But in the market, most retail investors, if they're not flat out, market weighted, they're in some sort of a actively managed portfolio that's probably low tracking error, right? We don't, I won't say closet index, but low tracking error to be expected. And if you're anywhere near market cap weight, you have a ton of these, technology, growth, communication, right? The enormous 8, magnificent 7, as you said. You automatically are going to have that just by being in market weight or close to market weight, which most of these investments are. So, what I would say to people is, to posture a little bit more defensively. Rates are telling us that, there's potential turmoil, and the bond market is a pretty good as indicators go, right? It's a decent indicator. So, quality type companies, even low volatility, right? These types of style factors where you can tilt a little bit. Again, not that you're taking on massive tracking error, but to the extent that you're tilting away from market cap weight, that's the direction I would be going in.
All right, Dana, thanks so much for joining us. Dana D'Auria there of InvestNet, talking about what she would do in markets. She points out that the bond market is a great indicator, and I go back to Cameron Kreis's Macro Man piece from, I think it was like 2 days ago. He has a great chart of the 10-year annualized growth in nominal GDP and the 10-year yields, and they track so well.
Yeah.
And now that we're starting to see yields tick up, you got to think nominal growth is going to go with it.
Well, I think it's that evisceration of the equity risk premium, right? I mean, the fact that, look, your risk-free rate now on a real basis, an inflation-adjusted basis here in the U.S. is more than the dividend yield or the equity yield you're going to find on stocks. I mean, you don't see that very often.
No, very interesting stuff. Let's take a look at what's going on in the markets. Right now, we've just got about 2 hours and 15 minutes until the market opens, but more like 3 hours until Jay Powell starts to talk. So you do have S&P futures up after a big drop, more than 1% yesterday. Futures gaining about 1/4%. Euro dollar unchanged there at 108.08. Which maybe that's good luck. The 10-year yield also unchanged, hanging right around 425 after bouncing back a little bit yesterday from under 420. And NYMEX crude just under $80 a barrel at 79.85. Brent crude, the global benchmark, is under $85 a barrel. So as I said, Tom, John, and Lisa are going to be here live. Well, not here. They're going to be there live from Jackson Hole with a special edition of Bloomberg Surveillance that starts at 8 a.m. and it's a show you don't want to miss because Jay Powell's speech will happen, I believe, 10:05 a.m. We're waiting for a 10:05 a.m. start for Jay Powell. Plus, on the program, we've got Adam Posen from the Peterson Institute, the IMF's Kristalina Georgieva will join us. Philadelphia Fed President Patrick Harker is on the show, and a friend of the program, Bloomberg opinion columnist and Queens College Cambridge president Mohammed El-Arian will be on the program as well. Then later today, you don't want to miss Tom Keene's interview, exclusive interview with ECB President Christine Lagarde. That again, live from Jackson Hole on Bloomberg Television at 4 p.m. Eastern. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. Today, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go.
Tune in for continuing coverage with a special edition of Bloomberg Surveillance live from Jackson Hole starting at 8 a.m. Eastern. Bloomberg, your global business authority.
What has taken place here is a travesty of justice. We did nothing wrong. I did nothing wrong. And everybody knows it. We did nothing wrong at all. And we have every right, every single right, to challenge an election that we think is dishonest.
Former President Donald Trump there speaking after turning himself in at Fulton County Jail. He got a mugshot. I'm not sure if he got fingerprints.
He must have.
I think, yeah, that was procedure. So maybe he had to get printed.
I mean, when I get arrested, I mean, they take my fingerprints.
Yeah, exactly.
Go all the time.
Same with me. Anne-Marie Hordern has never been arrested, I'm relatively sure. She is our Bloomberg Washington correspondent, joins us now out of the nation's capital. And we joke around about this. Obviously, it's very serious. A president of the United States has been arrested, essentially. He's been in jail, reportedly, for 20 minutes. He got his mugshot taken. We assume he got fingerprinted. And I guess this just goes and boosts his popularity with his base.
Well, it absolutely does. So it is an unprecedented moment in American history that you have a former president not just arrested. This is the fourth time he's been indicted. Showing up, he surrendered. As you say, Matt, a mugshot was taken. They recorded his weight and height. 6'3", 215 pounds. I cannot independently
215 pounds? I'm going to go ahead and call. No, that is not the case. I am 210. Is Donald Trump only 5 pounds heavier than me?
No comment.
Well, this is something that obviously, but yeah, this is something that actually people are debating on Twitter. But in all seriousness, this is actually what happened in Fulton County, Georgia, yesterday for about 20 or 30 minutes when the president showed up to surrender. He then went to the airport. He talked about how this was all a sham. And then within really minutes, you had his Super PAC campaign putting out fundraising alerts, and they're selling his mugshot on T-shirts for $34. So they are already monetizing this. And we do know that the Trump campaign does bring in a ton of money. And then he is using a lot of those funds from individuals that want to donate to his campaign to actually pay for these legal fees. And these legal challenges are just continue to pile up, and this being the latest.
All right. So this just, I think, supports his base, but maybe not Republicans who are on. By the way, I think it's a great mugshot. Not that it matters, but it's like a cool look. It doesn't matter to those who are looking for something else, right? And that's what the debate was all about. And I thought you had a fantastic interview yesterday with Nikki Haley. I thought a lot of her answers on issues were surprisingly different from the answers you would have gotten from Trump. In terms of the spending, government spending, she criticized both sides of the aisle. In terms of abortion, she said, while she's pro-life, she believes it's a woman's right to choose what she wants to do with her own body in terms of health care. So didn't you find that surprising as well?
Well, a lot of things that Nikki Haley said on the debate stage and also in our interview is really tailored as well to how a candidate on the Republican side would need to pivot in terms of a general election to gain independent voters. When you look at some of the stats following the debate and who won, Washington Post, Ipsos, they did at 538, they did a poll, and what they found is that DeSantis actually topped the stage, then Vivek Ramaswamy, and then Nikki Haley. When it comes to independence, Nikki Haley, the former UN ambassador, the former South Carolina governor, did very well. And it's issues like this, like abortion, that we've seen really dominate when it comes to moderates and independents and whether or not they want to go out and vote and who they're going to vote for. What you had on stage is a lot of individuals that want to talk about a 6-week ban, a 15-week ban. She said to the American people, we should be honest about the fact that there can never be a national ban because we just don't have the votes in the Senate. So she was trying to find some sort of consensus on an item like abortion. And then when it came to the economy, she didn't just throw the Biden administration out the window when it comes to spending. She also criticized the Trump administration, which, by the way, she worked for. She said $8 trillion was added to the federal debt under Trump. And she also talked about individuals on stage who voted in Congress to add to that debt. Ron DeSantis, Mike Pence. So she really took aim at everyone, and this would be how an individual from the Republican Party would have to start to pivot in a general election to pick up those independent moderate votes.
Anne-Marie, let's get serious for a second here. Interest payments on $1.6 trillion in student loans begins reaccruing on the 1st of September, right? A group of 90 Democrats, including Schumer and Warren, are petitioning Biden to do something about it. You know, I'm curious, at this stage, is there anything Biden can do to stop the September 1st deadline? And more importantly, what's the risk of doing nothing?
Well, the December 1st deadline is around the corner. I think what the Biden camp probably wants to do is say we gave it our best shot. The Supreme Court, of course, recently struck down what their plan was to help individuals with student loan debt, about, I believe it was up to $20K per person. And they can campaign on, we will continue to try. It does seem like it is too last minute as these repayments are going to be due. They have been frozen, remember, since the Trump administration. Trump, during the COVID economic hit a lot of individuals were facing, froze the student loan payments. But I should note, it's not just coming up here in Washington. on a lot of analyst calls from businesses, it is coming up. Levi's, Target, they're concerned that a lot of discretionary spending that individuals had because they haven't had to pay things like student loans, that's going to start to bite in the fall.
You know, mortgage debt is due as well.
Yeah.
I have interest payments on my mortgage. Do you think they can cancel that? Do we just cancel all debt?
I'll have Tom make
don't
some
you,
calls.
when you agree to a loan, don't you then have to pay it back? I don't understand why we're trying to wiggle out of this.
Well, I'll tell you this, you know, I mean, the reality is, and Anne-Marie, I wonder if you could just help me with this one last thing. I have to put my emerging markets hat on for this. You know, sanctions on Venezuela, right? Removing sanctions for free and fair elections in Venezuela, the Maduro, I mean, come on, is that real or is that just trying to bring oil back online?
Well, I think it's probably twofold, right? The sanctions in Venezuela has absolutely crippled their oil market. You have concerns about potentially how gas prices may react going into an election year. But this is about if there was actual free and fair elections. We have seen Maduro in the past not allow free and fair elections. He's coerced individuals. So he would have to make massive concessions in terms of an election in order for any sanction relief. We should just say Bloomberg is just reporting that there are talks about this. We are not there yet.
All right. Anne-Marie Horton, thanks very much talking to us from Washington, D.C., our chief Washington correspondent on the Trump arrest and what we can expect from the Biden administration. A total of $17.1 trillion in mortgage debt.
Oh, wow.
I mean, if you want to start just wiping away debt.
Well, I mean, look, the 1.4 sounds like a much more manageable number, right? I mean, we just expand the Fed's balance sheet, we go right back at it. But I mean, look, you know, what's most interesting is how disinflationary the impact of those payments coming back online very well may be. So everyone's talking about upping the inflation target. I'm concerned inflation may come down even faster once these student loan payments start come back online. I don't know if the markets are fully prepared for that.
But we want disinflationary.
Yeah,
we're trying to get rid of inflation,
sure,
right?
We want a hard landing, right? We want a recession. I don't know if we want that, but that's kind of...
I think we want inflation to come back down to 2%, right? That's the generally accepted level.
Yeah.
And we're pretty far away from that still. If you look at the core PCE, it's more than double that. And that's what the Fed targets.
That data comes out next week. We'll see what happens there. But let's see what happens once these student loan payments come back. I'm skeptical.
All right. Well, we probably will see it because the Supreme Court didn't let him cancel those. Take a look at what's going on in the markets right now. We don't have much happening in futures right now, up 0.25%. You did have a drop yesterday of 1.5% on the S&P, almost 2% on the NASDAQ. So gaining back a little bit of that, it looks like, but we're all waiting for Jerome Powell at Jackson Hole. You can see the euro dollar at 108, the 10-year yield at 4.25, and crude trading at $80 a barrel. Don't miss later on today Tom Keene's interview with ECB President Christine Lagarde live from Jackson Hole. As Damien points out, she'll be giving a speech at 3 o'clock. We'll probably take that live as well. And then our exclusive interview with ECB President Christine Lagarde. That's at 4 p.m. on radio and television. Coming up, Tom Tesouras, head of fixed income at Strategas, a Baird company. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
The top names in global leadership are on Bloomberg.
When the dust settles, Israel will not only remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority.
This is Bloomberg Surveillance. I'm Matt Miller alongside Damian Sassower. Tom, John, and Lisa will be along in just about 30 minutes' time. They've got a live special from Jackson Hole. It's a show you don't want to miss, obviously. We're going to get the speech from Jay Powell. The markets may start actually moving at that point. And then later on, Christine Lagarde will speak, and Tom Keene has an exclusive interview with the ECB president. So very much looking forward to all of that today. Let's take a look at what's going on in the markets right now. The relatively stayed after the big drops that we saw yesterday. Frankly, pretty amazing drops considering the fact that NVIDIA had such a massive beat and we thought so much was riding on it. It finished the day unchanged. The S&P was down 1.5% and the NASDAQ was down almost 2%. So a little bit of a bounce on S&P futures, up about 0.25% right now. No change in euro dollar, no change in 10-year yields, and NYMEX crude actually coming up $1.06 to $80.11. Under surveillance this morning, investors awaiting Fed Chair Jerome Powell's speech from Jackson Hole. We're going to be looking for clues on the central bank's outlook, the economic outlook, obviously. That's at 10:05 Eastern. Jay Powell's speech at 10:05 Eastern in Wyoming. Later today, as I said, Tom has an exclusive interview with Christine Lagarde. That is at 4 p.m. Eastern, which is an hour after her speech. So she'll give a speech at 3. But the cool thing will be her interview.
Of course.
Because not only is that exclusive,
it's Tom Keene.
It's Tom Keene, also must-watch viewing. But, you know, he gets to actually ask questions. Yeah. So it's not just the speech she delivers, but he'll get to dig into that. And I'm very much looking forward to it.
Right, he's very prepared in the line of questioning that he typically asks, which we all know.
Yeah, well, it's definitely good television. And Damian Sassower here with me to fill in while Tom, John, and Lisa prep for the special. Let's talk about something that Damian knows very much about: China unveiling new mortgage policies aimed at halting a slump in its residential property market. The rules include more support for home buyers as they look to revive the world's second largest economy. And I say you are well versed in this because emerging markets is your wheelhouse. It's your specialty for BI. What do you think about this?
Matt, thanks for pointing that out. I am the chief emerging market fixed income strategist for BI in my day job. But, you know, for me, China's going to be all about growth. It's going to be all about the PMI data, which comes out next Thursday, which is going to be weak. And really the fact that they just can't get the consumer moving in the right direction domestically. I mean, households are in trouble. They're highly geared toward the property sector, which is in a funk. Just today, we're going to find out if Country Garden, once the nation's largest private property developer, is able to come to terms with its creditors, right? And the verdict is still out, but it doesn't look likely given Evergrande and some of those who have passed before it. Waiting to see that by the end of today.
Well, something that is key to markets, and we're going to continue to read your excellent research, BI Go, to find Bloomberg intelligence. I want to talk about something frankly near and dear to my heart. Watches of Switzerland plunging after Rolex revealed that they've bought fine jewelry seller Bucherer. The relationship between Watches of Switzerland and Rolex in a way is in question, given that the world's largest luxury watchmaker is now going to own its own stores. And this is key because Rolex has always said it'll be independent of retailers. That's why it's had such a good relationship with its authorized dealers, and this puts that relationship in question. Will it favor its own stores?
But hold on, Rolex does have one store in its home city of Geneva. So, you know, it's not like the whole retail. No, I'm kidding. It's going to be all new to them. I mean, getting their Daytonas, their GMTs, their Submariners out through a chain of what I think it's 100 stores at Watches of Switzerland. It's going to be interesting to see how things shake out.
Yeah, I'm going to be following this one very closely because we still have, you know, used Rolexes are still going for more than new Rolexes, because if you want a new one, you have to get in line, you have to know an authorized dealer, and you have to wait for months to get it. Tom Tesouris, head of fixed income research at Strategas, joins us right now. Strategas is a Baird company, and we're happy to have him here with us, especially on such an important day for fixed income. Tom, what are you expecting? What are you watching for, listening for from Jay Powell?
Well, I don't envy Jerome Powell today, because no matter what he does, the market's going to move. If he comes out and suggests that there's more work to be done, which is what I think he's going to suggest, then you're going to see very likely the front end of the Treasury curve moves higher, the dollar rallies, risk assets wobble, in particular banks, in particular discretionary spending sectors. If he comes out and somehow suggests that we're coming to an end of the tightening cycle and we see a light at the end of the tunnel, then pretty much everything except the U.S. dollar is probably going to rip higher. And that's a problem in and of itself, because that means easing financial conditions when it's very clear to us that we're not getting close to the end of the tunnel. We're at a point where inflation is getting sticky and could very easily reaccelerate, especially when you see crude moving higher and you see wages continuing to remain 4.5% to 5%. So no matter what he does, the market's going to move. But my hunch says he's going to side towards the hawkish side here and say that we have more work to be done, which we all know for the most part, but he's going to leave it open-ended what that means. And in particular, what that means is rate hikes could happen. They're probably done, but there could be more. But balance sheet reduction is going to continue indefinitely.
Yeah, I'm watching the wages picture also very closely because, well, Damo's worried about student loans coming back, but we've seen unions gain a lot of ground, starting with Deere, and we recently saw UPS, right? Those drivers are getting $170,000 a year if you include benefits, and now the UAW is going to renegotiate contracts with GM and others, and that's going to be absolutely fascinating. Where do you see the 10-year yield in this case? I mean, we're up above 430 at the beginning of the week. The highest level since 2007, which I thought was absolutely fascinating, higher than the great financial crisis. And we heard, actually, Larry Summers told our David Weston a couple weeks ago that he thinks 475 is going to be the decade average that going forward. I mean, that's pretty high.
Yeah, so let me put it this way. I am very surprised the 10-year hit a new high, cycle high this year. Not because I don't believe the fundamentals support it, but because I believed, and I still believe, that we're going to have a reversal lower, a recession before we hit that next cycle high in the next cycle. But with that said, the second wave of inflation has already started. As you mentioned, we've got wages rising and we've got wage inertia in the pipeline for years to come. So that tells us that the second wave of inflation is just, I don't know, 6 months to 24 months away at most. So eventually 10s should go up to those levels that Larry Summers is speaking about, a 4.75 to 5%. That would be consistent with nominal growth somewhere around 5%, 10s around that level. But the question is, do we have a recession before we get there? That's the real question mark. And that's not an easy question to answer, because that comes down to, when does the consumer pull back? Does the consumer pull back and stop spending spontaneously, or do we have to see credit cracks emerge to force the consumer to pull back? If you assume the consumer is not going to pull back, then absolutely it's higher on the 10-year yield until we hit that recession. And somewhere around 4.75 to 5, very reasonable in my opinion.
So sans a recession, 4.75 to 5% on 10 years, let's say by 2025, right?
Yep.
Is that going to be driven by break-evens or real yields?
Both. So break-evens logically need to move higher, and let's just focus on 10-year break-evens. So somewhere around a 3% seems to be a logical level because, one, that's where inflation is getting sticky. Two, wages are getting sticky above 3%. And there's a very good chance that in the next 2 to 3 years, the Fed pivots towards a 2 to 3% inflation target. So we got break-evens around 240 or so on 10. So a 50 basis point rise in break-evens, very reasonable. It's not a huge move, but that gets you up to 475. But with the move in break-evens, real yields need to probably rise a little bit. If not, then monetary policy is loose and you could have an even bigger move in inflation. So both.
So in that environment, tell me which fixed income asset classes are best positioned to be successful? You know, is it going to be MBS? Is it going to be munis? Talk to us about that.
Well, very likely the front end of the curve, short duration investment grade corporates, and that's not a particularly exotic call.
Yeah.
That's pretty much a safe haven for most investors, but that very likely outperforms in the short run, especially if the Fed only gets a few rate cuts in along the way, so the Fed funds rate only comes down to, let's say, 3.5% to 4%, because then it's not much of a move from 4% to, say, a 6% Fed funds rate. In contrast, let's say we have a recession, 10-year yields drop down to 350, and then we go back up to 5%. You're talking about a dozen percent to 15% loss in tens. So at some point in time, we're going to have another round of bond pain.
Duration losses.
Yeah, exactly.
And probably spread widening off the back of that, one would think.
Very likely. So a steeper credit spread curve as well. So the question, again, becomes, if you're long duration, you must be expecting a recession to come before we hit that second wave of inflation. And very likely, I do believe that recession is going to come, but that's really what you're expecting if you're long duration.
You know what, that recession comes, and yesterday we were talking to Michael Darden from MKM. He said he thinks junk is insanely expensive. Those were his words, insanely expensive. If we start to see defaults at a higher rate, isn't that likely, especially if the consumer is delinquent on loans and the student debt payments come back? I mean, isn't it likely that more companies are going to default, especially in the junk sector?
Very likely. We have gone through the last 2 credit cycles where outside of the bank space, you really have not had a clearing of the rot in the junk space. And so you've seen average defaults around 2 to 3%, when typically they're average 4%. So at some point in time, we're going to have a decade plus of 4.5% to 5% on average default rates. Let's say you got a 5% default rate, then high yield spreads at, say, 380 or so are way too rich right now. If you have a 3% default rate, which is slightly higher than we've averaged over the last decade, then high yield's not too rich. But I do think we're going to move back to about a 4 to 4.5% to 5% average default rate. High yield will prove to be too rich. But important thing about high yield and investment grade credit right now is that we are not seeing a need to refi any of those maturities, because much of that maturity wall is 2025 for high yield, more like end of 2024 and into 2025. So we're still earliest 6 to 9 months away from a big pickup and refinancings. When the new supply hits, that's when you see spreads widen, and that's when you start to see public credit begin to move into a space that's really not sustainable from a cash flow standpoint. We're not there yet, but we will be.
I love that you're focusing on supply here. We had that 30-year auction last week. We saw the 30-year TIPS tail yesterday. We saw the 2-year floating rate note. It wasn't so great. Talk to us about the plumbing of financial markets, specifically U.S. Treasuries. Talk to us about the TGA, the RRP. Does any of that give you cause for concern?
Oh, absolutely. And let's put this is a great backdrop.
By the way, the TGA is the Treasury General Account.
That's correct. Sorry.
The RRP is the reverse repos.
Thank you, Matthew.
Well, but my mom watches. People. Not everybody knows all this jargon.
That's right. So it seems insane to me that right now the Treasury is finding that it can't come to market without having to pay up, but we're expecting corporations to indefinitely not have to pay up. The Treasury is giving us a look at what's to come in the future. That is, the supply is no longer going to be very easily digested, whether you're a Treasury or a CCC. So what's happening here is you're seeing Treasury supply now entering the coupon stack. It's no longer T-bills. And now go to your question about the TGA versus the reverse repo facility. When the Treasury was blasting T-bills into the market from June to August, much of that, not all of it, but much of it was coming out of the reverse repo facility. So it was essentially sterilized liquidity buying new sterilized issuance. That is changing because the Treasury cannot continue to finance itself at 5.5% when it's got a 4.25% on 10s. That's not a logical strategy for the taxpayer. So they have to increase their coupon auctions. So we're starting to see that. And the market is saying once you open the floodgates on rising coupon auctions, there's more to come, and you're going to have a bigger and bigger concession. So again, the question is, do you have a recession before the supply jumps another leg? If not, then you're just going to continue to see the concession build in Treasury yields.
Until something snaps.
Until something breaks.
And the crowding out effect.
Yep.
Tom, great having you in the studio today. Thank you so much for joining us. Tom Tesaurus there of Strategas. Say hi to Jason and Chris and Dan for us. Great group of guys there at Strategas. We're looking at futures that are rising, but not substantially, just about 0.25%, and really little change in a number of other assets, except for oil, which is up 1 1/3%. Coming up at 8:30 a.m., Neela Richardson, chief economist at ADP, will join Tom, John, and Lisa in the Jackson Hole special. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions. Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
This reacceleration could put upward pressure on inflation, stem the disinflation that we're seeing, and instead delay plans for the Fed to change policy.
Former St. Louis Fed President Jim Bullard speaking to Bloomberg's Mike McKee yesterday, kicking off our Jackson Hole coverage. Of course, in just about 15 minutes, Tom, John, and Lisa will be along with special coverage throughout the morning. Take a quick look at what's going on in markets. Right now, nothing. Futures, after the big drops we had in the cash trade yesterday, up about 0.25%. The euro stuck at 108. The 10-year yield unchanged at 424, 425. We do have a little bit of movement in crude, and it's been interesting to watch oil move around. Right now, it's back up over $80 a barrel. This is for NYMEX crude, and we do see the global benchmark, Brent, just under 85. So that's really one of the few assets that we see moving, because I think traders are waiting for Jay Powell's speech. That's at 10:05 a.m., so 35 minutes after the market opens, and maybe then you'll start to see some volume on this Friday. Joe Livornia, chief U.S. economist at SMBC Nikko Securities America, joins us. He is, of course, a former chief economist for the White House National Economic Council under Donald Trump. Joe, great to have you on the program this morning.
Thank you.
In terms of what the Fed is going to say today, you just heard Jim Bullard there talking about the reacceleration in the economy, and we've seen estimates from New York to Atlanta that are, growth of 3.8 to 5.8%, and that could, the concern is, stoke inflation, get those embers turning back into a fire. What are you looking at, and what are you thinking about the economy and the inflation right now?
Two things. Thank you for having me, Matt. Two things. Number one, if you look at past recessions, it's not unusual for there to be one last gasp in economic activity right before the economy rolls over. In fact, we've had it about two-thirds of the time where growth is over 3%, and the economy then goes into recession either that quarter or the quarter after. So GDP tells us nothing about where we're going. Those estimates right now are based on just a little bit of data we have for the third quarter, and it's going to change. That's number one. Where I push back against Jim's comments are, if you look at the good side of the economy, the New York Fed has a supply chain pressure index. If you look at import prices from China, both of those series suggest continued and ongoing deflation in goods. So the goods part of the economy is going to continue to soften, number one. And number two, if you look at the rents, the Cleveland Fed has a very nice new rental turnover index. It suggests rents are going to collapse. So this notion, Matt, that inflation is going to remain sticky, I don't understand where that's coming from. The inflation trends don't every month go lower per se, but the trends are definitely weaker. And if you look at the yield curve, the index leading indicators, where borrowing costs are for mortgages, autos, credit cards, personal loans, tightening and lending standards, all that suggests the consumer is going to be coming under significant duress.
So, Joe, to be clear, you are a cynic of the soft landing scenario, and I am happy to inform you, you are not alone. So talk to me about what a hard landing really might look like. Is it going to be something shallow or perhaps more sinister?
Recessions typically are nonlinear events, so something has to happen while you're kind of sort of in what initially oftentimes is a very mild recession. For example, in 2008, it was very mild. The services economy, looking at the ISM, was actually recovering through the spring. Many were saying that the economy had avoided a downturn. GDP grew almost 2.5% in the second quarter. Bear Stearns was saved by JP Morgan. Leading indicators were turning up. Then we had Lehman. So what would have been maybe the shallowest recession ever became a very deep recession. This time around, it will depend in part on what the Fed does. If the economy starts to weaken further, as I suggest it will, what will the Fed do? What will happen on the fiscal side? The politics next year will not be good for growth, given the uncertainty in the election outcome. That could cause a freezing in, say, business investment outside of, say, a couple of hot areas like AI or, say, ESG. So it will really, to sound like an economist, unfortunately, it will really depend on what happens as we enter it. We can't say, I don't think anybody can say at this point whether it's going to be hard or whether it will be soft. It will depend what the policy response is, what the regulatory response is when it begins.
So, Joe, I mean, you rightly point out that surge in real yields that markets witnessed back in 2001 and then again in 2008, right? So I guess, when I think of those years, my question for you is, do we think a major correction is nearly upon us here? I mean, and what might that look like?
The equity risk premium, if you take 3-month bills at yielding, 5.5%, suggests the equity premium is significantly negative.
Yeah.
And a correction could look something similar like what we saw back in 2001, where valuations are totally askew from what you could earn risk-free in the bond market. And if you look at the narrowness of the equity performance, it does suggest stocks are extremely overvalued. However, if the Fed becomes less hawkish, they start to lower interest rates, most of the rise in real rates has been due to expectations the Fed won't be as aggressive in cutting. It's not been a break-even story. Break-even inflation generally has been very contained. So if the Fed does cut rates and equities can grow into their valuations, I worry the Fed is going to keep rates too high for too long. There'll be some break in the system. It will become self-feeding and self-sustaining. The Fed won't move as quickly as it may be supposed to. That causes a deeper recession. And then you're looking at stocks, say, somewhere S&P around 3,100.
I want to ask about, Joe, your former boss and President Biden, both of them spending money like it grows on trees. I think President Biden put an extra, a $1.6 trillion deficit is what we're looking at this year. And President Trump spent, $8 trillion is there anyone who's going to call for some kind of fiscal responsibility, or are we all,
no,
modern monetary theorists now?
Yeah, I don't like the modern monetary theory at all. I think it's sort of big. There might be a valid point somewhere there, but and we saw when you spend Committee for a Responsible Budget, we said we had $6 trillion in COVID spending, and we spent almost all of it, and then the Fed did about another $7 trillion when they weighed it up. So when you have all that spending, you're going to get inflation, which is what's happened. There does not seem to be any desire in Washington right now to be more fiscally responsive. And unfortunately, I would argue the fact that the Fed's got this playbook of QE has given Washington on both sides the ability to spend, perhaps in the old days where that wasn't the case. Remember when Alan Greenspan said if Bush 41 raised taxes, we'd cut interest rates a little bit, and that's what happened. That is a relic of the past. So I think right now, while I clearly would argue that Mr. Trump's policies and Mr. Biden's policies are totally different, in aggregate, there doesn't seem to be any desire to have a good fiscal house.
So what does this mean for, Liz McCormick has a story out saying that just the interest costs, servicing the debt that we have is going to eventually eat up 20% of our tax revenues. When does this become a real problem? When do we see a debt bomb?
I don't think we see a debt bomb because the dollar is still the world's reserve currency. There really isn't anything at this point to replace it. That might change over the next few decades. We could finance ourselves. It'll depend on what the cost is. But Matt, one of those reasons those interest costs have risen so much is that we've had a record rise in interest rates. The Fed funds rate's up about 500 basis points, 525 basis points in the past 15 months. And that is what's driving interest costs. And the fact the yield curve is so massively inverted tells us that monetary policy is too tight. When the economy goes into recession, the Fed eases, that will help lower those interest costs. And then we see what happens thereafter.
Joe, great talking to you. It's been a long time. Hope we speak to you again soon. Joe Livornia there, SMBC, Nikko Securities America, talking to us about what to expect from Jackson Hole and this U.S. economy. Taking a look at markets, we're not seeing a lot, and I think you're going to see very light volume at the open as well. Futures now up about 0.2%, no change on the euro or the 10-year, and crude bouncing up just a little bit. But of course, you're going to expect, Damien, traders not to do anything serious until they hear what Powell says.
I'm thinking bacon, egg, and cheese. Well, I like egg whites personally. Maybe like an early lunch, right? Something light.
I eat the whole egg,
salad.
Which is why I'm 210 pounds. But do I look as big as President Trump?
No.
Is he really 215?
Very svelte.
I think they meant 250. Did they actually weigh him on a real scale?
Probably.
I do not believe that the former president is only 215 pounds. That just seems like made up, and I can't believe that they would do that at the Fulton County Jail in Georgia. Coming up next, a special edition of Bloomberg Surveillance begins. Adam Posen is going to join us from the Peterson Institute for International Economics. Tom, John, and Lisa are going to take you through the Powell speech to Christine Lagarde. This is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology. the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television. The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
For further market analysis,
we're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers.
And what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Chair Powell is not going to wave the victory flag today.
I don't think he'll be inclined to say much about the short term and the outlook for the Fed funds rate.
Powell has to come out and reaffirm what the dot plots were saying, that there will be cuts in 2024.
I really don't think Powell is going to come out and make some kind of declaration that the Fed is done tightening.
What's really important is less what we're going to hear from Chair Powell and more the price action in response.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from Jackson Hole, Wyoming, for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. 12 months on from the promise of pain from Chairman Powell. 12 months later, we're at the epicenter of soft landing hopes and dreams. TK, a few hours from now, Chairman Powell taking a stage.
A few hours from now, and maybe more than a few minutes, the zeitgeist this morning. The Bears are up early trying to get a game on the speech, and the rumor is a longer speech this year.
Longer than 8 minutes.
Longer than 8 minutes, which is large.
Elisa, what a difference from 12 months ago. The worry of unemployment surging to get CPI back down to 2%. And here we are with unemployment almost exactly where it was 1 year ago.
Does he reject the pain narrative? That's what I want to understand. Does he say we don't need pain to get where we need to get? We can actually get this soft landing. Well, but this is my question. If he sort of goes into this question of look at this, look at how we've really right-sized inflation, this could actually be exactly what we've never achieved before. I'm going to be more like Alan Greenspan and less like Paul Volcker.
Well, he may be more like Alan Greenspan. This is a really important point, and it goes to what a lot of the fancy math is maybe a new definition of what measured is. And maybe he'll address that within the speech, but I would suggest his major issue with UATA in attendance, Broadbent in for Bailey, and Christine Lagarde in for attendance, Georgieva to join us later. All of these elites are saying one thing, say as little as possible. And that's really what I think will
Well, let's go through it, Tom, piece by piece, and what we've got lined up for throughout this morning. It's not just about Chairman Powell. It's not just about the Federal Reserve. Arguably, if you strip the United States out of the equation,
I strongly
the
agree.
rest of the world right now is in a very, very different predicament. Slowdown in Europe, slowdown in China. They're struggling to respond to it. In the United States, we're talking about resilience and potentially 3% GDP growth this quarter. Germany right now, Tom, would kill for that.
This morning, the
Without
news
a
out of
doubt.
Germany was stunning. I'm going to open my conversation with Lagarde on a speech she gave in April. The world has been turned upside down since April, and this is a different Jackson Hole, Lisa, than I think we saw 6 weeks ago.
I think it's notable that we're here with the backdrop of classic American Western glore, and it's such an international confab with people traveling 30, 35 hours to get here from all over the world to come together. And there's a question here: who affects policy more, the central bank in the country or outside of the country? Does Bank of Japan have more effect on longer-term yields right now in the U.S. than Chair Powell? These are some of the questions at a time where this is a very global economy that is splintering.
In full disclosure, folks, within the wonderful tone here of the Kansas City Fed, I've seen more of the chairman of the Federal Reserve Bank of the United States of America in the last day and a half than any other chairman I've ever seen there. They're usually closeted away. Bernanke's up top. This time of year, Bernanke's up top watching the Red Sox. Okay, Powell has been very visible.
Is it fair to say he's more visible this time around compared to 12 months ago because he's in a much better position, Tom? It's so much better for him this time around.
And to your point, and you've been an arch critic. I mean, Farrell to get him through customs here at Jackson Hole was something with the Fed. But the truth is, you've been a critic, as others, of the mistake of transitory. And there's a couple good charts. Krubin had a great chart about, they sort of jump skipped. It was ugly, but sort of like transitory is here.
Well, what's the risk now?
I can't do a thing with my hair this morning.
We can sort that out for you. We can sort that out for you. What's the biggest risk now? The risk now for some economists, including Neil Datta of Renmac, others too. I'm going to mention Neil all morning. You know I am.
Yes, of course.
Neil's thinking about the potential for a re-acceleration in the economy, Tom, and maybe reigniting the risk around inflation again. Is that the risk we face this time around?
That's maybe a short-term risk, a traditional worry about inflation. That my major risk is the underestimation of coming out of a major health pandemic. All of our guests today can address where we are in the long COVID theme. They're all writing about it, whether it's China. Adam Posen will be with us in moments. Brilliant on China in the last number of weeks. This pandemic, we still have unmeasured.
The question about the risk, the balance of risks, if you're patient, which we expect to hear from Fed Chair Jay Powell, is there a risk that you get behind? How big is that risk? Do they have the confidence that they can get ahead of it after the fact, even if it becomes entrenched? Are they going to move away from this idea that people actually are going to have inflated inflation expectations?
We're 5 minutes in. It's time for some snark. Define patience. What, 20 years? Wait for this mortgage market to sort itself out? One conversation we can have, if you want to be critical of this Federal Reserve, how screwed up is this mortgage market now in the United States? And for how long, Tom? Is this a generation?
I went house
generational story?
Yesterday.
Yeah, good luck with that.
There's no
That's
problem
his own
with
story.
the American
That's his own
economy.
story.
I looked
That's a Tom King problem.
I looked at 1,600 square feet in Jackson yesterday,
100%.
4 bedrooms. It's got the cow motif for the elk motif.
Yeah.
Elk above the door, $2.45 million, and there's no garage.
Just for the record, Tom, I don't think that's a decent example of the rest of this country. Jackson Hole? Probably not. Let's check out the price action just briefly. On equities right now, we are positive on the S&P 500 by something like 1/3 of 1%. Yesterday was fascinating to see NVIDIA knock it out the park the way they did, and then see the NASDAQ Rambo off the back of it is just absolutely fascinating. This market a whole lot weaker in the last 24 hours.
We had a 107 on Eurodollar. I noticed that. I thought of you, John.
Thank you, Tom.
There's a little bear
thanks for saying 107 and thinking of me.
outside the door. I was awake at 2 a.m. And, I see a 107 on Euro, and you predicted
This is very emotional. I think it's probably time to get to Adam Posen, TK.
I think we should go. Let's do this right now. We start strong here at Jackson Hole. We always do that at Jackson Hole. And we do with the gentleman who set the landscape for China in the last 6 weeks. His article in Foreign Affairs magazine, definitive, but far more than that. Adam Posen is a student of the Federal Reserve System at the Peterson Institute, truly one of America's experts on Germany. That's a good place to start, John.
Fantastic. Adam, great to see you.
Thanks
Good morning.
for having me.
12 months on. It's so different. Can you frame for us the difference in the backdrop for Chairman Powell 12 months ago compared to where we are now?
Like you said, last year was 8 minutes. This year's going to be 20 minutes. Like you said, last year was a rifle shot, or I've said that, totally focused on getting the pain. This year is going to be totally focused on fuzzing things up. That we're committed, but doesn't mean we're going to drive the economy into recession. I think Powell will be prudent, best of both Greenspan and Volcker, not claim victory. But yeah, it's a different world.
Sarah House of Wells Fargo a number of months ago came on this program with us, and she talked about the last mile, getting inflation down from the 3s down towards 2. I think you've alluded to it just then. Is the juice worth the squeeze? Is it worth killing the labour market to get that extra 100 basis points of inflation lower?
I and a lot of people would agree it's not. The question is, how do you manage that from a communications perspective? And this is why my colleague Jason Furman is out there, and I'm out there, and others, Olivier Blanchard, are out there talking about potentially raising the inflation target. People say you can't raise it now, but my worry is the opposite, which is you say 2 means 2, but it's going to be another 2 years before we get to 2, and yodi-do. And so I'm wondering if you have a bit of a tension there.
I'm surprised here with John Williams walking by me, I think it was yesterday, the lack of an R-Star debate at Jackson Hole. Your shop, Peterson Institute, has provided real leadership on this through the studies of Olivier Blanchard. Give us an update where Jerome Powell's R-Star should be.
Well, first he should be substituting the 10-year bond rate for R-Star. I mean, if you go back to Powell's first Jackson Hole speech as chair a few years ago, you'll remember he said, enough with this unobservable star stuff, unobservable R-Star, unobservable U-Star. And I think that's right. These estimates that come out of Laubach-Williams are completely non-robust, don't update meaningfully in real time. They swing hugely.
Starting harsh in the sunrise.
Sorry.
Please.
It's Jackson Hole. It's time to get busy.
That's going to be our promo for the next 3 years. Carry on.
Excellent. But look, I think what we had, and you may recall, I hosted for Peterson a debate between Blanchard and Summers about 6 months back. And then the IMF has their views. Basically, there are a lot of fundamentals that say rates, long rates, which are the proxy for R-Star in the real world, should be down back to where they were pre-COVID. And then there's a bunch of arguments saying we're going to have fiscal boom indefinitely, defense spending, green spending, CHIPS Act, industrial policy, and a little bit of inflation premium. R-Star should be up.
Well, this to me is a crucial debate because it also raises a question about rate cuts next year.
Right.
If they think that R-Star is naturally lower, then the rate will be naturally restrictive, more restrictive, and will cause them to cut. Based on your conversations, there's already been a dinner, there have been lots of sightings. Based on your conversations, where are most Fed members right now?
I think the most Fed members are going to be like they were on inflation a couple of years ago, which is willing to be behind rather than make a big mistake by preempting on the basis of dubious forecasts. In other words, they're going to wait. They're not going to say, I know that real rates are going up because inflation's going down, because some of that's already priced in.
Do you think that's a policy mistake because it loses credibility for the Fed, especially if they don't explicitly state that they are going to allow inflation to be higher?
I think it's a risk. I think it's night and day versus a year ago, Lisa. I don't think the credibility risk is anything like what we were talking about a year or 2 years ago. But I agree. I think that's a risk. If you say one thing and do something else, it's always a risk.
The heritage at the Peterson Institute, the leadership of Nick Lardy in talking about China, you carry it forward with a brilliant essay in Foreign Affairs on what do we do next about China? What should be the Biden administration's 2024 path in this fractured relationship with China?
Well, first, let me say thank you for citing my colleague as well as my own article. And Nick has a blog where he fundamentally disagrees with me. And
that's the heritage.
Right.
That's the heritage of Peterson.
Right. We debate. And so just recommending people read my article, read that. In terms of going forward.
I like that, Adam.
No, it's true.
That's good.
Appreciate it. But look, I think going forward, as I put in Foreign Affairs, Biden administration has to be thinking more in terms of suction than sanctions. That because China's problems are real, because I think they did have a turning point with the zero COVID policy in Xi, that there's going to be more people, more money, more capital, more ideas looking to exit. And rather than us deterring China and trying to contain them, what we want to do is put pressure on the regime so that Xi, if he gets paranoid, which he seems to be doing, or gets into self-sustaining, puts up more barriers. And we've seen this movie before. The more barriers he puts up, the more people want to get out. I don't mean literally millions of people, but just the pressure outward.
We can squeeze this in, Adam. I think it's important. We've always given the policymaker there the benefit of doubt. That seems to be the consensus view in markets amongst market participants. There is this question just bugging people. Is it different this time?
Yeah.
Is it different this time?
On the plane over here, John, I reread parts of Ez Vogel's Deng biography, and it goes back to there was this multi-year battle between Deng Xiaoping and Chen Yun about too much austerity, too much growth. And I think we're back to that, except she isn't willing to listen to others the way Deng was.
I don't care. Red Sox 17, Houston 1. Are you going to walk down Beacon Street, across that magical bridge, just on the other side of Kenmore Square, to playoffs and World Series with the Red Sox this year?
I'm going to walk to my refrigerator and get snacks and watch it.
There we go.
Adam Posen at the Peterson Institute. Adam, thank you.
Thanks for having me.
You had to squeeze some baseball in there. Was that for the Yankees fans?
No, this is right. With the new playoff structure, John, this has changed.
Yeah.
It's like Premier League, but they changed the rules. With the new playoff structure, the new middle of September is right now, the end of August. It's mental.
You feeling better about this year?
I'm feeling better.
Okay, he's feeling good.
I thought that you were going to talk about Adam Posen's change in garb. I mean, he's like completely transformed man. No shorts, no short sleeve shirt. He's got a jacket on, and he came to set looking cold.
What's great here, folks, I really can't say enough about our team that set us up this morning. Just now, the glow of the sunrise above Bramo.
Which I don't think you can see.
You can't see it yet, but if you had the Bramo cam, it's just behind the Bramo cam. You can see the first light of Jackson Hole.
It's a very impressive green screen, isn't it?
It is. Yeah.
It's tremendous.
It's good. We're going down to Starbucks on 3rd Avenue after this, right?
It is beautiful. I believe sunrise in the next 15 minutes or so, TK. That backdrop's going to look a whole lot better in the next 15 minutes or so. Coming up next on this program, do not miss this, the IMF Managing Director, live from Jackson Hole. Good morning.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain.
That was Chairman Powell in Jackson Hole, Wyoming, just 12 months ago, and what a difference 12 months has made. We thought a year ago to get inflation lower, it would mean the pain that Chairman Powell promised. TK, a year later, and here we are with unemployment almost exactly where it was back then.
Let us remember, and you can go right here to Wyoming and the high prices and the working people of Wyoming. A lot of America doesn't feel that disinflation. This is an academic exercise wrapped around a huge body of Americans, John, that are like, I don't care if it's 3% or 5%. This is miserable paycheck to paycheck.
And it could get a whole lot more miserable. But at the moment, Tom, if you look at the aggregate numbers, the headline figures, we're talking about potentially resilience. Lisa, I don't even think resilience as a word captures where the US economy is, just in terms of how the data's come through. It's been so much stronger relative to what we've seen in China, relative to what we've seen in Europe, and continues to be so.
And everyone keeps waiting for it to diminish. Everyone keeps thinking it will eventually stop. And then yesterday, the jobless claims came out lower than expected. The labor market not showing the cracks that people were expecting. And then people freaked out. I think that that's fair to say. You saw a complete reversal. It just took one thing to say, nope, it's still not cracking. And that really raised some questions.
There's been one change in the last week. The retailers.
Yeah.
You just go through them one by one. Theft at Dick's Sporting Goods, flagging the repayments for student loans later this quarter, later this year from Target, from Walmart. Take your pick. I think it was Dollar General yesterday. Dollar General, Tom, talking about pain for the US consumer. The retail earnings we've had in the last week across a select few companies, TK, speaks to the pain that you're talking about in the US consumer that perhaps isn't captured in the overall headline numbers.
The single best chart on this, Liz Ann Saunders and her team yesterday at Charles Schwab showed the equal weight market versus the tech weight and all that, where we've really hit a tip point in the last 48 hours with that retail debacle. What we're going to do at Jackson Hole right now as we begin in the sunrise of this important Friday is take a more international perspective. She is not here at Jackson Hole, but in heart and soul, her institution, the International Monetary Fund, decisively is. Kristalina Georgieva joins us, the managing director of the IMF, off a recent essay on what everyone's talking about, the fragmentation, the fracture of the global economy. Dr. Georgieva, congratulations on the essay that you and your team put together for Foreign Affairs. You speak of fragmentation. How urgent is the need for solution right now? What needs to be done now to begin to a more stable global economy?
It is urgent, and that sense of urgency is lacking, Tom. Why is it urgent? Because we have moved in a more shock-prone world, in a world of more uncertainty. And in this world, we need each other even more than before, and yet cooperation is in a retreat. What does that mean? It means that unless we wake up and we act pragmatically in the areas where we can find common ground, and in the areas where we must find common ground, like the fight against climate change, we will drift into a world that is poorer and less secure. We have run the numbers. Unless we wake up and we pursue this pragmatic collaboration, we are going to be losing about 7% of global GDP in the long run. I mean, that is like wiping out France and Germany from the economic map of the world.
Because of time, Dr. Georgieva, it's so important. I get this in this morning. I want you to speak right now to the four major central bankers assembled here in Jackson Hole. The singular call this year is the 5-year caution of economic growth of your institution. You call it slowbalization. How do those four central bankers assembled here get us out of slowbalization?
It is not going to be only the job of central bankers, but yes, they play a role. And their role is to be very careful in assessing how data informs their actions. We are going to see, Tom, after a period of convergence in monetary policy action, tightening rates, fighting inflation, some divergence, because where the US economy is very resilient, I was listening to this discussion just before me, the European economy is not. There is less strength in the performance over there. So central bankers will have to recognize that some specificity in how they approach the fight against inflation and how they link this to their role in supporting growth and employment, how they approach that is going to be a matter of thorough assessment of national data. Let me just make one point about the United States. What we see in the US is very strong demand for services. Very good, but not good enough for the world economy because it doesn't translate into spillover for global growth. Right. And this is why my main point is there would be some divergence in policy approaches across central banks.
Kristalina, is fragmentation inflationary?
Of course it is. Why? Because...
How much so? How much should that be considered?
If you take the main impact of fragmentation through trade, what it translates into is pushing cost of production up on a global scale. How inflationary it could be depends, of course, on how that specifically reflects into cost structures across national economies in the world economy. But the pressure on costs and then through that on standard of living of ordinary people certainly comes when we fragment the world economy.
Kristalina, I just want to squeeze this in. I've got about 60 seconds, 90 seconds left on the clock. You've said the IMF needs more resources. Can you be a lot more specific about what that means? What do you need, and where do you expect those resources to come from?
Well, let's face reality. More shock-prone world means countries need to have more capacity to face these shocks. Today, global reserves are concentrated in a small number of strong, advanced and emerging market economies. 10 countries hold 2/3 of global reserves, and all the small, medium-sized countries hold less than 1% of global reserves. This is where the IMF comes in. We are the insurer for the uninsured. Today, our size, $1 trillion lending capacity, is just not enough to be the buffer against future shocks that we all anticipate are going to be happening. And also what we want to see is reliance on own resources. We are discussing with our membership to bring the quota resources of the fund again above 50% of our funding level. Today they are at 40%. So we are talking about a not a minor increase, but I think everybody understands that this is a provision of a global public good. If the IMF cannot hold financial stability in vulnerable countries, that is hurting not only those countries, it has negative spillover for the world economy. So
Kristalina, thanks for joining us today.
About a couple of $100 billion that we want to see being lifted up in our lending capacity.
Well, that was the punchline I was looking for. The IMF Managing Director. Kristalina, thank you. It's good to hear from you. Thank you. Thank you very much. Tom, I would argue perhaps an institution struggling for relevance in a fragmenting world. That's the brutal assessment of what they face at the moment.
I strongly support that idea. They are struggling for relevance away from the distractions of Argentina. In her essay, she talks about the train wreck of Zambia. They've got these major, major headaches wrapped around what the four major central banks do.
Chairman Powell, just around the corner, 10:05 Eastern Time. The preview up next with Neela Richardson of ADP.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Attempted to get you towards the weekend. Let's check out the price action on the S&P 500. Equity futures here elevated by 1/3% on the S&P. The Nasdaq trying to bounce back up 1/4%. Yesterday, I think brutal. And I'm going to say it's brutal, not just because of the move, but the move relative to the news. The news was good. Nvidia knocked it out of the park, Bramo. It's what we wanted to see. And the Nasdaq faded and faded fast.
And the fact that it was up, the Nvidia in particular was up almost 7%. And then all of that almost retraced. And everything else just sunk down. Sell the news, right? I mean, that basically is what everybody was saying.
It's an interesting time, but it's also August, and we're addicted to up, up, up. I mean, the pullback, have we had a correction yet? I mean, it's great.
What are you looking for, 10%?
It's terrible, but to your point earlier on retail, this is always true of a correction. There are selected sectors that are absolutely hammered, and that's what we're seeing.
What surprised this year? The U.S. economy. What underpinned that? Consumer spending, discretionary spending to be specific, airlines. Beyond the airlines, cruise operators. Is that going to start to fade into year-end, Tom? That's a big question. The retailers alluding to that over the last week, flagging that they think there's a potential for that to happen. The problem is, Alicia and I talked about this last week, Tom. It's the economist who cried recession 20 different times over the last 12 months. You've got the retailers flagging weakness again. And I think a lot of people are shrugging their shoulders and just thinking, well, I've been burnt by that view a million times over.
I'm not going to mince words about this. The people, the fancy people that wear Montclair ski jackets, it's just as simple as this. They haven't been touched by the recession yet.
Seriously?
We're 30 minutes into the program.
He's already trying to tweak it.
There's a part of America that has not been touched by this recession. Right now in Jackson Hole, Wyoming, 2/3 of America says, you guys are nuts. We're in a recession. That's the bottom line.
Do you want the feedback this morning? Great reporting, beautiful sunrise. Old school locals used to criticize the tourist newbies that incorrectly added the hole to the official name of Jackson, Wyoming. That's the feedback this morning, Tom. Is that helpful for you? The ski bums.
I've been here like 17 years. I'm going to Jackson tonight for the first time.
Can I tell you?
I'm going to some steakhouse and have fish. It's going to be great.
Nice. People call it J-hole who are, talking about it in other places, which is just dreadful. But, just to give you a sense of just how wrong we are.
Very wrong, apparently.
Very wrong.
Turn to the bond market just briefly. Two-year yield still in at around 5% at the moment. That drift higher in yields over the last month has been pretty impressive. 422.95. I think in the past week,
on a 2-year?
cycle high was about 436 on a 10-year, Tom. So we've come back from those levels, but that was a shocker for many. A shocker for many.
Did you see the 3-month T-bill yesterday? It was like, wow. I mean, these are some serious surging rates. Lisa, under surveillance this morning, it's our weather report from Jackson Hole. John, 48. Last year at this time, it was 42.
And raining.
And the 6-degree difference is like, this is like balmy.
It makes a difference.
It makes a huge difference on a perfect day.
I thought you were going to say something about the bond market, but maybe not.
No, I'm doing the weather report. That's what we're doing now for under surveillance.
From the weather to foreign exchange, let's squeeze in the euro and do something sensible.
It's natural segue.
Okay, you said we saw 107.
Yeah.
We're back to about 108.11, Tom, on the euro.
Swissy did not confirm the gloom in euro. Seriously, Swissy did not go stronger on this recent move in euro.
In Germany, the data, Tom, less than impressive. President Lagarde, you catch up with President Lagarde a little bit later. Run us through it. This is a tough spot for her.
The list of things I can't talk to her about. You can't talk about Germany, Tom. We'll see how that goes.
Don't talk about rate increases.
This morning.
Don't talk about policy.
What we're going to do right now is talk about the most important person in the lodge here at Jackson Hole. It's a bunch of fancy academics writing fancy papers. What they want to know is, what do the paychecks of America look like? With that leadership is Neela Richardson, chief economist at Automatic Data Processing. She, more than anybody else here, has an understanding of the American payroll, the American labor economy. With Parchment from the University of James Bullard of Pennsylvania, Maryland. Thank you so much for joining us. What does ADP say right now? What does the payroll of America look like right now?
It's solid, but it's fragmented. And we've seen notable declines in wage growth. After last year, wage growth moving sideways, we're actually seeing some traction downward. So that's good news to amplify the Fed's already good news going into this Jackson Hole meeting. And by the way, wow, what a view. You guys really...
Do you like that?
It's beautiful.
Matt Timmons did that. He moved the mountains 6 feet this way just to get the shot right this morning. I want to talk to you seriously about the dynamics of wages and inflation, the real yield. There's an optimist view that, yeah, the real yield's there, but wages will stay strong. Do you agree with that? Or do wages come in even while the real yield goes up? That's not good for America.
You know, that's the open question. There's a sense that where we've seen the highest wage growth has been for low-skilled workers with low pay. Now, let's be clear. Even though we've seen double-digit wage growth for almost an entire year, that translates to less than $5,000 in your average paycheck in low-skill industries. So it sounds like big double-digit numbers we should be concerned about when we look at pay growth. But for the person on Main Street, it doesn't really fill the gas tank and buy the eggs and pay for education and healthcare in the same way.
Let's carry on this conversation. I think this is so important. Why are people in this building in front of us, when they get together every year, concerned about pay growth, when everyone else, away from all of this, loves a pay rise? What's that about?
Well, you know, wages are the bridge between the labor market and the inflation, right? And so you want to make sure that that bridge is going towards lower inflation, not higher inflation. And in that sense, it matters for Main Street, too, because you want real wages to grow. You don't want nominal wages to grow. And what we've seen is a lot of nominal wage growth because of high inflation. Now, that's shifting as inflation goes down. The question is, will the persistence and strength of wage growth built by an undercurrent of productivity continue? Or was this all just churn and competition prompted by inflation? And I think that's the critical question for me in these many years.
Big pay deal from UPS, big pay deal for American Airlines pilots. A lot of people are going to see those headlines, go to year end, sit down with their manager and say, I want some of that. Why don't you think that's going to happen?
Negotiation at the end of the year is always pretty tricky. And one of the biggest questions we've heard from employers is, how do you negotiate a salary in an inflationary environment, right? Because you can't have a sense of what's next year's going to look like when inflation's all over the place. And now we've seen that trajectory go down. The balance of power has shifted back again to the employer. So what's on the table in terms of negotiation? It's remote work, it's benefits, it's wages, it's this whole package of things. And yes, there are some pockets and some occupations that can win the wage negotiation argument. A lot of other people are just going to see smaller bonuses this year.
Let's underscore this, especially because we do get the United Auto Workers vote at 11 a.m. Eastern today, and that could potentially have material impact on Detroit and all the auto manufacturers there. Are you saying that when we say the power is shifted to labor, that's overstating the fact, and that's not the reality? It's just a small pocket here and there, and the rest of them, it's the employer saying, get back to work, and you're not going to get that big of a pay rise.
The fallacy of the labor market, as it's discussed, is it's talked about like a monolith, when it's really just an aggregation of microcosms. And some are strong and some are weak. And so when you have a union negotiating a wage in a market, and it's early,
No
and there's not enough
words.
coffee in this world for that.
Here, have some Tang. Would you like some Tang?
You had a late night with Jay Powell. Carry on.
When you have a supply-constrained market, a collective organization bargaining structure, and the need to increase pay, that's like a perfect storm, right? But that's not the whole market. And so you're going to see different opportunities for wage growth in different microcosms of this market, and we can't talk about it as one broad stroke.
I was making a joke earlier, but it's not funny. The people here really listen to you in market economics and payroll economics. I want you to speak to 4 central banks right now. Are we beyond where we can aggregate any nation, any central bank, any America into one set of economic analysis, or are we out front of John Edwards where it's 2 Americas, 3 Americas, or the 28 Americas that ADP looks at?
Why I love this question.
I do okay?
Yeah, you did great.
Okay, thank you.
Why I love this question and why I love the theme of this year's conference, structural constraints or structural shifts in the global economy, is that it's a recognition that the inflation story has been mutated by the pandemic, and the trajectory we were on globally in terms of inflation has been permanently shifted. And that means that we can't just be cyclical, we have to be structural on the drivers of inflation over the long term. And the sense that once we get through this episode, we start cutting rates and things go back to normal, I think that's a little optimistic. That misses the whole point that inflation could rise again next year or 2 years from now or 3, that it's not going back to a 40-year slumber. And that's the important point.
Some people are talking about the long and variable lags. We laugh often, how long, how variable, what are you talking about? Within the labor market, how much have rate hikes actually diminished some of the power that you've seen in hiring and the ability to get jobs?
You know, it's been shifting. So we're still at record lows in unemployment. And what we've had is when one door closes, like large firms in tech hiring, another door opens, like small firms. In fact, over the summer, 60% of the new jobs added were from small firms with under 50 employees. These were the tigers of the labor market. Very different this year than last year. We also saw the hiring be very different in the motivation. So before, last year, it was a lot of replacement hiring. Now you're seeing firms actually add to headcount. So yeah, the numbers are going to be smaller, but they're going to be more real and more persistent and more sustainable. It's not just replacement.
Let's not do forecasts. Let's do best guesses.
So
I
12
love
months
best
ago.
Guesses. Best guesses.
Which is another way of saying forecast.
We're being kind. Best guesses. 12 months ago.
It's forecasts you don't back test
exactly.
later. So.
Exactly. We're being kind about this. 12 months ago, unemployment around 3.5%. 12 months later, unemployment around 3.5%.
Yeah.
When we do this again together next year, where do you imagine, best guess, unemployment's going to be?
I think it's going to be around 4%.
Which is pretty marginal.
It's pretty marginal.
Is that consistent with getting inflation back towards 2% in your mind?
This is what I'm talking about, of the mutation in the inflation trajectory, because those labor shortages are persistent. They're not going away. If you look at the demographic trends of the United States and in advanced economies in Europe, you see an aging population, a population that is non-working growing faster than the population that is working. That means there are fewer people producing the stuff that the population needs, and that is inflationary.
The heart of the matter, you did this at Maryland with their great public policy program. The bottom line is the middle of America is being carved out. ADP sees this in micro data to 4 decimal points as well. What's the public policy prescription for the next president of the United States and frankly the next chairman of the Fed to help the middle of America that's being carved out?
You're giving me 30 seconds for this answer?
No, 28 to go. We'll extend it.
You can have a couple of minutes for this one.
I think it starts with skills and job growth, because one thing I haven't heard yet, though I expect to hear today, is this innovation boom that is at the precipice of changing how all of us work. And the question for middle America is, can they evolve with the change in technology? Right now, it's a choice. That technology could make middle America more productive, which is when wages grow for the right reasons, and no one argues with wage growth based on productivity. That's higher profitability, that's higher standard of living, and it's disinflationary. What people do argue with is when it's displacing labor. And right now, the verdict is still out. I think the hope and the energy is around making workers more productive, and that could be helpful.
You sat next to Jay Powell last night at the dinner. So what did he tell you he was going to do? What's he thinking?
I think it was some guitar playing in his future, maybe some golfing.
Okay.
Hopefully some visits with his family.
Oh, nice.
So
Didn't talk about September 20th, big event.
He's retiring. Is that what you're saying?
Yeah, I think that those long-term plans. Remember, we're talking about the long-term
the long and variable lags in his work schedule,
not the short-term immediate future.
No, the long and variable lag for Jerome Powell is a distance to the next Dead concert.
He loves that, doesn't he?
He loves that. Yeah, he's like, massive. Yeah.
Yeah. Neela, this was fun. We've got to do this again.
Always
do it
fun.
again soon. We won't wait until next year. Don't
Picking
worry.
backdrops like this.
Can we take a shot at this?
Time
It's just beautiful. It's just beautiful. It's stunning.
Yes, definitely.
What a great location, TK.
It is. I've been looking for bar this morning and in elk, and it's a little. We haven't really showed up yet.
You've been looking for a bar or an elk? I wasn't sure.
Bar.
Elk and a bar. I don't know.
Bar. They say bar out here. They don't say bear.
Oh.
They call bear what?
Bar.
What are you talking about?
Stop it. I think you had a few too many and someone started winding you up last night. That would be my best guess. Neela, thank you.
Neela
Richardson of ADP. Mike McKee coming up next.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Names in global leadership are on Bloomberg.
When the dust settles, Israel will not only remain a democracy, it will be even a stronger democracy, but more importantly, it will not in any way impair the enormous business and economic capabilities of Israel in the new technological age.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
I would say that we are in a position in Europe now where the Eurozone economy is basically stagnating. We are now certainly in the restricted territory. And we got into the restricted territory by rapidly hiking the rates so far. Whether we are in a restrictive enough territory remains to be seen. And this is something that we'll only see from the inflation data that will come in the next spring.
Boris Vucic there, the ECB Governing Council member and Croatian National Bank Central Bank Governor, came very, very close to saying the S word. Not stagnating, stagflation. In Europe, it is a very different backdrop to what we're experiencing here in the United States, where we're making progress on inflation but still witnessing a robust economy. In Europe, anything but. They have an inflation problem and parts of the economy, parts of the Eurozone, TK, in recession. Dare we use that word stagflation to describe what Europe is experiencing right now?
With a war in Ukraine, and I think you can say I'm not knowledgeable enough to say you could say full European recession, but I don't care about any NBER stuff or other analysis. Boy, interview after interview, data after data, it's recession.
Where's the growth going to come from? I mean, if Germany is really the one that's leading the recession, and it really is driven in part by what's going on in China, and their economy has not been as disconnected from China in any way, shape, or form, the same way that the U.S. has.
$16,000 business class plane tickets to Paris. That's what's going to save them from recession. That's how silly this is.
With what airline?
Well, it depends.
United? Oh, yeah, that's right. It's based in the U.S. Carry on.
But the bottom line here is what's saving them is this hope and prayer of an elite. I'm going to associate it with Mr. Macron of France, which is probably unfair. But there's a whole other Europe out there that's flat on its back. There's no other way to put it.
Big time. Let's whip through the price action just to get you all up to speed and prepared for the day ahead. Equity futures on the S&P 500, slightly positive, up by 0.4%. In the bond market, the 10-year cycle highs in the last week or so. Backed away since then, 423.54 on a US 10-year. Going into Chairman Powell at 10:05 Eastern time, looking for a speech maybe a little bit longer than the speech from 12 months ago. But I just want to sit on this just for a moment. The numbers we had from NVIDIA in the last 48 hours supported this equity market rally on the tech side of things in a major way, and this equity market faded. Mike Wilson of Morgan Stanley, Lisa, saying to Bloomberg Radio that this is a sign that this rally is exhausted. We know Mike's view coming into the year. We know how difficult it has been, but I think many people might find it difficult to disagree with that after the last 24 hours we've seen.
Michael Hartnett of Bank of America coming out and saying it just shows how much these tech stocks are interest rate sensitive, that there is this concern that if rates go higher, they are not going to be immune, and you are going to see a valuation reset, which is the reason why you have sell the news, even though the news was incredible. I mean, the amount of beat was really out of the water. I mean, this is another one. Exactly.
They did it in May. They did it again in August. That stock's slightly negative in the pre-market this morning. TK equity futures slightly positive, up 0.5%.
Rule 101 to the optimist is the VIX is under 17. And I know there's a lot of different Dean Kernot-like noise and all that in the VIX, but we're not even back to a correction. Although, as we said before numerous times, so many people are looking at retail. I'm in shock over, say, what Nike's done for a number of days. I need a wide shot here. This is very important, folks. I just want you to understand that this morning on Bloomberg Surveillance Worldwide, as John brings in our leadership here, an umpteen years at Jackson Hole, we're cowboy hat free this morning. This was an executive.
I'm not sure why.
Executive decision. This is Bramo's decision, and we decided this early in the morning, cowboy hat free.
This is the first time I've seen Mike McKee. Because he's a superstar walking around.
Oh, yes.
Walking around the lodge. Oh, yeah, just ignores me.
Yeah.
Walks straight past us. So, Mike, it's good to see you.
Yeah, it's nice to see you too, John, and I'm glad I had a few minutes for you.
Chairman Powell, a little bit later, you're going to give us the official preview. How different is this address going to be compared to the address that we got 12 months ago?
Well, it's probably going to be about 10 or 15 minutes longer, for one thing. I don't think he has the same urgency in sending a message. Last year, the markets and the Fed were wide apart, and he wanted to bring it back closer together. This year, the markets are doing what the Fed wants. I mean, yields are up, and that helps make policy more restrictive for right now. We don't know where they're going to be September 20th, and he's going to probably say, we're going to wait till September 20th, or at least till the next jobs report and the CPI and the PCE inflation numbers, and see if they feel like they need to move again. And the bet is they won't, but he's going to leave his options open.
There's images on Instagram, folks. You can see this of Mike McKee leading what he calls a perp walk as the central bankers walk down here in a number of hours to gaze out at the vista behind us. Ueda, Lagarde, Powell, Bailey, not here this year. Are they unified? Is there any kind of a unified message of these central bankers, or is it, as Bremer would say, every central banker for themselves?
No, I think strategically they're all unified because they all have the inflation issue they have to deal with, and certainly the UK and the Eurozone have the same sort of inflation problem as the US. It's too high. The Japanese, it's too low. But the message from all four of them, when you throw Ben Broadbent in, who's going to speak tomorrow, is basically going to be stay the course. What we're doing now, we need to keep doing. We need to keep the pressure on inflation in those areas where it's too high, and in Japan, we need to keep inflation higher.
Yesterday, former St. Louis Fed President Jim Bullard was on Bloomberg Television with you, and he said this: I think the committee should take a little bit of a victory lap here. You were at the dinner last night. How much of a victory lap were people doing?
They're humble about it. Basically,
but they're still doing it?
Basically, they do still think that a soft landing is possible. They worry about the possibilities of some exogenous event, but they know that this, as somebody was calling in a research note I read last night, the last mile for inflation is going to be the most difficult, and so they know that it's still going to be a bit of a slog.
How much is the balance of risks clearly shifting among the majority of the members to killing off this proposition of a soft landing and not letting inflation get out of control?
I think that it's a dual message that we can achieve a soft landing. No Fed official or central banker is ever going to say, yeah, we're going to have a recession. And you were talking about Boris Vucic, and yesterday I also talked to Joachim Nagel, and they both said no recession, even though Nagel's economy is flat on his back. But they are going to say we can get a soft landing out of this, but we are going to do what we need to do even if we don't get a soft landing, because they need to keep the markets where they are.
There is a splintering on this committee. You've covered it really well for us over the last several months. We've heard it this week. The Boston Fed President, Susan Collins, speaking to the Financial Times in the last 24 hours, suggesting the resilience of this economy suggests to her that we might have to do more. Patrick Harker, who will be catching up with you a little bit later from the Philadelphia Fed, has spoken to various media outlets and suggested that he thinks we're done. Can you shed a light on that? Shine a light on just how much splintering there is at the moment on the committee?
These are tactical differences rather than strategic. Strategic, yes, we're going to raise rates, and we're going to keep them there for a long time. Tactically, do you go up by 25 basis points more, or have you done enough? That's the question that they're all debating at this point, but it's not really a huge division among them. And I think that basically the feeling on the committee is that the data will tell us what to do. If we see inflation start to rise, slam dunk, we're going to raise rates. Now, I don't mean just by a tenth or two that's base effects, but if we see some underlying inflation pressure, then we raise rates. If we don't, we can pause and wait for the next meeting, and all three of you will be debating that in November.
Back to Fed 101, as Chairman Powell speaks this morning, how much longer is his tenure? What is his timeline? This is not his last Jackson Hole, is it?
Oh, no. He was just reappointed last year, in 2001, by Joe Biden. So his tenure will end in 2025. And
really, that far out?
Whichever president is elected in 2024 will get to name the next Fed chair, whether it's Powell for a third term or whether it's somebody new.
Well, based on the commentary we've had from the Republican Party, it won't be Chairman Powell. Does this institution have one eye on the politics developing in America?
One eye in the sense of what could it do to the economy, but they insist, and you read the transcripts of previous meetings, and there's always been these debates between Republicans and Democrats, and we've had government shutdowns, and they don't talk about it. They don't let it enter their considerations. They are sensitive to the public, but not to the body politic, as it were.
Have you got the check to write for McKee? That was longer than 2 minutes.
It is. Well, he's paid by the syllable, so, it works out.
Thank you, Mike.
I put it to a new hat.
McKee's got me going to the Gun Barrel Steakhouse tonight.
Is that what you're going
tonight? It's a manly steakhouse.
I can't imagine you in
I'm
there.
trying to get in. I mean,
He's wearing a bow tie to the local diner.
Yeah.
I don't know.
I'm pretty sure it's Western themed tonight. Do you have your Western gear?
No, I only have this.
I heard about that
yes,
too.
and if you don't wear Western, you're in trouble.
Western Fridays.
Yep.
It's a big deal, TK.
Then I'm in trouble.
Coming up, John Lipsky, former First Deputy Managing Director at the International Monetary Fund from a beautiful Jackson Hole, Wyoming. Good morning.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think if you're a mission-driven investor, there's really no better feeling than knowing you're impacting the lives of 2 million people that are serving California.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge.
our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, a significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The top names in business are on Bloomberg.
We're seeing a resilient consumer out there. We're also seeing consumers premiumize, and what we mean by that is consumer habits are changing. People want to drink better, not more, but higher quality spirits. And so, look, it's been a bit of a balance this year, battling inflation. At the end of the day, we see volumes growing back over time.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg. Heading into Jackson Hole, we're not expecting a major policy shift out of the Fed.
There's some anticipation that Powell will talk about maybe higher structural rates, higher R-star.
Jackson Hole is going to be an opportunity for Powell to flip the narrative a little bit.
I still think he's going to embrace that narrative of higher for longer, just given how resilient the incoming data has been.
I don't think we should be looking for any big surprises. You know, my sense is that Powell is going to get up there and he's going to reiterate exactly what he's been saying.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From a beautiful Jackson Hole, Wyoming, for our audience worldwide, good morning, good morning. The second hour of Bloomberg Surveillance starts right now on Bloomberg TV and radio, together with Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. 12 months ago, looking out 1 year, this is not where we expected to be. This Federal Reserve has gone a whole lot further than we thought they would. This economy is a whole lot stronger. Tom, a lot of people got this wrong.
I'd take it from 12 months ago, they got it wrong, to even 4 months ago. The urgency of this Jackson Hole is something I don't think we even knew weeks ago. There's a tone here that I simply didn't predict, say, 2 months ago.
2 months ago, maybe a month ago.
Yeah,
this data, Lisa, has just been so much better. So at 10:05 Eastern Time, when Chairman Powell speaks, how different will this speech be to what we heard 12 months ago?
Last time he came around, it was all about pain, and how the pain on one hand of higher rates is better than the pain of having to struggle through inflation. And now we have inflation that's lower but still higher than it has been for years, not getting back to 2%, even by the Fed's own projection, until after 2025. Where's the pain? Is he going to talk about it, or is he going to reject pain and say, we don't need pain, we got it under control?
Well, we got it under control. I'm not sure how much control there is. They're going to do the walk this morning. McKee choreographs the walk where they go out and point at the mountains. I have no idea what they're pointing at, but Alan Meltzer climbed that high 20 years ago. But they're going to do the walk out. And to me, the question, John, you've mentioned this, the international tensions right now, the incredibly important paper by Barry Eichengreen to come tomorrow here. The international tensions here are underestimated by the American media.
Ex-US, strip out the United States. Part of Europe in recession, really struggling to generate economic growth.
Yeah.
China struggling to respond to the slowdown they're experiencing at the moment. And yet you can still feel this slight excitement, just a little bit, about the prospect for a soft landing here in the United States of America.
No
and I cannot tell you, Tom, that makes people nervous.
No,
that makes people nervous that maybe they think the job is done. Now, what they're willing to say and what they think, there might be two different things, but you can sense it, just in terms of the commentary we've had over the last few months.
Is that hope? You know, I do in all my reading, when I see the word hope, I circle it. Are we hoping for a soft landing, or is there any evidence of it? Yeah, they got a 5% American GDP. Let's pack it up and go home.
I will just say this. At 10 a.m., 5 minutes before Fed Chair Jay Powell takes the helm, we get University of Michigan sentiment survey, and we get inflation expectations over the next 5 to 10 years. I know how you feel about it, and I know how you feel about it. However, it does raise this question of the risks of waiting too long. What does that do to inflation expectations as people start to see year over year their costs just...
And there we go.
What was that?
Climb, go on.
Bremo dancing.
She was at the $1 million bar last night going...
All right, let's move on.
What we do, what's important here, I got an email. Do you bring... No, I got somebody, John, somebody emailed me. They said, do you bring the Bramo cam when you're on the road? Yeah, the Bramo cam's right over here, looking at the gloom. You know, we live stream it as well.
That's bonus content. That is 2K.
John Lipsky's, you know, we got a wide shot. For those of you on radio right now, Dr. Lipsky's looking at us going, what did I get into this early in the morning?
Patience, John, please. Please. Let's get to the price action for you. We are about 26 minutes away from the opening bell in New York City, and this is how things are shaping up. Going into the opening bell on Wall Street, equity futures are positive by 0.4%. We really are trying to bounce back from the weakness in yesterday's session. The fate of today, arguably in the hands of one man, Chairman Powell, potentially. That seems to be the view. That address from Chairman Powell, exactly 1 hour and about 30 seconds away. Lisa, have we got a countdown clock for that?
Well, we should have a countdown clock.
Come on.
It's just like 1 hour.
We got a countdown clock for when the first elk comes out.
In the bond market, 424. Yields going absolutely nowhere. Cycle highs, new cycle highs. This bond market has impressed in a monster way. Think about where we were post-SVB. Post-SVB, back in spring, cycle over, hard landing, financial conditions are going to be too tight, banks are going to fail, and we'll be talking about rate cuts before you know it. It's the end of it. Literally the day before it failed, a 2-year yield at 5.08%, cycle high. All of a sudden, end of the summer, data's decent, and a 2-year yield, Tom, is just south of the cycle high we were at the day before SVB failed.
The nominal yields that the financial market keeps up with, but what I'm looking at is the real yield in the convexity, the acceleration that we've seen in the real yield is sobering. Right now, 1.91%, I believe it is, on the 10-year inflation-adjusted yield. A week, days ago, it was 2%. That's stunning to all of these economists assembled.
Would you like to frame our next guest?
Let me frame our next guest. This is a joy as well, providing international public service and joining the IMF a number of years ago. This is John Lipsky. Dr. Lipsky, of course, owns the high ground from Stanford Economics, his work at Salomon years ago, and we are thrilled that he traveled all the way from Europe to come here.
That's very kind of you, John.
Very, you know.
John, it's good to see you. Thanks for being with us. I know one thing that you're focused on, and many people are focused on it as well, also people at home, listening, watching, our audience, the changing relationship between this labour market and price pressure. What do you think we need to focus on right now?
Absolutely. The big question is, do wages follow inflation, or do wages cause inflation? So far, the data suggests that wages follow inflation, not the other way around. And I think that reflects some big changes that have happened in the economy that haven't been clearly, some structural changes in the economy, international economy, that haven't been so clearly recognized. And that is the opening of markets in the 90s and the aughts and in the 2010s has turned many producers into price takers, from price makers. In the past, in the 70s, producers, especially in the U.S., were just willing to push costs along, pass them along to their consumers. As markets internationalized, that no longer worked, and they had to manage their production to markets, price takers. And as that has changed, the way wages have been settled as well. And so what we're going to find out is a test in this current environment. Is there any reason to expect wages to continue to cause inflation in the future? If not, then a soft landing at near the Fed's target is a real possibility.
I don't want to bury us with a history lesson right now, but to have Eichengreen here and Lipsky and others, we celebrate the 50th anniversary of John Taylor's PhD at your Stanford. 40 years ago, this is at Alan Meltzer and Carl Bruner's Carnegie Rochester, much like Jackson Hole's summer conference. Taylor changed the world by beginning to talk about a rules-based architecture. Is that ancient history, or can we get back to central bank policy as people like John Taylor prescribed?
Well, there was just a very interesting conference at Stanford to honor that 50th anniversary of the Taylor Rule. And there's certainly a great interest, renewed interest, in central bankers going back to some kind of more clear rules-based approach to setting policy. Not just setting a target, but explaining in a clear way what they would do to get to that target. Right now, we don't have that. And part of it is because, as we've seen, that our models about inflation, which is the target for central banks, hasn't been clearly established.
How much are central banks just basically cycling to keep up with fiscal policy and the fact that there's been so much debt and so much stimulus pumped into the economy, and they're trying to figure out new models for something that is modelless, that has no paradigm in previous history?
Well, that certainly has been a challenge, and it's one that looks like it's going to be there for a while, because a great move toward fiscal discipline doesn't seem to be in the cards right now. Anywhere in the world, we're going to have high fiscal debt for quite a while. But of course, part of this, the question is, we've seen central banks also take different kinds of action with regards to public debt. QE in the U.S. and elsewhere now turned into QT as they work down their balance sheet. This is going to be a complex challenge, and there is similarly no model right now.
And that's where I wanted to go. This question of the Federal Reserve balance sheet. Yesterday, the total came out. It's down almost $1 trillion from the peak, just north of $8 trillion. We still have a long way to go. I'm just wondering how much that's contributing to a tightening in financial conditions. That's sort of the story right now, especially on the long end.
An excellent question for which we don't have a clear answer. What the Fed has decided is if they go, let's call it a rules-based approach, and say the same amount every month or every quarter, that reduction in their balance sheet, that will keep markets calm because it's predictable. Sounds like a rule. But in fact, we don't have a clear view about how this is all interacting. And as was going to be discussed here at Jackson Hole, how well the Treasury market actually works, the Treasury bond market actually works, has been changing with rules and regulations have been introduced. And we'll be talking about, is there a way to make that market work more efficiently?
We're so honored at Bloomberg today to have you with us, with Christine Lagarde later on, and Dr. Georgieva with us earlier. And all of this is about fragmentation. You lived on airplanes for X number of years to the IMF, fighting against fragmentation. How close are we to the blocks, B-L-O-C, the blocks that we studied as kids?
It's a wonderful and important question, and not easy to think through because of the following. We started in the post-war era with blocks, economic blocks, based on ideological and geopolitical oppositions. Markets started out fragmented. Post-1990, we entered the period of what I call true globalization that had profound effects on the world economy and enormously positive. Now, there's no instance of an emerging market economy that has sustained growth without being connected to global markets for goods, services, and capital. So the question is, they understand this. Is it possible that they will allow renewed geopolitical great power conflict to break up those markets that have brought, in essence, will they kill the goose that laid the golden egg?
So we need to finish where we started. With this fragmentation, do producers, to use your analogy, become price makers again?
That's a risk. That's a great risk. However, those who are leading or part of this renewed geopolitical tension also recognize that their economy depends very heavily on access to markets. This is how this will be resolved is one of the key questions of the coming decade.
John Lipsky, this was wonderful and deeply thoughtful. Thank you, sir. It's good to see you, as always. The former First Deputy Managing Director at the International Monetary Fund, Tom, with some strong stuff to think about with regards to a country I don't think we named, China.
No, we've underplayed China this morning with a focus here on the four major central banks. It's true, but the key word from Dr. Lipsky I heard there was complexity. These are not simple concepts. And in the American media particularly, and we're as guilty of this as anything, in the Bloomberg News team, polices us and tries to show us the complexities that are real right now. Post-pandemic, they're a new level.
I would take it a step further and just say that China's the elephant in the room here, and what they decide to do, and Xi Jinping's reluctance to really come in and support the economy in a material way. I mean, he came out with some half measures, or the Chinese authorities, yet again, it lasted for about 10 minutes with a bit of enthusiasm this morning, and then everyone was like, you're not doing anything.
It's not getting it done, is it?
It's not getting it done. No. And at what point does he convince people that he wants to get it done when he doesn't seem to want to give what he calls welfare, and he doesn't want to necessarily connect to the international economy at the risk of risking national security?
This goes back to something John was talking about. There's a reluctance here, Tom, to adopt the Western model. A real reluctance.
Oh, absolutely. I mean, we want to get halfway back, and some of the essays here on China say precisely that. It's where is the first initiative to get back to something that Deng discovered 3-4 decades ago.
The opening bell is just around the corner in New York City. We've said it a few times. The fate of this session in the hands of one man, Chairman Powell. That speech, 51 minutes away.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
This reacceleration could put upward pressure on inflation, stem the disinflation that we're seeing, and instead delay plans for the Fed to change policy. There's some talk about base effects fading and going the other way during the second half of the year, so we'll see if that occurs.
The former St. Louis Fed President Jim Bullard weighing in on the global economy and Fed policy in the United States. I have to say, typically I'd say there are things you can say when you're an official at the Federal Reserve and things you can't say. And then when you're no longer a Fed official, you just sort of open up, you're unleashed.
It's like a changed man.
But with Jim Bullard, I don't think it makes a difference.
Come on,
I think Jim Bullard said what he thought when he was the president of the St. Louis Fed, and he says what he thinks now.
The great thing about Bullard right now is I think they did the shot from the football stadium at Purdue, and he's got the whole Purdue Boilermaker thing behind him, like he's rah-rah. But I'm going to give him at least till Purdue beats Michigan this year. I'll give him at least till then. I don't know when the game is. Ginormous. Okay. You know.
Well, I've promised people that I'm going to watch a college football game this year, so we'll make that happen. I want to check in on the price action for you. We are about 13 minutes or so away from the opening bow. Your equity market shaping up as follows. Equity futures on the S&P 500 positive here by 0.3%. On the week, we are just about positive, but only just after yesterday's losses. In the bond market, we've backed away from those cycle highs on a 10-year yield of about 4.36. We're back down to about 4.24.53 going into that speech from Chairman Powell, Tom, in the next hour.
It is, and this is a wonderful moment now as we go to that speech with the central bankers gathered here on, yes, U.S. economics, but of course, international economics. And they will listen more to Barry Eichengreen of Berkeley than anyone here. He owns the high ground from Golden Fetters, his classic book on gold, until what we see with globalizing capital and now his intense focus on debt and the debt mess we're in. Dr. Eichengreen, thank you so much for joining us. How bad is the debt mess we're in?
Well, I think it's a big change from the pre-COVID days. Governments are going to be constrained if and when we have a global recession, if and when a bad thing happens. They have a lot less room to run fiscally because of the increase in public debts worldwide.
As usual, you've been out front on this, and the phrase that I hear from you is, and you say it with respect to the institutional pressures and our political leaders, the modern medicine that we have. What is the more stronger medicine we need to take to get control of our debt and our ratios?
I think we're going to have to learn to live with these high levels of public debt that the advice policymakers are getting from the Bank for International Settlements and the IMF about bringing down debt ratios. That's unrealistic. We're not going to be able to grow out of these higher debt ratios. We're not going to have a more favorable real interest rate going forward than we've had in the past. We're not going to be able to run primary budget surpluses for long periods of time. So I think we're going to have to tiptoe likely through this problem and manage these heavy debts.
Tiptoe, your words, manage. Other people might say this ends in disaster. Barry, what's the argument against that?
For countries like the United States, there is a big, remains a demand out there from foreign central banks and the international private sector for U.S. Treasury bonds. So I think the U.S. government is an exception to the general rule in that it has room to run. Other governments are going to have to reform fiscal institutions, worry about fiscal transparency, do all the things that the IMF and others have been recommending for years.
Does it basically suggest that longer-term yields in the U.S. are where they need to be? That basically the term premium is going to be significantly higher, that essentially what you see is what you get?
Well, I think the term premium can come down a bit, but not back down to pre-COVID levels. I think everybody understands that we're in a new world with higher interest rates. The question is how much higher, and I wouldn't be a pessimist about that.
How much has the debt that the U.S. has incurred in particular driven a lot of the inflation that we see? How much can we really basically write the book and say helicopter money actually does cause inflation?
Well, I think the fiscal stimulus that we in the United States did in 2021 was a contributing factor to the inflation, and there will be debate about that today because there were other contributing factors as well, the supply shocks, a variety of other things.
Take your study of debt, your view on the inflation-adjusted yield, which is maybe what the adults, the pros, look at, and bring it over to the Eichengreen application of monetary policy. And there's a whole R-star debate in that. Are we going to move away from a 2% regime? And how do we search out an anchored level that is higher?
Well, I think the Fed has to bring inflation down to 2% before it really opens that conversation. We saw in this recent episode the importance of credibility, and credibility and 2% are synonymous for the time being. The only time you talk about changing the regime is when you have everything under control.
Let's go down the hall at Berkeley to Brad DeLong's office. You and I are going to walk in with Professor DeLong, and I'm going to say to both of you, with your academics and his more political view, what's the price of bringing inflation down to 2%? What's the cost of that to Americans?
Well, so far the cost has been minimal compared to the doom and gloom scenarios we heard about unemployment going up to 5 or 6%. So far, so good.
But that's your hallmark. You have been the arch optimist against doom and gloom. And how do you respond to the doom and gloom that we hear daily from Lisa Abramowitz, or that we hear out in all of economics? How do you respond to that American gloom that you fought against for 50 years?
Well, look at what the Atlanta Fed now tracker is saying. The U.S. economy is on track. There's no sign of inflation on the horizon yet. In this kind of assembly of economists, there has to be one optimist.
Lisa, this is like the GOP debate, isn't it?
Yes.
Your name was referenced. Would you like to reply?
Well, I just wanted to wonder, at one point, is it unsustainable, this kind of enthusiasm, this kind of growth, right? I mean, at some point, you're not going to get down to 2%. I'm already changing to 3%, 2% for quite a while, even by the Fed's own admission.
2025.
Exactly. After 2025. Right. Doesn't that reduce their credibility to some degree?
They have to have a credible strategy for getting to 2%. So this is the classic, give them a target 2% or give them a date, never give them both.
2%. Can we think about where it came from? Is this really about some people in New Zealand in the 1980s just coming up with a number? Is that what we're all doing here? 2%? What is it about 2%?
That's exactly what we're all doing here, but history has consequences.
Can I sneak in one quick? No, you're dead on. I mean, absolutely dead on. Absolutely dead on. The first time I think I met you, or it was like within the year I met you, some guy almost took a swing at you on a stage in Singapore at a G7 meeting. He was so angry with you. How do you respond to, OMG, the dollar's dead, renminbi ascended? Do you throw chalk at people at Berkeley when it comes up? How do you respond?
No, at Berkeley I don't hear it, but that kind of interchange, you get more invitations.
Do you get some more speaking fees off that. Do you suggest the dollar is at risk given all these stresses?
I think the dollar is not at risk yet. So we in the United States can do things to damage its credibility, but nothing that happens at the BRICS summit this weekend will much affect the dollar.
You weren't invited, were you?
I would have chosen to come here anyway.
The word yet is so loaded. Barry, thank you. This was wonderful. Trudy, thank you very much, sir. We are about 5 minutes out from the opening bell in New York City. This is what we're going to do. So at 10:05 Eastern Time, you'll have an address from Chairman Powell. We'll take that live and in full on Bloomberg TV and on Bloomberg Radio. Bloomberg's Mike McKee is going to react to that, and also Mohammed Al-Arian, just the perfect guest to spend a little bit of time with Tom off the back of that address from Chairman Powell.
Can I just say the team that's put this together, and McKee years ago, I mean,
are you emotional?
McKee, I'm emotional
on the edge
now.
Of tears?
We have, I'm not at the edge of tears, it's too cold. Lipsky, Eichengreen with us, Gorgieva before, Lagarde later, Dr. Al-Arian, and that. This is just so cool, and I didn't think it would be this cool even 5 weeks ago. That's how immediate this meeting has become.
On the edge of tears, 1 hour and 25 minutes into the program.
Well, I just saw the first elk out there. It's over Bramo's shoulder.
Are you going hunting later?
No, they wouldn't let me do that.
Okay, hunting in a bow tie.
People like, have a drink.
To a bear.
To a bear,
to
exactly.
A bear.
That's
okay.
A bar.
Your opening bell is about 5 minutes away. From Jackson Hole, Wyoming, good morning.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
The week ain't over yet. The final trading day of the trading week. Your equity market on the S&P 500 positive. Futures up by 1/3%. Up on a week, but only just. On the Nasdaq, up on the week and up again. Up by 0.2% and trying to bounce back from yesterday's losses. There's your opening bell. Switch on the board and get to the bond market. We look like this in treasuries right now. A 10-year yield, cycle high in the past week. 436, back to about 425. Yields nudging up just about a basis point. 35 minutes away from Chairman Powell. The dollar showing a touch of strength. The euro some weakness. Earlier on today, a breaker 108, a 107 handle. More weak data out of Europe, Germany specifically, through most of this week. That currency pair at the moment, 108, Tom, 05.
The correlations are, John, are germane, but I'm not seeing a breakdown like in strong Swiss franc. That really hasn't happened. The real yield hasn't popped through from the shock of 2% to a new level. But as I mentioned earlier, to me, the news yesterday, you take the 3-month T-bill, and I think you got to go back to Eisenhower's presidency over where it is. I'm kidding there, but you got to go. We're starting to go back on Eisenhower, John, president, just coming out of World War II.
Oh, thank you, Tom.
50s,
Thank you. Thank you.
But the idea here, we've lost scope and scale as of the people here of where these yields are back before 2007.
We'll do Churchill in the next hour. How about that? Does that work?
like that.
Okay, cool.
Yeah.
About a minute into the session,
Break out
your
the
equity
cigars.
market positive by 0.4%. Any excuse. On the Nasdaq right now, up by about 0.5%. Lisa trying to bounce back after a pretty dreadful day of losses off the back of Nvidia, when Nvidia looked pretty decent in yesterday's session for the best part of 5 minutes.
There seems to be a fear that people got overly complacent with the soft landing narrative. And to me, that has been the theme of this week, the slow transformation into Fed Chair Jay Powell. If he seems complacent, what that means for the long term. If he's not, and he pushes back with hawkish rhetoric, which some people think he will, in order to keep inflation under control, what that does to a market that is priced to perfection.
Or is it just simplicity in that if we do get disinflation, if it breaks down, and there's many people, David Rosenberg, Ed Hyman of Evercore ISI, if we get their outcome, do yields just naturally come down? Is that the massive bet that's really in doubt this late August?
I can't bet on what he's going to say at 10:05 Eastern time. I'm on the same page of people who believe there is an incentive here to say nothing. I think he's highly incentivized not to say much at all. But again, Lisa, there has been this conversation about a higher R star, a higher neutral rate. I think when you talk to people around here, there's a reluctance to really subscribe to the idea that he's going to talk about that later on this morning. Why would he?
I can't imagine that he would. I mean, honestly, he's got no incentive to do so. So it's unclear whether this is going to be a market-moving kind of speech. What people are talking about is the tone, and whether he has a hawkish tone, a dovish tone. Does he talk about pain? Does he talk about soft landing? Does he talk about what he sees in terms of his future dinner plan?
Did you just say, is the chairman of the Central Bank of the United States going to talk about pain? Did you get that on the Brennan cam?
Okay. Well, but it's the tone. It's all about the tone. But to me, it's indicative of the importance of this meeting that the head of the South African central bank spent 30 hours getting here. Ueda, probably governor of the Bank of Japan, probably spent just as long, if not longer. They all came to this spot to look at these mountains, to talk about inflation, because they all are flummoxed. They don't know what to do right now, and I think that's important.
The confusion, and as Lipsky said, Dr. Lipsky, formerly of the IMF, said, the complexity right now is over. It's different than 07, 08, 09. I remember the sweat then. It's different. This is not like Lehman, but it's just as complex as well.
At risk of sounding too much like you, TK.
We don't want that.
What does it come down to? Comes down to one thing, doesn't it? Comes down to the data. We've still got another CPI print. Let me get through it. Let me go through it. It's painful enough, all right?
This is really painful.
We've also got a payrolls report next week, next Friday. Okay.
Oh, next Friday. I'll be here.
September 13th. Good to know. September 13th, CPI. September 20th. September 20th, the Federal Reserve. We've still got to get through that to think about what they do in September and beyond. And if we still see GDP prints like the one we're like to get in the third quarter in early 2024, then the idea that this is done and dusted, I think you can park that idea pretty fast.
It's a 2-year, 3-year disease in the pandemic of asking too much of our central bankers. They're just going to look at the data. That's what they've done. Over the history of this event, back to Paul Volcker in the 80s. Do you know they got Volcker here just to do fly fishing?
I do understand that, yeah.
Yeah, I didn't know that.
It's the Kansas City Fed Symposium, right?
Yeah, and it was, somebody said, well, why is Kansas City in Wyoming? But that goes back to the huge history of these central banks.
Do you want to do that history now?
No, I don't want to do that history now. Stephen Whiting is going, yeah, I read that in my economics. Joining us now from New York here, an important conversation with the markets opening with Stephen Whiting, Chief Investment Strategist, Chief Economist of Citi Global Wealth. Stephen, I got to cut to the question of the moment within the tension of the market. What is the temptation to go to cash?
Well, it's a huge one. It's the highest yield on the curve is at the front end. We don't have depressed equity markets. The Federal Reserve has been tightening for a couple of years, and so that's really drawing a lot of interest. And again, is it going to be something that's going to outperform over the long run? You could take a look at the history of cash, and it really lags behind both bonds and especially growth assets, equities. And in terms of having a portfolio, you don't want, again, to sell your family business over what can be a yield that usually lasts maybe 6 months at its peak level before the Fed cuts.
Steve, moments from now, Chairman Powell's going to walk out here and, to Tom's point, stare and point at some mountains, and then we'll all listen to him speak in about 30 minutes from now. Steve, from your perspective, from people you speak to, are expectations high for him to say anything at all later on this morning?
No, expectations are not high, or I would say there aren't very strong views as to what he would say. Obviously, he's not going to say, well, we're going to let our guard down on inflation. That's not going to happen. But apprehension, anxiety over the possibility that you learn something that you're not positioned for, that creates trouble for investors. And one of the things you can see right now are record high levels of short positions in futures and 10-year notes and 2-year notes. It's a lot like where we were in the equity market at the beginning of the year. We see a lot of shorting of bonds right now. And again, we could end up seeing some relief after all of that apprehension ends, regardless of what he says.
Steve, there was a big question yesterday about the move in NVIDIA, and this question reigniting by Michael Hartnett of Bank of America about whether we're seeing tech stocks become interest rate sensitive again. Suddenly it matters that yields have climbed as much as they have. Do you think that that's going to be a more predominant narrative yet again over the next few months?
Look, interest rates will always matter. Whether or not it becomes the predominant issue depends on other fundamentals going on at the same time. I'd bear in mind that when you have, companies that have doubled, that have tripled in the year, okay, well, you don't think that they're going to be raising their earnings and their guidance and this sort of thing for companies that have become really huge. I mean, the Magnificent Seven U.S. tech stocks have accounted for something like 70% of the whole total return in global equity markets this year. So that concentration issue, that level of positioning, these things become important. And if you give them higher interest rates on top of that, that can be an excuse.
How have you shifted over the past couple of weeks when we've had this roller coaster of emotions, soft landing, basically baked in, given, suddenly maybe it's too strong, maybe we have too much dynamism, rates are going to go up much further and that's going to curtail some of this. Have you shifted any of your positions or beliefs during all of this time?
So for the U.S. economy, we are getting upside surprises. We're seeing that this year's growth rate is going to be stronger than last year. But I think everyone who believes that the economy can somehow escape any slowdown, or the labor market, which has outperformed the economy so much, can escape any slowdown in the coming year, I think that that's going to be the wrong point of view. And in fact, I would expect Chairman Powell to reflect on the fact that consumer finance rates have moved up a great deal. Not only that, the number of banks who are lending in the economy and doing so the way they did a couple years ago has changed. So monetary policy has tightened a lot. I do not in any way believe that these lags in policy have disappeared. Markets may be fast, but the economy is still slow. Now, I would say there has been some good news. We are working down the need to have a recession. What I mean by that is we've been able to keep employment and services growing for so long that it's supporting goods demand, that we're getting inventories down. That's usually the kind of thing that happens when we're coming out of a recession. So in many respects, I think the declines that you see that are very real in housing and manufacturing, we've managed to take some of these losses of a recession already. Our outlook for next year is 1.8% real GDP growth in the U.S.
Stephen Whiting, everyone at this time, the complexity, the tensions of the moment, everyone turns to the Citi Surprise Index. What does the Citigroup Surprise Index tell you right now?
Well, it's showing remarkable strength, upside surprises, but they're wearing off a little bit. Once everybody has adjusted their view higher, it's harder to keep them surprised. Now, if you take a look at China or the European Union, we're having big downward surprises, and everyone adjusts their views to that. And so it's never static. If we take a look at the next year, we can never assume that these surprises really continue and that you're going to have just a static view of outperformance of the U.S. economy. That's something I'd be cautioned a little bit about. Now, that's even as we do think, again, just as I said, the American economy can probably have rolling recessions, take its losses in some sectors, and because of the instability of the last few years, actually grow slowly below trend for a couple years and get through this without a collapse everywhere. But again, I make one little point again for the Fed. In a period when they've inverted the yield curve, where they've tightened this much, the potential, the vulnerability to an outside shock is higher. And we saw this again 18 and 19 after policy has tightened and COVID came along. I don't want to say too much about that, but again, the possibility of having to absorb a shock with tight policy is something that you'd want to be aware of.
Steve, none of us want to talk about COVID either. Now, forgive me, away from here, the most important development in the last 24 hours is not anything anyone's got to say around here. It's about what happened with NVIDIA. They come out with earnings, Steve. They knock it out of the park. And I know you can't do single names, but surely you have to take some signal away from the earnings, which were fantastic, and the way the market responded to it, which was less than fantastic. What's the takeaway from that, Steve? So
John, you cut out for a second, but I think I'm going to try to answer your question, hopefully appropriately. We have just made moves into U.S. equities, specifically in equal weight indices, to not build up our concentration in the Magnificent Seven. That, again, wonderful companies that grow their earnings extremely well, and when they sell off sharply, if they have secular power behind them, you want to buy them. But when they have already galloped higher and generated so much return and such a massive market cap, we don't want to increase our exposure again and double up exposure in companies that have succeeded so much in the marketplace this year.
Steve, thanks for dropping by. It's good to catch up as always. Steve Whiting there of Citi Global Wire. Steve, thank you. You know the cheat guide to interviews, TK. You hear something you don't like, you didn't hear it.
No, it's great. It's great. I think our guests do better when they can't hear our questions.
What was that, NVIDIA? What, single names? No, single names? What, NVIDIA? No, you cut out, John.
Do you know, we have a global audience today with all that we're doing here at Jackson Hole. Mrs. Bramo emailed in.
What did she say?
She said, let's go to Walt Disney. Born on a mountaintop in Tennessee, greenest state in the land of free, raised in the woods so he knew every tree, killed him a bar when he was only 3.
All right.
Davy,
That's right.
Davy Crockett.
My mom was correcting my correction of you. saying bar instead of bear.
Grandma.
Yeah,
No.
that's just no.
When Tom says bar, do you really think we're thinking bear?
Exactly. Do you think that anyone, you said, like,
No,
I was looking
you
for
say
a bar.
You were looking for a bar. I'm like, yeah, what's new?
No,
I'm not thinking bear.
He's like, wait a second, I was cutting out.
It's actually pretty serious up here, Lisa. You were out hiking around. I took a hike too.
Yeah, how far?
But there's signs up, and what's interesting is some of the signs have, like, you know, magic marker on them. It's a mom with cubs.
Yeah,
we're not kidding.
That.
You know?
Don't mess around with that.
And it's serious. Up at Jellystone Park, the people are taking the kids and they're going right up to the bison. You don't do that.
No.
I mean, I don't know what these people are thinking.
Tourist TK.
Yeah.
Tourists. We're at one with our environment, you know, a TV studio. Coming up shortly, Chairman Powell, 10:05 Eastern Time, 8:05
so
local.
it's like 20 minutes away.
20 minutes away, TK. We've got the clock ready to go. The clock is ready to go. Chairman Powell just around the corner, and responding to that, Mohammed Al-Arian and Michael McKee. Looking forward to all of that. And Tom, in just a moment, Christina Roma.
She's expert on the Depression. If you have fears of our history, she is the expert.
The former chair of the Council of Economic Advisors. That conversation up next. Your equity market higher by 0.4%. From Jackson Hole, this is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they founded, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
When we talk about monetary policy, what I said is that we have to be stubborn here, even more stubborn than inflation. This is what we have to do. This is our mandate. We have to bring inflation down to 2%. It's, for me, much too early to think about a pause. I think we have to wait for the next numbers.
Joachim Nagel of the Bundesbank, the president, speaking to Michael McKee. This is a single mandate central bank. It has an inflation target. It is not the Federal Reserve. Right. It's the ECB. And that ECB in the last 12 months, Tom, dare I say, has looked a lot more like the Bundesbank than it did under Mario Draghi in the previous decade.
That was brilliant. You're expert on this, John. I'm going to be speaking with Christine Lagarde. And within an academic conference, folks, I can't say to her, what are you going to do September 16th?
You can.
So instead, I'm going to go to John Farrell and say, John Farrell, what is the ECB going to do September 16th?
They're in such a tough spot. I don't know. I really don't know. The backdrop for them is so different to the United States. We have really robust growth. If they had robust growth, I think they'd probably hike again. I think they would, but they don't. They have parts of the economy facing recession, Tom. Inflation's still sticky. The nightmare word the nightmare word in the last 18 months was stagflation. You certainly can't throw that around in the US economy. I think you can start mentioning it in Europe, and they hope they don't get stuck there.
Then how do you, and it won't be discussed here, but how do you overlay a war in Ukraine with conventional monetary policy?
I don't think you
understand.
can. That's what they've been facing. That's what they've been facing. Lisa mentioned this, and Lisa, when you said it, I think you're just dead on. The fact that things are so fragile over there that you can see something like a strike in Australia sending European gas prices through the roof all over again. That's how vulnerable they are to outside forces. And not just that, China's another great example of what's taking place in the European economy at the moment. And the US, I think, has the luxury to speak differently about these issues. Europe does not. They do not have the insulation that the US economy has.
And one of the big existential questions here that has to do with that difference is where the fiscal impulse really played into that. The stimulus that the U.S. put into the economy during the pandemic that Europe did not, that is still percolating out into consumer spending.
We're going to have that this afternoon. Christine Lagarde, she will speak here after Chairman Powell. John, what, 15 minutes away on Chairman Powell?
17, something like that, yeah, TK.
Chairman Powell will speak, and then Christine Lagarde will speak. She will answer questions here among the assembled, and then we are thrilled for Bloomberg to bring you our conversation with Christine Lagarde on her paper here, and maybe a bit on the European Central Bank. This is a great moment, and this is, first of all, there's Adam Smith in economics. The modern name for Smith is Romer. AEA did a survey, and there's like 42 economists, world-class name Romer. There's a laureate, Paul Romer, on technology, some guy named David Romer as well, and Christina Romer joins us now from Berkeley, iconic on the history of our nation's economics. I have to tell this story. It's one of the great stories. You're like 22 years old, you and David Romer, I don't even know if you were married at the time, and you literally flipped a coin at MIT over who would get Stan Fisher and who would get Rudy Dornbush?
It's true. Now, in fact, David thought he won, but it turns out I think I won.
You won with Rudy. Good morning, Dr. Fisher, I know, watching it this morning. You are definitive. What an honor I had to meet Anna Schwartz in the last years of her lives. Tell us the history, the prism of all the fears that our listeners and viewers have. This is going to be like the Depression. This is going to be a crisis. Do you feel that way?
I have felt that way in the past. Take me back to 2008, and knowledge of the Great Depression was strangely relevant. I don't feel that way now, obviously. I think things are, going pretty well. We're getting inflation down, and the economy so far is holding up.
Are we asking too much of our central bank?
We are asking a lot. It's amazing they're delivering so far. It's way too early to declare victory, but they're threading that needle.
Rudy Dornbush would have talked about, if he was here, he died tragically, folks, of cancer far too early. If Rudy Dornbush was here, it would be a dollar-centric conversation. In your study of our slowdowns, how does dollar worry fold into this? Should we be afeared of a weak U.S. dollar or a dollar that loses sovereign ability?
I don't think so. I think I feel very strongly the dollar kind of follows from what we do on other policies. So I think the main thing we worry about is the Fed doing the right things, is Congress and the President doing the right things on the fiscal side, is our banking system sound. Those are going to be the fundamentals.
There's also a question in your study of the Depression of what the response will be from the U.S. government if there is some sort of downturn, the inability to stimulate further because of how big the debt load is, because of what they've done and where borrowing costs are. How much do you think that affects the likelihood of a recession when you look not next year or the year after, but down the line that could last a much longer period of time?
I think I'm not very worried about that. I'm worried, right? So just the high debt loads in general kind of limit the fiscal response. I've actually done research that shows that that's the case. Certainly was the case during the global financial crisis. And so we ought to get our fiscal house in order. So we've got both tools to use. I think the Fed has made it very clear they're not going to be afraid to raise or lower rates, if that's what the economy needs.
Have you ever seen deficits this large with unemployment this low?
Well, I mean, yes, right? Because big deficits tend to go with low unemployment. Think World War II, right? The last time we were at 100% was when we had this very, very low unemployment. So in the short run, it's good, right? So you're stimulating the economy. We talked about how that fiscal impulse early in the pandemic was really a big part of why the U.S. coasted through.
I've been dying to ask you this question. Everyone from the left and the right have talked about it. Can you make an analogy to the economic carnage after World War II, 1947, starvation, the Marshall Plan and all that? Can you do an analog to 1947 over to the double deflations that we saw in early Eisenhower? Should we worry about the deflations of the early 50s, that same analog?
I don't think so. I mean, there were sort of special things going on. There were price controls coming off with Korea. So I think that I wouldn't worry very much with that. I think we're in, I think, a much more kind of normal. We've had inflation.
Oh, come on, Christina, half of America feels like they're flat on their back. I mean, we have the disaggregation. I mean, Meltzer would kill me for this. The disaggregation of the economy right now is appalling. Half of America feels like they're flat on the back. What is the public policy that we can prescribe for those people?
I mean, it's a tough one because I agree, inflation makes people really mad. And that is, I think it's why it's so important that the Fed, really get back to their 2% target. I think there's just no question on that. But there's also the case, if you look at the basic fundamentals, for heaven's sakes, the unemployment rate is 3.5. GDP has continued to grow. I think, yes, people are struggling. They're certainly struggling with the cost of living, but a lot of the fundamentals are good.
You sound very positive. A lot of people have. Are people here taking a victory lap?
They shouldn't. And if I had to guess what Chair Powell's going to do, he will not take a victory lap. He will be cautious. He will say we've still got a ways to go because everybody else is doing the victory lap for him.
You can feel a little bit of happy talk around here, can't you? It just makes me uncomfortable.
No, and I agree. I think that we don't know what's going to come. We have still had a bunch of monetary contraction come in. It's not really hit us yet, and it could.
Oh, you think it has? Because Bill Dudley, the former New York Fed president, is arguing to some extent that maybe those lags are shorter. We've seen them. Everything they've done's already hit us. You think it's out there in the distance into next year?
I think it certainly could be.
Interesting. Christina, wonderful. Thank you so much.
Were you with Dudley at Berkeley when he took his PhD?
Were you there?
I think we're trying to wrap that up there, Tom.
I can just see the fist fight.
Thank you. Just say it.
Thank you.
I can just see the fist fight.
There's just this thing called a commercial break.
She's got claws. She's tough.
He didn't hear. His IFB went out.
Oh, is that what he did?
Yeah. That's what happened.
Selective hearing.
There's a bar over there.
Always.
Yeah, what do they serve at the bar?
I'll do it for a fourth time. Christina, thank you. Christina Roman of UC Berkeley. Appreciate it. Thank you very much. Your equity market's just about positive on the S&P 500. 10 minutes from now, Chairman Powell in Jackson Hole, Wyoming, addressing, I would say, not just this audience, but the global economy as well, Wall Street and beyond. Tom, a very, very different speech is expected from the one we got 12 months ago.
Well, a different speech from 12 months ago, John. This is a different speech from 4 weeks ago. I feel that, like I've never seen in Jackson Hole, things have changed. Even back to 2009, back to Lehman, things have changed in 4 weeks.
Chairman Powell in the next hour on Bloomberg Surveillance, live from Jackson Hole. Good morning.
Global economic pain may turn into emerging markets gain. Investors say they plan to allocate more funds to emerging markets over the next year. That's according to the latest Bloomberg survey of professional and retail investors. More than 60% of respondents are betting emerging markets will either push higher or outperform the developed markets if the U.S. economy tips into recession. This would mark a significant change in leadership that's been in place for more than a decade, in which U.S. stocks have returned more than 700% since March 2009, dominating the rest of the world. Within EM, market watchers rank stocks as the best investment, followed by a tie between debt in local currencies and U.S. dollars. Lower valuations is a big draw. In equities, the MSCI Emerging Market Index trades at 12.5 times estimated 2023 earnings. By contrast, the S&P 500 has a multiple of more than 18.5. External factors may end up proving to be bigger influences on emerging markets than domestic politics. The dollar's weakening trend means companies in emerging markets should have more room for growth, and countries that did not prop up their economies with stimulus during the pandemic may be better positioned to return to a growth rate that's sustainable. Looking out over the next 2 years, respondents overwhelmingly made Southeast Asia their top pick, beating out Latin America and Eastern Europe by a wide margin.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg. Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Heading into Jackson Hole, we're not expecting a major policy shift out of the Fed.
I think Powell will be prudent, best of both Greenspan and Volcker, not claim victory.
Jackson Hole is going to be an opportunity for Powell to flip the narrative a little bit.
I still think he's going to embrace that narrative of higher for longer, just given how resilient the incoming data has been.
I don't think we should be looking for any big surprises. My sense is that Powell is going to get up there and he's going to reiterate exactly what he's been saying.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It is almost the moment you've been waiting for. The most important hour of the week, arguably of the month. Chairman Powell addressing Jackson Hole, Wyoming in about 4 minutes from now. The third hour of Bloomberg Surveillance starts right now. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Going into this, your equity market on the S&P 500, slightly positive by 0.4%. TK, this event about global structural shifts in the global economy and all of that good stuff. We've got one question. Tell me about September. Tell me about September and beyond.
He's going to be data dependent. We know that. The shock of last year's speech being 7-8 minutes or whatever, truly a shock, folks. I really can't say that enough. And, the headlines will come out here and Mr. McKee will warble gaily and away we go.
TK, I'll share this with you. 12 months ago, I raced off set to go to the bathroom.
I remember
Go to the restroom. And I raced back again. I couldn't believe it was only 8 minutes long. There is a sense, Lisa, this is longer. It's more thoughtful. It's less just about inflation and much bigger themes. There is a hint from other people. I'm not sure where it's really come from. The neutral rate. Are we going to talk about R-star? I would suggest to take a guess that this has come about because the economic data has been so much stronger over the last several months or so that people are starting to have that discussion. They'd like him to have that discussion. Whether he chooses to have it 3 minutes from now is a completely separate question altogether.
And most people would say, no way, he's not going to do it. And you say, what are you going to do in September? He's not going to say. He's not going to say what he's going to do later on. But what is going to be interesting is the longer that the speech is, the less clear the message he's trying to convey. Short, very clear. Pain, we need to get there. We need to get inflation under control. Is inflation going to be the same enemy this year that it was last year? Is inflation at 3% pernicious or acceptable? And I don't think he's going to necessarily weigh in on this, but the tone that he takes will really give a sense of that.
I got this message just moments ago from a Bloomberg subscriber. Thanks for that. It said, come on, Jonathan, get with the program. You're in Wyoming, dress like Michael McKee.
Good morning, everyone.
Chairman Powell stepping up to the podium. Here's the chairman of the Federal Reserve.
Symposium, I delivered a brief, direct message. My remarks this year will be a bit longer, but the message is the same. It is the Fed's job to bring inflation down to our 2% goal, and we will do so. We have tightened policy significantly over the past year. Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective. Today, I will review our progress so far and discuss the outlook and the uncertainties we face as we pursue our dual mandate goals. I will conclude with a summary of what this means for policy. Given how far we have come, at upcoming meetings, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. The ongoing episode of high inflation initially emerged from a collision between very strong demand and pandemic-constrained supply. By the time the FOMC raised the policy rate in March 2022, it was clear that bringing down inflation would depend on both the unwinding of the unprecedented pandemic-related demand and supply distortions and on our tightening of monetary policy, which would slow the growth of aggregate demand, allowing supply time to catch up. While these two forces are now working together to bring down inflation, the process still has a long way to go, even with the more favorable recent readings. On a 12-month basis, U.S. total or headline PCE inflation peaked at 7% in June 2022 and declined to 3.3% as of July, following a trajectory roughly in line with global trends. The effects of Russia's war against Ukraine have been a primary driver of the changes in headline inflation around the world since early 2022. Headline inflation is what households and businesses experience most directly, so this decline is very good news. But food and energy prices are influenced by global factors that remain volatile and can provide a misleading signal of where inflation is headed. And in my remaining comments, I will focus on core PCE inflation, which omits the food and energy components. On a 12-month basis, core PCE inflation peaked at 5.4% in February 2022 and declined gradually to 4.3% in July. The lower monthly readings for core inflation in June and July were welcome, but 2 months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. We can't yet know the extent to which these lower readings will continue, or where underlying inflation will settle over coming quarters. 12-month core inflation is still elevated, and there is substantial further ground to cover to get back to price stability. To understand the factors that will likely drive further progress, it is useful to separately examine the three broad components of core PCE inflation: inflation for goods, for housing services, and for all other services, sometimes referred to as non-housing services. Core goods inflation has fallen sharply, particularly for durable goods, as both tighter monetary policy and the slow unwinding of supply and demand dislocations are bringing it down. The motor vehicle sector provides a good illustration. Earlier in the pandemic, demand for vehicles rose sharply, supported by low interest rates, fiscal transfers, curtailed spending on in-person services, and shifts in preference away from using public transportation and from living in cities. But because of a shortage of semiconductors, vehicle supply actually fell. Vehicle prices spiked, and a large pool of pent-up demand emerged. As the pandemic and its effects have waned, production and inventories have grown and supply has improved. At the same time, higher interest rates have weighed on demand. Interest rates on auto loans have nearly doubled since early last year, and customers report feeling the effect of higher rates on affordability. On net, motor vehicle inflation has declined sharply because of the combined effects of these supply and demand factors. Similar dynamics are playing out for core goods inflation overall. As they do, the effects of monetary restraint should show through more fully over time. Core goods prices fell the last 2 months, but on a 12-month basis, core goods inflation remains well above its pre-pandemic level. Sustained progress is needed, and restrictive monetary policy is called for to achieve that progress. In the highly interest-sensitive housing sector, the effects of monetary policy became apparent soon after liftoff. Mortgage rates doubled over the course of 2022, causing housing starts and sales to fall and house price growth to plummet. Growth in market rents soon peaked and then steadily declined. Measured housing services inflation lagged these changes, as is typical, but has recently begun to fall. This inflation metric reflects rents paid by all tenants, as well as estimates of the equivalent rents that could be earned from homes that are owner-occupied. Because leases turn over slowly, it takes time for a decline in market rent growth to work its way into the overall inflation measure. The market rent slowdown has only recently begun to show through to that measure. The slowing growth in rents for new leases over roughly the past year can be thought of as in the pipeline and will affect measured housing services inflation over the coming year. Going forward, if market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well. And we will continue to watch the market rent data closely for a signal of the upside and downside risks to housing services inflation. The final category, non-housing services, accounts for over half of the core PCE index and includes a broad range of services, such as healthcare, food services, transportation, and accommodations. 12-month inflation in this sector has moved sideways since liftoff. Inflation measured over the past 3 and 6 months has declined, however, which is encouraging. Part of the reason for the modest decline of non-housing services inflation so far is that many of these services were less affected by global supply chain bottlenecks and are generally thought to be less interest sensitive than other sectors, such as housing or durable goods. Production of these services is also relatively labor intensive, and the labor market remains tight. Given the size of this sector, some further progress here will be essential in restoring price stability. Over time, restrictive monetary policy will help bring aggregate supply and demand back into better balance, reducing inflationary pressures in this key sector. Turning then to the outlook, although further unwinding of pandemic-related distortions should continue to put some downward pressure on inflation, restrictive monetary policy will likely play an increasingly important role. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth, as well as some softening in labor market conditions. Restrictive monetary policy has tightened financial conditions, supporting the expectation of below-trend growth. Since last year's symposium, the 2-year real yield is up about 250 basis points, and longer-term real yields are higher as well by nearly 150 basis points. Beyond changes in interest rates, bank lending standards have tightened and loan growth has slowed sharply. Such a tightening of broad financial conditions typically contributes to a slowing in the growth of economic activity, and there is evidence of that in this cycle as well. For example, growth in industrial production has slowed, and the amount spent on residential investment has declined in each of the past 5 quarters. But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer-run trend, and recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. The rebalancing of the labor market has continued over the past year, but remains incomplete. Labor supply has improved, driven by stronger participation among workers aged 25 to 54, and by an increase in immigration back toward pre-pandemic levels. Indeed, the labor force participation rate of women in their prime working years reached an all-time high in June. Demand for labor has moderated as well. Job openings remain high, but are trending lower. Payroll job growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual normalization in labor market conditions. This rebalancing has eased wage pressures. Wage growth across a range of measures continues to slow, albeit gradually. While nominal wage growth must ultimately slow to a rate that is consistent with 2% inflation, what matters for households is real wage growth. Even as nominal wage growth has slowed, real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response. Turning to the path forward. 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including 100 basis points over the past 7 months. And we have substantially reduced the size of our securities holdings. The wide range of estimates of these lags suggests that there may be significant further drag in the pipeline. Beyond these traditional sources of policy uncertainty, the supply and demand dislocations unique to this cycle raise further complications through their effects on inflation and labor market dynamics. For example, so far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades. These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve a sustained period of strong labor market conditions that benefit all. And we will keep at it until the job is done. Thank you.
We will keep at it until the job is done. Chairman Powell, 12 months later, after promising pain, without much sign of it, 300 basis points later, the goal is still the same. 2% is and will remain our inflation target. The price action off the back of this address in Jackson Hole, Wyoming, shaping up as follows on the S&P 500. Equities elevated, and it stays that way. The S&P up just a little bit on the S&P 500 right now. If we can run through the boards, we get equities up, and then we can get bonds, and we'll do it piece by piece and start with stocks. Stocks are still positive on the S&P 500. Yields look like this, Tom. They're lower by 3 basis points on a 10-year, 420.39.
Dollar comes in. Let's go right to it, John. Euro, a little bit of dollar weakness with the euro 107 earlier, and come out to a 108.04 maybe with a little bit of a euro lift here.
Knee-jerk reaction, Tom, but I would be hesitant to define this speech based on the intraday price action on the S&P 500 in the bond market. That was a Federal Reserve chairman effectively telling us all, Lisa, that the job is not done, and if we need to do more, we'll do more.
This was a Fed chair saying, stop talking about 3% as the new normal for inflation. 2% is what we're going to get down to. We are not going to stop until we get there. The long and variable lags are long, but they are going to come to fruition. He talked about how there is tightening that's going to hurt. But to me, that is the takeaway. They are not entertaining a 3% target for inflation, despite a lot of people saying that maybe that's what they ought to do.
A perfect Jackson Hole morning, and with the food spread that we've got laid out in support of our staff here, the crows descend, and while the chairman was speaking, it was the Jackson Hole crows. All the hawks are indoors. Because my first take from the first sentence of the speech is it was a hawkish speech.
If the labour market is not easing, monetary policy needs to respond. How much of a sign are you seeing that this labour market is easing?
I'll let McKee and the others I'll let Dr. Laird and Mike McKee judge this. I'm not going to judge it, but I'm just going to say all the hawks were inside listening this morning.
Well, two things. One, either the market doesn't believe that they're actually hawkish and just thinks that they're trying to job them down, and the fact that he didn't come out and say we're going to hike again is basically an all-clear signal, and maybe that's what he could take the market reaction. And number two, are they really convicted to go through with this? Yes, they're going to get down to 2%, but if it takes to 2035, does it matter? Right? I mean, in other words, how imprudent is it to bring it down quickly?
Our first math of the morning here, 8:19 a.m. Mountain Time. Is 2% 2.0%? Or is it 2.4? Or is it 1.9 rounded up? I don't know.
The former Fed Vice Chair, Rich Clarida, in a secular outlook over at PIMCO, saying it's 2 point something, that might be something they tolerate. Tom, at the end of the day, if they're still shooting for 2%, except 2% is out there in 2025, that's a shift, isn't it?
Yeah.
Isn't that tolerating above target inflation for longer?
Yeah, but there's a lot of data to come before we get to that point. I think the heart of the matter is I don't have it in front of me, but in a given set of cities in Kansas or Ohio, the unemployment rate's under 3%. To me, that's the heart of the matter.
And Mike McKee alongside us to go through this speech. Mike, your first thoughts. What did you think of that?
Well, it was a hawkish cast to it. He didn't say anything he hasn't said before, but basically they framed it in a way to send a message to the markets that don't get ahead of yourself and thinking that we're going to halt or cut rates. We're going to keep going with what we need to do, depending on the data. And I think he wanted to make it clear that another rate move is still on the table. It may not be for September, it may not be for November, but don't count us out. We'll see what happens as it goes forward. And he kept re-emphasizing that point, saying 2% is still a long way away, and we're going to go to 2%. To your point, John, the Fed has basically said, and Powell said again today, they will not hold back on cutting rates until they get to 2%, but they're going to keep rates higher until they get to 2%. Because, as he pointed out, real rates are up, and real rates will continue to rise as inflation falls, so they might calibrate down a few basis points to try to keep tightness at about the same level. But they're not going to get rid of all of their tightening until they are convinced they're heading towards 2%.
He started early, which I thought was interesting. He started about 10:02,
John, you noticed that?
44 seconds rather than 10:05.
That was deliberate to keep me from off the air breaking headlines. Jay Powell.
There you go. He wanted to prevent against a Michael McKee slip-up. There's a real question. There was almost an urgency. Hey, first I want to talk about the 2%, and then I want to just talk about all of the vagaries and all of these things. And we haven't decided yet. We're very aware of them. We're understanding the balance of risks. How much is he uniting all of the other members versus just coming out and saying, stop thinking I'm going to say something. I'm going to reconfirm what I've said already and just let it be already?
Well, I think he's basically appealing to both sides here, because while the speech reads hawkish, he didn't promise any additional rate cuts, rate increases. So he can go either way after this. This is more aimed at the bond market than it is aimed at members of the committee. It was interesting, though. I kind of found it fascinating that he clearly is reading the papers and listening to what people on Wall Street are saying, because he responded to them. He said, we don't know what our star is, so we're not going to talk about it. And he said, we are not going to change our 2% target.
No new target.
Yeah, so if that's what you're writing about, take it off of your company website.
You know, I love Total Drama Island. I watch an episode every week I can. This is like Total Drama in Jackson Hole. Forget about it. You're in there. It's a press conference. What's your first question? This is the only place McKee gets a first question. What's your question to Chairman Powell after that speech?
Oh, I think what you would ask him basically is, what is it that is going to determine how long you keep rates up? We know you're going to keep rates up, but is it going to be the move in the real rates, and when would you expect that to happen? Or do you just stay with higher rates until you are maybe below 3% into the twos?
I'm curious about one dimension of this speech. He talked about the need for below-trend growth and easing of the labour market. We don't have below-trend growth. When they talk about being sufficiently restrictive and telling us that they think they are, what evidence do they have for that, Mike?
Well, they don't have it yet, and Powell noted that. He said it looks like growth is faster than anticipated, and certainly the numbers, the preliminary numbers for the third quarter are telling us that. And I think that feeds back into his assertion that we are not done and we will do what's necessary, because he made a tie between the idea that the economy is moving at a faster pace and the labor market, and the fact that we could see inflation develop out of that, which is something that some of the other more hawkish members of the committee have suggested, that the growth rate is something that concerns them. So he tied those two together and leaves the possibility of higher rates maybe even a little bit closer than they were yesterday.
Mike, stay close. You going to stick around?
Yeah.
Patrick Harker coming up a little bit later. The first reaction from inside the Federal Reserve, right here in Jackson Hole, Wyoming. That interview coming up in about 30 minutes from now. The perfect guest for reaction to this speech is Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge. Mohammed, thanks for being with us and being with us through that speech as well. What were your thoughts when you heard some of those words from Chairman Powell just moments ago?
I had three takeaways, John. First, it's a speech that said very little that is new. He repeated what he has said in the past, and he has retained maximum policy optionality. Second, he reminded us that with the exception of the inflation target, which he said is 2% and will remain 2%, everything else is uncertain. And his reference to our star in particular was very interesting. And third, what I thought was also curious is how he ended the speech. He ended the speech talking about we will follow the stars in a cloudy sky. Everybody sees the cloudy sky, but what's interesting is that the rest of Jackson Hole will be about moving stars, all the structural changes that are going on domestically and internationally. And that just adds to the topic that the three of you have been talking, that it's a very complex world out there, and the Fed has to navigate a lot of moving pieces.
Mohammed, one conversation you and I have had over the last several weeks, the last several months for that matter, people are having this discussion here as well. Are we, from your standpoint, in your opinion, sufficiently restrictive?
John, this goes immediately to what is the right inflation target. If the right inflation target is 2% and they want to get there in a credible period of time, then we are not sufficiently restrictive. if the right inflation target, as you've heard many people say, including Adam Posen today, is above 2%, given all the structural changes, and the way we're going to get there is not by announcing the new target, but by following a shadow target, and then once we see it stable, adopting it, I think that's the most likely outcome, by the way, then we are sufficiently restrictive.
Mohammed, does it concern you that we've heard a lot of people who sound pretty happy, actually, other than Jay Powell, who is taking sort of the adult tone of, we're not there yet, stop declaring victory, there's a lot more down the pike. Everybody else sounds like things are going really well and the Fed policy is achieving exactly what it sought to.
So I don't think it's everybody else, but most people are, especially in the marketplace. Not so the economists. You have Larry Summers, for example, reminding us this morning that if you look at the 70s inflation cycle, this one looks very similar. He has the two graphs up, and he's sort of warning implicitly that we may see a pickup in inflation. So I think the marketplace is much more complacent than the economists are. The economists recognize that there are many moving pieces, whereas the marketplace thinks that we've gotten to a new equilibrium, and from here is going to be cuts next year. That remains to be seen.
Do you think, Mohammed, that it's important for the Fed to get ahead of a potential resurgence in inflation, or do you think that Jay Powell's approach of watching the stars and seeing what they are will be sufficient to curtail some sort of more embedded inflation?
It's hard, Lisa, because as you know, they have not, like past Feds, opted for a strategic view of inflation, nor do they have a functional monetary policy framework. So they've become highly data dependent, which means that they are using instruments with lags on backward-looking data. So they are in a bit of a tough situation. They're going to remain data dependent. So I don't think he knows what they will do in September. He's going to wait to see what the jobs report is. He's going to wait for the CPI numbers, and then they're going to decide what to do. But this is the irony, it's a highly dependent, data-dependent Fed using instruments that act with a lag.
On radio and television here from Jackson Hole, Mohammed El-Erian with us this morning. And as Dr. El-Erian speaks, John, markets are moving here. I just noticed the rebound in dollar back above DXY at 104 to Global Wall Street. That's important.
Break of 108 on the euro as well, Tom, against the dollar right now, about 107.95. Equities elevated through that speech, but coming back just in the last 10 or 20 minutes. Yeah. Plenty of feedback, Tom. This coming from Neil Dutta of Renmac, just published in.
Please.
Saying the following: I thought Powell delivered a neutral speech. The Fed sees its monetary policy stance as restrictive and will make a more tempered approach to future meetings. Proceed carefully, risk management. These are all catchphrases for do nothing right now. The view from Neil Dutta just moments ago.
A lot more response coming in here. Mixed market, red and green on the screen. Dr. El-Erian, I want to touch upon your iconic working game theory. And that the word that I'm hearing this morning is complexity. I heard it from you. I heard it from John Lipsky and others. The simplicity we're all begging for is T decisions. You are known for this. This is a Jackson Hole devoid of T decisions. How do our viewers and listeners handle the complexity now and to come?
Tom, I think the most important thing to understand is that we have left the world of insufficient demand and we are now in a world of insufficient supply. And there's many reasons for that. It's a world that's not going to go away anytime soon. It's not pandemic issues that are fully reversible quickly. There are longer-term issues going on. Changed globalization, supply chain management, the functioning of the labor market, and the list goes on. So we are now in a different world of supply-side constraints. And that world will mean that countries will become more inwardly looking, which we've seen already. And it also means that policy has to adjust to that. Now, put on top of that the layer of industrial policy as we embark more meaningfully on a green transition. And it's all about the supply side, Tom. And that's where monetary policy is really challenged, because it acts on the demand side.
We're thrilled, Mohammed, to have Dr. Georgieva with us, and then you and Christine Lagarde with us later. And the heart of the matter is, are we beyond the supply shocks of this pandemic? Where are we on that continuum, Mohammed? Have we escaped COVID?
I mean, we've escaped the worst of COVID, but we're dealing with the legacy of COVID. But we're also dealing with the legacy of the war. We're also dealing with many other legacies. You know, Tom, it's fascinating that you will have President Lagarde on, because if you think the U.S. is complicated, then in terms of degrees of complexity, Europe is even higher. The UK is even higher than that. So it's going to be really interesting to talk, as you will do, to President Lagarde, because even though she has a single mandate, her environment is significantly more complicated than the Fed's, which is already complicated.
So, Mohammed, she is so much more exposed. Europe is much more exposed to what's developing in China at the moment. Mohammed, if you took the US out of the equation right now, and we were talking just about Europe and China, wouldn't we be talking about things like rate cuts and easing and stimulating the economy?
If you take the US out of the equation, you would be talking about stagflation. And that's what everybody is afraid of. The US is exceptional, and it's exceptional in its economic performance. And if you take the US away, then you're taking away the only engine of growth for this global economy, but you're not taking away the supply side issues that are causing the inflationary pressures. So if you take the US away, we would be talking about not just the risk of stagflation in Europe, but you would be talking about the risk of stagflation in the global economy.
Mohammed, is that the risk or the reality in Europe right now?
John, is still the risk. You know, yes, Germany is struggling the most, and that is, if you like, the engine for Europe. But there's also good things happening in Europe away from Germany. It's a high risk. It's flashing red, not even yellow. It's flashing red, but it's not yet a done deal. The U.S. is much better off. China, ironically, is the one that's suffering the most. As you've been discussing all morning, there is no obvious policy response, and now these piecemeal responses are being rejected by the marketplace really quickly. The marketplace is no longer embracing the notion that China can get itself out of the mess it finds itself in.
And that's perhaps the cause of the manufacturing recession that we see in Germany and parts of Europe. But the services side, we've been talking about how that's maybe more directly affected by the ECB's policies and where rates are and the more direct transmission mechanism than in the U.S. Jay Powell just said that there is evidence that the long and variable lags are coming to the fore and will actually reduce growth materially in the U.S. Is Europe a model for where the U.S. is headed with respect to services in the next couple of months or in the next year?
I hope not, Lisa. Our service sector has been stronger, and even though the PMI numbers this week were disappointing, at least they were over 50 for the service sector. We don't want PMIs south of 50. And also, ironically, the service sector is where Europe gets the stagflation as well. It's not the goods sector, it's the service sector that's the inflation source of an inflation problem. So I hope we don't follow Europe, because if we do, then we will be talking about a very different outlook for the U.S.
We're still talking about the potential for some sort of weakness down the pike. One thing that Jay Powell's speech did was seem to remove rate cuts in the near future, at least for the foreseeable future, and you can see that shifting upward in the rate expectations. Do you think that this economy can handle a 5% Fed funds rate for the remainder of next year, even with all the strength that you're hearing about?
Lisa, we don't know. And he did use the word agile, and that's absolutely correct. He's got to be agile. Look, there are all sorts of sectors that adjust with a lag. We haven't seen the full impact yet of the higher rates. You're starting to see it play out in various segments, but in a very small way. Remember, not everything gets refinanced immediately. This is very unlike the UK economy, where the effective duration is much shorter. So you get refinancing quickly, and the rate effects happen much quicker. So we don't know how well we can navigate the 5%. It seems that the big issues in the banking sector are behind us. But so far, and it's really important to stress this, we've dealt only with interest rate risk. We have not dealt with credit risk. We have not dealt with liquidity risk. And that's what people in the marketplace have to keep an eye on.
Mohammed, stay close. Just want to go through what we've heard in the last 30 minutes from Chairman Powell. The 2% inflation target is and will remain our inflation target. We'll keep at it until the job is done. A far more nuanced speech from the Fed chairman this time around compared to, say, 12 months ago. Plenty of feedback on the Bloomberg terminal. Thank you for that. Keep it coming. This from one subscriber this morning saying, back in 2022, this was the quote, "We're taking forceful and rapid steps." 2023, the quote this time around, "We are in a position to proceed carefully." It's a very, very different tone, to borrow Lisa's language, in the last few moments compared to, say, a year ago. So let's take a look at the price action from where we've been from this morning through that speech and out the other side. Your equity market shaping up as follows on the S&P 500. Equities right now just about unchanged. Equities going absolutely nowhere. In the bond market, yields up, Lisa, by 3 basis points to 426.90.
And that's on the 10-year. On the 2-year, you're looking at a new high of 5.08%, which is interesting and speaks to this potential for another rate rise, but even more, no rate cuts in the foreseeable future, and that's something that's new.
Stuart Kaiser of Citi, publishing just moments ago, give you a flavour of what's happening on the south side. Not a game changer for markets from Chair Powell, but reminders on upside risk to inflation that demand downside risks to growth. Mohammed Al-Arian still with us. Mohammed, I just want to finish on that with you. The downside risk to growth to counter the upside risk to inflation. Is that something we all need to be cautious of going into year end and beyond?
Yes, and that's why Chair Powell had a speech full of optionality. You know, I go back to what Mike McKee correctly said. It's not that the content was new. It wasn't. There was nothing in that speech that we didn't know before, whether it was explaining what has been behind inflation or whether it was explaining the range of policy possibilities and the risks and the need for risk management. All that has been said before. What was notable this time is that it was packaged slightly more hawkish than dovish. And that's what people are picking up on. But ultimately, John, if we step back, the only thing he said is that what we know for sure is his belief is that 2% is the right inflation target and will remain the right inflation target. That issue is going to be hotly discussed in the next quarters as we get more and more data.
Yeah, Mohammed, I don't think that debate's going away anytime soon, even if Chairman Powell tries to put it to bed. Mohammed, thanks for being with us today. Appreciate it, as always. Mohammed Al-Arian. Let's go through the markets. Equities on one board, bonds on the next. We'll finish on foreign exchange, starting with stocks. In the last hour or so, the price action shaping up as follows on the S&P 500. And on the NASDAQ, we look a little something like this. Equities on the S&P just about unchanged now, going nowhere, so we fade from where we were at the opening bell. On the NASDAQ, just about unchanged as well. If you switch on the board and get to the bond market, we'll just slice up this yield curve. 2-year, 10-year, 30-year. Cycle high on a 10-year in the last week of 436. Yields were lower initially, now they're higher by 3 basis points on a 10-year, 426.70. That 2-year really close to a cycle high right now of 5.08% and higher, Tom, by 5 basis points on the day.
To cut to the chase, if I'm a CFO of any large cap, mid cap company, I'm looking at that data check and I'm going, how do we adjust to this? Critically off the real rate, which is not through 2%. But I'm sorry, these yields are something where everyone has to adjust.
That 2-year, not necessarily higher, but high for longer. That's what we're starting to think about.
Yeah,
just
the
a little
longer,
bit more.
I agree. The longer.
High for longer. I want to finish on foreign exchange. Yeah. Off the back of that, the euro, a break of 108 again. The euro against the dollar looks something like this: 107.84. We're negative 0.2%. If you want to take a look at cable, the pound against the US dollar, 125.74 here, Tom, negative 0.2%.
We're going to continue this discussion and really stay with you for the next number of hours. Moving to Christine Lagarde here, after her speech here, I should say, at Jackson Hole. Please look for that. But far more, it will be analysis and interpretation. Owning the high ground on that is Joseph Weisenthal and Tracy Alloway. They host a podcast, Odd Lots. Alloway had to redo her fireplace mantle because the awards have come in.
Oh, right.
So
they're
large. Yeah, they're piling up. I mean, my Weisenthal already had a mantle that could hold 300 pounds.
In New York City. Joining
us, Tracy Alloway from Outlets. Weisenthal would not get out of bed this early this morning. What I love about your work back at the FT and years ago is you own a perspective of London and New York in synthesizing the Western world. China, and an exceptional Japan with Ueda in attendance here in this YCC disaster, just had to listen to his hawkish one. How does Asia interpret what we heard this morning?
Well, I'm kind of confused at some of the bond market action that we've seen. So 2-year yields going above 5%. Hawkish interpretation, but I'm on the Neil Dutta side here, which is this was a very dovish speech, actually. Powell sort of gave a nod to the R-star debate, the idea about whether or not the neutral rate of interest is structurally higher in the current world. But then in the next sentence, he basically goes, but we have no idea what R-star is anyway, so it's completely irrelevant. And they're talking about being at restrictive.
That's not a small matter,
already.
John. Yeah, that's not a small matter. This has come up a couple times today. The guy from New York City, you know, the private equity guy, whatever Powell is, he's not too big on the plugins of our stars.
But Tracy, something you've discussed, this probably shouldn't come as a surprise, should it?
I don't think so. To me, it very much resembles what we saw last month from Powell. It's very much a data-dependent speech, which makes sense because you have two major data points coming up before the next Fed decision. Why would Powell stick his neck out at this particular moment in time? And of course, there is a lot of uncertainty about those long and variable lags, as you were talking about, Lisa.
Well, and this is a problem right now for Jay Powell because he wants to bring things down, but he doesn't want to curtail dynamism too much. Do you think that it seems fair to view his speech as saying that rate cuts are not in the cards for a longer period of time next year? Because that's maybe what he wanted to say in the implicit sort of tone, but not what he actually said.
I think he'd have to see a real deterioration in the underlying data to justify a rate cut, and that's just not happening. We have a lot of sort of anecdotal data points about maybe consumer spending is starting to weaken, but we haven't seen any of that in the unemployment rate, right? Now, that said, I know the tone of this particular Jackson Hole is very different to last year, where Powell was talking about how we'd have to assume more pain in order to bring down inflation. But that said, it's still a really uncomfortable moment for central bankers because inflation is coming down in a way that they didn't necessarily expect, right? The Phillips curve says that if inflation's coming down, the unemployment rate should be going up, but that hasn't been what's happening. So there's still a ton of uncertainty here.
This is essentially, while it is global central bankers coming together, it's also essentially an academic conference. You're here with Odd Lots to speak to some of the academic research. What are you hoping to illuminate in this whole shifting global structure that was sort of the theme?
Yeah, that's exactly right. So I know that the focus is always going to be on the sort of short-term outlook for interest rates, but really Jackson Hole is about the long-term framework of monetary policy. And one of the big themes that is starting to emerge is this idea of higher public debt. And we've seen that borne out in the Fitch rating cut recently, bond yields higher because of some concerns over the outlook for U.S. fiscal health. And again, the unusual thing about this moment in time is that we are seeing massive fiscal spending at a time of low unemployment. That hasn't really happened before. And so I think there are a lot of people at this conference who are wrestling with that idea and that dynamic.
You and Joe Weisenthal have Rockstar Hours. You just sort of wander in and you do your podcast, and you do it by piecing together conversations where Bloomberg surveillance is complete and total chaos 24/7. What's the conversation here you're most looking for into your next podcast?
Well, thank you for assuming that Odd Lots isn't constant chaos as well, Tom. Well, we're having you on later today.
No, that doesn't count. That was just,
counts.
You know, well, please. What's the conversation you want right now at Jackson Hole?
Okay, the big picture goes back to that bond outlook. What does a world of structurally higher debt look like? Does it necessitate higher interest rates? And what new financial risks does it introduce into the system? So we basically moved from a system that was very much reliant on bank lending to one that is far more bond-based. And how do you square a world where bonds really, really matter with central bank mandates to bring down inflation? There's a tension there. You can't build the financial system on bonds and assume that they're going to be very low volatility and then try to bring down inflation and have higher rates.
Tracy, this was great. It's good to have you here.
Thank you. Thank you for having me.
Thank you very much. Tracy Alloway, the co-host of the Odd Lots podcast. Let's turn to the price action. I want to bring your attention to the 2-year. If the 2-year closed right here, right now, on a closing basis, that would be a new cycle high, 5.09%. Yields are higher at the front end by close to 7 basis points, just short of 5.1%. I believe the cycle high intraday was something like 5.11% earlier on this summer. but we're getting closer off the back of this speech. Not the initial reaction, but it's the reaction in the last 20 minutes or so. The 10-year yield's higher by 4 basis points, 428. The cycle high there was a little bit earlier in the past week of about 436. Right now, 427.89. Just to go back to what Neil Dutta said, described it as neutral, Bramo. Said it was a neutral speech from the chairman. I said, don't define that speech by the intraday price action off the back of it. I don't think you should do that now either, but ultimately the early interpretation of what we heard from Chairman Powell in the past hour is high, potentially for a whole lot longer.
And this concept of we are getting back to 2%, the fact that he led and emphasized with that really highlights that he's trying to cast cold water on all those people saying, maybe we just need to fudge a little bit, that everything can be good.
There's 2 events today. Chairman Powell, that event's behind us. The other one is to hear from ECB President Christine Lagarde. So let's put those 2 together in one currency pair, the euro against the dollar. And clearly the dollar is where the strength is right now against the euro, which is weaker. The euro against the dollar at the moment on my screen, 107.76. Tom, that's your break of 108 all over again in the past hour.
You see that with the euro, and then you look at sterling as well. Remind me where Jordan Rochester was at Nomura. What's he doing?
Jordan's talking up. He's talking up 122 on sterling, and he's talking up or talking down euro dollar to about 105.
And this is where Jerome Powell becomes central banker to the world. We're not talking about Bailey, central banker to the world, Ueda, even Lagarde. We're talking about Powell having to react to each and every type that's here.
Mohammed was with us 20 minutes ago, Tom, and he was talking about the risk of stagflation in Europe. My question was, is that a risk or reality right now for the Europeans? And I know you'll have that conversation later with President Lagarde.
It's going to be interesting. And the key word I've learned today, folks, for those of you just joining us worldwide, thrilled with the feedback. Thank you so much for your feedback as we really commit to this debate about where are we heading into 2024, or for that matter, 2034. But really the heart of the matter for me is one single word: complexity, and how it redounds onto others as well. So we will take a turn here and look at the central banker of the world and how he affects other nations. Lesetja Kganyago joins us now, governor of the South African Reserve Bank. You know what I did on the Bloomberg, sir. I went to USD ZAR to capture the thermometer of the Powell speech upon EM as well. What are the ramifications if South African Rand breaks through in the coming weeks to new weakness, dare I say, to a 20 level? What is the ramification of weaker currencies right now?
Well, we are a central bank that targets inflation. And the focus is on what that would, if such a weakness does materialize, what it would mean for inflation in South Africa. We have started much earlier to tackle inflation. It has come down significantly. It is now closer to the midpoint of our inflation target range. And on the horizon, we actually see the exchange rate as one of the risks to the inflation outlook. So if there was to be a weakness in the currency, it does have implication for the inflation outlook. Though what we had seen had been that the pass-through effects from the exchange rate to inflation had weakened over the past while.
So on balance, Governor, is this high for longer? Is that the approach of the South African Central Bank? Is it similar to the Federal Reserve and what we heard from Chairman Powell, or is it different?
Well, we are focused on the outlook for the South African economy, for both growth and for inflation. The job is not yet done. The decline in inflation is welcome, but we have just had 2 good prints of inflation. That does not mean that the inflation monster had been conquered. There are still risks on the horizon, and we would watch that very closely.
So it took you 30 hours, I believe, to get here. Is that correct?
Yes.
It took you 30 hours and transferring through different places to get to this remote spot.
It took us 30 hours to get from New York.
It's such a remote spot. What were you hoping to hear? Was this speech worth it?
It's always important to hear what the chair of the Fed says, because what the Fed does has got implications for global financial conditions. And as a small open economy, the effects of U.S. monetary policy have got implications for our outlook. Jackson Hole is always a place to learn. It's not just about the speech of the chair of the Fed. Many of you, I know that is what you watch, but there are very important technical discussions that are going to be taking place over the next 2 days.
There's a bias here, Governor, that I think you can help us blow up. The approach is always, what can you learn from them? What can they learn from you? Emerging market central banks, they are the original front loaders in this cycle. You guys got ahead of this before these guys, before the Federal Reserve. What can they learn from the inflation dynamics that we typically associate with emerging markets? What can they learn from you?
Well, as emerging market central banks, we can tell inflation from a distance. We have, unlike the advanced economies which had experienced close to zero inflation, we had always lived with inflation for some time. And I think that the important lesson just for all the central banks is that complacency could become the enemy. And secondly, that the decisions that we have to take are very complex, but that you can't wait until you have got all the data before you act. By that time, it would be too late. So a risk-based approach is the correct posture.
So do you think that on the margins, this Federal Reserve is complacent or too complacent to track the data and to be data dependent in a way that's backward looking and not getting ahead of inflation that can get out in front of them?
Central banking and monetary policy decisions are very complex. And I have got no doubt that the decisions that the Fed takes, they take them on the best information that they have. And this is central banking. And you make decisions, and economic history always judges you. So I will leave it there.
Something that has happened in the news, which is agreements of China and your South Africa building technology utilities in South Africa brick by brick. Help us understand what South Africa just signed on an economic basis with China.
I have not been privy to those kinds of agreements. What I can tell you is that we, as central banks in the BRIC community, we have been in conversations with each other, and our focus had been really on the business of central banking. It had been a focus on putting in place safety nets, and secondly, making sure that our payment systems are interoperable and that it could facilitate trade. That is what central banks have been focused on.
Governor, I've known you a long time. You've been a good friend over the years. Thanks for being with us. Appreciate it. It's good to see you here in Jackson Hole. Thank you, sir.
Much appreciated.
Governor Lesetja Kganyago there of the South African Central Bank. A couple of headlines I want to draw your attention to. Might be a wrinkle in the outlook for this Federal Reserve, by the way, as well. This from the auto workers, authorising the union to strike if contract talks fail. UAW members clearing the path for an auto worker strike as soon as September 15th, so potentially the middle of September. We talked about this a lot over the last couple of weeks. We had a deal with UPS, higher wages. We've had a deal with the pilots over at American Airlines, higher wages. And Lisa, one thing you said we haven't had are the strikes that go with some of this labour power. You wonder if that changes over the next couple of weeks.
And what they have to get if it doesn't change, right? In other words, what kind of concessions do they get from the auto manufacturers that they've said what will amount to about $1 billion in extra costs every year?
These are market moves in the last 10 minutes, and I'm going to suggest folks may be wrong in this. We're a bit abandoned out here, but this recent move, John, is off this auto worker news. Equities, soggy, yields moving up. We're starting to talk about 2008 levels, dollar dynamics as well. There's more going on than just Jackson Hole.
Does this complicate the effort of this Fed chair, of this Federal Reserve?
Yes, because there's something in the air. Far more important about this is that John may be leaving. I don't know if you know this, folks. John may be leaving us here in the coming weeks for UPS trading to try to get towards.
Hey,
Lisa, can you see him in the brown shorts?
He's going to work for UPS during the day.
I said American Airlines on the weekend.
American Airlines on the weekend.
American Airlines is my airline.
Okay, there you go. You'll get status.
Think what Sean in Boston has done with Teamsters and bring that over to UAW.
Yeah.
This is not your mother's UAW. This is not Steve Ratner's UAW. It's got to be a new UAW.
And then I'm going over to the governor, to Joburg. I'm going to be an intern at the South African Central Bank.
Good.
Next summer.
You're still going to have to get your luggage.
I don't think the Central wants that to happen at all. It's just like, absolutely no thank you. No thank you. Coming up shortly, the Philadelphia Fed President Patrick Harker, the first reaction from inside the Federal Reserve to that speech from Chairman Powell. That's all coming up shortly. Your equity market right now, negative on the S&P 500. In the bond market, yields higher by 6 basis points on a 2-year. On a 10-year here, up by 3 basis points. It's yields up, dollar stronger, stocks down. This is Bloomberg.
Fixing things that go wrong and smoothing out bumps in the road is what customers expect from energy providers. And for Duke's renewable assets, that process is overseen from one room in an office building in Charlotte, North Carolina. Brian Savoy showed me around the company's Renewable Control Center.
This is where our operators are monitoring and managing over 5,000 megawatts of renewables across the United States.
How would this differ from like a conventional asset monitoring center?
Yeah, so assets, historically, they would have the monitoring center on site. So you might have an operator with screens, but at the site. Whereas this, we can do 90 sites. There's offshore wind, onshore wind, solar, and they're looking for the smallest change in output because every megawatt hour is money. When one of these assets isn't producing full capacity, we're putting another resource on, and we're having to toggle this on a consistent basis. And this, as clouds come, this is by the minute. This is not, or the hour it's off. No, it's by the minute, and it'll fall, come back, and we have assets that follow this digitally as well, so that we can keep a consistent flow of electrons on the grid.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customers like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
It is the Fed's job to bring inflation down to our 2% goal. and we will do so.
People say you can't raise it now, but my worry is the opposite, which is you say 2 means 2, but it's going to be another 2 years before we get to 2.
They have to have a credible strategy for getting to 2%.
It's way too early to declare victory.
It's a very complex world out there, and the Fed has to navigate a lot of moving pieces.
This is Bloomberg Surveillance, live from Jackson Hole with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
We will keep at it until the job is done. The message from the Federal Reserve Chairman in the last hour, live from Jackson Hole, Wyoming, for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Alongside us now is Bloomberg's Mike McKee. And Mike, I don't think we should waste any time. Joining us is Patrick Harker, the Philadelphia Fed President. Patrick, good morning.
Good morning.
Let's start right here. Not what Chairman Powell said, but what your colleague over at the Boston Fed said in the last 24 hours, that this resilience of this economy suggests maybe we might have to do more. You take a different view. Why?
So look, we have to get inflation down to 2%. We all agree on that. I mean, we're all committed to that. The question is how to get there. We are at a restrictive stance, in my view, and we're putting pressure on the economy to slow inflation. The question is whether we need to increase the pressure or just keep pushing. And I'm in the camp right now, just keep the pressure going, let this work through. Again, the data may dictate that we change course, or I change course. But for right now, what I'm seeing and what I'm hearing, particularly soft data, what I'm hearing, I've been around my district all summer talking to people, is that the plea I hear is you've done a lot very quickly, right? You've taken a lot of pressure quickly. Now let us work through that. Let the banking system work through it. Let the corporations work through that. So that, I agree with that. I think we just keep the pressure on and see how things turn out.
Jay Powell didn't really say anything new, but he did sort of cast it in a hawkish light. And he talked about how the economy is perhaps growing faster than anticipated, and that could increase inflationary pressures. So what would it take to get you to change your view and think we need to raise rates more?
If we saw that the decreases in inflation were stalling, right, that we weren't making that progress that we need to make.
But how would that manifest itself? Because the people who calculate CPI, the analysts, suggest we're going to see it go back up just essentially for mechanical reasons.
On the headline side, for sure. But we're going to see shelter inflation come down, right? That it's coming down now. You see this with real-time rents. So if service inflation in particular, or core service inflation, whatever you want to call it, super core, if that continues to stall, then I'd say we have to do more. But again, I really want to emphasize, we are doing something right now. It's not as though keeping rates where they are is doing nothing. We're actually continuing to put pressure on the economy.
You said, and Jay Powell just said, that it was important to get inflation back down to 2%. That was unequivocal.
Correct.
Does it matter when? I mean, we're right now can see in the dots that it's not until after 2025. If it takes till 2030, does it matter?
Oh, yeah, 2030 is a long way off.
2026, 2027, when's this sort of sense?
We're going to get under 4 this year, under 3 next year, and then get to 2 in 2025. So, yeah, it's going to take some time. But what really matters, what I hear all the time is not just a headline, not just super core, but think about the essentials of life, the things that people really need: shelter, food, transportation, energy. As long as they're moving in the right direction, Americans are better off. And we need to be committed to that.
You clearly think we're sufficiently restrictive. Other people think we don't. So let's go through their points. Unemployment still 3.5%. Growth this quarter could come in at about 3%.
Yep.
What is the evidence that we're sufficiently restrictive? What can you actually point to beyond the soft data? Let's talk about the real hard data.
So inflation is starting to soften. We are hearing story after story. I'm hearing of.
And you think that's connected to where interest rates are right now?
Yeah,
What's the channel for that?
Labor markets are definitely easing up. We're hearing this over and over again. It's easier to get employees. And the retail numbers I'm a little suspicious of, because what we're hearing, for example, from a major supplier to the back-to-school market, is sales are not what they expected. So we are starting to see these early signs, but they're early, right? And so I don't think we need to react either way right now. Just let this ride a little bit. Let's just keep putting the pressure on.
Well, if you keep the pressure on, but even don't raise rates, how long do you need to keep the pressure on? When would you see moving away from the peak?
Clearly not until next year at the earliest. And when next year, again, the data will have to dictate that.
Well, there is a question about if inflation keeps coming down, real rates continue to rise and put additional pressure on the economy. Would you see the Fed recalibrate its peak rate to keep the pressure steady as opposed to letting it grow? I realize this is a fine point for the markets, and if you give if you say this the wrong way, they're all going to start pricing in rate cuts.
Look, it's possible, right? But at this point, we really need to see inflation moving down. And we're seeing early signs of that, again, and I'm getting story after story from all our contacts that it is starting to happen. But I want to keep rates where they are right now, and then we'll decide later what we do.
What do you think is happening with labor market wages at this point? Because that was the big concern, especially with Jay Powell's non-housing services. These guys were talking about the United Auto Workers negotiations going on. Have we broken the back of rising wages rising at a too fast a pace?
Too early to tell right now, but it does seem like what I'm hearing from all our contacts is that it is starting to ease, right? I mean, we're not where we were, where mid-year increases are there. Nobody's considering that. So we are starting to see some easing, particularly in the service area, you know, hotels, restaurants, and so forth. We are starting to see it getting a little easier to get the table at the restaurant. And you know, and one of the things that I think about, one of the potential risks is that when student loan payments come back in, I don't think it's a big economic issue. I mean, when you run the numbers, it's not, but it's a psychological issue. Here, I've not gotten that $300, $400, $500 bill. Now I get it. And so I've been talking to a lot of people of that generation who are saying, yeah, you know, I may have to back off some of my spending.
Well, but this goes to this question of, okay, well, the savings are going to get borne down, and then we're going to start to see the real economy expose itself, right? A lot of people have questioned that. But I am wondering, what kind of neutral rate, what kind of, you know, sort of longer-term expectation for the Fed do you expect in the new normal? What does it look like?
Yeah, so we don't know for sure, right? Let's start there. We don't know exactly what that new normal looks like. But one of the things I think about is what's fundamentally shifted in the economy between before the pandemic and now. Remember before the pandemic, hard to remember for all of us, right? Given what we've been through. But we had low interest rates, low unemployment, and low inflation. What's fundamentally shifted? There have been a lot of things. We're going to talk about this in this meeting. There's supply chain issues that are shifting and being re-engineered. But fundamentally, I think it's plausible that we can get back to that. No, I'm not predicting that right now, but it is plausible. So I think we have to realize that we lived in that world. We've proven that that can happen. And so could it happen again? Yes.
Sounds like a base case when I listen to you. Is that your base case?
I don't know. I mean, at this point, I'm not quite sure. But clearly, we're going to get, we think we'll get back to trend growth in a couple of years. We'll get inflation under control in a couple of years. And inflation and unemployment will tick up, but really in the 4-ish range, back to the neutral rate.
You've offered example after example in the last 8 minutes. It's highly anecdotal. Is the beige book now more important to us than US retail sales?
When I step back and I think about myself, and I can only speak for myself, right? When we were going through the early part of the pandemic, and we were saying that inflation was transitory, it was just used vehicles and so forth, what we were hearing, what I was hearing from my contacts was now really, it's more persistent. And I didn't factor that in. The mistake I made, if I made a mistake, was I didn't factor that really soft data, that anecdotal data. But it's more than anecdotal data. It's what people are really feeling real time in the economy. Now, we've done a lot of things, like done real-time pulse surveys and so forth to get ahead of that now. I don't want to make that same mistake twice. And so what I'm hearing right now from those same contacts is things seem to be slowing more than the data's showing. That could be wrong. That's why we have to, as Chair Powell said, risk management is an important issue here. But if they're right, if that soft data is right, then I think it really then just solidifies my view that we stay putting pressure on, not necessarily increasing right now, to see how that all resolves itself.
Nerd question for our friends on the trading desks out there, especially the bond guys. The balance sheet has been coming down, but very slowly because of the caps and the way that works. You haven't hit maximum reduction yet on a month-by-month basis. And at the same time, we have seen financial conditions remain easier than you would expect. So the question is, do you do more with the balance sheet because it has an effect on how tight the policy is?
At this point, I don't see us changing course on how we're reducing the balance sheet. Again, circumstances could dictate something else. But for right now, I think we just stay the course, keep that on, as I've said many times before, on autopilot. Just let it run. And if we need to adjust policy, we adjust that with the Fed funds rate.
Well, there has been a question on the other side of how close you are to stopping balance sheet reduction when you reach the level of demand.
Yeah, we don't know. I don't think we're there yet, but we do clearly have to monitor that. If you go back to the last time we did this, we knew we were at that point where we needed to stop when we saw the market indicators, the volatility in the market. We've not seen that yet, but we could.
We have seen real yields climb significantly. Today, 5-year real yields, inflation for adjusted yields, rose to the highest levels going back to 2008. Are you watching that closely as an indication of the transmission mechanism of the balance sheet runoff?
Sure. Yeah, I mean, that's one of many. It's also just a simple trading and things like the Fed funds market and so forth. Not at this point. I mean, but it is clearly something we need to keep watching.
Can I finish on this? Slightly provocative. Have you destroyed the mortgage market in America for a generation?
I don't think so. I mean,
why not?
Well, it is clearly tough when you talk to bankers.
Beyond tough. People are locked into mortgages at two handles for the rest of their lives.
First-time home buyer, really, really hard because there's no inventory. Right? Even if they could afford the mortgage, they can't find a home because people are locked into that low mortgage rate, in their existing home. That's why I think we don't keep going with rates, right? It's that we can stay steady, and at some point, as we reduce rates, we can bring those mortgage rates back down. There's no question that's an issue.
But we're not going back to 2% mortgages over 30 years, are we?
Yeah.
So that inventory is offline, maybe for a generation.
Less.
You're not there yet?
Yeah, because what we're hearing from some of the home builders is they keep selling houses.
Oh, they're having a great time.
Yeah.
Their stock's having a great time. You've done that a huge favour.
Yeah.
I'm talking about whether this housing market can really recover in the next several years, given that this feels quite generational. This feels like a really tough time.
But there's a lot of inventory coming online. I can tell you in Philadelphia and across many cities I know, but Philadelphia, for example, a lot of multifamilies coming online in the next few years. So we are increasing inventory.
Patrick, it's good to see you, as always. Thank you, sir. Patrick Harker, the Philadelphia Fed president. The first reaction there from inside the Federal Reserve following that speech from Chairman Powell in the last hour. Mike McKee, there's an individual that thinks we could just wait here, just keep the pressure on. But keeping the pressure on does not mean increasing interest rates any more than we already have.
Well, you asked me earlier whether the chairman was appealing to one side or the other, and I said in the middle, and at least we've heard from one side here that he doesn't think that Jay Powell is challenging him or making any case against what he's saying.
His point about the soft data is important, I think. And I think especially because anecdotally when I speak to small business owners who are my friends, they talk about how their lifeline is getting a lot shorter in terms of their flexibility and things that they used to be able to do with financing, they no longer can afford to do, especially with some of the other pressures.
So Mohammed Al-Arian, who got the inflation call right, I remember saying to him, what guided you? And what guided him is exactly what Patrick Harker just talked about. It was the responses from companies at the time who were saying, you need to take this more seriously. The conversation continues. Your equity market trying to recover, just about unchanged on the S&P.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Today, European Central Bank President Christine Lagarde sits down with Bloomberg's Tom Keene for a conversation on the political economics of Europe and the permanent shifts in the global economy. Tune in for the exclusive interview live at 4 p.m. Eastern from Jackson Hole, only on Bloomberg.
After decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy.
The chairman of the Federal Reserve System, Jerome Powell, this happens once every year, 40 years or more, at the meeting of the Kansas City Fed at Jackson Hole, Wyoming. We welcome all of you this morning. Jonathan Farrow, Lisa Bramwitz, and Tom Keene on radio, on television, truly worldwide today. Thank you so much for the comments. And what an interesting moment. I was off set here with Mr. Harker with you. Lisa, this, more than any year I've been here, has been the most surprising year, and I can't believe I'm saying that after 08, 09, Lehman Brothers and all that.
It's a highly complicated moment for central banking and for fiscal and monetary policy making, and we're seeing all of these different economists and policymakers try to calibrate and not err on the wrong sides. You can feel like we're on a precipice of not knowing the other side, and everyone's grappling with how to really weigh in best.
The people are off camera. They're all waiting to meet you. I happened to stumble on one person knew who I was, and he was a doctor, and he's treating COVID, and we talked about the new discussions of COVID, and some of it's in the zeitgeist, talked about the booster to come this fall, but I am adamant that COVID, the pandemic, still touches all that we're doing.
There's something that came clear after Patrick Harker speaking with us, the Philadelphia Fed president, which is the soft data, the conversations that people are having are less positive than the conversations that people may be having here economically about what the numbers are saying. And one key question is, what kind of ammunition do governments have to support an economy that does go into a downturn, given how much debt and given real yields? It's a hard time to see how they're going to come down to such a significant degree.
It's a 5% Atlanta GDP now Fed.
5.9%.
Discuss. Oh, sorry. I didn't get the decimal. We don't do decimal points at Jackson Hole. Okay,
it's almost 6%.
But come on, it's a 6% GDP economy. That's not a slowdown. It's
a reacceleration, which is causing a lot of angst for a lot of people.
Okay, we're going to continue forward here. We've got a lot coming up. Justin Wolfers will join us here in a bit. I believe he has a shingle from Michigan. We had to do better than that. The Kellogg School of Management right now. Janice Eberly joins us, professor of finance at Kellogg, and of course a former assistant secretary for economic policy at Treasury as well. Thank you so much. I flew in through O'Hare. And, you go over the firmament of Northwestern, and to all of us of a certain vintage, and you've had the great honor of all the academics at Northwestern, of Robert Gordon and his ancient, iconic work on the growth of this nation and his doubt in recent decades over our sustained growth. Take the Gordon Northwestern view into all the policy work you've done about a confidence in American economic growth.
Well, Bob, of course, is iconic, and thank you for inviting me back here today. It's great to be with you. Bob Gordon is one of the stalwarts of Northwestern and the economics community more broadly, and he had a long set of papers questioning what the future of productivity growth would be like, that we'd had this boom, and we've seen a little bit of it in the papers already this morning, and what comes next. Though I will point out that a year ago, Bob had some work that showed some optimism, uncharacteristically, about productivity growth that was coming out of COVID.
Bring it into what you do. What you're famous for is how do we solve fractured policy? We can all agree that we have fractured policy in America right now. How do we coalesce our policy to get to a better growth, a better productivity?
Well, in the debate that we saw reflected a bit in the chair's remarks this morning, as Lisa was saying, it's a very complicated moment. And as the Fed is looking forward to what happens next, you see, a clear focus on the target, but also a little more of risk balancing than we saw, last year in particular, and a more nuanced message that reflects that at a 5% interest rate or higher, raising interest rates further is different than raising interest rates when they first got started. And that balance of risk, I think, reflects some of the complications that you were talking about.
There's also an issue and a complication here of what the potential casualty could be about going into a downturn, given the lack of potential fiscal stimulus that could really get pumped into a system given the debt load and given how high financing costs are. How much does that create a more difficult scenario next time this nation, among many others, goes into recession?
So that's the short run. It creates a more difficult calculus for the Fed immediately because the increase in interest rates has more of an impact when the economy is weakening, when balance sheets are wavering more than they have in the past. So part of the reason we've had this surprising strength now is that we came into COVID with a pretty strong economy, and so it had less of an impact. But going forward, we can't count on that, and so the Fed's complicated decision-making reflects hard decision-making for families, for businesses, and the choices that are being made throughout the economy.
We were just talking about the mortgage market and how everybody locked in their 30-year, everyone who got smart and got ahead of this. The U.S. government did not do that. They did not lock in the longer term, low-yielding debt. Is that a big problem? Why didn't they? Why didn't the U.S. sell more debt that was 30 years long and had a 2% coupon?
It's a combination of the Treasury and the Fed. I mean, the Treasury always has discussions about the maturity structure of the debt. And during a crisis, they're especially focused on providing liquidity. And that means going in and providing shorter run securities rather than longer run securities. So U.S. government debt tends to have a shorter maturity structure, partially because of its special role in the global economy. But there's clearly an awareness that there's a cost to that of not locking in the longer run rates.
One of the key things we know is Northwestern is closer to Wrigley Field than Chicago. I want to dovetail what Krosner's doing down at Chicago with what you're doing up at Northwestern. You and Randy Krosner are hardwired to pay attention to American business. How does American business react not only to the yield, but just the Newtonian calculus of a moonshot in T-bill, a moonshot in two-year yield? Some would dare say a moonshot right now in the real yield.
So, you're seeing already a market response to rising issuance, and that's really gotten people's attention because we haven't seen that kind of response certainly in the data that we've seen in our professional lives. And so that gives pause, and especially for businesses because their costs of capital are a premium on what looks to be or is close to a risk-free security. So it makes investment more costly, it makes debt coverage, debt service more costly for businesses. So that's going to lead them to pull back. And Incidentally, that also can make the Fed's inflation fight harder, because ironically, the higher interest rates also, if they lower investment, say in lower residential construction, also put upward pressure on inflation. So that's part of the reason that the calculus is so hard now, because there's these counter flows and not just, you know, the march up higher rates to try to fight inflation.
Professor, thank you so much. Greatly,
My pleasure.
Pleasure to have you here today. Janice Everly of Northwestern and Kellogg School of Management. Lisa, very quickly here, bonds, it's all anybody's talking about. These yields extraordinary.
Especially real yields. When you take out inflation, what you're looking at is new highs in this cycle, and that raises some questions about how restrictive that's going to be for the economy.
Giving you expertise on monetary policy here at Jackson Hole, Julia Coronado will join us, some macro policy perspectives. Stay with us worldwide at Jackson Hole. This is Bloomberg Surveillance.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Let's go straight into the price action this Friday morning. Going into the weekend, your equity market shaping up as follows on the S&P 500. On the Nasdaq, equities just about positive. We have been all over the place in the last 60 minutes or so. Call it the last 90 minutes. The S&P just about positive. The Nasdaq joining the party, heading towards a first week of gains for a while for the Nasdaq 100. Into the bond market following Jay Powell, the chairman of the Federal Reserve, speaking in the last 90 minutes, Tom, talking up the potential to do more, but also the job is not done, and we're committed to a 2% inflation target. Your two-year yield higher by 4 basis points to 5.0671% on a 2-year.
To Redux, 20 minutes ago, or was it 27 minutes ago, we did an overlay of wages UAW. I wonder if UAW has a little bit of dynamics going on here besides Jay Powell.
The potential for a strike, Tom, is a wrinkle in the story, that's for sure.
Yeah.
That's for sure. Lisa, we'll go back to a conversation we've had a few times. We've had the pay rises. We've had the union action. We haven't had the strikes.
Exactly.
And I don't think anyone wants to see those strikes anytime soon either.
Which has transmitted into this belief that labor has the upper hand, and that if labor has the upper hand, price increases can continue not just at union jobs, but more broadly. And that is the key question here. Is that going to continue so that you see a longer and higher inflation and a stronger and better economy for even with the rates that we see right now?
So it's time for the surveillance extrapolation. We do this every year at Jackson Hole. John, I'm trying to envision you, brown shorts, working your butt off at UPS, popping 170 all in.
That's so never going to happen, just to be very clear.
Why not? Why are you talking down the potential for this to happen?
If we put John...
Even our next guest is laughing.
Exactly.
Okay. Yes,
John,
exactly.
Lisa, if we put John at Flint, Michigan, building Buicks, what are you going to pop, 225?
Not sure.
You got to pay an auto worker more than a guy delivering boxes.
I want to see this guy wearing those brown shorts, and then we can have that discussion.
I'm not a shorts kind of guy. I think you know where I stand on shorts.
I know,
shorts are for the beach.
This is serious stuff. This wage thing. Are we? You know, maybe it's a question for Lagarde. Are we going to come back to a more unionized European labor system? I don't believe it, but it's.
If we did, and I know we've discussed this a few times, but while we're here and the conversation has come up, if we had the same level of union membership we did back in the 1970s,
totally
can you imagine the pass-through into wages that we would have experienced?
Huge. 30 seconds before we get to our wonderful guest. My word for Jackson Hole, complexity. I did not think I would say that 2 days ago. That's the zeitgeist this morning, the complexity.
The speech I'm interested in, Chairman Powell, without a doubt, is the biggest speech for global markets. There's no dispute about that. But the speech I'm interested in is the one from Lagarde a little bit later.
I agree.
It's such a tough spot for the Europeans at the moment, looking at how the data's coming in. Inflation's still elevated. And over there at the ECB, you've got a single mandate central bank with a lot of pressure coming from various parts of Europe. And what's been interesting for me is listening to some of the more hawkish central bankers not sound hawkish at all over in Europe. When you listen to people from the Bundesbank, yes, they're committed to getting to 2%. We know that. But are we hearing things like we need to go another 25, another 50? That conversation's changed.
We're going to change the conversation right now as we shift from a discussion of Jerome Powell and the U.S. Fed to Bloomberg's coverage of Christine Lagarde. John, the speech here coming up in an hour, so I lose the time zones. But
Bramo's got it all written down.
We got the Lagarde speech soon, the Lagarde Q&A, and then we'll have our Bloomberg discussion with Christine Lagarde.
You're going to talk with her at
I don't know when. My people know when. I don't know when.
4 p.m.
But the answer is, we're going to, right now, for this half hour, you need to stay with us. Coming up, Justin Wolfers will be with us from Michigan, and joining us from basically Texas with macro policy perspectives, Julia Coronado, who thinks we're going to talk Fed, but Dr. Coronado, we're going to shift this right forward to ECB. How much worser is it for Lagarde that makes her speech more important than what we heard from Chairman
It's a much tougher spot, as you just outlined. I mean, with the U.S., we have the beautiful combination of lower than expected inflation and better than expected economic growth. And Powell can just say, we're going to be patient and watch the data and do what we need to do. Lagarde has a tougher line to walk. You know, the data are weakening in a pretty alarming way, and inflation is yet still elevated. So how do you factor in lags? and the nuances and the risks.
I'm going to interrupt right now because, John, it is a moment here at Jackson Hole, which is of importance when the lead central bankers come out to gaze at the Bloomberg surveillance set and to take a walk to look at the mountains. John, why don't you identify the victims?
Well, let's go through this piece by piece, Tom. Chairman Powell, Governor Ueda, and President Lagarde. The United States, Japan, and Europe. And Tom, I think we can say 3 central bankers facing 3 very different issues. Julia Coronado just went through the United States. At the moment, Chairman Powell arguably in the better position of the 3. Robust growth, inflation, they're making progress, there's still work to do. Governor Ueda at the moment, Tom, inflation, arguably what they've been looking for the last several decades, and viewed as a once-in-a-generation opportunity to reset inflation expectations higher in Japan. And then you've got President Lagarde somewhere in between, where inflation is above target and growth is a problem. 3 central bankers, 3 different issues.
The symbolism of this post-pandemic is, I can state clearly, I have never seen this. We go back to Volcker in the 80s. I can't talk about those years, but for our American audience, this is a different central banker at the Bank of Japan. Mr. Ueda, very much American educated, wonderful command of English. He joins these central bankers, including Governor Bailey, with a real grasp of the linkages of Japan, Lisa, to the Western banks.
What this highlights to me is how everyone's grappling with the same mystery from very different vantage points and how interconnected the systems are. The idea of yields in the U.S. and the long end rising, some people say that Governor Ueda has more responsibility to do with that than Chair Powell. There is a question around how much they talk about this interconnectedness as they craft their policies.
There's nothing synchronized about this global economy right now, Tom. There's nothing synchronized about it. If we'd had this meeting between these 3 individuals a year or so ago, we'd maybe say that President Lagarde and Chairman Powell has a lot in common. They've got some work to do. Let's get inflation down. If we were coming out of the pandemic, I think we'd all sit around a table and say, we're on the same page, we're all working in the same direction. Are those 3 working in the same direction now?
No, I think there's completely 3 different subsets. And literally, ECB US, I would say there isn't a direction here as well. Justin Wolfers there shaking the hand of the chairman of the Federal Reserve. Mr. Wolfers will join us here in a moment so we can touch his hand as he is shaking the hand of Jerome Powell. Gazing at all this, including taking fan photos and selfies. Julia Coronado.
I can't help it.
This is not in the textbooks you studied in Texas. None of this.
No.
Just for our American audience, give us the foolishness in the textbooks of YCC in Japan.
Oof, the YCC is a tough one, and I think what we're seeing with Governor Ueda is the difficulty in the transition. That's always been the challenge with YCC, right? How do you get out of it once you've gotten into it? It's bound to be difficult and nonlinear. I think actually that they've managed pretty well so far, and that yes, as Lisa outlined, it definitely has had a spillover to the U.S. undeniably, right? I mean, we are all interconnected, and that has been part of the rise in long-term yields. And that may be a reality that we are facing with it. So maybe, Japan had been so entrenched dovish and bucking the global trend of inflation fighting. Now they're not. Now they're moving, and so that actually could make Powell and Lagarde's job easier, right? You've got higher yields. We've seen it in mortgage applications response. You're going to see it in auto lending and all kinds of credit channel effects from these higher yields. So maybe that patient approach means that we will see that housing market turn back down and Powell, the Fed being able to remain on hold if these yields stay at these levels.
Europe, Julia, has been a fascinating case study when it comes to monetary policy. They've made the transmission away from all of that QE. I honestly thought that when President Lagarde backed away from some of that we might have problems on the periphery that didn't really materialize in Italy, Spain, Greece, and elsewhere. There's another really interesting case study that's developed this year. Germany. Arguably going into recession, but still with an inflation problem. What do you think we can learn from that?
Yeah, well, I think that one thing we're seeing is very different productivity dynamics, right? I think the U.S. we're starting to see a real dividend post-pandemic as the sand in the gears clears, and we're really seeing, if we are seeing labor demand, hiring cooling, and GDP tracking well above trend, that adds up to a whole lot of a productivity boost. Could be temporary, but we're not seeing that in Europe in the same way. So, the U.S. does tend to be a more flexible, dynamic economy in that sense. Maybe we're just getting more of a dividend on that front.
Do you think the United States is an island in that respect, given what's happening everywhere else?
I'm very reluctant about the decoupling notion, right? We are all ultimately intertwined, and our markets and our capital flows are all, we're all tied up together. So, hopefully Europe will catch up to us, not the other way around.
There is a concern about the soft data showing a very different story than the hard data. We heard that from Patrick Harker saying that the soft data suggests weakness that the hard data isn't reflecting. Is the hard data getting less and less accurate, regardless of the reasons why, of its response rate, of whether it's just, in terms of how it's calculated?
There are huge challenges with all the data. The response rates that you touch on have been an issue before the pandemic. That's even worse now. So I think it really does highlight the need to triangulate across all the data sources, the high frequency, the surveys, the hard data. The other mantra that I learned at the Fed was, who knows what GDP is in real time? Follow the labor market. We have so many good, solid labor market metrics. You look at hiring, it's still solid, but it's slowing. Aggregate hours worked are slowing. He touched on that. Labor supply is improving. We've seen a bit better, that kind of cooling off dynamic in the labor market data that isn't showing up in Q3 GDP. So again, that sort of favors that. Let's gather some more data, take some more time, look over a broader sweep of information.
Have we rejected the idea that being late is problematic? If we are late with raising rates sufficiently to curtail inflation, are we now rejecting the idea of embedded inflation expectations?
In terms of the fact that they were late, is that what you're asking?
In fact, the fact that they feel the confidence to be patient and that inflation won't become unmoored.
Right, yes. I think that they demonstrated last year was the year of regaining credibility, which they did by going very aggressively and sometimes surprisingly aggressively and showing, last year at Jackson Hole, and he touched at this at the beginning of his speech, he had to sort of smack the bond market upside the head and say, no, we really mean it. And it worked. And now the bond market's like fully buying into the Fed's higher for longer messaging. So he doesn't need to do that anymore. And again, if that turns around or if he sees that there are worrying signs of easing financial conditions, he can always readjust the message. But right now it's just sort of hold the line. Yes, higher for longer. We think that's what it's going to take. I found it very interesting for him to describe the risks as a little bit of doing too much versus doing too little. He didn't say balanced, but he kind of put them side by side, Like we don't really want to crush the U.S. and global economies. We want to, do this as well as we can, thread this needle as well as we can.
That's a change from last year.
Yeah, a big change from last year.
If you ask them what's the biggest risk, doing too little, doing too much, I think we know the answer.
Yeah.
If that's become more balanced, here's my question to you. Do you believe 2's the goal? Do you believe 2% is the goal?
I think it's beyond Chair Powell's tenure to answer that question.
So I want your opinion.
Interesting.
Do you believe 2% is the goal?
I think that is absolutely what they're going to keep saying until the next policy review.
That wasn't the question. Do you think it is the goal?
It really depends on the circumstances. Like, let's say we get inflation that stabilizes. I do think we need to get a 2 handle. Let me put it that way.
Right.
And if we are stabilized around 2.5% and the economy's humming along, are you really going to break it?
Okay, Steve, come on out and bring me my Tang out here as well. I got one more question for Dr. Coronado. Let's cut to the chase. You're widely vetted with your academics as a potential governor of the Federal Reserve System. Would you like to see more dissent, Dr. Coronado, in this job interview at the Fed?
So setting all of that aside, I have enjoyed seeing a little bit more range of views. I think that's good and healthy, and I'm looking forward to seeing more of that. You've got President Bostic coming out out a little bit more, laying down the dovish line. Everything is relative. Nothing is dovish, right? It's higher for longer or even higher for even longer. But I think a range of views is very healthy. Very, very healthy.
Julia, this was wonderful. The catch up. Thank you. Julia Coronado, macro policy perspective. 2 is kind of the goal.
Kinda.
2 point something, kind of,
2.9.
maybe, perhaps, some point in the future.
Is crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint.
Fed Chair Jay Powell earlier on this morning in Jackson Hole, Wyoming. Live from Jackson Hole. Good morning to you all. The price action shaping up as follows this morning off the back of that speech. The S&P 500, I have to say, all over the place. Negative, then positive, and just about positive now by 1/4%. One move that stuck for about an hour longer was the move in the bond market. Now that fades, Bramo. Your 10-year, 423. Can we look at the short end just quickly? Yeah. Bring up the 2-year, because that came very close to a cycle high following this speech on a 2-year yield. The 2-year right now, 5.056%. TK still elevated this morning, but nowhere near where it was about an hour ago. Yields up there at the front end by 3 basis points.
John, these are the yields of my youth. I mean, I know we're going back to 2008, 2007, blah, blah, blah. We haven't seen this structure, and my number one question throughout the morning, how does corporate America adapt to this? I mean, if you're Apple, and like clockwork, you come out with an X billion-dollar refi to buy back shares, is Mester and Cook, are they sitting there right now going, maybe not this time?
The good news for them is that they did the adapting in the pandemic when interest rates were so low. They pushed that maturity wall out, and you'll get a lot of people in fixed income that will tell you now that's in 2025. They've done a lot of work, Tom, to make sure those balance sheets are super, super resilient. Then on the mortgage side, we know what's happened on the mortgage side. You've got people out there, Tom, on 30-year mortgages with 2 handles on them who aren't selling. Inventory's not coming back into the market. So what is the pass-through? We talked about this a lot. We know where rates are at 5.5%. The question you've got to ask is, who's paying them?
Lisa, are we popping 8% mortgages? Is that what we need to reframe as we stagger back to New York?
I think the mortgage market clearly is broken. I think that that's what we've learned in terms of the number of people actually taking out mortgages there. Right. The big takeaway that I've heard is who is going to suffer with these higher rates? Maybe some smaller businesses from Patrick Harker. On the peripheries, you're hearing it more and more.
Strongly. I missed the Harker interview. Michael McKee did that, but I strongly take that point of the uniqueness of small business. We began hours ago in the dark, the cold and snow-filled morning of Jackson Hole with a gentleman from the Peterson Institute Adam Posen. We finished strong with another gentleman, a senior fellow at the Peterson Institute. Justin Wolfers joins us now, professor of public policy and economics at Michigan. And this is finally at Jackson Hole, where we will have an R-Star discussion, because you studied with Blanchard and Alberto Alesina years and years ago. Blanchard has led the charge on trying to figure out where we're heading on R-Star. Take that we're going to return to low R-Star out to the gloom of an unanchored higher R-Star. Where do you see us, not in 1 year, 6 months, in 5 years?
I think it's the right question, Tom, because if you want to think about what really pins down long-term rates, it's not what the Fed's doing day to day, it's doing deviations around R-Star. So then the big question is, what is R-Star? Well, you could try and look it up on the terminal, but it's not there. And this is
don't tell them.
Yeah, no, this is the difficulty, though, of macroeconomics, that so many of the variables that we think matter aren't observable. With R-Star, we got a million theories about it, but what we do know, or think we know, is over 4 decades it's declined. So what's your best guess for the next decade? Seems like a pretty good pattern. So Larry Summers has come out and he sort of thinks R-Star might be higher now. That's part of his campaign to get rates a little bit higher.
Ken Rogoff said the same thing. Where is Justin Wolfers on this?
Mate, I reckon if you don't have a good idea about where something's going and a really solid story, you say things are just going to keep on being the same. And none of the stories I'm hearing seem particularly convincing, other than, I'm a macroeconomist with a view and I get paid to look confident. I don't want to overstate anyone else's confidence.
I've got to dig into that.
All right, mate.
You mentioned Larry Summers.
Yeah.
You think there's a campaign there to get interest rates higher at this Federal Reserve?
Oh, not in the cynical sense. Larry is a profoundly interesting economist, and Larry's a friend of mine too. What I'd say instead is Larry has a restless mind. Larry spent 5 years trying to convince us all that R-Star was lower. I didn't understand what he was talking about with secular stagnation for the first couple of years. I finally understood it, and at that point he changes his mind. So the argument and the evidence, I think, for his original secular stagnation thesis looks really pretty strong. Then what's the story that says Larry was right 5 years ago, and today's Larry thinks 5 years ago Larry is wrong? I think he got it right a few years ago.
So you think, just in terms of what we're going back to, pre-pandemic, low inflation, low growth, do you think that sticks?
So I'm glad that you put it in the context of the pandemic, because we all like talking about the post-pandemic economy. We all like talking and feeling like we're in a post-pandemic world. But if you start to think hard about like the interactions within the economy, the pandemic continues to exert a really important influence on the economy. And I think in ways that a lot of lay people and a lot of people on Wall Street don't think about. And I think there's an emotional part to that. I want to leave it behind. I want to stop thinking about it. And so I leave it out of my models. But the moment you think about labour supply, think about the return of women to the workforce, work from home, a fundamental transformation in the way we work, all the investments that didn't happen, the shift towards services, like are gyms going to continue to be important in the future? This is going to continue to shape the economy for another 2, 3, 4, 5 years.
Okay. I could dive into that today.
But there's a question here.
Wait a minute. Wolfers runs the marathon like he's from Kenya. I mean, he's like completely cut and chiseled and in shape. He's worried about gyms in the future.
You've seen too many photos with my shirt off, Tom, and you should linger a little less.
All right, moving forward, there is a question. If it's going to take 4 or 5 years, does that mean that the prudent strategy for central banks is to sort of be more patient and to sort of let things happen without gunning it too much with rates?
I think it's that you want to be a little less model-driven. You want to be a little less sure of what's going on. I mean, this was obviously true in 2021. If you stood there in 2020 or 2021 and said, this is what my Phillips curve says, in a moment where we were shutting down economies around the world, that of course was crazy. Pandemic economies are different than normal economies. Economies recovering from a pandemic are also different in very interesting and important ways. And so that means you're a little less confident about what the model says and a little more looking at what the data says.
And which data are you looking at? Because we heard earlier that the data is flawed, the models are flawed. Do you now just do anecdotes?
Well, the economists are flawed too. But you know, the only thing that's more flawed is the critics. I've always said the single best defense of economics is that there's no better alternative. We are the least worst alternative you've got out there. So let me give an example of what I mean. Inflation right now is 3% and on the way down. You could look at your model and say, well, with unemployment at 3.5%, inflation's definitely going to be on the way back up. Or you could have a bit of a pause and say, I'm not quite sure the models are operating right now. In which case, I'm not quite sure that inflation's going to shoot back up again. And that's what I mean about being a little bit more driven by the data. Keep your eye on the things you actually care about and less on the intermediate variables that your models tell you should be focusing on.
I think we've all been humbled over the last few years, and I always say, Justin, that I'm in the cheap seats, that to be a critic of what's going on around me, we've all been humbled by what everyone has got wrong about going into the pandemic, coming out of the pandemic. Do you think that humility that's come about from that is good for the profession, good for economics?
What an utterly charming thought. Yes, humility is wonderful and a wonderful, wonderful strategy for economists. Now, have you met economists?
Many.
It's in very short supply. We get paid to look confident, to beat our chest, to... If I come on your show, and actually I just did, I apologize for this, and you say, hey, what's going to happen? I'm like, I don't really know. It's kind of hard to know. I got to guess, but I could be wrong. I'm not coming back on. And so that humility, I want to lay the challenge out to you. You want to inform your viewers? Then accept and embrace humility. And the next overconfident guest you have, shorten their segment, and the next person who says it's hard to know, lengthen theirs.
So limit Larry to like 4 minutes. 5? 5.
Delta Airlines is committed to net zero carbon emissions by 2050. Because we know a thing or two about getting where we need to be. And it's time we all got going. Together.
That's great.
Guarantee you're back on soon. I'll send the invite in like the next couple of weeks.
I look forward to it.
For more than 4 minutes.
Absolutely.
Thank you, mate. Justin Wolf is there at the University of Michigan. That wraps it up for us, TK.
It does.
In Jackson, Wyoming, until next year.
You got the Gulfstream, right?
Ready to go?
Yep.
Jackson Airport. Going to race over there now. I wish.
You know, it's wonderful to have Christine Lagarde with us coming up after her important speech. But the real thing is, I'm a complete mystery what her speech is going to be. How does she address where she and Frankfurt are right now?
She is in a tough spot. Looking forward to the conversation with Tom Keene and Christine Lagarde later on this afternoon. From Jackson Hole, Wyoming, the message from Chairman Powell. There's more work to do. Good morning.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lang.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Most of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, They have gigantic market values, and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, the United States, and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow here in San
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Jackson Hole, well, it's not morning, afternoon, I guess now officially. We've just had the surveillance Jackson Hole coverage, 4 hours of it. Don't forget, more's coming later on today. Tom Keene sits down with Christine Lagarde for an exclusive interview at 4 p.m. on both Bloomberg Television and Bloomberg Radio. But we did have Jerome Powell coming out and doing exactly what I expected Jerome Powell
Much
was
ado
do.
about nothing, as Cameron
Absolutely.
Price, our markets columnist, put it.
Simone Foxman is joining me. Paul Sweeney is at the Sweeney Estate on the, well, I'm not supposed to talk about the Jersey Shore, but that's, I assume, where he is. And yeah, we're looking at a market that hasn't really shown a ton of reaction. Before we went into the Jay Powell speech, I saw the U.S. 10-year hovering just under 425 at like 424.53, and right now it's trading at 424.53.
I think the only thing that's really showed more movement was the 2-year. But I guess we kind of knew the message was going to be higher for longer. It's just how much higher for longer.
I mean, the message is higher for longer. It's been higher for longer. September was a live meeting. The dot plot shows another hike. I mean, aren't people paying any attention at all? Let's get over to Charlie Pellet right now. He's got your Bloomberg Business Flash.
Thank you very much. And here's what's going on. Right to the numbers here. A Jay Powell Friday, a Jackson Hole Friday with the S&P now up by 5 points, has been fluctuating, up now by 0.1%. We've got the Dow up 118, up by about 0.4%. NASDAQ lower by 7, also has been fluctuating, down by about 0.1%. The 10-year, 4.24%, with the 2-year 5.06%. Powell saying here on Bloomberg Radio the central bank is prepared to raise rates further if needed and intends to keep borrowing costs high until inflation is on a convincing path toward the Fed's 2% target.
Although inflation has moved down from its peak, a welcome development, it remains too high. We are prepared to raise rates further if appropriate and intend to hold policy at a restrictive level until we are confident that inflation is moving sustainably down toward our objective.
Reaction to Powell's speech from Bloomberg opinion columnist Mohammed El-Arian, who is also the president of Queen's College, Cambridge.
It's a speech that said very little that is new. He repeated what he has said in the past, and he has retained maximum policy optionality.
And you can hear more of that conversation on the Bloomberg Surveillance Podcast. You can download it wherever you get your podcasts. And, of course, a lot more reaction coming up right here on Bloomberg Markets. Spot gold lower by $8.50 the ounce, now at $19.08, down by about 0.4%. West Texas Intermediate crude up 0.6%, $79.52 a barrel. Bitcoin at 25,930 now, down by about 0.3%. Briefly after earnings, Gap shares, they're up now by 2.9%. Nordstrom after earnings down by 10.8%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thanks very much for that. Matt Miller here in the Interactive Broker Studio with Simone Foxman. Paul Sweeney is on assignment. We just finished our 4-hour Jackson Hole special coverage, the surveillance team out there in Wyoming with Jerome Powell and Christine Lagarde and all of the most important central bankers in the world. But we got absolutely no reaction to the speech. I mean, even futures were up 0.25%, and now we're looking at an S&P 500 that's up 0.3%. So,
I mean, they were down for a second. There was this moment where everyone was like, oh, this is a hawkish speech. And everyone's like, wait a second.
Okay, I stopped watching markets at 8 a.m. and just started again at noon. So, I don't know what happened in the past 4 hours in terms of the numbers, but they look the same to me. Let's bring in Liz McCormick. She is our chief correspondent for global macro markets over at Bloomberg News. And Joe Weisenthal, host, you know him as the host of the Odd Lots podcast. I know him as the host of What'd You Miss? It's a